A strong demand, but they are warning that operating profit will be slightly lower for the rest of the year due to higher maintenance costs, so that's something to watch out for. AB InBev in focus. Beer sales dropping on sliding demand in China and in Brazil, so we'll certainly watch those two individual names as well as the banking sector and autos and everything else that has reported, Guy.
Everything else, and there is an awful lot of everything else. Let's talk about the index levels. Let's show you some numbers. As we've indicated, probably the action a little bit below the surface, but the FTSE 100 doing nothing as indicated. First thing this morning, keep an eye on what's happening with Shell, LSEG. You've got BAE Systems. We're going to be talking to them a little bit later on after posting numbers yesterday. There's an awful lot going on below the surface. Stock 600, nothing to see here, just moving sideways. We're going to talk to Michael Masika a little bit later on from our markets team. Has the bad news, the expectation on European earnings actually largely been priced into these markets? It seems so at the moment. We're not going anywhere in a hurry, and that certainly is the trade that we're watching this morning. The IBEX is up a little bit more than most. It's up by 0.6%. We'll wait for the CAC, we'll wait for the DAX. Single stock sectors look more important this morning. Critty, what do you got?
Well, right off the bat, Shell seems to be your biggest index contributor to the upside and your biggest winner, higher by about 2% this morning, seeing a lot of volume. And that's, of course, a big earnings beat that they came across with, as well as even an update on some of their trading businesses, their chemical businesses. Don't seem as bad as expected. But again, I'm seeing a lot of rotation action here as well when we took a look at this from a specific sector basis. So yesterday's underperformers are today's outperformers. Healthcare seems to also be in the lead, and I'm looking at Roche, Novo Nordisk, a lot of those kind of names as well. And then the banking story is a little bit of a mixed bag.
Right, and so the buyback theme sort of unites both of those, doesn't it? Energy and banks, because we've got a big buyback from Shell, and you rightly mentioned that stock is up by now more than 2%. The banking sector, yes, also gaining. SocGen is up very strongly, up by nearly 7%. BBVA is up strongly, up by more than 4%. We have some other strong performance coming through from some of the other names in the banking sector. We're just looking for some of the others that reported. Standard Chartered, a little bit of a move higher there. So, yeah, a kind of mixed picture. I'm also, my eye is also drawn to the bottom of the sector picture and what's going on with basic resources. It's a really complicated picture around copper. That's a separate conversation perhaps, but we haven't mentioned, perhaps should have mentioned, that we had some disappointing data out of China around manufacturing, and iron ore prices and steel prices through the Asia session have been really weak. Steel in particular down by more than 4%. On top of that, Guy, we've got the Anglo-American numbers, but you know, it seems as if the sector as a whole is being weighed down by something bigger than that.
And the copper story. But you need to throw into all of that as well. Crazy moves yesterday in the copper price. So, yeah, so you've got Glencore tracking a little bit lower. Anglo's a little softer as well. So you've certainly got some weakness there. Some of the pharma stocks are giving up some ground as well. So it's definitely banks. There's a bit of upside in Safran this morning. It's doing relatively well too. It's up by over 3% in the aerospace sector. Airbus having a slightly sort of tougher time of things right now. Certainly that was what the indication was out yesterday. It's hard to kind of get a clear... I'm trying to see what... Are there themes that we should be picking up on here in terms of where we're seeing the movement? Or is it just simply kind of almost stock by stock in terms of how you should be perceiving this market? SocGen is up, Arcadis is up. I think the only takeaway I can see this morning is that banks are doing better. That's the only kind of clear narrative that I can take away, even within the sector kind of story, that it's banks that are the ones that seem to be on the front foot, and they are by far and away the best performing sector so far year to date.
Well, yes, year to date, absolutely. Here's a late entrant for theme of the morning. Technology stocks now the best performing sector here in Europe. it's always a difficult read across from the likes of Meta and Microsoft into Europe, but somehow somebody's managed to do it. The technology sector is up by 0.9%. Nasdaq futures up by 1.3%. I'm not sure any of the individual names add up to, a real direct read across from US megatech. But anyway, for what it's worth, that is now the best performing sector this morning.
Yeah, I wonder how much cold water gets thrown on that after the Apple and Amazon results after the US bell today. Let's get a little bit more market perspective. Jeff Yu, Senior EMEA Market Strategist over at BNY, joins us around the table this morning. Jeff, pleasure to have you.
Thank you.
Always. Let's put that theory to the test. Are buybacks holding up the European market right now?
It's starting to feel like it. If you go on a sector-by-sector basis, let's look at financials. For example, I guess the non-bad news, so to speak, is even if there's going to be more easing by the ECB, and our view is probably just one more precautionary move in September. So if we're not going to deviate too much, from the NIMS outlook for the financials, then they can continue to move ahead. We're always hoping over the medium to longer term there can be greater consolidation, banking union, capital markets union, things like that. And especially now, I guess the market's reaction to the trade deal, Europe, let's just focus on what could be done here rather than on the external front.
What about the trade impact? I mean, what about the trade read-through, not just in the 15% that applies to the EU, but all these European corporates that have exposure to parts of Asia, part of Latin America? How do we think about that, and how do we price it in?
So I would go back to the ECB's forecasts from June. They had a mild scenario. They had a very adverse scenario. I think we're landing somewhere in between right now. You're avoiding maximum tariffs, so to speak. But you're absolutely right. On the external demand side, you're going to take a hit from the US. And also, as mentioned earlier, Chinese demand isn't really picking up. We saw that from the data overnight. Hence, your outlook is going to be troubling on a top-line basis. So perhaps then you have to lean back into your cash reserves and then just look at how buybacks can support your share prices and valuations right now.
Jeffrey, help us understand the latest data out of China and its significance, because you don't see steel prices move by more than 4% on a very regular basis, and they did overnight in the Asia session. Basic resources, the worst performing sector here in Europe. We've also got some earnings out, and as we've been talking all morning, the copper price is doing incredibly weird things because it dropped the most ever over in the United States because of the about-face on tariffs over there. To a large extent. Help us understand the underlying story then around Chinese growth and what matters.
Copper. Why hasn't anyone looked at the monetary policy report from the Central Bank of Chile?
Oh, tell us.
On Monday. So
honestly, it's on the list somewhere.
They had a line in there, so just going through it. So they acknowledged in the short term there's a bit of supply and demand inventory mismatch versus Chinese growth, but they saw no reason to revise their copper view between 2025 2027 because of the China growth impact, right? So, or the lack of upside Chinese growth impulse. And China itself, this week has mentioned it's really quality over quantity. So yesterday's announcements, even when it came to mega projects, infrastructure, stuff that should boost demand for resources, for an iron ore, copper, and everything else, that was only stated in the context of how to improve livelihoods and how to improve household expectations and household wealth. So I think that says it all, really. You've got the suppliers on the Chile side. You're not going to see a big boost in terms of investment growth. China focusing on quality over quantity. So I'll just go back to what I think the IMF and OECD all stated. That's not going to be a main driver up ahead. But from Chinese equities perspective, if you're going to see better margins because of this anti-involution campaign that's going on, and you're going to see better quality, then I'm still actually quite optimistic for household incomes and confidence. So the volume demand is there. The question is pricing right now.
Okay, so you're not so there is nothing to be excited about, perhaps, about the Chinese growth story from here. I mean, because every time we see negative numbers, or rather, I should say, disappointing numbers around Chinese growth, people say, well, the Chinese were going to step in and stimulate, and that will change things. Right. Any expectation of that?
So I think the stimulus is not going to look like the stimulus from the past that we're used to. Remember, there was the Chinese real estate market. That chart was known as the most important chart in the universe. Well, that's certainly no longer the case. So focus on household spending. Let's start with volume. So what I'm really focusing on right now, stimulus. So the childcare support package, for example, National Health Commission yesterday said this is the biggest, basically, direct form of household support since the founding of the Republic. It was 90 billion renminbi, so in the grand scheme of things, what they could deploy, probably not as large as some expectations, but they're moving in a different direction right now. So they're giving direct injections to the household, and that can boost spending as well. Focus on consumption, focus on household demand, right? So there are sectors that can benefit from that.
You see a lot of flow data.
Indeed.
What has changed? Has something changed over the last few weeks since the European deal was announced? Is the Europe trade over? Is that money that maybe was flowing across the Atlantic in this direction starting to peter out? What's going on?
So I go back to my 3 key sectors and how they're positioned, relative to rolling average. Aerospace and defence.
Yep.
60% above the rolling 12-month average. Right. Okay. So bulletproof almost. Right. And then you look at autos and look at luxury goods struggling to match still the rolling 12-month average. So if I just look at our flow data, we talk about concentration in terms of holdings, in terms of tech, but in Europe, concentration in aerospace and defence. Financials, yes, it's done well in terms of levels of performance, but holdings, nowhere near, where the aerospace side of things is. So, that's where, if you look at the external demand side, European airspace sector is still exposed to external demand. So, that's where maybe some rotation needs to happen. Right?
Okay. So what do you think it does happen on the back of that? If that's the trend at the moment, extrapolate it forward for me. If I'm looking to invest money in, do I just keep going with the bulletproof, to excuse the pun, or do I go with something else that looks better value? What do you think? Because it's a really confusing picture in Europe.
Yeah, indeed. So the tendency, always tends to be is if it ain't broke, it ain't broke, don't fix it.
If it ain't broke, trace it.
Yes. So I had anticipated and want to be across the 40%, 45% threshold for that to come off. So it certainly has been overextended. The question is, why is there no confidence in the other sectors right now? So I just go back to if aerospace is the European domestic investment story, so fine, but it's time we look at the secondary and tertiary effects of that. Can it actually start to boost European households? So
where would that be? Just walk me through that.
So, that would actually be, I think, in terms of sectors, in terms of in the consumer side of things, so consumer staples, and also, healthcare, things like that, where you can see intrinsic European demand, again, led by public spending as well. The difficulty, I think, for clients in terms of pricing that is, how do I draw this large defence budget, that's being pushed forward right now into the household side? So, again, it's about household incomes. It's almost like what China is trying to do right now. Let's focus less on the numbers. I think the numbers are being priced in. Focus more on the quality of growth. So if there's that controversial phrase, trickle-down effect from the investment, going into the industrial side, if that starts to boost household incomes and real incomes in particular, and it's helpful because inflation is coming down. Let's see what the German numbers are going to be today. If HICP is saying 1.8, 1.9%, then real incomes can be growing up, and then can households start to spend. That is always tricky when it comes to Europe, when it comes to Asia, relative to the US and UK.
So a lot of stuff being taken on faith with
yes, indeed. So especially on the consumption side.
Yeah, Jeff, great to see you. Thanks always for joining us. Jeff Yu, Senior EMEA Market Strategist, joining from BNY. Let's take a quick look at what the core six looks like this morning. There's a bunch of 52-week highs in the banking sector. I think the entire sector looks like it's having a relatively good morning. It's not in the entire sector, but broadly that is the picture at the moment. The 52 highs in the aerospace sector, but Novo's flat this morning. LVMH is a little bit softer. Ferrari's up a little bit. ASML is the tech play this morning. Schneider, which is interesting, obviously the numbers versus kind of the overall trend, and Nestle down by 0.8%. But actually, take a look at the beer sector. Take a look at what's happening at AB InBev this morning. There is a lot going on. Let's start with the banking sector story in more detail. Close here with the details of that.
Morning, Guy. Let's start with Société Générale. So we are up more than 7% this morning. That's on the back of a buyback, a new interim dividend, and also lifted outlook. So investors seem really happy about that. SocGen had already been doing so well over the last year, and we've got an extended boost today with those results. Moving on to AB InBev. So AB InBev is down almost 10% this morning. It reported really weak sales, especially in Brazil and China, where there's really weak consumer spending. So that dragged down sales and volumes, and also shares this morning down 9.6% at the moment. Moving on to ArcelorMittal, the steel maker. So it said that the outlook for steel demand was weaker. So it cut its forecast for steel demand across the world, and said that that kind of feeds into customer hesitancy. So we are down 4.4% this morning. Moving on to the engine sector. So Rolls-Royce up 11%. It actually lifted its outlook this morning and said that there was really strong demand for jet engines, and also the cost-saving program is a real benefit. So we're up almost 11%. And then finally, miners. So we've got obviously the 50% tariff on copper that was announced, and that is dragging down all of those names across that mining sector: Glencore, Rio Tinto, Antofagasta, and Anglo American, all of them down this morning by quite a bit.
Chloe, thank you very much. Chloe Melly with a host of movers this morning. So many to choose from. Here's another one for the list. Just Group, which is actually in the insurance space here in London. An offer from Brookfield Wealth for the business at 220 pence a share. The stock then goes higher by 68% this morning. Not actually up to the offer price, so perhaps some execution risk in there, but not far from it. So 212 is where it trades. An offer price from Brookfield Wealth at 220 pence per share. Coming up on the programme, back to the earnings story and the global macro as well. Anglo cutting its dividend as lower commodity prices drag on profit. We'll be speaking to the CEO next. This is Bloomberg.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back. 17 minutes into the session. As you can see, equities are going broadly higher. In terms of the sectors that are driving us, you've got a tech stock story, which is focused very much on what is happening over in the United States. You've got a banking sector. We'll talk about 52-week highs and lows in a little while, but believe you me, the banking sector is chock full this morning of 52-week highs. And we've also got an aerospace sector, a defense sector that is doing well. BAE Systems, Rolls-Royce, Safran, all having really interesting stories over the last 24 hours. And we'll come back to that as well. But this copper story is mind-blowing. The move that you saw yesterday was just absolutely sensational. We've known that there's been this arbitrage trade between copper in the United States and the rest of the world because of what was happening with the tariff story. Trump, like that, closes it yesterday. And you just see this epic move.
That is what you see on the chart. Yeah, this is the spread between, if I'm looking at this right, the premium for US copper over London, and it absolutely collapsed. It was created by the Trump tariff narrative, and then it collapsed yesterday when the announcement came through that they were excluding refined copper. Somebody we know who might have some views on this is waiting in the wings, but let's start the conversation with Duncan Wanblad on the earnings from Anglo American. They cut their dividend this morning, and they've announced earnings. Let's get into the conversation with this business, this mining business around restructuring. I'm pleased to say that the CEO, Duncan Wanblad, joins us now. Duncan, thank you so much for joining us. No doubt you're interested in the copper story as well. We'll get to that shortly. Tell us about the underlying message from the earnings here, because we've got a 20% drop in underlying profits, an 83% reduction in the dividend, but there's a narrative that suggests the problems or the downdraft is coming from the businesses you're selling. Is that the correct interpretation of the numbers this morning?
Good morning. Yes, absolutely. That would be correct. So basically, the earnings were compressed by three key things, really. One was a massive flooding in South Africa, which took out one of the platinum mines for the best part of 6 months. The second was the fact that we've got 2 coal mines that are not in operation in Australia at the moment. And the third, of course, is the continuing weakness in the diamond markets. The balance of the business is performing extremely well. I mean, those three just also happen to be part of the exiting businesses. The RemainCo businesses are performing really, really well.
Okay, no doubt we'll return to some of the bits of the business you're selling and the conversation around the restructuring there, but I just want to ask you about the copper story. What is the impact of tariffs on the copper business at Anglo American, or is it just very difficult to keep track of the news flow there and very difficult to say? We've had some developments overnight that suggest refined copper is excluded from US tariffs.
Indeed, look, there's an enormous amount of volatility, not only in copper, in many of the metals on the market at the moment, relative to what's actually going on with tariffs and where they're ultimately going to land. As far as copper is concerned, I think what we really are seeing here is the short-term rectification of what was a really big arbitrage between where finished goods found themselves just in anticipation of the tariffs, so either in US markets or in European markets, etc., and so that's going to take a little bit of time to unravel. I think more fundamentally for us, though, as we look at a business with a time frame of the assets that we have under management, we have to set ourselves up for long run outcomes, not short run outcomes. But the short run is very, very noisy in terms of what happens to metal prices. Long term, the fundamentals for copper remain absolutely fantastic. There's going to be great demand for the metal in terms of the energy transition particularly, but there's also going to be a real squeeze on supply, as it certainly takes a lot longer to bring projects into play. So yeah, short-term volatility, long-term stability, I think.
Duncan, good morning. It's Guy. So you are going to become a more focused copper business going forward from here. Obviously, that's an interesting place to be. But as you say, you are going to be getting rid of some businesses. Diamonds is the one area that I think a lot of people are watching very carefully at the moment to see what the plan ultimately is going to be. The softness in the diamond space continues. What's the current plan for De Beers? What's the timeline? Is it moving? Can you just update us on what your current thinking for when and how that exit happens?
Sure, Guy. Look, first of all, let me say that whilst the markets are still under quite a lot of pressure, I think that we are starting to see hopefully some green shoots here, and certainly demand out of the US, out of India, and even to some extent out of China. For the rough looked pretty reasonable during the first half of this year. So, fingers crossed here. We are starting to look at a bit of a turn in the market. As far as the process is concerned, as I've said before, we are running a dual track. So obviously our preference would be to try and do a trade sale of our stake of this business to the right buyer. But to the extent that that's not possible for whatever reason, we're very happy to on a market recovery, run this through an IPO. In terms of timings on this thing, we're in a process now with a number of very credible and very interested buyers. So there is some hope that we may be able to conclude that towards the back end of this year or early next year. An IPO probably more likely in the middle of next year.
Okay, so the IPO is. Do you think the IPO is becoming more likely? Would that be a fair assessment of the situation?
I don't at this particular point in time, but I certainly am not taking my foot off the gas in terms of keeping the option open for an IPO if that's what we need to do.
Duncan, it's Creedy in London. Let's talk about another one of your businesses that is also currently being under the selling process, and that, of course, is your steelmaking coal business to Peabody for about $3.8 billion. There's been some questions around whether the deal should be scrapped, at least Peabody claiming that after a fire. Can you just walk us through the update in terms of those negotiations, that sale process?
Yeah, sure. Look, I mean, we actually concluded a sale agreement with Peabody, and so we have a contract with Peabody, and so we're just in that bit of the contract where you're between signing and closing. As you say, we did have this really rather unfortunate incident at one of the mines in April of this year, but subsequently, we've determined that there is absolutely no damage to the mine at all, and there's no damage to any of the equipment in the mine, and we're continuing with a really collaborative, transparent, open process with a number of parties, stakeholders, including unions, the government, the regulators, etc., in a staged process to reopen the mine. And certainly everything that we can see today and our understanding of the progress that we're making, and certainly the fact that there's no damage at all to the resource, there is no possible way that this is a material adverse event under this particular contract. Look, a little bit of work to go still with the regulators to get the final approvals for a restart, but making very positive progress on that journey.
Duncan, let's wrap up this interview with a final question on simply the broader picture of things. You talked about with Anna a little bit of the copper tariff situation, but just broadly, as so many of these tariff deals are getting inked around the world, how does that affect things like investment, supply chain management, or even just underlying demand for the metal from your perspective?
Yeah, it's a great question. As I say, hopefully, ultimately there will be some stability that get brought back in when everybody understands exactly, what tariffs are going to be sat where. But fundamentally, I think from a first order impact in terms of businesses like mining, there's not necessarily a direct consequence of these tariffs. Generally speaking, that would be. But more fundamentally, I think the second order is that around the world, I think we're going to experience some very serious inflation over time, and that's going to affect a number of the inputs to production from a supply chain point of view. It's certainly going to impact finished goods prices and so on and so on. The consequence of which is that I think generally and globally costs are going to go up. So I think we're all going to have to get ready in terms of dealing with that and managing that in our businesses until such time as the price adjusts, because the price, of course, must adjust to accommodate that. Otherwise, material won't flow eventually. And then, of course, I think in periods of great volatility like this, people find it really difficult to make big investment decisions in mines. So we just
Duncan
need some
Wanblad, Anglo-American CEO. We are going to have to leave the conversation there, but we thank you so much for your time this morning. This is Bloomberg.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. we're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
This is the opening trade, about 30 minutes into today's session, and green on the screen, really seeing some optimism baked in, really coming off of what the positive earnings we got, of course, in the States. There's a little bit of a tech read-through as well, but also plenty of earnings stories where you're seeing buybacks front and center in the banking sector, but even that kind of secondhand effect of even those tariff woes not showing up in this market today. Of course, it's probably following what we're seeing in the U.S. picture as well, but your outperformer, no surprise, is the DAX this morning higher by 0.6%, Guy.
Let's talk about where we are seeing the detail of that story evolve. There's a bunch of things going on. I think it's worth sort of going into these markets and trying to understand what is happening. Now, clearly, this morning there are more buyers than sellers, but it's a bit more nuanced than that. In terms of the breadth we're seeing in the market, higher versus lower, you've got 363 up, 223 down. But the sector story, the breakdown is really interesting. And where the 52-week highs and 52-week lows are is really interesting too. Volume, I should have just said on that last chart, actually quite good this morning. You're certainly seeing it above average. There's a lot to get through. There's a lot of single stock names that you need to be focusing on, and there's a lot of variety within this market. But two key themes continue to stand out. I'm going to park tech to one side. Defense and banking. These are the two areas that have dominated Europe of late, and that trend is very much evidenced in the 52-week highs that we're seeing this morning. Rolls-Royce up by 9%. It's actually off its highs, doing really well. Safran's having a great session as well. We're watching the defense space continue to do really well. Rolls-Royce tracking higher, 52-week high. But then it's the banks. The banks have been the real standout story. Go to the 52-week high list on your Bloomberg terminal this morning. You'll see just a series of banks hitting 52-week highs. SocGen stands out with its numbers, up by 6%. BBVA up by nearly 6% as well. Two stocks hitting 52-week highs. But there are some lows out there. This is not a single market story. You've got Nestle, which is flat this morning, but at a 52-week low a little bit earlier on. Haleon in the consumer pharma space down by 3.2%. And Renault in the car space, another area. Are we seeing that sector bottoming out? But this is where the 52-week highs and lows are this morning. But it's basically just banks and defense. That's the European story, Anna, right now. And it continues to be this morning.
Yeah, banks and defence very much in focus then when it comes to a stock market moves perspective. Let's widen the lens and tell you about some of the other stories that we are tracking, though, this morning. And trade, of course, is part of that. President Donald Trump says he'll impose a tariff of at least 25% on India's exports starting on Friday, though he later added the two sides are still in talks. Meanwhile, President Trump has delayed the implementation of 50% tariffs on Brazilian exports by 7 days, while exempting many products from the levy, causing the country's currency to rally. Meanwhile, British retailers are warning that food inflation could hit 6% by the end of the year as they raise prices in response to April's hike in payroll taxes and the minimum wage. 2/3 of companies surveyed by the British Retail Consortium, the BRC, say they intend to increase prices further to offset higher costs. Food inflation hit a 16-month high in June of 4.4%. And over to China, authorities there have summoned NVIDIA representatives to discuss alleged security risks related to the H20 artificial intelligence chip that is, of course, made by NVIDIA. The move marks an abrupt change in tone after the Stockholm summit between the US and China, and the trade officials from both countries gathered there. The H20 product has been banned from sale to China by the Trump administration since April and had only recently been cleared to return to the market. So just as you thought that the mood music between China and the US had improved, Kriti, you get this kind of story around NVIDIA, which makes you take a pause and think.
Makes you take a pause, but yet we got some massively strong earnings when it came out of the tech space. And we were talking about that kind of push and pull or tug of war in the tech space. Right now, the earnings are beating the geopolitical risk. Let's dig in a little bit further. We're joined now by Bloomberg Senior EMEA market strategist Michael Masika around the table. Michael, you put out a very cool chart this morning, and I wish I had it with me, but really talking about how the tariff story and the geopolitics affects those European corporates specifically. Can you just walk us through your analysis there?
So it's a strange thing. You had analysts pricing a very, very heavy hit from tariffs at the beginning of the year, especially after Liberation Day. Earnings have been cut massively for the past few months in Europe, and it seemed that about 20% was priced in. Now we've got 15, even though we lack details and everything. So it's like we are almost at the point where the peak uncertainty is gone, and that what was baked in was just much stronger than what might happen in the next few months. So we're going to start seeing more upgrades on earnings. And we see it in some stocks already, like companies are talking about tariffs, that there is an impact, but a lot of them are going to, sail through those, either through price increase, change of the supply chain. They're adapting, and I think investors are responding to that.
In terms of, therefore, where we go from here, 52-week highs this morning dominated defence and the banking sector. Those have been the two areas in which Europe has been able to deliver that international investors have recognised. Do we see a broadening out now? Do we start to see other sectors beginning to perform a little bit better?
Well, you need a bit of convincing for that. If you look at autos, for example, okay, we might be at the bottom, but do you want to buy it? Are you expecting like a massive growth in that sector? It's a big question mark. So you have a lot of sectors like that which, still carry a lot of uncertainty, whether it's from the actual tariff impact down the road or like very steep competition from China. For example, so it's tricky, but you have two big stories. The big story is banks. We've seen now over the past few quarters that even if the ECB has cut rates, it has not impacted the profitability of banks. They've been doing very well. They keep doing buybacks, keep paying hefty dividends. They're going to be responsible for most of the shareholder payouts this year in Europe. Again, it's a trend that keeps on giving, and investors keep riding it. As for defense, well, this is the only story where there is an actual commitment from the European Union, from countries, like at a country level as well. So, again, it's something that's really, really set, and that investors keep riding. And now, do you want to move out from that and try to broaden out? Yeah, maybe, but you need convincing.
Yeah, we spoke to Deutsche Bank yesterday, didn't we? And they're not sure that continues, or at least they think the theme continues. But whether it's in the price for now was the question we were asking, and the view seemed to be that maybe it was. Let me ask you about tech, because it's an awkward read through from a lot of the US earnings news that we have there. So we've got Nasdaq futures up by 1.4%, Michael, because of all the strong performance in Mag 7. I mean, what's in that for Europe? What can Europe do with that? Tech is the second best performing sector this morning, so we're riding the theme to some extent. But is there anything we can take away from that theme?
So it's the same thing. Like if you look at how we came into the earnings season, there was a big catch up from the US markets led by tech, and expectations are much higher than in Europe, for example. in US tech. But at the same time, we see those companies, whether it's Microsoft, Nvidia, they're delivering. They are delivering. No matter how high the expectations are, they keep beating, and they raise guidance, and they keep going. So investors seem to, have been convinced that this is still the trends to be in. They had a bit of a wobble at the beginning of the year, but now, like, positioning is rising massively on that sector. It starts to being stretched. We're getting to stretch level now. That's the indicators that we're having. But, you can be at stretch level for a very long time.
Go ahead.
What? Is this the only story now? Like, you've got a bit of Europe and a bit of defence and a bit of banking. Yes, the numbers there look good. But are we basically back to the last 15 years of the only story, there is no alternative, just buy US tech. And as long as that trend continues, stock markets just keep getting dragged higher and higher and higher.
But hold on, isn't that the exact narrative with defense, though, to your point that everyone's kind of filing into this because there is no other place in Europe to consider safe, literally?
Yeah, it's the same in the US. You buy US tech because that's the place where you have growth. That's the place where you have like a big trend. The demand for AI is showing no sign of abating. You have a problem with regulation. That's the tricky part, but it seems that, it's okay. Rate cuts, well, as long as tech delivers, even with like a 4.5% interest rate, it's fine, no problem. It doesn't, investors keep going for this.
But there's so much noise, right? Yeah. Loads of noise, tariffs, Fed, BOJ, lots of stuff going on. Can I just ignore all of that at the moment and just US tech? Maybe I think about European defence, but US tech. That's the only needle in my compass, to quote Jean-Claude Trichet.
Yes, it is. It is kind of that. I mean, it's very liquid. It's delivering. It's doing better than anything else.
Yeah.
And like I said, the problem was for a few months there was a big deleveraging on tech, on US tech, and now there is a catch up. So all the hedge funds are releveraging, mutual funds are releveraging on that. They're buying more of it, and the thing is, like, the higher it goes, and the more they catch up. Now we're talking to a lot of fund managers about, even if they have a long-term view, like 3-5 years, and the market is doing what it's doing right now, and you're not overweight, or like you're not even market weight on that sector, you keep buying because you need to catch up. And it doesn't matter if you have a 3 or 5 year view, you still have, like, your management coming after you and saying, oh, the tech is going crazy, the S&P is going crazy, and we are not making the money we were supposed to make. So you chase, and you keep chasing, and that's what's going on here.
But as you were speaking, I just did a quick little terminal search on PE ratios of Microsoft versus Rheinmetall. Microsoft's trading at a 33 multiple. Rheinmetall's at 59.
Yeah.
That's crazy. Is there an argument here that people are quite literally, I mean, this is so controversial, but you're buying American tech at relatively cheap multiples?
Compared to a defense stock, yeah, maybe. Now the difference is in the defense company, you have like a very heavy commitment from the region, whether like at the local level.
Hold on, a promise.
A promise. Yeah. Yes, it is. Yes, you're buying a promise, but you're probably more certain that promise is going to be delivered because they have targets than tech that can be a bit more let's say wobbly in terms of like cyclicality and everything. So it's a trade-off. At the same time, you have to bear in mind one is super liquid and the other one isn't that liquid. So if you have one theme in Europe and you're a European fund manager, or like you're exposed to Europe and you want to have exposure to something, it doesn't really matter what you're going to pay for it. And because if you're convinced that they're going to deliver and that this promise is going to be delivered in terms of like spending, defense spending, then that's a trend you want to ride.
Michael, thank you very much. Bloomberg's Michael Masika with us to digest the latest moves on equities this morning. Coming up on the programme, we've been talking a lot about defence, in fact, this morning, and that being one of the key themes that investors have been buying into year to date. We'll continue that conversation with an interview with the BAE Systems CFO. That conversation around the earnings story, sure, but the defence broader outlook, really interesting. That's coming up next. This is Bloomberg.
cidade estava sitiada.
Isso ao começo eu também não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering, and someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
45 minutes past the hour. A moment ago, we were talking to Michael Masika about the kind of sectors that stand out in the European equity space right now. One of them is banks. The other one is certainly what is happening in the defence space. So let's carry on that conversation. BAE Systems raising its earnings outlook for the full year. This is the UK defence contractor, benefits from increased military spending in Europe. Remember, it's got a big business over in the United States yesterday. There was an upgrade broadly in terms of the overall picture. I think the market maybe sold a stock, and I haven't actually got to the bottom of this, to be honest, on maybe the lack of an EPS upgrade, a cash flow upgrade as well. But let's try and answer some of those questions at the moment. The CFO of BAE Systems is Brad Grieve. He joins us around the table. Fantastic to see you. Good morning.
Nice to see you, Guy. Morning.
Is that the reason? And the stock dipped a bit. Yeah, I know the 52-week chart looks amazing. But the question that I think has been asked by a number of analysts is why didn't we get those upgrades when it came to cash flow, when it came to the EPS line? Is there a kind of easy answer to that question?
There is actually. I mean, we did upgrade sales by 100 basis points. Yep. We upgraded EBIT by 100 basis points, but EPS couldn't get upgraded because we had a higher tax rate in France, which we have a bigger MBDA earnings, which is our joint venture that we're 37.5% owners of. France is growing, MBDA is growing, so our profits are growing in France, so it's a little bit of a higher tax from that. And then because our share price has gone up as much as it has, it means we're not taking out as many shares in our buyback program. We're still spending as much in quantum on buyback, but we're taking out fewer shares because of the higher share price. So those two things is really why we couldn't upgrade EPS by 100 basis points, but sales and EBIT both up 100.
Okay. So fundamentally, everything kind of on track, looking good. We were just talking about the defence space. Is it a promise now that Europe is going to continue to deliver? Can shareholders take this one to the bank? The governments are going to be spending more and more and more in Europe, and they're going to be spending it on European kit. Is that just the reality that we now find ourselves with? Is that cast iron? I can take it to the bank. It's already reflected in the share price to a certain extent, but is there any doubt in your mind that is the narrative we are now dealing with?
Look, you have to. I've said this many times before. There's been a massive underinvestment in defense in Europe since the end of the Cold War. It is massive, and so now Europe has to play catch up. And so you've seen the commitments of 3.5% on core defense spending across NATO, and an additional 1.5% on infrastructure and industrial capability. So those commitments are there. So it's going to take some time to get to those levels. But some countries across Eastern Europe are already above those levels, and that is a reflection of the threat that we see in the continent now. And so I think that chronic underinvestment, now there's a catch-up that has to be fulfilled. And then on top of that, replenishing inventories that were contributed into Ukraine is another part of that. Yeah. So that's why there is this sort of super cycle of spending that we see. And that's...
Oh, we're just at the beginning of that?
I think so, because we haven't seen this big increase in a lot of the big countries in Europe to get to that 3.5% level. And then there's additional 1.5% on top of that. So 5% of GDP on defense, that represents a massive increase when we only just got to 2% in 2024.
It is. And Brad, good morning. Maybe it's too early for this question, but I'm interested in the timescales. How long does it take for those commitments, though, to turn into orders? Because that Guy's question about how bankable is this, for you running a business, that's what will matter to you, is how quickly the orders come through. So what are you already seeing on the orders side?
Yeah, we have we talk about orders and how they feed into backlog, and we have a backlog today at 75 billion pounds. And beyond that backlog, we've got a pipeline where we're the incumbent on positions that will eventually turn into backlog, and that number is like 180 billion pounds. So when you add those two numbers together, it's 8 times current revenue. So what we see is a really current high demand. We see strong backlog and pipeline, and all these things are what are going to drive growth going forward. So we're really well positioned. We're already seeing high growth. We printed 11% in growth yesterday in our half-year results, and we are really well positioned for continued growth at a really high pace.
So it sounds like CapEx then. I mean, can you deliver those numbers you describe, 8 times current revenue?
Yep.
Is the business able to deliver that? Are the supply chains able to deliver the kind of growth that you're talking about?
Yeah, it's challenging. I mean, we spent £1 billion in CapEx last year, and we'll spend a number pretty close to that in 2025.
Will it be more? Because I know you were on with Tom not long ago, well, 6 months ago maybe now, and it was that kind of number then. I mean, have we seen a step change in the CapEx commitments? Are you going to be spending more to be a bigger company and produce more?
Yeah, we've already been spending high levels, and I think what we're investing in is capacity and scale. So that the £1 billion we spent last year and the $1 billion that we'll spend this year, it's going to things like the Jacksonville shift lift in Florida, where we increased capacity for ship repair for the U.S. non-nuclear Navy, the artillery factory in Sheffield that we just opened up, the shipbuild hall in Glasgow, the Janet Harvey hall that we just opened up, which allows us to build 2 Type 26 simultaneously. So all these investments that we're doing across the world are really geared on capacity expansion. These take time, from starting a greenfield project to getting productivity, it could be 3 or 4 years in some cases. So that's why I think there is a bit of a gap between the spending increases and orders coming through, because it does take time to get that capacity. And that's why I think in our U.S. business, we're really well positioned to have foreign military sales from the U.S. portfolio that we have into what Europe will require.
Brad, in the Draghi report, Mario Draghi quoted Goldman in saying that all this European spend, ultimately 70 to 80% of it leaks to American defense manufacturers. Part of the trade deals inked with Europe specifically, and even across Asia, has been active spend on American defense technology. How much of a dent does that put in commitments and contracts for you?
Well, we have a great business in the U.S., so almost half of our sales are in the U.S., and those are programs that are really aligned to the national defense strategy of the U.S. So our U.S. business is really well positioned for growth. And Europe does need to have domestic capability and capacity. So Europe does need to invest in its own capabilities and sovereign capability. And we play into that as well. 11% of our revenue today is non-UK Europe. But if you look at our backlog, that 75 billion pound number I talked about, 30% of that is non-UK Europe. So BAE Systems is already really well positioned for that growth vector in Europe that we see. But all across our portfolio, I think we're really well positioned. I think that's what makes BAE Systems a little bit special, is that geographic footprint that we have that none of our peers have.
Well, Brad, clarify this for me then. You said you have 50% of your sales come in the States. You have a portfolio business there. If you're talking about active spending on U.S. defense manufacturing, are you benefiting from that, or are you getting hurt by that?
Oh, we're benefiting from that. I mean, you saw the U.S.
To what extent? Give us a number.
Yeah, well, you saw the U.S. budget today, or not today, but it's 13% increase. So the budget plus the resolutions there.
But that's from U.S. defense spending.
Yeah.
That's not necessarily from the trade deals, the promises that are being inked with Japan, South Korea, India, you name it.
Yeah, but look, I guess what I'm trying to say, Curdy, is that we have a portfolio that's aligned to all the themes that are happening in all those places that you mentioned. When you talk about Australia, AUKUS is a great example. When you talk about Japan, GCAP is a great example. when you talk about our U.S. business, very well aligned to the priorities of the Indo-Pacific theater, which is really where the U.S. strategy is aimed at. And then when you look at Europe, I've already talked about all the key ways that we benefit from that European increased spending. So, in all the places in the world that we operate, we're really well positioned to benefit from spending that we see.
You bring up GCAP, sixth-generation fighter. I think you call it the Typhoon.
Sixth gen is a Tempest guy.
Sorry, is the not the Typhoon, the Tempest? Yeah. I got my aircraft mixed up, not the Typhoon. The Typhoon's current generation.
Exactly.
There's some disagreement. I talked to Eric Trappier, Guillaume Faury at the Paris Air Show. There's obviously some disagreement in terms of the other program, the FCAS program, that they are running. Where do you think this ultimately settles? We've got these two big programs. Eric's convinced that the French should have a French program, and that's should be the way that we go. But do you think there is, how much interoperability can there be here? Do you think it would be possible for Airbus to shift its allegiances in terms of where it puts its chips? How fluid is the situation currently from your point of view? Because you're cracking on with the Tempest, and it's kind of moving along, whereas there's a disagreement with the other program. How do you see this evolving?
Yeah, hard to see, and we really don't aren't concerned about what's happening with that rival program. What we're concerned about is making sure that we deliver to our timetables. And initial operating capability by 2035 for the 6th gen is really what our focus is. And we are really making excellent progress on that. We'll have a flying demonstrator for the Tempest in 2027.
Yeah.
So that's a testament to how fast
How much
we're
interoperability
moving
do you think there could be, though?
Well, you look at weapons packages, for instance. Those are going to be the same on
both,
on whether they have a program or not.
Yeah.
It'll be the same weapons package.
If they have a program or not?
No, it's up to them to resolve. I mean, I think that it's well written about how challenging that program is, and we let them take care of that.
Would it be nicer if Europe had one program? Do you think that would be better?
Look, we are focusing on our program. We're making excellent progress. I think time to market with something like this is going to be important, and we've got a really strong lead on that.
Thank you very much, Brad. Thanks so much for spending time with us this morning. Brad Grieve, CFO of BAE Systems. It's just coming up to 9 o'clock here in London. I feel like the day is a whole day must have happened. There's been so much news. But we still have other things still to come. German CPI, US PCE. We've got some earnings after market, Apple, Amazon. And it seems to be the tech story over in the States that overnight is setting the pace. NASDAQ futures up by 1.5% this morning.
Absolutely. It's a fascinating one as we line ourselves up to the Apple, the Amazon story. If Microsoft, if Meta was all about CapEx, about the AI investment, will Apple and Amazon be about the trade story that I feel like took a back seat today as well? So lots to digest there. Of course, you want to stay with Bloomberg for full coverage of that conversation and an interview with former Kansas City Fed President Esther George. You can catch that conversation at 12:30 p.m. London time. A really fascinating one, of course, coming right off the back of two dissenters, if the Fed.
Yeah, was the Fed the story yesterday, or was Tech the story yesterday? I think it probably was
Fed
Tech.
What Fed? Trade what trade?
Who cares about rate cuts and all that kind of stuff? Anyway, there's much to discuss on the Pulse. That is coming up next. This was the opening trade. Hope you enjoyed the show. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question.
I so appreciate that question.
You certainly ask
Interesting questions.
Bloomberg Television. Top experts, great questions. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg. Mag 7 momentum, bumper beats from Meta and Microsoft boost sentiment on a busy day for earnings. Trade surprises, U.S. copper collapses as President Trump exempts refined products from tariffs, while also announcing rates for India and South Korea. Plus, double dissent at the Fed, rates on hold, but 2 committee members vote for a cut. So there is quite a lot going on today. We could just take 3 hours talking about earnings, but it's really the stellar blockbuster, especially on CapEx spending from the tech sector that's giving a lift to a lot of these stocks. You can see S&P futures gaining some 1%. And then the other story is, of course, what's happening with the trade and tariffs. Copper has been all over the place. The one in the U.S., the CMX is 438 because President Trump exempted, I guess, the good stuff, the ones that we directly use into some of the economy to do the transition and in our phones. And then the other story is really what's happening with the Fed, euro dollar 114.49. I have to say, Jay Powell was at real pains in the press conference to very carefully say that despite 2 dissenters, the first time we've seen in 30 years, he's staying the course because we're also getting a lot of data prints from now until the decision in September. Let's also take a look at the European markets map. Again, the story of what we're watching out in the U.S. and that GDP figure from the U.S. is also filtering through to Europe. The UK, well, the FTSE, the DAX, and the CAC can gain between 0.2 and 0.5%. We're getting a little bit of inflation. Actually, in some of Germany, the parts in Germany, North Rhine-Westphalia, July CPI rising some 1.8%. And then let's also look pre-market. Look, Microsoft and Meta, definitely the 2 ones we're focusing on. Surging in late trading yesterday after the tech giants posted better than expected quarterly profit. And you can see pre-market, it advances between 10 and 12%. Qualcomm shares falling after hours, reporting some weaker than expected smartphone chip sales data. So Chinese authorities, the other thing we're watching out for, Chinese authorities summoned NVIDIA representatives to discuss alleged security risks related to its H20 artificial intelligence chips. Despite that, you can see NVIDIA gaining 2%. So for the conversations that matter, we have a lot of them, and the insights you need. Let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacroix.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in London. Investors navigating a barrage of headlines from tech tariffs and, of course, the Fed. Upbeat earnings from Meta and Microsoft have bolstered optimism over resilient corporate profits. Now, in trade news, President Trump has unleashed a series of tariff deals and demands on the eve of his Friday deadline, including surprises on India and copper. Now, over at the Fed, the chair, Jay Powell, has shrugged off pressure from the White House and rejected arguments for an interest rate cut from 2 dissenting officials. Well, joining us to make sense of it all, Nadia Grant, head of global equities at BNP Paribas Asset Management, our tech reporter, Mark Burden, and Jill Deeses in Hong Kong. There's a lot to get through. Mark, it's all about tech. Why are we liking tech so much? Is it that they're actually spending, hard cash
on AI and data centers.
Yeah, in the case of Meta and Microsoft, I think the investor response here is that they're willing to spend in part because their core businesses are doing so well, right? I think we should be careful not to confuse. I saw an analyst note this morning that said this is unprecedented AI demand. Yes and no. I think, in Microsoft's case, their cloud business is doing tremendously well, and they're able to keep this spending on what they expect to be a future in AI sales, but we haven't seen evidence of that yet. In Meta's case, it's an ads business, right? They are basically a duopoly with Google. Their ads business is printing money, and then it's allowing them to invest very heavily in this future, which Mark Zuckerberg sees around superintelligence and AI.
Yeah, and Nadia, I guess this is also largely, when you look at tariffs and trade, and we'll get to some of the surprises that we got, it seems that tech, put Tesla to one side, but certainly the Mag 7 are doing pretty well.
Oh, absolutely, and they've kind of been able to avoid some of the potential hit from tariffs. So when you've seen earnings coming down from the beginning of the year for all other sectors, tech is the only sector that has been actually earnings upgrade because it's more service-based, more secluded from that.
Jill, talk us through the latest tariff rates on South Korea and India. And again, this is ahead of that deadline. That's tomorrow, August 1st, Friday. And we had quite a lot of news coming from the White House.
Yes, that's right, Francine. So I think a couple of things to really look at here. Obviously, a pretty favorable rate for South Korea. First of all, that 15%. I think what you're seeing there is a template that we already experienced with Japan, which got a really similar 15% rate with some of those, sort of tariffs moved over for autos in particular. And then there's an investment amount that's kind of rolled up in there. Trump seems to have really liked over the past couple of weeks getting these countries to pledge to invest, something to the tune of hundreds of billions of dollars in the U.S. And then, he ultimately gets to choose that for whatever investment purposes he kind of wants. That seems to be how he's negotiating some of these deals. And so I think what you've really seen, particularly over the last couple of weeks, is countries kind of emerge. And I think what, Lutnick and others, his Commerce Secretary and others have kind of described as these buckets where maybe you put, the EU, South Korea, Japan in a 15% bucket. You see Southeast Asia, a lot of those nations are in this more like 19-20% bucket. But India, I think India is the really big surprise here because, wow, they really got walloped there with that 25% rate relative to some of these other places. And I think, one that's a really big blow to, the Indian Prime Minister Modi because he was one of the first ones to go out to the White House and really kind of make an appeal, toward the start of the year on trying to get something negotiated here. Instead, what ends up happening is he gets, sort of a slap on the wrist here with this 25% tariff, and then Trump really kind of going on a tirade about how India buys, Russian energy, oil. Obviously not new news there, but certainly something that's rankled Trump as he's trying to get this, Ukraine-Russia war deal with Putin over the line. And so I think that's really kind of put India in a pretty bad spot here.
Yeah, and Jill, the other big story is, of course, copper, because President Trump effectively backed off on a lot of the copper tariffs, right? He threatened 50% tariff was only on semi-finished copper, not ores and concentrates. So that saves a large chunk of copper.
Well, Francine, I would point to copper as being a pretty big cautionary tale here. Look, a lot of these trade deals that we've seen from Trump, they exist in the form of conversations or Truth Social posts or something like that. We haven't seen a whole lot of white papers here. And I think it really shows you that, tariff deals, trade deals are often really complicated to negotiate. And all we really heard on copper before, this latest thing on how he was exempting the refined metals. So really, as you alluded to earlier, that's kind of like, the linchpin of international trade here. All we really knew is that, he wanted to apply tariffs on copper. Obviously, we saw a lot of stockpiling, ahead of then trying to get copper over to the U.S. because traders were really scared of what was going to happen with copper tariffs coming into effect. Well, finally, you get some details from Donald Trump. He says that he's ultimately exempting the most critical part, of that copper trade, that refined metal. I think it really just shows you that when it comes to some of these trade deals, it's really unpredictable. And ultimately, until you actually get that written down on a white paper with detailed plans on how exactly all this is going to work, it's really, really, really difficult to navigate the entirety of global trade around it. So, there you go. I think we'll obviously see what happens from there, but really, really difficult, sort of to tell what's really on Trump's mind sometimes.
Yeah, this is the problem with investors, is that there's just so much uncertainty and it could reverse quite quickly. Mark, China also summoned some NVIDIA representatives over alleged security risks in its H20 AI chips. What more do we know?
Yeah, it's a big roller coaster on this story. We just recently saw the news where NVIDIA is now getting this permanent license from the U.S. administration to sell its H20 chips This is not its highest end, but the ones they've specifically made for the Chinese market. Now, Chinese officials from our reporting are saying that there is a potential security flaw, basically a backdoor, where the U.S. government would have access to data from NVIDIA chips. And NVIDIA has denied this. But this seems to be a signal that this is not like smooth sailing for NVIDIA to return into China and see its prior sales. Of course, the context here is that especially Huawei and some of their competitors have been advancing pretty quickly. And there are Chinese rivals to NVIDIA, I'd say, in a way that there probably isn't in other countries.
Nadia, when you put all of this together, how difficult is it to navigate for investors, the trade and tariffs, and is that why, by and large, they seem to be ignoring it to just, touch record on record?
I think you're correct that it's extremely difficult to navigate, and that's why for us it's really a case of understanding each business model individually, because depending on whether you have manufacturing footprint in the US or whether you don't, depending on how your supply chain is organized, you'll get very different outcome from the current tariff, and then as you say, it's ever changing anyway. So the market has been shrugging off some of that, but it's also true that economic news and earnings so far have been extremely strong. So the impact has yet to be seen in terms of earnings. We're still expecting, I think, mid to high single-digit earnings growth in the U.S., which is extremely good when you think about the scare that we had early April. So probably the market could price more of a tail risk, but at the same time, I think you do have an upside surprise on the economic front and the earnings front so far.
And I also want to ask you about the Fed, because the chair, Jay Powell, says interest rates are in the right place to manage the risks around tariffs and inflation, really tempering expectations for a U.S. rate cut in September. Notably, Governors Christopher Waller and Mickey Bowman voted against the FOMC's decision to hold rates. Now, in his news conference, Powell lent into the view that the Fed is well positioned for now.
If you look at the labor market, what you see is, by many, many statistics, the labor market is kind of still in balance. It's things like quits, job openings, and let alone the unemployment rate. They're all by many measures, very similar to where they were a year ago. So you do not see weakening in the labor market.
Let's bring in Valerie Teitel. Val, how hawkishly did the market perceive the press conference?
The press conference was quite hawkish from Jerome Powell. He lent in, as you heard there, on the strength of the labor market. They still characterize it as solid, despite the warnings from Governor Chris Waller, who thinks it's on edge, was one of the main reasons why he likely dissented in this decision. Powell went on and on to say that the risk to inflation, the fact that inflation remains elevated, really does warrant monetary policy staying where it is, staying moderately restrictive. So we did see two-year yields rise around 7 basis points over the course of the press conference. And perhaps most importantly for global investors, the dollar, again, on a winning streak. Yesterday was one of its best sessions of the year, rising nearly 1% in the session. It is on a 7-day winning streak, its longest winning streak since February, up almost 2%, really putting into a lot of doubt this dollar declines. Whether that was just the first half move and the second half is going to be a lot different for the U.S. dollar. When it came to those dissenters, yes, we had 2 Fed governors dissenting, something we've not seen in over 30 years. Governor Chris Waller, who set out his dissenting opinion essentially right before the blackout period, was joined by Governor Mickey Bowman. Powell did say in his press conference that he expects these two to release a dissenting opinion detailing why they voted to reduce interest rates at yesterday's meeting. It was very interesting to see both of their rationales.
Yeah, I hear a lot saying, if you read the second quarter GDP report that then landed a few hours before the committee's decision was announced, you might conclude that they were probably right. Valerie, thank you so much. Valerie Teitel. Nadia, when you look at, first of all, the economic growth in the U.S., it's slowing down. I mean, we saw some wild swings because of imports and inventories, making the headline growth pretty much illegible. But if you look at final domestic sales, there's still some points of weakness. Nothing huge, but it's weakening.
Oh, totally, and we're absolutely expecting a slowdown in H2, and it's about the magnitude of that slowdown and the effect it's going to have for us on the earnings stream, and how much of a surprise will it be, because most but I think consensus estimates are for a marked slowdown in the second quarter. And at the moment, what we're watching is really on the consumer side, how is it holding up? Commentaries that we've had from earnings from the financials were pretty supportive so far. So yes, we're expecting a slowdown. We think it's priced in. And so unless you have a big downside surprise, I don't think it's a big hurdle from here.
Yeah, so when you look at your equity picks, I mean, how much does it have to do with consumer spending? Again, you look at spending, it accelerated a touch from the first quarter, but it's actually, comparative to last year, it's gone down.
Yes, so that's why when we look at company, we really look at companies that have strong secular growth, companies that can grow organically. So we really like the tech sector. We like the financial sector there. What we've heard from this quarter is that actually you have a bit of a renewal of the animal spirit. We thought it was lost. And so I'm sure you've seen we have started the month with quite a lot of M&A announcement. It's really picking up. And so we pick the spaces where we think the sectors, the themes where we think you really have a good outlook. So defense, I think earlier on was mentioned, has also been a fantastic theme to be exposed from a secular standpoint, as well as we continue to really very much like tech. And we think that earlier on this year, when it was lagging, we thought that was not justified. We really liked what we saw in the first quarter earnings on the spending side and on the top line acceleration. And I think this quarter is really a confirmation that that AI spending is starting to see benefit, and they're able to accelerate their growth on the top line. So the ROE, on that investment is really coming through, and that's also obviously really good for the semiconductor sector. So still areas that you can where you can see a lot of growth from a stock picking standpoint.
So Mark, by and large, are the Mag 7, apart from maybe again Tesla, are they largely immune to consumer spending right now?
That's a good question. I mean, I think that they obviously are operating largely different businesses. I mean, Amazon certainly isn't. If you look at like on the tech side, Apple isn't. Google and Facebook are very much driven by consumer trends, but they all have these really pretty sizable market positions and moats, is what they, in the industry term, right? Like that even we're seeing Google probably is most vulnerable because of the rise of ChatGPT and a lot of this new search competition hasn't seemed to hit their earnings at all, right? They're still performing. They're still outperforming the market. They're still growing on all cylinders. And we're seeing this cloud business, like earlier conversation about Microsoft, that is a huge secular trend, right? A lot of that is just companies moving from on-premise storage to the cloud, and all the estimates suggest that's going to continue to grow.
What are you expecting the Fed to do, Nadia?
As an equity analyst, I'm just looking at the consensus. So I see the consensus was expecting a few rate cuts this year. It looks as though September now is more 50-50. From an equity standpoint, the companies that we like have strong balance sheet. They're not as dependent on rates. So I think so far it's proven that although interest rates are quite high, it hasn't put a dent on the economic growth. So yeah, we're fine with the rate outlook. I think my company has our macroeconomics teams has a view for no rate cuts this year.
Okay. Thank you all I mean, we did a lot in those 15 minutes. We covered all of the news for the week. Nadia Grant, Head of Global Equities at BNP Paribas Asset Management, Bloomberg's Joel Deeses, and Mark Bergen. Now, Mark is also the author of today's Big Take about an award-winning entrepreneur who brought the first big boost to the AI boom. It's a great read. We'll also push it out on social media, how an entrepreneur of the year brought the first big bust to the AI boom. It's today's Big Take. We'll also push it out, of course, on social media. You can find it on the terminal. Coming up, the boss of Knighthead Capital Management plans a £3 billion investment to build a new sports quarter in the UK city of Birmingham. We'll talk to Tom Wagner next, and this is Bloomberg.
bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francina in Sintra, Portugal, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Well, ever since he bought the English football team Birmingham City, Tom Wagner has been building his investments in sports. The co-founder of Knighthead Capital Management has committed £3 billion to transform part of the city into a new sports quarter and purchase the Birmingham Phoenix cricket team. Now, Tom Wagner from Knighthead Capital Management is with me. Now, Tom, thank you so much for joining us. It's really exciting having you on the pulse. You're really in the space where everybody wants to be in. I mean, suddenly it's like, you know, it's fun, I imagine, but it's also an investment opportunity. Why the UK and why football?
That's a great question. We spent quite a bit of time researching English football before making our commitment to Birmingham City, and a lot of that was grounded in the principle that success in football is oftentimes connected to your success off the pitch in growing commercial revenue. And we felt in the case of Birmingham, it was a unique opportunity with a very, very large club in a city that frankly had been underinvested in for a long period of time to pursue something that was pretty novel and to take a club, you know, out of the shadows and into the limelight by investing in the club directly, investing in the club indirectly through an infrastructure project. And candidly, all of that was too compelling given the UK's commitment to high-speed rail infrastructure that would serve the city and specifically our project.
Have you asked for government support for the stadium redevelopment?
So not directly. What we asked for were transport links that actually have been sought by East Birmingham for quite a period of time. So improving infrastructure in a train station at Adderley Park, and more importantly, creating tram lines that would lead from the center of the city out to the neighborhood where we're building our project, which had been underserved and led to, I think, or contributed to the fact that it is a deprived community, you know, one that is in desperate need of investment, desperate need of jobs training, all of which will come as a result of our project. So while we're not asking for any direct government support, that indirect support through transport, I think, will really help make things happen.
Has the government been forthcoming?
Very much so. We began talking to them last fall, and in June, Rachel Reeves was kind enough to visit our stadium and announce a £2.4 billion infrastructure investment into Birmingham and the West Midlands that will really connect the center of the city, our site, the airport. If you couple that with the ongoing investment in HS2, which we're confident will happen, you know, it really creates a site that will be one of the most connected as it relates to stadium and entertainment projects in all of Western Europe.
You think it'll happen, which is news in itself. How quickly do you think it'll happen?
We hope to get planning over the course of the next 12 to 18 months, and then we'll go from there. So I would say that our objective is to have the stadium open in the 30-31 season. We've been pretty adamant in articulating that as our timeline. And I think that lines up well, you know, from the perspective of where all these different elements of the project can come together, both transport, our investment, and then from there, it continues to grow. You know, our site is more than just a stadium. It's a stadium, arena. There'll be a smaller venue for the women's side until we grow fan support enough to put them in the larger stadium. And all of the training grounds for men's first team, women's first team, our academy, and then we've got housing, hotel, and office space as well.
That's quite an offering that you want to put in place. Tom, talk to me about other opportunities in the UK. So also, there's cricket, but there's just much more investment appetite, especially from American capital coming into the UK.
Yeah, I think we've seen, as a result of some of the policy changes, some capital has left the UK, some professionals have left the UK. I would hope that American investors will fill that void. We're beginning to see that with inbound investment into some housing in London specifically. But I think as it relates to the UK as a whole, there's a great opportunity to find ways to put capital to work. We've got 3 or 4 different projects that we're pursuing at the moment in the UK, all of which are very compelling to us, are extremely exciting. And I think it's consistent with our mandate. Sometimes we run to opportunities where others are perhaps looking the other way.
Give me a flavor of what you're looking at.
Yes, so we've got 2, in addition to this project, we've got a real estate development project that we're pursuing in the south, which will be more high-end. That one I think is pretty exciting. We've got a race team investment here. We've got 3 sport investments here, and so three beyond the race team. So, it's a good number of opportunities, and I think one of the things that we find compelling is that there are certain sub-industries here that are world-class. Football, world-class. F1 and other race teams, our endurance racing team at Jota, world-class. And so when you find world-class industries within a particular market, it's a good place to go and look for opportunity.
Tom, do you think American capital or American owners will change, actually, the sports industry in the UK?
Yeah, I think, as is the case with most sport, it's transitioning from family ownership to institutional ownership in many cases. Not entirely, but in many cases you're seeing that. And what's happening with the institutional ownership is there's an increased focus on growing the commercial side of the business and really increasing the inbound connectivity between the B2B connectivity between a sports team and other businesses, and to grow revenues that way, as opposed to simply raising ticket prices or charging more for your pint on match day. And I think that professionalism is something that we'll see continue, and that should bring increased investment, more infrastructure investment, more stadium builds, which will hopefully lead to greater worldwide publicity.
Tom, I speak to a lot of chief executives, and they say it's always their childhood dream or even their now dream to own a football club. What's been your best and worst surprise?
Oh boy, that's a great question. I think the worst moment was April and into May of 2024 as we went through the process of experiencing relegation. And, I'd be foolish to say that wasn't a great learning experience, and a difficult one at that. I think the best part of this is to see just how important the club is to the local community. It's much deeper connection than most other sports because, unlike the U.S. where you've got 4 or more major sports going on at various points in time throughout the year, with football you begin in August. You really begin in July as everyone ramps up for the transfer window and the beginning of training. But season begins in August and runs through May, and it's just part and parcel of people's lives that entire time, and it's extremely important. And what it led us to understand is that we're not the owners of the club, we're the caretakers. The owners are the supporters.
Okay, Tom, thank you so much for joining us. Tom Wagner there, chairman of Birmingham City and co-founder of Knighthead Capital Management. Coming up, a clutch of banks have posted earnings that beat expectations. We'll bring you all the details next, and this is Bloomberg.
Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Mag 7 momentum, Meta and Microsoft surge pre-market, boosting sentiment on a busy day for earnings. Trade surprises, U.S. copper collapses as President Trump exempts refined products from tariffs, while also announcing rates for India and South Korea. Plus, double dissent at the Fed, rates on hold, but 2 committee members voted for a cut. Now, Standard Chartered has announced a fresh $1.3 billion share buyback as the bank reported second quarter earnings that beat expectations. Bill Winters, the chief executive of Standard Chartered, told us the bank is significantly increasing its profits.
This is a bank that's growing its operating earnings in reasonably substantial double digits. We've been growing it at 20 or 25% for some time now in terms of our underlying earnings. And I think that can go for some time, based on the investments that we've been making for years. That should come through to our stock price over time. So I don't get too obsessively focused on the stock price day to day, but of course I'm happier at 1370 or wherever we are, rather than 6 when I used a bad word to describe our share price.
Well, let's bring in Jenny Serrain, who leads our finance team in the UK and the Middle East. Jenny, thank you so much for joining us. So Bill Winters, they're very clearly saying actually every part of the business is booming. What do we know?
Yeah, it's interesting because they really did join in with the rest of Wall Street in terms of benefiting from all the volatility wrought by Donald Trump's trade war. So I think heading into the quarter, there was a lot of questions from investors about, if Donald Trump actually succeeds in, suppressing trade and really winning on this America First agenda, is that going to be bad news for a bank like Standard Chartered that is involved in a lot of cross-border flow? But what we really heard from them today was even if, the U.S. takes a step back and then maybe reduces some of its trading with certain partners, you see all those partners kind of rushing to trade with each other. And so in the end, it seems like it's really still benefiting them. They have a trading business. It's also actually benefited massively from the volatility. Wealthy people are still looking to put their money to work. So this was a solid quarter all around, and they're really firing on all cylinders.
I mean, there are a lot of earnings out there. Crédit Agricole, Société Générale in France, both beating expectations as well.
Yeah, no, absolutely. So it was sort of interesting that you really saw the Europeans coming in strong after the strong showing we saw just a few weeks ago from these U.S. banks. And so I think now the kind of question is this the chance for the Europeans to finally gain share and kind of
remake themselves in the form of a JP Morgan, a Citigroup, a Bank of America. And you see them really putting up a strong fight here. So it's interesting. We've heard a lot from these banks this quarter about as the American banks, as they're working with clients here in Europe, these clients, maybe want to work more with European banks because they don't want to be seen only aligning with U.S. banks. So I think there's lots of tailwinds here for the whole sector.
Is there anything? I mean, I know we're still on M&A watch. The UK, that's a different story for some of the banks. But is there another main takeaway that you're looking at?
I think it was interesting because Bill Winters, in the conversation with us this morning, he did note that a lot of clients are still on hold. So we still haven't quite seen that full resurgence of M&A, that full doubling down on investment that everybody thought we'd see coming into the year. But he still seemed hopeful that there was a chance that would come back. As volatility has subsided, people have a little bit more visibility on these tariffs now. They're feeling better. They want to get back in the game. These banks are excited to kind of take advantage of that.
So interesting. Jenny, thank you so much. Jenny Surrender, who leads our finance team in the UK and the Middle East. Now, Swiss specialty chemicals maker Clariant has reported a better-than-expected second quarter operating profit. The company says despite economic uncertainties, it remains committed to delivering its medium-term targets. Well, joining us now is Conrad Kaiser, the chief executive of Clariant. Thank you so much, Mr. Kaiser, for being with us. Now, we have this deal between the U.S. and the EU, at least 15%, of course, of tariffs. How does it affect your decisions when it comes to investment, but also hiring, pricing, and supply chain management?
Yeah, good morning, Francine. In terms of the trade deal, how it affects us, we have done calculations on our revenue and what it means in terms of total tariffs that we're paying right now. On an annualized basis for the company, that is roughly 25 million euros of impact in terms of tariffs. Now, what we see is the company has a very global footprint with 68 sites globally. In the United States, for example, we make 70% of our sales locally. And for the 30% that we import, we do not have really local competition. So these are unique technologies in our catalyst business, in our additive business. So we're working with our customers to pass on these tariffs ultimately to the U.S. consumer. So on balance of this 25 billion impact on margins, we do not expect that in the EBITDA line because we will offset it through pricing.
So it doesn't look like you have to trim your guidance actually to reflect this new uncertain environment.
Yeah, if you look at our guidance, we maintain our profitability outlook for 17 to 18% EBITDA margins for the year. We have revised down slightly our revenue guide. We were guiding before for a 3 to 5% growth in local currency. Now we said it's going to be a 1 to 3% growth in local currency because there is an impact on our customers. There's clearly a slowing of consumer spending on durable goods. And we saw that already if you look the comparison from quarter one to quarter two. And we will continue to see that in the remainder of the year. We do guide for 1 to 3% growth in local currency. That impacts also and that reflects also above market growth that we can achieve through the two new plants that we will start up in China in November.
I mean, is there a concern that actually some of the, that this hurts demand going forward if there's more uncertainty for a longer period of time? There does seem to be a belief in the markets that, maybe we're over the worst of the uncertainty, but it could come back in a couple of months.
Yeah, what you see, bigger picture is everybody was hoping this year for a shift back in overall GDP from services GDP to a bigger component of industrial GDP. So coming out of COVID, we saw a lot of spending, restaurants, vacations. GDP hold up well, but it was primarily spending on services. What we were actually expecting at the beginning of the year is this switch back to durable goods spending. That is actually delayed now. Durable goods, consumer goods are and will be impacted by tariffs. So there is actually a delayed recovery in this switch back in GDP to industrial GDP, which is in the end what the chemical industry needs.
Okay. Does it mean, is there anything that you have to change in terms of, the structure to simplify it, or do you have to give more back to shareholders in this kind of environment?
Yeah, we are pleased that what we show with our guidance of 17 to 18% EBITDA for the year, this reflects a strong improvement in profitability this year in a low or no growth environment. As a reminder, last year we had a full year EBITDA margin of 16%. In 2023, we had a full year EBITDA margin of 14.6%. So we basically saw 3 years of consecutive strong improvement in profitability, but it was very much driven by self-help. This is very much the cost out program that we finished in the first half, which took a total of 175 million Swiss francs out of our cost base. And that is actually a structural improvement that positions the company well to maintain high profitability levels, even step them up further in a low or no growth environment.
How are you dealing with currencies? How much do you have to hedge given the fluctuations and, again, the uncertainties?
In terms of currencies, we also benefit here from our global footprint, where basically 68 sites we produce typically in a region for a region, also based on local raw materials. So there is not a significant transaction impact from currency devaluation. But what we are seeing in the top line, but this is a translation effect, we report in Swiss francs. We are seeing an 8% effect from the strengthening of the Swiss franc. But again, on our EBITDA margins, this has virtually no impact because we have typically our cost base in the countries where we are supplying.
Is there anything else that you worry about going forward? For example, if you look at your catalyst business, what does that need? Are you seeing any turnaround? And when are you hoping to see the fruits of your work?
Yeah, the catalyst business, Francine, is very much linked to the chemical industry overall. What you see here is that we are bottoming out, but operating rates are still at a relatively low level. So if you look at the capacity utilization rates of plants in Europe, it is basically around 75% right now. You look at the United States, it's around 80%, and in China, it is a very mixed picture. These are historically low operating rates, and we see the impact of that in our catalyst business. The outlook for the year for our catalyst business is basically flat revenue growth. We think we are bottoming out, but it is a challenging environment in catalysts right now. Therefore, also in catalysts, we were very pleased with the step up in profitability, despite some of the revenue headwinds, where now we are achieving a 22-23% EBITDA margin in the second quarter. Really also the effect of margin management, but also the effect of a structural lower cost base.
Are you committed to the catalyst business, or could you sell it off?
We are very committed to all of our businesses. They actually, right now, if you look at our numbers, all three of the business units are doing very well. And it is actually in catalyst where we have unique technology also that positions us very well for the green hydrogen economy. So we supply the catalysts that basically enable green ammonia, basically climate neutral shipping, when you replace bunker fuel with green ammonia. We are well positioned for the sustainability trends. And with our catalyst business, day in, day out, we lower the carbon footprint of our customers by enabling chemical processes at lower temperatures, at higher yields. So it also very much fits the purpose of our company, which is greater chemistry between people and planet. It's all about sustainability-driven growth.
Conrad, thank you for joining us. Conrad Kaiser there, the Chief Executive of Clariant. Now, on to another industry, Renault, having reported an operating margin for the first time, or for the first half of the year, that missed the average estimate. Now, analysts are now expecting a better second half as the French automaker appointed a company veteran as Chief Executive. Well, Bloomberg's Craig Trudell is with us. First of all, Craig, I mean, Luca de Meo didn't leave this in a great shape because there was quite a lot of, it was a difficult set of results.
Yeah, I think maybe this was a good time for him to look for the exits, in the sense that I think we should give him credit. He managed to turn this company from, I think in his words, he referred to this company as being in hell when he started out, to, on much more solid footing. And yet, in the first half of this year, you did start to see some real slack in the performance. And I think it was only going to get more difficult, and is only going to get, sort of tougher sledding for European manufacturers in their home market, given the success that the Chinese manufacturers in particular are really starting to have serious traction, not just in the EV market, but as we've seen tariffs hit electric vehicles from the Chinese, some sort of, moving around those and offering up hybrids and even just out-and-out combustion cars that are gaining traction and squeezing the likes of Renault.
So the newly appointed chief executive definitely has his work cut out for him. I mean, he's a company man, so he's not an outsider. Like, what should be on his priority list?
Yeah, not quite a lifer, but a long timer, more than 20 years with the company. And knows sort of how to run the trains here. Was, I think, instrumental in forming a partnership with Geely that was quite interesting under DeMeo, where you heard DeMeo in the last year or so referred to that being sort of the new Renault-Nissan alliance, that Renault-Geely may be the sort of partnership that replaces that. I think his experience with that and with China operations and the China industry will be something really, for us to watch in terms of how much he's able to leverage that lower cost base in China to make Renault more competitive here.
Craig, BMW, what did we find out?
I think, this was a case of yet another company really squeezed by tariffs. You would think that they would maybe be somewhat better positioned than some of their peers, given the fact that their biggest plant in the world is in Spartanburg, South Carolina. And yet, I think this is something that we saw earlier this week as well with Stellantis, which has a fair number of U.S. plants. Even if you have a serious presence in the U.S., that plant needs parts from outside of the U.S. And so even that operation is being squeezed, and there's sort of nowhere to hide if you're in the auto industry from these tariffs.
Craig, thank you so much. You're my Musk guy. We speak about Elon Musk. I can't believe we're here talking about BMW and Renault. We'll have to get you back on to know what's happening with Tesla. Craig Trudell there, our global car czar. Now, from autos to aviation, and Airbus has reported a bigger than expected cash outflow as a shortage of engines hampered its ability to deliver aircraft. Now, the chief executive, Guillaume Faury, told us Airbus hopes to get deliveries back on track.
We have 60 aircraft sitting on the ground, fully finished, but with engines missing. We call them gliders. So if you look at what we've been able to produce, including the gliders, actually we are mostly on track with what we expected to do in the first half. So we count on engine makers, namely CFM and to a smaller extent Pratt, to recover on their engine deliveries to Airbus, so we can be back on track with a number of deliveries.
Meanwhile, Lufthansa says second quarter earnings rose by a third and reiterated its full-year targets. Now, earnings growth was driven by strong demand on transatlantic routes and lower oil prices. Air France-KLM also reported higher second quarter earnings as a revamped business and first-class product boosted yields. And Tata Steel has reported first quarter net income that beat estimates. The CEO says the Indian steelmaker is planning to explore alternative markets due to rising tariff risks. Well, TV Narendran spoke exclusively to Bloomberg.
So you would mitigate by looking at other products which are similarly profitable and other markets, whether in Europe or elsewhere. For instance, the Middle East is a growing market for some of these steels, so we're looking at Middle East. We're looking at Latin America as a market. So we're looking at other markets where there is a requirement for these high-end steels and where we are not impacted by these kind of tariffs.
TV Narendran also spoke about the impact of Chinese overcapacity on the global steel industry.
China was exporting more than 100 million tons of steel, and last year and this year as well, China's been exporting at the rate of 100 million tons of steel and more. That's a matter of concern because, steel industry is a global industry. A lot of steel flows across borders. Our concern is if the Chinese industry is not making much money but still exporting steel, that depresses the profitability of steel companies globally.
Well, that was the Tata Steel Chief Executive and Managing Director, TV Narendran. Coming up, pre-tax profits at the Weir Group rise 10% year-on-year as the engineering company reports positive results. Well, the Chief Executive, John Stanton, joins me next, and this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Now, UK engineering company The Weir Group has reported adjusted pre-tax profits up 10% in the first half, ahead of average estimates. Joining us now, John Stanton, Chief Executive of The Weir Group. John, thank you so much, as always, for giving us a little bit of your time. So I have to ask about tariffs because, it's a day before the deadline, August 1st. That's tomorrow. How has the tariff uncertainty, first of all, impacted your decisions for investment, but also your pipeline and orders?
Yeah, well, good morning, Francine. Thanks for having me. Yeah, so it's been a complex 6 months in terms of having to deal with the tariff situation. Philosophically, we've approached it to say, first of all, we want to try and pass as little on to our customers as possible and use our capability to avoid doing that, but also to protect our margins. And we have the benefit of having a sort of global manufacturing footprint that's kind of regionally distributed. So we've been able to play lots of tunes across our network and supply chain to actually avoid things that we previously imported into the US and therefore the tariffs, and move them into other parts of the world in terms of where we're exporting to. So we did a lot of work through our network to enable that, which meant that we've avoided a lot of tariffs. And then, the little bit of product that we had to bring into the US from China and Canada, then we have passed on price increases to our customers. But given all of the work that we've done to try and mitigate that for them, that's been an okay conversation in the circumstances. So I think in terms of those philosophical objectives, we've delivered on both of them for our customers, and in terms of completely mitigating the effects for our profitability as well.
John, do you see any customers actually being hesitant? Because there's a lot, if you look at commodity prices, it's booming. You have quite a lot of demand for it. But are there any, customers saying, well, let's wait and see, because they look at geopolitics and they're not quite sure what happens next?
Yeah, I mean, there's a little bit of that going on at the moment, but I think, the mining industry that we serve and that we have to be prepared to serve, it thinks really long term. So while there's kind of volatility in the world today and, movements in commodity prices, our customers are really thinking long term and making plans based on that. And therefore, I think even though there's been some uncertainty, it's been minimal. We're certainly moving ahead with our investment plans. If you take copper, for example, that's going to be a big growth driver for the mining industry, for the Weir Group over many, many years ahead. So we need to be ready now to take advantage of that. And I think there are actually some really encouraging signs in terms of government policy responses in the US, places like Chile, to say actually we need to free up some of the licensing, permitting, maybe the capital constraints that have meant that projects haven't been pushed forward very quickly, and that's improving.
Well, John, I mean, if you look at copper, I feel like all hell broke loose yesterday, and it was down, quite significantly in the U.S. because what we thought would happen on tariffs actually didn't happen because part of them was exempt.
Yeah.
So again, between having a pipeline of customers and then orders, does that take longer?
No, I mean, again, I'm not really bothered about short-term volatility. When you look at copper prices today, they're still well above the average cost to produce, and they're in line with sort of long-term incentive levels. So you're going to see this volatility probably with tariffs, and Western countries like the US figuring out how they're going to enable more supply of critical minerals within their own domestic production capacity and capability. So there's going to be uncertainty. There's people kind of making strategic moves. But the long run, I think it's really just short-term volatility. The long-run outlook for copper and many other commodities is really, really positive.
You mentioned copper. What about gold? Is there more, mining demand for gold, and is there anything else? I don't know whether lithium's on the rise.
Yeah, no, gold is clearly very positive at the moment for obvious reasons. So our customers who are the pure play gold miners are very busy, working really hard to try and increase production and productivity across their existing mines. So that's a really, really active space for us at the moment. Iron ore's been a little bit weaker, but then again, the high-grade iron ores, which are necessary for the energy transition, are moving ahead quite nicely. And then, when you look at the battery metals, we have been through a little bit of a correction over the last few months. Nickel in particular has been one that's been quite challenging. But given the global nature of our business, we kind of lose in countries like Australia, where they've been closing mines, but we're winning in Indonesia, where Chinese-funded expansion is still going ahead. So it's a bit of a wash for us. And that's the beauty of our business, being so diversified across commodities and across countries around the world.
I mean, have you seen any of your clients having to diversify some of the trade routes, or because it's so much, it takes so long actually for the mining to happen, it hasn't really affected your industry too much?
No, not really. The other good thing that's happening at the moment is that it has taken a long time for some of the big expansions and greenfield projects to come through. As I said, there's been some government response to that, which is quite encouraging. In the meantime, all the brownfield, all the existing mines around the world are just running really hard to try and keep up with production and demand. So we kind of win-win either way. We'd love some big new projects and expansions to come through, but if they don't, we're very happy delivering on the momentum that our current customers have in the mines around the world as they seek to expand production.
I mean, you're in a good place, but so what are you most excited about for the next 12 months, and what are you most worried about in the next 12 months?
I'm not worried about too much, because I think for Weir today, a lot of our future is in our hands. We feel really in control of the situation. The long run potential of the business is really, really exciting. And what's been great in the first half of this year is that, alongside strong results, we've really been able to deliver some significant strategic progress. We bought a big software company. We made some investment in technology. We're buying a manufacturing business in the US, which actually will give us more flexibility as it comes to tariffs and so on. So I think the strategic progress that we've made in the first half on top of the trading performance has been phenomenal. And I think you're going to see Weir do more of that over the next few years. We've got a strong balance sheet, and we'll be reinvesting in the business. Yeah, that's the plan.
More acquisitions in the US, or is it all in play depending on geopolitics?
We're focused on software and digital, product extensions, geographic expansion. So those are the three focus areas for us. We did one of each in the first half of the year, which was really nice. But we've got a good sort of playbook of assets that we'd like to have within our portfolio. So we'll be focusing on them as we move forward.
All right, John, thank you so much for coming on, as always. John Stanton, the chief executive there of the Weir Group. Now, we are looking at a lot of earnings. I have to say, it feels like it's a busy day also because of the added layer of tariffs. We were talking about copper with John, and look, the copper market really reeling from its biggest shock yet after Donald Trump imposed 50% tariffs on copper imports, but exempted refined metals. So the move triggered a record plunge for U.S. prices. Copper futures on COMEX in New York falling by more than 22%, and a large premium from New York futures over London seemed to be evaporating. We talked to analysts at Goldman Sachs this morning saying they were surprised by the exemption, but added that they do not see it changing market fundamentals and don't expect large-scale re-exports from the U.S. Up next, Bloomberg Brief, and this is Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
I think people are paying attention now to what we're doing in a way that wasn't happening 5 years ago. I think the convergence, not just of the hardware investments, but the AI investments in particular, have been the real watershed for us in helping people understand why we've always believed having these devices be wearable and having sensors and having context in the world around you has been so important. And it's like, oh yeah, of course, now that you realize there's going to be a potentially super intelligent assistant that's operating there, you want it to have, for free, all the context on what you've heard, what you've seen, what you're doing, so it can help you the most out as you go about your day and try to accomplish what you're trying to accomplish. So we feel a lot of vindication on that. I think the question is, yeah, will it be us? Will it be a competitor? That depends on our execution and their execution. I have a lot of confidence that the paradigm that we're in right now, which has been stable for a long time, right? The phone that you all have in your pockets now is roughly the same as the phone you had in your pocket 4 or 5 years ago. There's not really a lot of new innovation happening at that scale. There is a lot of things. The phone is the greatest consumer electronic device ever built, and yet there's also a lot of things that we wish it could do better or different. And I think with AI and integrated context with the world around us, that becomes more and more obvious. So I'm very confident that the paradigm will shift in that time frame. And you all know the saying, we get a lot less done in 1 year than we think and a lot more done in a decade. That really is going to be true, I think, when it comes to these shifts.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
It's 5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Thursday. The Fed stays put. Investors pare back rate expectations for cuts as Chair Powell stays on guard against inflation. A rush for deals and demands. The U.S. sets its tariff rate with South Korea and India on the eve of the August 1st deadline. And get ready for the busiest day of earnings this season. Apple and Amazon are on deck after blowout results from Meta and Microsoft. And it was those blowout results that are guiding futures higher this morning. Up 1% for the S&P. For the NASDAQ, it's more than 1.3%. You can see what happens when you don't have the big tech in the indexes. It's what the Russell is doing, down 0.1%. Yesterday, we declined into the close after that Powell decision where he was more hawkish, 2 days of declines. Again, we reversed that. Also, a lot of tariff headlines to deal with this morning, but that's not what we're trading on. For the bond market, it is a rebound after yesterday's decline. So we are looking at bond yields moving lower this morning. Yesterday, we saw two-year yields rise the most in 6 weeks with a Powell who didn't really incorporate those two dissents into his view. In fact, he was more hawkish to the point where he said, hey, you could argue we're looking through tariffs as one-off by not hiking. So that's where we're at. September odds of a rate cut go to 50-50. Let's get some moves underneath the surface, including some of those big tech names. With that is Valerie Teitel. Hey, Val.
Hey, Danny, let's start there with Meta and Microsoft out with some decent beats when it comes to revenue and some strong guidance from both of these names. Investors are viewing this extra CapEx spending they're talking about as worth it, given their core businesses are performing so well. Meta narrowed its CapEx guidance to the top end of the range, and Microsoft, the CFO, saying that the current quarter CapEx is running around $30 billion. Investors are still cheering all this extra CapEx spending. It's not just impacting these stocks, but the broader tech stocks today. I know you noted the move in the NASDAQ futures overnight, but take a look at Amazon and NVIDIA. These stocks also getting a boost from this extra CapEx spending. Amazon up over 3%, NVIDIA over 2%. And this is despite, Danny, this is despite China calling on some of the NVIDIA CEO, NVIDIA executives to explain some H20 chip security issues. So NVIDIA rallying even with those negative news when it comes to China security. There is one stock that is sticking out like a sore thumb amidst all this tech optimism, and that is Qualcomm. Those shares are in the red so far this morning in the pre-market trade, down over 5%. Qualcomm is one of the main suppliers to Apple. It's highly leveraged to the smartphone market, which is still showing a sluggish turnaround. Danny.
Valerie, a fantastic wrap-up. We'll catch up with you later in the hour to see how those moves evolve. Also in this hour, in just moments, Jane Foley of Rabobank will be joining us on the dollar strength. Later this hour, Evercore's Julian Emanuel will be here with me as a guest host for the back half hour in New York around the desk. Back to the Fed, though, one of our top stories. Chair Powell bucks the pressure from President Trump and holds rates steady.
Despite elevated uncertainty, the economy is in a solid position. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation could be short-lived, reflecting a one-time shift in the price level. You could argue we are a bit looking through goods inflation by not raising rates. You know, we haven't reacted to new inflation. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the other information we get.
So you can see the hawkishness from Chair Powell there, and a combination of that, higher yields, a solid GDP print yesterday, sent the Bloomberg dollar spot to its highest level since May. Now the dollar is on course for its best week since 2022. Joining me now to discuss is Jane Foley, head of FX strategy at Rabobank. Jane, does this mean that there is a revival of U.S. exceptionalism, that the dollar is back in vogue and the weakening trend is broken?
Well, you know, it's really quite interesting because if we look at US equity markets since June, then we could be talking about that then. So, for instance, in the equity markets, you could say, well, look, this rotation trade away from US assets, which really characterized trading in the first 5 months of the year, was over. And yet the dollar in June and then actually beginning of July mostly was on the back foot. There was an attempt at a dollar revival at the beginning of July when that payrolls data came in firmer. But the dollar, I think, has been lagging this end of rotation trade. Stock markets really picked up a bid. The dollar didn't, perhaps because the market was anticipating a more dovish Fed. But I think we needed this washout in positioning. I think the market had become too long dollar at the start of the year. This rotation trade certainly caught up and characterized all US assets, but whereas the stock market began to recover, a month ago, more than a month ago, the dollar did not. And so I think this is what we've just seen this week, is this washout of positioning and this recognition that the US economy hasn't been as hard hit as we all thought it could be back in April.
Well, part of the trade, at least yesterday, Jane, was indeed a Powell who didn't even really lay out what the dovish conditions would be for them to be able to cut in September. We heard it there. He really just didn't even want to get into it. So it was a dollar that was driven by rates, by rate differentials. Jane, it's something we really haven't seen this year. It had been the rotation trade, the revival of Europe. Are rates back in the driver's seat? Is Fed policy back in the driver's seat for where dollar goes from here?
Well, if it is, then we could see, again, a weaker dollar in 2026 because, what happens come May when we get a different Fed chair? What if the Fed's Powell steps down from his role as governor? What if we get 2 new seats opening up on the board of the FOMC next year and a much more dovish committee? Now, if that is the case, then we can still be looking at a weaker dollar again next year. But I do think we also have to examine what's been going on the euro side of the euro-dollar equation, because I think really since March we've seen a very strong performance of the euro, and I think we all recognize that that was very much a recognition of the change in Germany's debt brake, the expectation that would unleash a big round of growth, not just in Germany, but potentially in that whole European region. And I think what we've seen, perhaps on the back of the EU-US trade deal, is this dose of reality, this recognition recognition that things are still going to be hard for a number of German exporters. Yes, they've got these 15% tariffs on the US. They still have relatively high labor costs and energy costs and labor constraints in some instances too. And if they had a stronger euro, well, that's just another hurdle. So I think there's been a dose of reality. The growth in Germany this year is widely forecast to still be really very low. And some of that growth that should result from this stimulus may not really be reflected in the data till next year.
So it's pressure for both euro and the dollar. And Jane, you laid out there an argument of things bringing clarity for both the euro side and the dollar side next year. The dollar, of course, being a more dovish Fed chair that it cuts and more dovish members on the committee. Jane, what about until then? What is your read on whether September we will get something of a cut? We've moved below 50-50 odds. It was a Powell who didn't want to get into it. If they need the data clarity in order to cut in September, will we really get that in time?
Well, we certainly perhaps be a little bit better informed when we see that payrolls data tomorrow, but also we need to see more inflation data. And I think what's going to be really pivotal on the argument as to whether or not the Fed can ease in September is whether or not there's more weight on the argument about whether the inflation impact of tariffs is going to be transient or not. And there's a number of economists who suggest, yes, it will be transient, it'll be a one-off impact, the Fed can move through that. And that argument certainly has been strengthened by the fact that the tariffs won't be as strong as we thought they could be in April. But on the other hand, there is still the risk that we could get secondary implications. And that, to some extent, depends on how tight the labor market is. If the labor market loosening, it doesn't really happen much. Then the workers probably have a little more power to negotiate higher wages if their cost of living goes up. So there are still a number of factors up in the air, and we do need more data. But of course, you could argue that by September, we still won't be entirely sure whether or not that the inflation impact will be significant or transient from the tariffs.
What happens, though, Jane, with all of that, if you have tech companies spending tens of billions building out AI infrastructure? What does that do to a U.S. economy? What does that do to the Fed's ability to cut if there are pockets of weakness, but just incredible spending still ongoing from these companies?
Well, precisely. I think if we do get a lot of investment in the U.S., if we do get this capex, if we do get continued high productivity growth in the U.S., this all stands to show that the U.S. economy is in really good shape. But of course, the more productivity growth we have, then you could argue, well, that means there's not going to be so much of an inflationary impact, and therefore the Fed could potentially still cut interest rates. So all of these things, all feed into what policymakers are thinking. And this is why they're always arguing that they are data dependent and they need to see more data before making those really important policy decisions.
So the cross currents and the muddle continues on. Jane, thank you so much for joining us this morning. Jane Foley of Rabobank. Now let's get you some other top stories that are trending on the terminal this morning. A Delta Airlines jet made an emergency landing in Minneapolis. It injured at least 24 people due to the severe turbulence. Delta Flight 56 was less than an hour into the 9-hour flight from Salt Lake City to Amsterdam when pilots met with challenging conditions were forced to make that emergency landing, that according to a statement from Delta. The Bank of Japan's governor has cooled expectations of a near-term rate hike after deciding to hold rates steady. Kazuo Ueda said that the bank wasn't in danger of falling behind the curve on inflation, even after boosting its median inflation projection from 2.2% to 2.7%. And Russia has defied President Trump's push for peace with Ukraine by attacking Kyiv with a barrage of drones and missiles overnight. The bombardment lasted for several hours, killing at least 6 people, including a child, and injuring more than 50, all of that according to the Kyiv city military. Coming up on the show, more tariff surprises. Copper traders get a huge shock the day before the deadline. We'll show you the wild swings in the copper market and more on the tariffs. That's coming up on your brief.
the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. It's Jobs Day, and Bloomberg has the report under surveillance.
It is definitely a stagnant market.
Everybody's looking for a slowdown in job creation.
You're seeing a tightening in parts of the labor market.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
Jobless claims have just hung in there.
This is a hot report. It's definitely going to be taken with notice and optimism from this administration.
The July Jobs Report, Friday on Bloomberg.
Korea, as you know well, has always been very challenging on trade for the United States. We've had an agreement with them in past years, but our trade deficit with Korea has continued to be extensive. However, President Trump has raised the natural leverage of the U.S. market to really obtain some significant concessions from the Koreans.
Just a day away from President Trump's tariff deadline, the self-imposed one, and he announced the latest deal with Seoul on Truth Social, writing, quote, South Korea will be completely open to trade with the United States. We have agreed to a tariff for South Korea of 15%. America will not be charged a tariff. Joining us now is Bloomberg's Brendan Murray. Brendan, it was a lot more than South Korea, but let's just start there. And it's another 15% deal. Does this seem to be the floor barring the UK, but 15%? Is this likely what we're going to see for more countries as we move forward towards tomorrow's deadline?
Yeah, exactly. Somewhere between 15 and 20% looks like the new baseline across the world. It was very important for South Korea to get this deal done, given that it basically got the same agreement that Japan did. A big rival in autos and electronics and steel. So the fact that they could get this done before Friday means we provided some relief to South Korean officials who were facing higher tariffs and potentially a disadvantage against one of their chief rivals in Asia. So we're expecting another busy day at the White House today with more executive orders, perhaps more deals in the last few hours before the deadline. But it's definitely, we're starting to see how President Trump is reshaping the global trading system country by country and industry by industry.
Well, there's some of these tariffs that were reached by agreement, be it the EU or South Korea, Brendan. And then there are others that Trump just declared the rate. India is one of them, a 25% tariff. How much of a shock was it for the nation, and how have they responded thus far?
India was one of the countries that President Trump said early on were progressing well and toward a deal. That was a couple of months ago, but India has a reputation of being a very difficult trade negotiator, and that is proven to be what's played out in the talks with Washington this time. Now, President Trump says they'll continue to talk, so it's not as if that 25% tariff that India is getting is set in concrete over the long term. So there could be more discussions heading into the months ahead for India to try to get that rate down. But in the meantime, yeah, it did come as a surprise that the president couldn't get that one over the line.
Brendan, just a minute here, but can we just take a bigger step back? A lot of these deals are being pushed through, again, with 24 hours to go until the deadline. How do we judge the quality of these deals, the meat of them, how much substance there is to them, and how much really more is going to need to be worked out throughout the remainder of the year and beyond?
Yeah, there's a lot of fine print we still need to see, and about whether these are actually legally binding, whether the commitments made. South Korea had another one of these investment funds like Japan did, whether they're actually realistic in terms of the size of the purchases that the countries are pledging to make. Remember, President Trump had a phase 1 trade deal in his first term, and that went nowhere after he left office. So whether these, are sort of the new paradigm of global trade, or just, deals written on a piece of paper that, don't have any lasting effect, is something we still have to wait for the fine print to understand.
And wait, we will. Brendan, thank you very much for that. Bloomberg's Brendan Murray will also catch up with you later in the hour. Now, the tariff surprises didn't just stop there. President Trump also slapped 50% tariffs on copper imports, but he exempted refined metals. You can see the huge plunge that had in U.S. traded copper, down 22% in the 2 days, about 20% just yesterday. Joining us now is Bloomberg's Martin Ritchie. Martin, how did this all unfold?
Well, as you said, this is another big surprise for the copper market after a year of big surprises and quite a lot of volatility. The copper tariffs have been signaled well in advance since at least February, but for a long time the kind of market expectation was for a 25% tariff. Then earlier this month, Trump, in off-the-cuff remarks, said it was going to be 50%. But very few other details were given. And even right up until, less than 24 hours ago, we didn't know what products were going to be covered. We didn't know if there were going to be any exemptions at all for any countries or producers. So when the proclamation finally comes out and it excludes what's called refined copper, the stuff that's really traded on the international exchanges, this comes as a major surprise. It was well short of expectations for what the tariffs would cover. Copper futures in New York went down by more than 20%. The prices went back into parity with the London Metal Exchange. A little bit of an earthquake in the copper market this morning after that announcement.
Martin, what is your understanding and why even have this exemption? Something that Trump, again, he had talked about copper, but never brought this up before.
Yeah, sure. It speaks to actually the kind of complexity and challenges involved in his campaign to bring back metals manufacturing to the U.S. Tariffs on steel and aluminum are one thing because the U.S. has a substantial amount of supply of its own. Copper is something different. It's very dependent on imports. So to try and put in tariffs was always going to be a challenge, especially if you raise them up to 50%. So I think if you were going to be as generous as possible to the administration about the sort of delay and the last minute nature of this, it's like this is a very complex market to sort of work out what to do. And what they've done is they've put a stay on the tariffs on refined copper. Instead, there will be duties on more downstream products. That's like cables, wires, tubing, and whatnot. And there will still be consideration of tariffs starting 2 years from now. So it looks like we'll be coming back to this subject, a year or two from now.
Well, hey, Martin, we will definitely have you on before a year or two from now. So much going on here. Martin, thank you so much for joining us. Martin Ritchie there. By the way, we'll be catching up with Julian Emanuel shortly, who points to the decline in copper prices and its bleed through to other systematic and VAR-affected assets. But first, coming up, we're going to take a look at what else is making headlines in your front page news. That includes the easing of ties between the president and Jamie Dimon. That's coming up next. This is Bloomberg.
applications have been received positively both in Kenya and UAE, and we are optimistic that we should be able to open the office in the fourth quarter. We think the Middle East have deep capital sources. It has strong logistics for trade, and it is a strong center for investment. And we are seeing increasingly the global GDP is increasingly becoming overweight in Asia and Middle East. So that linkage with the middle income segments growing in India and China will provide a very strong market.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
You're watching Bloomberg Brief. I'm Danny Berger in New York. Let's take a look at the front pages this morning. First up, the New York Times reporting that the White House has followed through on its threat to hit Brazil with a 50% tariff. The rate is the highest actually imposed by Trump this year and comes after the Times interview with President Lula, who struck a defiant tone in face of those levies. Next up, the Wall Street Journal reporting that Jamie Dimon and Donald Trump are talking again. The JP Morgan CEO has visited the White House twice in the past 2 months after a rift that lasted years. Last week, Dimon discussed the economy, trade, regulation with Trump. According to sources, Secretary Bessent and Lutnick were also at the meeting. Finally, you can read this on the Bloomberg terminal. China summoning NVIDIA over security of H20 chips just days after the latest talks with the U.S. concluded. Chinese authorities have asked the chip maker to provide documents relating to serious vulnerabilities just weeks after CEO Jensen Huang met with senior officials in Beijing. Coming up, more on the tariff impact and tech earnings. Julian Emanuel will be joining us for the next half hour. Stay with us on your brief.
Number of games overseas in recent years, and in fact, you opened the season going to the opening game in Brazil. So do you expect to do more overseas games, and is that a part of your strategy?
It is. We had 5 last year. We expect to have 8 this year, which will be the highest we've ever had. Our hope would be at some stage to get to 16 games in the next few years. We think we could do that. I think it's an indication of the popularity of our game. Every time we take our game to a new market, Brazil's a great example of it, the fans go crazy for it. They sold out the tickets in less than 90 minutes. People had a wonderful time. It was the talk of the town. And I think it will be the basis and the sort of the match that lights the excitement
and the popularity of the game in that market, as well as what we're doing around the world. So we're very excited by it. It's just one element of that strategy. You need to have television, you need to have activity and participation in the sport, and flag football is a big part of that. So all of those factors, I think, are going to be what we think will be a very successful formula to be a global sport.
Do you ever envision having a team that's based overseas in Mexico City or in London?
Listen, we've talked an awful lot about it, and I think there are markets that could, without question, support an NFL franchise.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know this morning. The Fed stays put. Investors pare back rate cut expectations as Powell stays on guard against inflation. A rush for deals and demands. The U.S. sets its tariff rate with South Korea and India on the eve of the August 1st deadline. And get ready, the busiest day of earnings this season. Apple and Amazon on deck after blowout results from Meta and Microsoft. And that is what's guiding equity markets higher today. Yesterday was about a hawkish tone from Powell that sent the S&P to its second consecutive days of declines. It looks like we'll reverse that today with the NASDAQ outperforming thanks to Meta and Microsoft and the tens of billions that they will be spending in capital expenditures. We also have to digest some tariff deadlines, some tariff headlines as well. But for now, it was Powell that seemed to be moving markets, at least bond markets yesterday, with the two-year yield hitting its highest level in a couple months. You see it reversing this morning, down about a basis point for the two-year yield. 10-year yield goes down a basis point as well. Let's get some stocks moving in the pre-market now. With that is Valerie Teitel. Hey, Val.
Good morning, Danny. Let's start with the big tech. Meta and Microsoft out with some decent beats when it came to revenue. Both of their core businesses holding up decently well, and investors are cheering the extra CapEx guidance on top of it, saying it is worth it given how well the core businesses are doing. For Meta, they revised their CapEx guidance for the full year to the top end of the range, and Microsoft, the CFO, saying the current quarter CapEx is running around $30 billion, a record for the company. If this isn't enough green on the screen for you, Danny, I have two more. One of them is eBay, a sales surge leading that stock to jump in the pre-market, up 13.5% for eBay. This comes also on the back of some optimistic guidance. They're seeing the consumer as resilient and maybe some consumer patterns changing, Danny. They're seeing a lot more consumers trade down to used and refurbished goods. Maybe that's a way that these consumers are navigating price increases or anticipated price increases from tariffs. Lastly, let's end on Carvana. A bit of the same theme here. The used car reseller seeing a record amount of used car sales in the previous quarter, 41% gain, and they're able to keep up inventory off the back of that. So those Carvana shares up some 16% in pre-market trade, putting those short sellers into doubt. Danny.
Valerie, thank you very much for that wrap-up. Excellent work this morning. Now let's get back to one of our top stories. Washington and Seoul strike a deal.
Korea, as you know well, has always been very challenging on trade for the United States. We've had an agreement with them in past years, but our trade deficit with Korea has continued to be extensive. However, President Trump has raised the natural leverage of the U.S. market to really obtain some significant concessions from the Koreans.
The U.S. sets a 15% tariff on imports from South Korea, plus major investment in key American sectors. President Trump writing on Truth Social, quote, South Korea will give the United States $350 billion for investments owned and controlled by the U.S. Additionally, South Korea will purchase $100 billion of LNG or other energy products. Joining us now is Bloomberg's Brendan Murray, who's back with us. And Brendan, this also mirroring what we got from the EU of pledged investments there. Let's just talk about the investments for a moment. They are pledged investments. What is the likelihood that they come to fruition? How difficult will it be for nations to actually achieve this?
Yeah, so that $100 billion in LNG purchases by South Korea, for instance, isn't really much more than they already purchased. So I think the important thing to remember here is the net figure that's different from what they're already doing. The figure from the European Union was also in the hundreds of billions of dollars, and it looks unrealistic, their energy purchases, to even to have the capacity to purchase the kind of energy that they've agreed to purchase. So a lot of these deals are coming in with these big numbers, and they're impressive. And Trump could now say, it's in the trillions of dollars, the amount of money that's being pledged. But the real test of this and whether it leads to actual investment in the U.S. are going to take years to play out. And we're still on watch for more of these to come across today ahead of the deadline. So we're expecting another busy day of executive orders and other kinds of things coming from the White House.
I hope you had enough sleep in 2024 to carry you through to 2025, because obviously that's not happening anytime soon, Brendan. There are deals like that of South Korea that have been reached by agreements, and then there's other shockers. India, 25% tariff was a shock. All of a sudden, this change in copper, a 50% tariff, which he had hinted at, but a exemption for refined copper that sent prices plunging. Brendan, what is the difference and what is driving between nations and various sectors that get an agreement versus ones that get a surprise tariff rate?
Yeah, definitely. India is emerging as the biggest loser in Asia so far with that 25% tariff, and then the surprise from the copper tariffs is the kind of thing that we could see again today and going forward. President Trump made clear that things are coming out tomorrow. These tariff rates are going higher, but these discussions are going to continue on. He wants to further negotiate with India and see if they can reach some sort of better deal for both sides. But I think the bottom line is this patchwork of tariffs on countries and products that we're seeing being rolled out. It's going to be difficult to distill down what it actually means for the U.S. and global economies until we see it all on the table and it all gets implemented, which so far, we're not even at that stage. We're at the beginning of this rather than the end.
Brendan, thank you so much for this morning. I'm sure we'll talk again tomorrow. Bloomberg's Brendan Murray there. Now, Evercore's Julian Emanuel weighing in on the surprise on copper, that exemption, writing, quote, lifting the copper tariff caused a price plunge of 19% in minutes that quickly spread to other VAR-affected systematic trader instruments. These dislocations still leave us tactically cautious as asset price volatility in general is too cheap coming into the seasonally challenged August-September timeframe. He's Senior Managing Director of Equity Derivatives and Quantitative Strategy and joins me for the next half hour. Julian, thank you so much. Great to see you this morning.
Good morning.
This is really interesting, and by the way, I'm sure you're not sleeping either these days, so thank you especially for joining us early. This is really interesting because the price plunge in things like S&P futures, the euro-dollar move also happened at the time of the Powell presser. Are you saying that some of the volatility caused by the surprise in copper was more of a driver yesterday?
Yeah, if you look at it, so the announcement around copper basically came out when the Fed's announcement was released prior to the Powell presser. So it started before 2:30. And really, the damage in the copper market was essentially over by the time Powell started talking. But what happens is in an environment like this, where volatility across assets has been squeezed so low, and rightly so, given the strength of the rebound off of the April lows, but there's been this sort of systematic feeding where position sizes have been getting bigger and bigger, and you get to a point where things get a little stretched, and obviously you have a dislocation like what you saw in copper, and it just quickly spread. It spread into the currency markets, it spread into Bitcoin, gold, and then ultimately again in the S&P 500, but that was addressed after the close when we got the AI results.
Right, exactly. This is the thing. It rebounds really steadily this morning because of the AI results. So if we're headed into a period of dislocation, more volatility, should you do anything about it if there are other factors in the economy and earnings that can just turn around and lift things right back up?
Well, and it's funny because investors tend to believe that when the markets are trading as well as they are, that it's an easy time to invest. In a lot of ways, it's much more difficult because valuations are high, volatility is low, and we know that's not sustainable particularly coming into August and September. We always know September is challenging. Essentially, our view is you sort of stay with the AI theme. It's worked. Obviously, it's working this morning. It's going to continue to work. But owning some protection beneath is really wise, particularly when you think about it in the backdrop of how much these names have already outperformed.
Well, the interesting thing is that for the most part, people are really just shrugging off the tariff impact, at least for now until it shows up in the data. So until it shows up in the data, is this the risk that we could get more announcements that dislocate things?
And let's remember, tomorrow is August 1st. I don't know how we got there already.
I don't either, Julian.
but you know, China is still an issue. We don't even know if the can is getting kicked. That still has yet to be announced. And then, of course, Canada and Mexico, and you put them all together, that's over 40% of imports into the U.S. That's still an open question. And from our mind, a lot of the valuation drift higher this summer has been a function, to your point, of the fact that investors don't believe, because they haven't seen the tariff impact hit yet, they're discounting that they'll actually see it. You know, our economics team does believe that you're going to see it in terms of a bit moderate growth and, you know, inflation really remaining firm the next number of quarters.
But when does that show up? I guess what's the order of things? Can you continue to hit record after record throughout the entirety of this year, or do you start to see things show up in the second half that really challenges that?
Well, again, I think it's a seasonality thing, it's a valuation thing, and then, of course, part of the narrative has been because the tariff collections have actually been lower than expected because a lot of goods were exempt, a lot of goods were on the water, but that's sort of all fading away. So in our mind, the challenge will come with the expectation that the data will turn, call it September, October.
How important is it for this equity market that we get Fed rate cuts this year?
Look, September, I have my dollar coin. It's a coin flip, okay? And the thing about the bull market over the last couple of years is that it's been able to shrug off, you know, the Fed's cutting, the Fed's not cutting. The biggest point in momentum-driven bull markets is not whether the Fed's cutting, but the fact that there's under no circumstances is the Fed going to get tighter whatsoever. That's really the important thing, and that lets the fundamentals fully express themselves. We think it's a 50-50, but clearly when you look out to the end of 2026, the expectation is that we are going to resume this cutting regime.
All right, well, I'm looking forward to tossing some more coins. Julian, stick with us. That is Julian Emanuel, who will be with us throughout the rest of the show. First, though, let's get you some other top stories that are trending on the terminal this morning. A Delta Airlines jet made an emergency landing in Minneapolis. It injured at least 24 people due to that severe turbulence. Delta Flight 56 was less than an hour into the 9-hour flight from Salt Lake City to Amsterdam when pilots met with challenging conditions, had to make that emergency landing, that according to a statement from Delta. The Bank of Japan's governor has cooled expectations of a near-term rate hike after deciding to hold rates steady. Kazuo Ueda said that the bank wasn't in danger of falling behind the curve on inflation, even after boosting its median inflation projection from 2.2% to 2.7%. And Standard Chartered CEO Bill Winter says that he still doesn't see the need to force his senior bankers to be in the office more. He told Bloomberg, quote, "We work with adults." Winter has maintained a high degree of flexibility at his bank, even as others like HSBC and JP Morgan have cracked down on hybrid work arrangements. They surely must be one of the last to allow that. Coming up, blowout earnings from Meta and Microsoft, Apple and Amazon on deck. We're going to look at big tech's performance. That's coming up next on Your Brief.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
AI is definitely in the center of it, and we're looking for how do we spend time and which industries do you invest in. Investors becoming more and more digital or AI enabled that actually adds value to economic growth. And this, we think could be time because you have a strong hardware power and you have a strong software power as we see, and it's accelerating significantly. But a very important another element, which is changes in demographics. More AI-enabled softwares and applications may improve the people's lives and actually increase productivity in times where demographics are decreasing everywhere around the world. So this, I would say, is a major theme. So digitalization and AI-related technologies, and we think of it technology, but in reality, a lot of the businesses coming up and claiming to be technologies that are actually cannibalizing a lot of traditional businesses.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
To build this future, we've established Meta Superintelligence Labs, which includes our foundations, product, and fair teams, as well as a new lab that is focused on developing the next generation of our models. We're making good progress towards Llama 4.1 and 4.2, and in parallel, we're also working on our next generation of models that will push the frontier in the next year or so.
Meta and Microsoft results driving futures higher in the pre-market trade. Microsoft is set to hit $4 trillion in market cap with that 8.3% rally. Meta up nearly 12% in the pre-market. Let's get into the numbers. Joining us is Mandeep Singh, senior tech analyst for Bloomberg Intelligence, and Evercore's Julian Emanuel is still with us. Mandeep, some huge numbers being put up by these tech players.
Yeah, look, I mean, in the case of Microsoft, I think we saw a 500 basis point sequential increase in their Azure growth. And when you look at Google, they also had a very similar increase. And in the case of Microsoft, clearly, they are taking share when it comes to the overall cloud and AI pie combined. And, when you are compounding the business at 40%, and you have got a backlog of over $300 billion, it gives you a lot of visibility to the run rate and how this business may look 2 years from now. In the case of Meta, I would say clearly the ad recommendation engine is working very well. AI is helping that. But in terms of visibility, yes, we are talking about superintelligence labs and what they are doing. They still don't have the kind of frontier model adoption that we have seen from ChatGPT and Anthropic. And that is where I feel from a visibility standpoint, Microsoft is far better. It reflected in their numbers compared to Meta. But again, nothing to take away from the fact that the quarter was great for Meta. Probably the TikTok ban, the potential ban is helping them capture more video ad share. And there is potential in WhatsApp monetization, but I still feel Microsoft visibility is far better.
So, Mandeep, you talked about the adoption, and curious, what's the commentary around how the depth and breadth of customers across industries have begun to use the product and really engage in recent quarters?
Yeah, I mean, Microsoft called out that coding agent use case, which is reflected in their GitHub Copilot adoption. They are seeing that, in other types of products. So that's where they're end-to-end. They provide the AI infrastructure, but they also have applications that are, showing the adoption. in the case of Meta, it's a big bet. I mean, they're talking about $100 billion in CapEx spend. OpEx spend is going to grow 25%. I would be very skeptical about margins expanding from here on, especially for 2026. Again, 20% growth on the top line is great for margins, and for their core business, the incremental margins are very solid. But for the spend that they're doing on AI, they don't have an established use case. The one promising use case is WhatsApp's use in customer service. That's where they could get a lot of momentum. But for that, they need a model that's comparable to OpenAI and Anthropic and Gemini. And right now, they're more in fixing mode in terms of getting the model to where the frontier models are.
And when you think about CapEx in general, when we came in to 2025, the expectation was that you were going to reach sort of the peak of the CapEx cycle in terms of AI, call it the first quarter or the first half of 2026. Where does that stand now?
So Microsoft yesterday told us that they will likely be supply constrained through the first half 26. And to my mind, if Microsoft, the biggest player in terms of inferencing, is telling us they're supply constrained, that really bodes well for CapEx investment. And Meta talked about, over $100 billion in CapEx for next year. So the CapEx numbers look really promising, and we know inferencing demand has been aided by these reasoning models and test time compute. So from that perspective, I do think we are good, at least for the first half of 2026.
Hey, Mandeep, just quickly before we let you go, Apple and Amazon today, what are the expectations?
So we saw Qualcomm print was okay in terms of handset revenue. So there is no big refresh cycle looming on the horizon for Apple, and plus tariffs. The India tariffs would likely be a bigger drag compared to the guidance, the 900 billion guidance they have given. And for Amazon, look, they need that 400 to 500 basis point sequential increase in AWS, similar to what we have seen from Microsoft and Google Cloud. So the bar is high. They need to show that AWS is neck and neck when it comes to cloud compared to the other two hyperscalers.
Mandeep, thank you very much. We'll see what those earnings bring. Mandeep Singh of Bloomberg Intelligence. And Julian, I love that question you asked Mandeep about adoption. How much is that guiding you when you look beyond the hyperscalers? How important is that to see other companies start to use some of these AI tools and find a use case for it that can increase productivity?
Well, it's really the whole ball game. Look, we've known, and the hyperscalers have been aggressive for going on 2 years now. They spotted the opportunity. Clearly, every roadblock that would suggest that CapEx would come in has been surmounted because there is growth and there's expectation. But the key as to why the AI theme has worked as well as it has this year is because whether it's industrial automation or whether it's, customer service or back office functions, it is really being adopted by the entirety of corporate America. And the modeling that we did when we launched on AI 2 years ago said that corporate America would be at 25% adoption rate by the end of 2025. We're right on target.
The interesting thing, though, is there was a point, Julian, where people didn't want to own Microsoft because of the capital intensity story, and that people liked companies like Meta, like Alphabet, because they were capital light. That has obviously changed. Should we also be re-examining these companies and the types of valuations that we give them if their business model is now different?
That's a great question, and I think that is part of the sort of the psychological evolution with respect to the fact that, I think there's no way of getting around it. Technology has become an ever more increasingly important part of the economy and clearly part of the market capitalization. There will come a time, and which is why I asked Mandeep about the extent of the CapEx cycle, where we will question that. But at this point, that seems further off in the future.
Well, as we were talking about before the commercial break, that you are you're a little bit nervous because of some of the valuations. But long term, as long as these companies are spending, as long as there's AI, can you bet against this equity market?
It's very difficult to do it. And in fact, as a long-term investor, you shouldn't do it, okay? It's prudent to hedge every once in a while. It's prudent to move sort of your cash allocations around a little bit. But for us, the meat of the returns are where we've been the last couple of years. And it is, you know, and we see it on the screen this morning, it is in the AI theme.
Well, lucky for us, we have more AI earnings to get through. Julian, I just want to go through the calendar of what we're going to get today really quickly. A look at what's ahead. Before the bell, we're going to get earnings from MasterCard, Norwegian Cruise Lines, among others. 8:30 a.m. Eastern, we're going to get U.S. PCE and personal income and spending data. And then it's more earnings. Apple, Amazon are due after the market close. Julian, when you look at drivers for the rest of the week, so we have all of that. You also have jobs data on Friday, too. What to you is going to be the most important driver? And again, we also might get more trade announcements coming up ahead of tomorrow's deadline.
I would suggest that, again, the Mag 7 reporting this evening, the bar has been set very, very high based on what we're seeing this morning. In our mind, it's probably going to be the trade announcements. You know, if Canada or Mexico or China sort of gets tweaked, contra to expectations, although there is a suggestion that Canada may be made an example, that's going to be a reminder that, you know, risk and volatility is perhaps a little bit underappreciated.
What's your understanding then of how sensitive this equity market is to economic data? Is it not very if maybe jobs is less important tomorrow?
Well, here's the issue, okay? And Powell pointed this out yesterday. When supply and demand of labor is both decreasing, it's much more difficult to handicap what the effect of a number is. So if you recall, you had the ADP data the prior month was negative. It was, you know, there was a flawed data series, not correct. But the fact is that given what's happened with immigration, the sort of the bogey for the monthly jobs ad is closer to 100,000 than perhaps when it was a year and a half ago at 150,000. But we're still trying to parse through the cumulative effects of immigration, of tariffs, of stickier inflation.
All right, Julian, we're going to have to end it there. Thank you so much for joining this half hour. It was really wonderful to see you this morning. So many interesting things to cover. That is Julian Emanuel of Evercore ISI. All right, let's quickly get a market check as we head to the end of the hour. It is an S&P 500 session that continues to move higher this morning, up about 1%. It is an outperformance from the NASDAQ thanks to some of those tech earnings. Bloomberg Dollar Spot continues higher after trading at its highest level, or at least is on track for its best week since 2022 after that Fed decision. Your 10-year yield, that's down by 1.5 basis points after yesterday, a 2-year yield that moved higher thanks again to some of the more hawkishness, shall we say, from Powell. Let's quickly look at some of the companies moving the pre-market too. Qualcomm, they are the lone tech player that's down nearly 6% this morning. A lackluster growth with concerns that tariffs will take a toll. Lam Research down 6% despite a beat in forecast. Finally, Amazon, strong results from Meta and Microsoft lift shares ahead of earnings. Again, Amazon and Apple will be reporting after the bell. That's it for Bloomberg Brief this morning. Surveillance will take it from here. You're watching Bloomberg TV.
Estava sitiada.
Isso eu começo, eu tremia, não sabia o que fazer. Foi a mais terrível que eu passei na minha vida. Eu temo, né, que o Brasil se torne
num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering, and someone is driving a Range Rover with their money. Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
Investment story in AI is real, and it's going to be significant.
Once again, AI CapEx plans are actually exceeding expectations.
The market is pricing in some idea that you are going to get that broadening of the AI benefits.
AI is a watershed event on the timeline of technology, and we believe that this flows through all 11 sectors.
AI has the potential to be the biggest productivity enhancer for the global economy since electricity.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, Jehu. Following the worst Fed day performance of the year so far, stocks bouncing back as earnings from Meta and Microsoft crush estimates. Ahead of one more read on the health of the Magnificent Seven. Apple and Amazon are coming up next.
I think you framed it perfectly, the idea of Jehu. The Fed meeting took a backseat yesterday from tech earnings that blew it out of the water. When you look at the share price response, given the gains we've already seen this year, it tells you a lot. Given the fact that Microsoft already has performed with returns of some 20% so far this year, to see their shares absolutely surge and become a $4 trillion company, the second in the United States, gaining some $314 billion of implied market cap overnight like that, gives you a sense of the momentum behind the AI names.
Jehu and tariffs, what tariffs? Ford, a $40 billion company complaining about tariffs. Microsoft, a $4 trillion company, absolutely crushing estimates. Rick Reeder this week, markets aren't ignoring risk, they're pricing a system built to absorb it.
You have on one side this idea of policy uncertainty, you have questions around inflation, and then you have the freight train that is technological advancement that seems to have no end in terms of profitability. And frankly, remember that Ripple moment when investors were worried about how much some of these companies were spending on advancing this technology? Now it seems like you cannot spend enough. Meta comes out and says, yes, we are accelerating our spending, and guess what? We're going to do it even more next year. But the cash engine is revving so wildly that people just embrace that and say, thank you, can I have another?
So question, here's two. How relevant was the meeting yesterday for the Federal Reserve? How relevant will the meeting be on September 17th?
You know, it depends on the economic data, and I think what yesterday did was very much focus us all on tomorrow. And I'd hate to jump the gun because there's a lot going on right now and a lot to parse through that already did happen. But the jobs report on Friday, tomorrow, is going to be incredibly important. If you start to see a ticking up in the unemployment rate, suddenly you have to wonder whether you can see this broadening out, this just incredible enthusiasm around AI spread to the rest of the universe, or whether you're looking at something that's kind of a secular theme overlaid on a lot of kind of lumps. And that, I think, is what people are looking at.
Payrolls tomorrow morning, 8:30 Eastern Time. A sneak peek of the estimates so far. The median 104, the high 170, the low is 0. the range is incredibly wide. That's the story for tomorrow morning. For this morning, this hour, we'll catch up with Chris Verone of Strategas as big tech drives stocks higher. Stefan Stawinski of BNP Paribas looking ahead to earnings from Apple and Amazon, and David Seif of Nomura as Fed Chair Jay Powell stays in wait and see mode. We begin this hour with stocks bouncing back after a strong start to earnings season from big tech. Both Meta and Microsoft rallying hard in the pre-market. To discuss, joining us now, Chris Verone of Strategas, a Baird company. Chris, good morning.
Great to be here, John.
How difficult is it to short this market when Microsoft and Meta put up numbers like that?
Well, you can't short uptrends, and I think yesterday certainly reveals that to us. I think it's a broader reminder that in uptrends, expect surprises to be on the upside, not on the downside, and I think the results certainly reflect that here as well. You know, when you put it in context of the bigger picture, there's going to be a lot of attention. Oh, look, it's just these big stocks driving the whole market. But remember, equal weight S&P also made a new high this week. So I recognize the average stock might not be the leadership, but at least the average stock is still involved. The leadership is clearly still coming from the top of the tape, but equal weight S&P at new highs is not a bad thing.
I mentioned Rick Reeder of BlackRock. He put out a piece in the Financial Times earlier this week and talked about the resilience of the system, the economy, and financial markets in America. Can we just reflect on that, on where we are now compared to where we thought we might be just a few months ago?
Yeah, I thought that was so well said from Rick. And when you look at the message of the market here, I think it continues to emphasize the economy's fine. You know, cyclicals versus defensives are making new cycle highs. We've been of the view for some time that there's a lot of shades at 96 right here, and you see it certainly in the results from tech, but you see it from the continued leadership from the banks. You go back to 96, it was one of the only times in history where the Fed cut with banks at all-time highs, and the next year was quite good. So I think the characteristics of this advance remind us a lot of that mid to late 1990s.
So I go back to Jehu. Is this a market that doesn't need Jehu to cut rates because ultimately you're already seeing that dynamism?
Listen, I think the two-year yield is 3.90, and I think the Fed funds rate is above that. I think the market's ultimately telling you where he's going to go. My suspicion is it's September. Whether it is not, whether it's later in the year, I still think ultimately that's where they're going. And the rate-sensitive cyclicals, I do think, have started to sniff this out over the last couple of weeks. You've seen improvement in housing and home building. Consumer goods starting to outperform consumer services. So there's little hints that the rate-sensitive corners of the market that have, frankly, been on the wrong side of the tape here are starting to sniff out Powell, ultimately getting to where the market wants him to get.
There's a larger point here, not just parsing Fed speak, which we're not going to do it too much this morning, I hope, because ultimately there are more interesting stories. The idea is there are these pressures, these uncertainties that still are out there, whether it's what's going on with inflation, whether it's what's going on with growth, whether it's what's going on with tariffs, and the potential what's coming down the pike and how they'll be really distributed across the economy. So are we saying that the AI story overwhelms it, is a separate story, is masking that, or is feeding into the rest of the universe to sustain a broader kind of bleed up?
Well, let's pick up on a word that you just used, inflation. And for the life of me, I cannot figure out why they're weighing these risks equally. You know, when Powell spoke yesterday about, he was talking about washing machines, and I mean, as Whirlpool actually bottoms and turns up. The irony of this to me, when energy stocks are making relative lows, when material stocks are as weak as they are, I mean, copper was down 20%. So we think about this picture, and I can't make the case that inflation is much of a meaningful risk here. Five-year forwards have been in the same range they've been in all year. The 10-year yield has been as benign as anything out there. Two-year yields pointing low. So I don't see inflation being the big threat here.
I'm pleased you've brought this up. I think it's important. If you think about the sources of inflation, goods, services, the labor market, energy, why are they seemingly only focused on one piece of the puzzle?
I think it's a little find the data that supports the case. You know, you go back to September when they cut. It's, almost a year ago now. Stocks were at all-time highs. Spreads were on the tights. Gold was making new highs. Pretty similar environment to the one that we're in right now. Now, the irony is the word they should be using today is transitory, but they're prohibited from using that word for the rest of time. It is probably the correct language to describe the environment that we've been in here. A tariff or a price change like that is a transitory event. And I think the reluctance to almost repeat the error that they made in 21, 22 is prohibiting them from making the correct call right now.
There's some scouring there, without a doubt, and that's one side of the mandate. On the labour market, what was confusing for many yesterday is how anchored the Fed chair's view is. Just around one data point, the unemployment rate. And a lot of people might make the argument this morning that that's a misleading data point as well in the labour market, that there are cracks there. So I was surprised yesterday to hear the Fed chair talk about how he doesn't really see a weakening in the labour market, where we can all sit here this morning and pick out various data points that say otherwise.
Yeah, he really seemed to hone in on the idea that there is an equalization between supply and demand in the labor market, that because you've had the number of immigrants or migrants in this country go down, that has equalized the number of people out there. You start looking at all of this, and it goes to Chris's point. How does he dismiss potential weakness, talk about the potential inflationary threat, while there still is that kind of dissonance on the Fed and a real recognition that there are cracks out there?
As the chairman was speaking just yesterday, we were all watching bond yields start to climb and the dollar climb with it. Can we talk about the dollar trade? Back in April, saw bonds break down, yields up, and the dollar go in the wrong direction. Feels like we've reestablished the kind of relationship we're used to. What's behind that?
So we wrote yesterday, a benign bond market and dollar rallying doesn't sound like the capital flight we were all promised, right? So I think when you look at the dollar here, there's a couple things going on. Number one, sentiment is about as one-sided as I've seen in years and years and years. There are dollar bears and dollar shorts everywhere you look. And I think a lot of people have missed that probably growth differentials are starting to suggest stronger dollar here, not weaker dollar. DXY closed above the 50-day for the first time on Tuesday all year. Euro USD started to break down here. When you look at our own proprietary measures of sentiment, you have dollar bears just abundant here. So I think you're set up for a pretty big contra rally in DXY here. Maybe 102, 103 is certainly in the cards.
Is that a headwind to U.S. multinationals and a tailwind to U.S. bond markets?
Yeah, it's a good question, and we kind of addressed this yesterday. It seems like this market, everything in front of you has been the right call. What could upset or disrupt that? And I do think maybe the new piece of information over the last week or two is this dollar starting to rally, and how does that impact groups like industrials and tech, which have carried the baton of leadership for much of the year? Now, certainly no evidence of that in last night's numbers, but I do think if we're thinking about what could change over the next 4, 5, 6 months into the back half of the year, that is certainly something I would be alert to. I do think it's notable. It does seem like gold is breaking down here, or at least attempting to break down. I mean, for everything that's gone on in the world from April forward, gold's made no progress. And again, below the 50-day moving average. Watch the 32.50 level on gold. Underneath that, I think it becomes easier to make the case maybe you're going back to 29, 28.50.
How bullish are you then, given all of this, given the fact that it's a question of looking for leadership, not necessarily where are the cracks going to be? How much do you feel like this equity market has a lot of room to run?
So it's not what I think. I think this business is about behaviorally training yourself to be on the right side of the trend. And when the trend is up, expect surprises to break in the direction of the trend. I think we saw that with the numbers yesterday. So not that things can't change or won't change, but I still expect higher prices from here. We started the year 67.50 on S&P target. I'm still in that camp. That may be too modest by the time that we get there. But I think we're in a bull market. I think there's shades of kind of late 90s. I like the fact equal weight S&P is getting involved with tech. I think the big question is, does the reemergence of dollar here upset some of the leadership characteristics?
Chris, it's good to see you, as always. Thanks for dropping by. Chris Verone there at Strategas Equities, charging on higher by about 1% so far this morning on the S&P 500. With an update on stories elsewhere, with your Bloomberg brief, let's cross over to Yahara Anand. Hey, Yahara.
Good morning, John. If you haven't heard, despite pressure from President Trump, the Fed kept interest rates unchanged. Fed Chair Jay Powell said growth moderated in early 2025 and repeated that uncertainty about the economic outlook remains elevated. 2 governors dissented, the first time that's happened in over 30 years. Governors Michelle Bowman and Christopher Waller favored a quarter-point rate cut. Meanwhile, Microsoft is set to become the second company in the world to reach a $4 trillion market cap. Shares are rising 8% in the pre-market after it reported better than expected growth in its cloud business, with its Azure unit posting a 39% rise in sales. Microsoft said it will spend more than $30 billion in the current quarter to build out its data centers for AI. And moving on to another big spender, shares of Meta are rallying 11% in the pre-market. The social media giant reported second quarter earnings that beat Wall Street estimates and forecast better than expected results for the current quarter. The Facebook owner said it's taking advantage of its lucrative ad business and stepping up spending next year. That's your Bloomberg Brief. John?
What a move in the pre-market. Yahira, thank you. More from Yahira later on this hour. Up next, approaching President Trump's deal-making deadline.
We made our deal with the European Union. The Japan deal is done. We're talking to India now. We'll see what happens. But you'll know at the end of this week.
That conversation up next with Tobin Marcus of Wolf Research, live from New York City this morning. Good morning.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Check out these moves in the pre-market from big tech. Meta, Microsoft, big rally. The South Side likes what they heard yesterday. Wedbush, a slam dunk quarter for Microsoft. On Meta, Truist, a license to spend, and spend they will over the next 12 months.
Yeah, an estimated $100 to $120 billion for full year 2025 potential expenditures. And right now, people are seeing it pay off. Just to give you a scope of the move that we're seeing pre-market, just a little bit more than 8% gain in pre-market trading means a market capitalization gain of $314 billion should it hold through the remainder of this trading session.
It's a huge move. Equity futures charge on, up by 1% on the S&P 500, up by even more on the NASDAQ 100. The NASDAQ 100 higher by 1.3%. Thank you, big tech. If you don't have it, the small caps negative 1/3 of 1% this morning. That tells the story. It tells the story of the U.S. equity market. Under surveillance this morning, approaching President Trump's deal-making deadline.
We made our deal with the European Union. The Japan deal is done. Many of the other deals are done. Indonesia was a very big deal, but we'll see what happens. We're talking to India now. We'll see what happens. And it doesn't matter too much whether we have a deal or whether we charge them a certain tariff, but you'll know at the end of this week.
It's the latest this morning. President Trump declaring more deals and demands ahead of his deadline tomorrow. The president announcing 15% tariffs on South Korean imports, matching the rate for Japan. Bloomberg's Tyler Kendall joins us now for more. Tyler, 1 day to go.
John, 1 day to go, and we have gotten some surprise announcements leading up to it, but there's still a whole lot of big questions when it comes to South Korea, of course, clinching that 15% rate, considered to be preferential. It does extend to autos, something that's been a really critical sticking point in these negotiations, but we still have questions about some of the investment commitments that the White House says South Korea has committed to when it comes to a $350 billion U.S. investment fund, mirroring what we saw with its regional rival Japan Japan, but still we're not quite sure exactly how that's going to be structured when it comes to investment versus loans, for example. But there's still a lot of other trading partners that we're waiting for. I'd say that I'm watching closely whether or not Cambodia and Thailand get some new rates today. The U.S. Commerce Secretary Howard Lutnick last night said that they have reached an agreement with those two countries. We're likely going to see their 36% threatened tariff rate lowered, and probably some talk about this idea of transshipment when it comes to countering China. Just to stick with China for a quick second here, President Trump there talking about India. We did see a surprise 25% levy threatened against them yesterday, also with the additional threat of additional penalties when it comes to how India imports Russian energy supplies. This was considered to be a pretty big reversal, John, considering that we know that the U.S. has been courting India as a strategic ally when it does come to countering China.
Tyler Kendall with the latest. More from Tyler later on this morning. Tyler, thank you. Tobin Marcus of Wolf Research joins us now for more. Tobin, welcome to the programme, sir. Are the pieces of the puzzle falling into place?
Trade deal earlier this week really settled the last major outstanding question. So I think even before this latest flurry of deals with clarity on the tariff rates for the EU, along with the previous deals on Japan, Vietnam, Indonesia, and the Philippines, in our view, that really landed the plane for the most part on what markets are looking at for this August 1st increase. We are seeing still a big tariff increase on August 1st. We're going to go up by about $80 billion in our latest numbers in terms of the reciprocal tariffs that are applicable. When all these new numbers phase in, they're lower than feared, lower than threatened, but still higher than current prevailing rates in every case that's been announced so far. On the reciprocal, that's partially offset by some sectoral relief. And then when we look a little further down the road, we have semis, we have pharma. Those are both potentially quite material with very large bases of goods to which they're applicable. So we're still in the ramp-up phase here.
Tobin, let's talk about some of the agreements that we have in place. Lisa has talked about this. Tyler just mentioned it. For certain deals, they're blending in foreign policy objectives. See India yesterday. I just wonder what's your reaction to that and how you think this is going to play out going forward.
Well, it's been clear since the campaign that President Trump really likes tariffs, not just as a revenue source, not just as a direct trade policy tool, but as a general purpose source of negotiating leverage for anything he wants countries to do. And we're seeing that, very clearly in the Brazilian case, to some extent across the board. I think that he is serious about using them to get countries to the table on whatever he wants to negotiate over. The resolution, the Brazilian case, I think is a little bit unclear because it's not really at President Lula's power to do some of what President Trump is asking for in terms of the treatment of Bolsonaro within their political and legal system. But they did pull the punch a little bit on the breadth of those tariffs yesterday. So that's not as alarming of a situation for them, even in the interim.
Tobin, at a certain point, there was a question about whether President Trump would force some of the trading partners to choose between the U.S. and between Russia and China. Do you feel like that really has been a theme through all of these talks?
So it's certainly been an issue in the talks, particularly in Southeast Asia, where these big exporters obviously have deep commercial ties with China. We've seen this 40% transshipment rate announced for Vietnam. As Tyler indicated, I think it's fair to expect that we see something similar in the Thailand and Cambodia deals when they're rolled out. Still no details whatsoever about what that's how that's measured, what triggers that threshold. I assume it's going to be done based on some Chinese content threshold, but they have not put out any details yet. But, I think the coherent vision of the tariffs as a way to present a unified front against China and maximize pressure on them that's been articulated by Secretary Bessent looks a little bit different from how President Trump himself is directly approaching China, where we're in a fairly conciliatory mode vis-a-vis China. So some elements of the tariffs that we're seeing rolled out do have that sort of China pressure strategy reflected in them, but at the same time we are not really confronting China that aggressively directly when we look at stuff like the H-20 restrictions being rolled off.
We see some certainty. We see some frameworks for deals, and a lot of people in markets have cheered that certainty. It is better than what we had over the past number of months of speculation. How much does that get disrupted? And frankly, how much market risk is there? Should the courts today overrule some of these tariffs and the IEEPA Act that was used to justify them?
Yeah, so today we have oral arguments in front of the Court of Appeals for the Federal Circuit. They're not going to take any action today. I think the action is probably a month or two down the line, but we will get an indication of how they're leaning from the questions that we hear at oral arguments. I think in terms of the tariffs themselves, if they get struck down, they can be replicated. The president can use other authorities, Section 338 foremost among them, to recreate the same pattern of tariffs that he's been rolling out, just with a little bit less nimbleness. You know, those would take effect after 30 days, slightly different legal requirements, but I think he can basically get to the same endpoint. The question of what happens to the revenue that's collected between when these tariffs took effect and roughly end of year, which is when we think the Supreme Court's going to weigh in, that's an interesting question I think has been under-discussed. My expectation is that that revenue will need to be rebated to the importers of record who paid those tariffs because they were collected unlawfully. And so even if we end up recreating the same prospective pattern of tariffs, that could be a really big wave of kind of accidental stimulus that we see in the first half of next year, along with the intentional stimulus from the big, beautiful bill. Among other things, if I were sitting in the FOMC, that is something I'd be concerned about in terms of cutting early.
So, Tomer, there's another obvious question to ask as well, and not just the monetary policy dimension, just the tariffs themselves. Given what you just said, if I don't fully understand the legal standing of the tariffs being implemented, why would I roll out the sectoral tariffs anytime soon, given that that might be a tool available to me to respond if I had to?
Well, so, you know, the sectoral tariffs, of course, are under a different authority. So I think they are still proceeding with those. They want to get that kind of complementary piece of the puzzle settled. Those have turned out to be pretty broad. You know, the focus has been on the country-by-country reciprocal tariffs, but the sectoral tariffs are a very large piece of the puzzle as well. So even if IEEPA does get struck down, ultimately, we'll have those sectoral tariffs remaining in place as they try country-specific rates. So I think that piece of the strategy makes sense. I do think that they're going to move forward within the next few weeks on both semis and pharma, and we'll see what the details of those look like.
Tobin, appreciate your time, sir. Lots to get through. Tobin Marcus of Wolfe Research. This just coming. Marcus of Wolfe Research. This just coming. Here's a headline for you. EU wine and spirits to face a 15% US tariff. In the interim, the negotiations continue. Wine and spirits, according to the European Union.
Yeah, so down the road, there could be an exemption from the tariffs on French wine. All I'm thinking is there going to be a rush to the Napa Valley to try to stock up in the meantime because they are going to have relatively cheaper prices, at least in the United States, just theoretically for an individual who might enjoy wine.
For you, for instance?
Well, maybe. I mean, yes,
perhaps. Would be very unhappy if they didn't get their exemption.
What this highlights is how much still has yet to be discussed. And we heard this from the EU Trade Commissioner saying there still is quite a bit of discussion around items that could be put in the 0% tariff bucket when it comes to transnational trade. So look, still a lot of questions to be determined, and French wine, Spanish wine, Italian wine is very much front and center for a
Some issues are more important than others. That's the latest on trade. Drive Higher Plus, Danny Berger with your morning movers as Ford warns of a big tariff hit. That stock is down by close to 2%. This is Bloomberg.
you've said 25% last year, I believe, of Google's code is AI generated. 3,000 employees right now. Is it half that in the future?
I expect we will grow from our current engineering base even into next year, right? Because it allows us to do more, right? I think the opportunities are also increasing. I just feel it's making engineers a lot of the mundane aspects out of what they do, allowing value-added tasks, but that means it's an accelerator. People will be more, which means maybe we'll create new products, and hence we will need more people. At least in the near term, to me, it looks like we will expand engineering velocity. And that doesn't mean we're constrained in what we will do. End up doing more as a company as well.
It's the countdown to the market open as we bring you the first trade across Europe.
I'm Guy Johnson.
I'm Creedy. I'm Anna Edwards. Join us every weekday morning. London.
Only on Bloomberg.
Gains, that's what we're looking at on the S&P 500. Equity futures add some weight to the rally, up by 1% this morning on the S&P. On the Nasdaq 100 higher by 1.3. With 3 hours until the opening bell. With your morning movers is Danny Berger. Hey, Danny.
Hey, John, and here's why. It was the hyperscalers themselves, the amount that they project that they're going to be spending with capital expenditures with tens of billions of dollars every quarter. So the results, strong ad results from Meta, strong Azure results from Microsoft. Together, they're set to add $530 million in market cap. That alone would be the 17th biggest company in the S&P 500, putting it right above Netflix. Microsoft set to hit $4 trillion. But it was a split screen of companies that did well because of AI and those that are being hurt by tariffs. Ford among them. A $2 billion hit is what they estimate for the year because of tariffs. Tom Narayan, though, of RBC, pointing out it's not just that. It's things like expiring EV tax credits, weakness in Europe, and some warranty issues they've had. So those shares down 1 3/4%. And not all tech was created equal. Qualcomm also falling 6%. It was disappointment in the weak guide for what it looks like to be their phone market. Of course, one of their biggest businesses is supplying chips to smartphones. They also have an expiring or potentially expiring relationship with Apple as they move in-house for their chips, John.
Danny, thank you. Appreciate the update. More from Danny in the next hour and more on big tech in just a moment. On our radar this morning, Fed Chair Jay Powell shrugging off pressure from President Donald Trump, holding rates steady and saying the full impact of tariffs on the economy is still unknown. Powell saying no decision has been made on a September rate cut.
And what you saw is Fed funds future price out just a touch the chance of a rate cut in September. The commentary was pretty uniform. Essentially, yes, you got 2 dissents from Fed governors for the first time going back to 1993. But Steve Englander of Standard Chartered for Fed Chair Powell, wherever there was wiggle room, he wiggled hawkish. Stuart Kaiser at Citi, stocks pulled back during the press conference more on vague answers and a high bar from positioning. And then Blake Gwynn, we think Powell had a clear hawkish lean. So definitely that was the main takeaway.
My favorite take, Mike Ferrari, JP Morgan, more about auditioning for the Fed chair appointment than about the economic conditions. I think he called the dissents 2 job applications. at yesterday's meeting.
And we heard Fed Chair Jay Powell say, you can listen to them explain it, and I'm sure they'll have a thing to explain it. I think that was what he sort of said, referencing with their commentary that he's expecting.
I think it's slightly unfair to look at those dissents and just say they're job applications when someone has come forward and put forward a pretty credible argument to reduce interest rates.
You said someone. There were two dissents, John.
I meant Governor Waller.
Yes.
I'd like to know more from Governor Bowman in the coming weeks about how she's thinking about the situation, given her other views at the end of last year in the other direction. But Governor Waller has been pretty clear, I think, pretty clear about why he thinks we should be reducing interest rates.
And a lot of people would agree with him. I mean, even Rick Reeder, you mentioned him of BlackRock earlier, even though he's relatively bullish and sees this as a stock-proof economy, he said right now it does seem like a good time to cut rates because there is this weakening, and you're seeing it in a host of different measures. So a lot of people agree with that view. It's not that much of an outlier view to call it purely political.
That's the latest on monetary policy. More on the Fed a little bit later. Here's the latest on trade. The president unveiling fresh trade deals ahead of tomorrow's deadline, announcing 15% tariffs on imports from South Korea, 25% on India. The president also announcing sweeping exemptions to his 50% levy on copper, triggering a major move in yesterday's session.
So we could delve into all of the trade agreements, but we really should take a note. Let's just take a moment for copper. The idea of people who, piled into the copper trade with this expectation of 50% tariffs, and the copper prices in the U.S., not necessarily in London, totally wiped out. I mean, this to me was something Julian Emanuel said. Liquid markets don't trade like this. To see a 19% plunge in copper prices. Why? Because essentially he's exempting the main product from copper that is used. So kind of not really relevant anymore for a lot of what gets used in production.
There was some miners getting very excited as well. It wasn't just the commodity. Some miners here in the US getting very excited about the prospects of them being the only game in town.
Yeah, Freeport-McMoRan shares really followed the sentiment shift in real time, and it was sort of the rise and the fall of the emotional roller coaster that has been 2025.
That's the latest on copper. That emotional roller coaster continues. For NVIDIA as well, apparently. Authorities in China summoning NVIDIA over alleged security risks related to its H20 chips. The move clouding the outlook for the business in the country following CEO Jensen Huang's visit with senior officials in Beijing just earlier this month.
Yeah, it's sort of, we're going to have to wait the 2 years to get NVIDIA earnings, but in the meantime, we do have this sense of the liabilities of being brought so close to President Trump and being an American company in China. We keep seeing that again and again. Can the rock star of AI remain immune to that in China at a time when the chips are necessary, but there are a lot of questions there about their national security as well as in the United States?
Stock is up this morning. It's not trading on that. It's trading on this. Meta and Microsoft pushing stocks higher after posting beats on earnings and boosting AI spend. Investors now turning their attention to both Apple and Amazon after the close. Stefan Slowinski of BNP Paribas Exane rising his price target on Amazon to 264. We believe investors will increasingly view Amazon as the Gen AI leader. Stefan joins us now for more. Stefan, welcome to the program, sir. I actually wanted to start with the likes of Microsoft, because there was something you said coming into earnings season. You said we were looking for investors to go from relieved to excited. Credit to you. Is this the excitement phase?
Morning, Jonathan. Yeah, I think we're starting to see that on Microsoft. Obviously, the stock had a really good run after the relief of the March quarter print. Today, we're starting to get more excitement. So when investors see this type of revenue growth acceleration at scale, they're really wowed. And to be fair, Meta is showing that today as well. So Microsoft is a $300 billion run rate company on the top line. Growth just accelerated from 15% in their fiscal Q3 to 17% in their fiscal Q4. And obviously, all the talk was about Azure accelerating from 35% to 39% growth. And that's about an $85 billion run rate business. So, yeah, I think we're going to start seeing investors getting more excited about Microsoft.
Stefan, can you spend some time with us just explaining where their acceleration is coming from, what's behind it, and whether it's just even more incentive to keep on spending?
I think the interesting thing here is it's not about AI, or it's not all about AI. So when you look at Microsoft's comments last night, they said the beat or the outperformance came from their core cloud business. That's boring things like Nestle moving their SAP systems to the cloud. AI was in line with their expectations. Same thing on Meta last night with their strengths. AI is helping at the margin, but it's really the core business. Gen AI is not really contributing a lot just yet. So the core businesses, the core platforms are doing very well for Microsoft, Meta, for these hyperscalers. And the exciting thing is Gen AI is really just ramping, so that's still to come. to your question, yes, that's what's driving this investment. When you look at Microsoft, Amazon, Google, and Meta, CapEx is set to go from $150 billion in 2023 to, we think, over $420 billion next year in 2026. So that spend is accelerated, and the AI acceleration theme continues.
Wait, hold on a second, Stefan. Can you repeat that? Because I don't think I wrapped my head around those numbers. $420 billion in CapEx next year for one company. Is that what I just heard you say?
That's for those four hyperscalers.
For the four
So that's Microsoft, Amazon, and Google.
That's a little bit better.
And Meta together.
Okay, so right now we're looking at something, a conservative estimate by our own Dan Curtis here at Bloomberg of something like $330 billion of CapEx in 2025. This level of spending and the fact that they continue to gain share raised a question: where is this money being felt in the economy? Is it being felt in the efficiency by, just the rank and file S&P 500 companies? Is it coming in an inflationary boost somewhere down the line? Do you get a sense of what this is doing economically?
Well, of course, the main beneficiaries, as you just mentioned previously, are going to be those providers. So one of the shifts that the hyperscalers are talking about is shifting to spending on the kit rather than the shell. There's been a lot of data center build over the last couple of years, building out those buildings. That'll continue, but they're actually shifting the spend more towards the chips themselves, the networking equipment themselves. That has a benefit in the sense it converts into revenue much quicker. The downside is it also converts into depreciation much quicker. One of the things we've been doing is writing about increased depreciation, increased OpEx with all this CapEx spend. That's what we're seeing at Meta. Meta's guidance basically is for EPS growth to collapse next year to near 0% as margins come down 500 basis points. Microsoft and Amazon are taking steps to alleviate the OpEx pressure. We think we should continue to see 15 to 20% earnings growth from those companies. So we're starting to see the moment of truth where a lot of that spend is going to come through and hit the P&L. For now, it's the data center providers, the chip providers, of course, who are benefiting from that spend.
Are these buyers price insensitive? And I'm talking about how much NVIDIA can raise prices of their chips and just have these hyperscalers absorb it with no consequence, at least for now, because of the hopes and dreams around AI.
Yeah, I think so, in the sense that when we look at what a company like Meta is spending to hire AI talent, when we look at the spending on the infrastructure build out itself, these companies think that the winners will be those that have the talent, those that have the data, and those that have the capacity. And so they're willing to spend whatever it takes on those three things in order to reach that magical artificial general intelligence first. In Microsoft's instance, they have $380 billion of committed backlog. So Microsoft is essentially saying, look, we already have this commitment. We're not building this infrastructure hoping that we can use it. We know we're going to use it. We need to build that infrastructure because the demand is already there.
Stefan, just before you go, we've talked in general terms about the opportunity for these stocks. What's special about Amazon as we look for those numbers after the bell?
Yeah, so the pressure's on Amazon right now. Obviously, Microsoft and Google saw cloud acceleration. Google and Meta saw advertising acceleration. So the pressure's on Amazon to deliver. All eyes are going to be on that Amazon Web Services growth. Consensus was around 17%, so was the buy side. We think maybe that nudges up to around 18% growth after Microsoft's strong quarter. We need to see that, or else Amazon Web Services is going to be looking like it's losing more share to Microsoft Azure. Overall, Amazon should see revenue growth accelerate as AWS and advertising become bigger. And that should also help their margins as well, because those are the two higher margin businesses. And then finally, Oracle and Microsoft have been dominating the narrative around AI infrastructure, AI monetization. We think as we head into the second half of this year, Amazon joins that story, if you will, as AI capacity comes online, as their Anthropic relationship begins to ramp, and as their Trainium 3 chips ramp as well.
Stefan, appreciate your time, sir. Thank you. Stefan Slowinski there of BNP Paribas Exane. I think these are the numbers you're after. This came from Luke Cower. He was quoting Neil Datta of Renmac just yesterday. So far this year, AI CapEx, which we define as information processing equipment plus software, has added more to GDP growth than consumer spending.
This is the reason why so many of these other uncertainties haven't been as relevant. And that's the reason why people are getting so excited about the U.S. exceptionalism story. I will just say a note for Amazon after the bell. I want to see how they're using AI to remove some of the advertised suggestions when I search for something and actually give me what I want.
Is that your personal complaint?
I'm just telling you that this is something I personally would desire, yes.
There you go, Mr. Bezos and Mr. Jesse. Stock is higher in the pre-market by something like 3%. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. The U.S. reached a trade agreement with South Korea that will impose a 15% tariff on imports, including cars. It also sets up a major investment in American energy and shipbuilding. Commerce Secretary Howard Lutnick said the deal includes a $350 billion South Korean fund for U.S. investments, with 90% of the profits, he says, going back to the U.S. Meanwhile, Ford shares are falling 1 3/4% in the pre-market. The company did report better than expected second quarter revenue, but warned earnings will see a sharp drop this year by as much as 36%. That's in large part due to a net tariff impact of $2 billion, about $500 million more than the company previously thought. And President Trump and JP Morgan CEO Jamie Dimon have started to meet in person after years of mixed public remarks between the two. Sources telling us here at Bloomberg the pair resumed talks back in June. And just last week, Trump and Dimon spoke in private at the White House, where they discussed a range of topics, including the Fed and economy. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. More from Yahara in about 30 minutes. Up next, double dissent.
We had two dissenters who, I think, you want that clear thinking and expression of your thinking, and we certainly had that today.
We certainly got that. We'll talk about it next with David Seif of Nomura from New York City. You're watching Bloomberg TV.
Welcome back to the circuit. This time, we're taking you to the frontier.
Do we have a camera, or do we? We don't want to lose you, Emily, in all of this.
Stargate, put that name down in your books.
What we're undergoing right now is sort of the largest infrastructure bill in human history.
To meet the people rewriting the rules of code and culture.
How do you personally grapple with the pace of it all?
It does feel like it's going very fast.
When did you realize, oh my gosh, my life is never going to be the same?
The day I got engaged, I was like, whoa, what have I bitten off here?
Where the future gets real.
How confident are you that AI's promise will outweigh the perils?
I'm not confident.
So the tech companies are lying or fudging.
And a little weird.
What's the point of this?
What is the point of any of this?
Tune into Season 3 of The Circuit with me, Emily Chang, Thursdays at 6 p.m. Eastern on Bloomberg Originals and Bloomberg TV.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
The rally resumes. Equity futures higher by 1% on the S&P 500. Thank you, Meta. Thank you, Microsoft. The Nasdaq higher by 1.3%. Under surveillance this morning, double descent.
On the dissents, you know, what you want from everybody and also from a dissenter is a clear explanation of what your thinking is and what are the arguments you're making. And we had that today. We had two dissenters who I think, you know, you want that clear thinking and you know, expression of your thinking, and we certainly had that today.
Here's the latest this morning. The Fed holding rates steady, prompting the first double descent from Fed governors in more than 30 years. David Seif of Nomura writing the following. The apparent increased willingness of Fed governors to dissent does signal that if Powell's replacement as chair is significantly more dovish than the bulk of the FOMC, it could bring an end to what has been decades of de facto Fed dictatorship by the chair. David joins us now for more. David, good morning.
Good morning. How are you?
I'm very well. Thank you, sir. Dissents make headlines. Do they make a difference?
Well, they don't make a difference in the short run, we don't think. Powell was pretty clear. He was very gracious to Governors Waller and Bowman, talking about what a great meeting it was. But he did not seem to accommodate their views at all. But what it does probably make a difference, too, is what's going to happen in the post-Powell era, which is no more than about 10 months away. If governors are now more willing to dissent than before, we may be ending the so-called dictatorship of the Fed that has been going on for many decades and is a very different model where you really have to count the votes and try to figure out at the end of every year which presidents, regional Fed presidents, are rotating off, who's rotating on. This has been a very academic exercise for decades because at the end of the day, what the chair wants, the chair has gotten. That may not be the case, especially if Powell's replacement is not in line with where the bulk of the committee is.
So markets will want to know, investors too, does it make the committee more hawkish, more dovish, more volatile? Which one?
Well, you know, I think that we really do need to see how the 12 members, the entirety of the FOMC is. And so I think that if the chair is more dovish, maybe the committee gives a little bit of deference at first, but it would be one thing for the new chair to want to cut a couple extra times, 25 bips each, more than the rest of the committee. But to try to cut a couple of percentage points more than the committee wants, I think that's where we'll really see the committee, the rest of the committee probably harden a little bit if we get to that point.
Let's split the difference and talk about 100 basis points of rate cuts next year, which seems to be more in the offing for people if there is a sort of more dovish Fed that is a Fed chair that is appointed next year. You've been saying that there will only be one rate cut this year. Looks like the market's kind of coming your way slowly. I'm just wondering, do you think that raises the prospect of a greater number of cuts next year?
Well, our thought is that we're really not that far away from neutral. And so our thought is that there'll be two rate cuts next year, and that would be it. Now, that's, of course, assuming that the committee stays generally the way it has been. Presumably, especially if Powell stays in his governorship, President Trump's only going to have a single seat that he's able to fill. So it would still be 9 non-Trump appointees on the FOMC. I think that probably is enough to keep it from being all that much more than that. I could easily see some of the names that have been floated for Fed chair, all of whom are serious economists, being able to finagle an extra cut or two out of it, but I don't think that whoever it is going to have the ability to simply roll over the rest of the committee and get hundreds of basis points of cuts.
Is this a good thing or a bad thing? Does this actually lead to less credibility of Fed decisions in the minds of markets, or does it lead to more?
I think that the dynamic has actually so far been fairly healthy. That could change, but right now what you're really seeing is the president has been saying what he wants, the Fed has been acting like an independent institution, and ultimately it hasn't changed markets' expectations all that much. You haven't seen inflation expectations become unanchored or anything like that. So I do think it's a little bit of a scary situation, so to speak. This could go wrong. But as of now, the back and forth between the Fed and the president, I think, has shown sort of how strong these institutions both are, and so far not been such a bad thing.
You've talked about the division between the institution and the White House. Let's talk about the division inside the Federal Reserve on the committee right now. Seems to be over the labour market and not so much on inflation. I think we've talked a lot about the inflation story, but on the labour market,
yes.
Governor Waller is saying that we're on the edge. Chairman Powell spent basically the whole news conference saying that the labour market was okay, and he anchors that view around one data point, the unemployment rate. Do you think we're anchoring the view, or rather is Chairman Powell anchoring his view on the labour market around a misleading data point?
I actually think that this is the right way to do it. I think that what we have seen and what we are continuing to see is that because immigration has come down so much, the number of jobs that need to be created each month, so the so-called break-even NFP, is a lot lower in order to keep the unemployment rate steady. So we would estimate that over the last year and a half or so, that number has gone down by probably 50,000 jobs per month. And actually, some others have estimated that it's gone down by even more than that. And so what is full employment? Full employment conceptually is not how many jobs are being created each month. It's does everybody or almost everybody who wants a job have a job? And that is really measured well by the unemployment rate. There are problems each month. It's not the best series on a month-to-month basis, but over a series of months, over a longer period of time, that is really what you want to focus on, even if non-farm payrolls growth has slowed down.
So I think that John really set up today well when he said Jay who, because after hours we heard from the Fed chairs Satya Nadella and Mark Zuckerberg talking about the transformation they're engaging with in this economy and how much it is going to transform potentially the way we work and the labor market as we know it, as well as inflation. I mean, how much power does the Fed have at a time of technological advancement that we're seeing from some of the hyperscalers at a pace that we really haven't seen in decades, if not centuries?
Yeah, I mean, it's really interesting because when you have an exogenous thing such as the AI explosion that we're having in terms of investment. I mean, who knows what it's going to lead to at some point in the future, but right now it's leading to a lot of economic activity in the form of investment. And that, what we're seeing, that can really just dwarf all the other things that are going on. So tariffs provide perhaps a negative hit to the economy. You know, that could be a speed bump in the context of something much bigger going on that's beyond the control of anybody at the Fed or in the government or anything like that. And I think that is really what we may be seeing right now. It still remains to be seen how much investment there's going to be, but what is going on has nothing to do with policy or tariffs or anything like that.
We just have about a minute, but is the $330 billion that the big hyperscalers are expected to spend this year inflationary?
All else equal, it certainly is inflationary, but the question is, if it's filling a hole that would have been slowing economic growth, then perhaps really what it is preventing disinflation or deflation from occurring. So it's going to presumably raise the inflation rate higher than it otherwise would have been, but that number may have been falling, especially once the hit from tariff-induced inflation has passed.
David, appreciate your time.
My pleasure.
Thanks for breaking it down. Thank you, sir. David Seif there of Nomura on the Federal Reserve decision. Apparently dissents do matter.
Well, it matters in terms of maybe not necessarily this year, but next year. If it is a trial for who's going to be the next Fed chair, then the market has to take that seriously. And so far, the market might be pricing out some rate cuts this year, but pricing in a couple more next year. And that might ultimately be more important because it's where the Fed rate ends up, not necessarily how quickly it goes in the next couple of months.
See you next time on September 17th. I just wonder if 2 months is enough to resolve the issues on that committee right now. I have my doubts.
I think that right now it feels like an ideological difference, and it's hard to know how that's going to get squared.
Up next on the program, we'll catch up with Mira Panda at JP Morgan Asset Management, Jason Furman of the Harvard Kennedy School, Daniel Rusker of Bernstein, and someone who knows something about dissenting, the former Kansas City Fed President, Esther George.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Let me break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network, right? Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that 3-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. This is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
The Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments.
They have to wait because they're not really sure what's going to happen to the economy.
You still have an inflation problem, and I think the Fed is not still appreciating that enough.
We're all expecting some level of stagflation in the second half of the year, but we don't know the magnitude or shape of it.
This is going to be like the last, quiet meeting. I think when we get to September, it's going to be a much different ballgame.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Can we just have a quiet summer? Heading towards a third month of gains on the S&P 500, closing out July like this. Equity futures on the S&P 500 charging higher, pushing higher by 0.9%. On the Nasdaq, up by 1.3. Thank you, Meta. Thank you, Microsoft. Those earnings after the bell yesterday, absolutely knocking it out of the park. Meta up 12%. Microsoft up by close to 9%.
No is the answer to your question of can we have a quiet summer? And the answer is it's the trifecta. You have policy certainty coming down the pike. You have this question around economic data coming in stronger than expected. And you have the economy that is big tech absolutely powering a massive technological shift to the tune of two $4 trillion companies now in the United States, if these moves hold, and Microsoft at a time where it seems like they cannot spend enough when it comes to AI investment, and this market is ready to reward them for that.
Those two names, Meta, Microsoft, about $5.5 trillion of market cap. Just those two names, 10% of the index. It's very difficult to fight this market when names like that put up numbers like that.
Yeah, and today we have $8.7 trillion of market cap that will be reporting earnings. It is the busiest day for earnings of the season at a time where, again, it seems like these companies have incredibly high expectations. The bar has been set very high, and they managed to just hurdle over them and then some with the promise of more to come. It raises a question of how much that move, that secular shift, is overwhelming the noise of absolutely everything else.
Said it a few times in the last hour, Jay Hu. Just how relevant is the Federal Reserve in the face of what we're seeing play out this morning?
What we're seeing is the relevance play out in small caps, and that really has been the direct move. If you do see a Fed that remains on hold, some of the smaller companies are going to really have a harder time because they have been expecting, and we've seen gains on the heels of the expectations for rate cuts. Question is, if the economy is solid, great. If this is a political disagreement that ends up in a too late Fed, as President Trump was talking about, that does lead to some potential problems. But right now, anyone who is bearish on this economy has just gotten blown up, so you can't really find too many of them on the street right now.
The week isn't over yet. After the bell, we'll hear from Apple, we'll hear from Amazon later on this morning. At about 8:30 Eastern time, you'll get jobless claims tomorrow morning, 8:30 Eastern time, the jobs report just around the corner. For now, though, futures positive by 0.9%. Coming up this hour, Mira Panda to JP Morgan Asset Management, where stocks are raising Wednesday's losses. The former White House economic advisor Jason Furman as countries race to strike a trade deal, and the former Kansas City Fed President Esther George after the Fed's biggest descent in more than 30 years. We begin this hour with stocks rising after upbeat earnings from both Meta and from Microsoft. Mira Panda of JP Morgan writing the following: short-term volatility is likely, but a durable correction seems less so. Mira joins us now for more. Mira, good morning.
Good morning.
Asked the question in the previous hour, how can you fight this with numbers like that?
It's very difficult because you have the profits backing up the equity market story here, and you also have a broader equity market overall, which helps further support the rally. So yes, you have the Mag 7s supposed to contribute about 2/3 of overall profit growth. But then if you look at what's driving markets, the Mag 7 are driving about 1/3 of overall market action. So that's healthy in our view to see that markets are still benefiting from a lot of different catalysts here, but you still have that anchor when it comes to the Mag 7 and technology to help lift the tides a bit.
Do you think it reduces the relevance of the Federal Reserve?
So I think that there are times in history where the economic data demands that the Fed acts. This, to me, is not one of those times. There is a credible case for the Fed to cut. There's a credible case for the Fed to keep right where they are. Ultimately, the economic engine is always going to be corporate America. The Fed is also going to try to create some of those bumpers and guardrails for the overall economy. So I don't think it renders the Fed irrelevant, but I certainly do think that right now, despite the very impassioned two camps of the Federal Reserve, there is a credible case to do either at this point. So I don't know that the Fed can actually go wrong in the near term.
Given that sort of backdrop, it's amazing how rate insensitive this broader market has become. How much does it even matter when the Fed cuts to risk asset valuations and, frankly, even to economic activity, given the fact that it seems to be holding up just fine?
Whether the Fed cuts or not, we're probably still going to have a pretty durable market. I mean, think about the last 2 years where we've had rates even higher before the Fed did start to cut, and markets still produced 20+% returns. And at that point, the Mag 7 did contribute about 2/3 of those overall returns. So the fact that you're still having the Mag 7 hanging in there, you're having more participation from other areas of the market. CapEx seems completely undeterred, does mean that whether the Fed cuts or not, we can still have a pretty successful market potentially.
It feels like people can't get more bullish this morning. I really can't find anybody who is negative, particularly after seeing those earnings from Microsoft and Meta. And we see the dollar reflecting that. If it continues to gain, if it continues to strengthen, it will be the biggest weekly strengthening going back to 2022 in the dollar. At what point are we going to see the first half of this year reverse, where all of those flows out of the U.S. and U.S. assets start to come back in force, given some of the developments that we've seen?
What we have seen already this year is, despite a lot of the overtures of Sell America and the end of U.S. exceptionalism, you didn't actually really see foreign investors selling treasuries. You didn't really see foreign investors selling the equity market. Foreign investors still own about a quarter of the treasury market and about 20% of the overall equity market. And by the way, neither are U.S. investors. You've seen retail doubling down for months. You're starting to see more of that activity coming from hedge funds and some of the more institutional buyers. So you certainly really haven't actually seen in the markets the Sell America narrative, despite the fact that it's been so pervasive at a headline level.
Came up almost every single month in Bank of America's Fund Manager Survey. The most crowded trade, the most consensus view was to short the US dollar. Euro dollar pushing towards 120, and here we are, back at 114.
Welcome to the summer pain trade. Because of that positioning, maybe it gave real legs to the move that we're seeing, really in stunning magnitude, given that we could be poised for the biggest dollar strengthening in a week, going back to 2022. And a lot of it has to do with big tech, and a lot of it has to do with the fact that the Fed might not have to cut rates as quickly.
Mira, can I ask you, what is the most compelling reason to look abroad right now, given the fact that Europe doesn't have a Meta, doesn't have a Microsoft, doesn't have an Amazon, doesn't have an Apple?
You're looking for diversification of catalysts. So if I think about Europe, for example, it's more about the fiscal story. While the Fed is on hold here in the US potentially, or maybe cutting modestly, you have Europe all the way down to 2%, maybe still about to cut. And they're a much more interest rate sensitive economy when you look at some of the lending practices out there as well. So you have a different form of catalyst. Let's not try to look for tech in other places necessarily where it is not already dominant, but let's look for some of those other types of diversifiers and catalysts. Because if something does fall down, if something doesn't work out, you still have something that is not linked to the AI, tech, US story to provide some other sources of return within your portfolio.
How concerned are you that we've seen some pretty violent moves? You start to talk about diversifying catalysts. Well, it seems like the market's pretty calm, but then you see the move like what we saw in copper, 19% plunge just in hours on the heels of an announcement from the president. We've seen some really big, historically big responses, even in stocks after earnings, even when they haven't been massive pronouncements from the companies. What do you make of that in a market that's supposed to be very liquid?
Areas that are going to be volatile are going to stay volatile. Things like commodities, we always tend to see pretty volatile. So those are some of the areas that will react to trade news in a big way. But when we think about the stock market itself and what we've seen from different sectors within the US market and areas of opportunity, is there are multiple stripes of catalysts. So you have the AI stripe, you have the other stripe, you have the policy stripe. I think of an area like financials or industrials or utilities. They all have probably 2 out of the 3. Financials, you have the other, which is the yield curve steepening. You have policy, which is deregulation and some of that insensitivity to tariffs given some insulation. You look at utilities linked to AI, but you also see, not only the power generation piece of that, but again, some of that insulation from tariffs, very domestically oriented. You take industrials, it's actually got all 3. You have the automation when it comes to AI. You have the policy, perhaps some reindustrialization on the margins. And then you have the other, things like HVAC, aerospace, transport, all doing well this year. So when I think about the market, I think about the froth that is in certain areas. I do think about where are the genuine catalysts that are diversified across the board in different areas of the US market. That's where I feel a little bit more conviction.
Can we finish on what you don't like? What don't you like right now?
Some of the areas that are more defensive, areas like real estate, staples, consumer discretionary is not necessarily defensive, but when we think about staples, discretionary, the consumer overall, you are hearing some good stories out of earnings season in terms of some of that resilience. But what I do worry about a little bit is the margin story there when we think about not only some of that overseas revenue, but also the tariff impacts to demand overall. So those are some of the areas I would still be a little bit more cautious on. Areas like healthcare still have a huge overhang from the administration, from some of the cuts from the One Big Beautiful Bill when we think about things like Medicaid and where that funding comes from. Pharma tariffs could still be on the docket. So those are some of those areas where I would say they have the reverse of some of those catalysts. Maybe they're not linked to AI, they have some negative policy catalysts, and the other maybe doesn't look pretty compelling.
Mira, this was compelling. Appreciate your time. Thank you. Mira Pandit there of JP Morgan Asset Management. Stocks higher by 0.9%. Mira alluded to Europe and the financials. Euro stocks 50 banks up this year by more than 50%. 5% so far in 25.
Yeah, on the promise of some of that stimulus that you could potentially see, as well as even deregulation. I know that that sounds crazy. We are talking about the Euro region. I loved what she was talking about stripes of catalysts, and I was thinking that if she wanted to illustrate this, it could be a zebra with lots of stripes, the multicolored stripes. That's where I'm at this morning.
You're tired, aren't you? Yes, you probably need some sleep. Possibly. Okay, let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. President Trump suggesting he won't make a trade deal with Canada. Trump posting on Truth Social, quote, wow, Canada just announced that it is backing statehood for Palestine. That will make it very hard for us to make a trade deal with them. Canada faces a 35% levy on imported goods if it does not strike a deal by tomorrow's deadline. Meanwhile, Chinese authorities have summoned NVIDIA representatives over alleged security risks related to its H20 chips. The country's internet watchdog cited comments by U.S. lawmakers about the need to install tracking capabilities into advanced chips sold to other countries. The move comes after CEO Jensen Huang visited Beijing earlier this month. And Norwegian Cruise Line shares are popping in the pre-market up 6%. It reaffirmed its guidance after seeing strong demand in recent months. Its revival comes after Norwegian called out softening trends back in April, seeing choppiness in its European bookings. Rivals Royal Caribbean and Carnival also saw a spike in demand this quarter and boosted their full-year guidance. That's your Bloomberg Brief. John?
Yahira, thank you. I'll always respect the numbers. I'll just never understand the motive. The motivation to get on a boat and be stuck there for weeks on end.
Weeks on end? How long do you think people go cruising?
People? Some people go cruising for weeks.
Oh, you think you're going to be one of those people who retires onto a boat?
I'm not going to be any of those people.
I think that you should. I think you could
not
see the world.
Chance.
I think you could see the fjords, but you could also see, you know, beaches and different islands. I think you would really
do well.
The
only way you ever get me on a cruise is if Uncle Mike writes a massive check and sends me on a cruise. You would have to pay me.
Okay, hold on a second.
I would never,
I could see you going on a
ever,
cruise. You know, one day I'm going to catch you on a cruise going around the fjords in Norway, and I'm going to say,
that's the exception.
Oh, there we go.
Those
all
beautiful Viking cruises.
Yep, okay, here we go.
Okay, that's different.
Yeah, well,
that doesn't count.
That's called a cruise.
That's on a river.
All right.
All right. Okay. Up next, counting down to the president's trade deadline.
We made our deal with the European Union. The Japan deal is done. We're talking to India now. We'll see what happens. But you'll know at the end of this week.
A conversation up next with Jason Furman, the former economic advisor to President Obama from New York City this morning. Good morning.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We are risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
For a moment, things were a little too quiet. The president has this to say on the Federal Reserve decision in the last 24 hours. Jerome Too Late Powell has done it again. He's too late and actually too angry, too stupid, too political to have the job of Fed chair. He's costing our country trillions of dollars.
I thought it was notable that yesterday we didn't see a Truth Social from President Trump on Jay Powell. Here he is. Here's a question that I have. Is this actually a relief to people? Because yes, he is responding. Put another way, Too Late is a total loser and our country is paying the price. He doesn't say fire him. And that actually might be taken as a relief, and that's where the bar is this morning.
I want to repeat something Mira Pandit said and others have said too. There are credible arguments to cut interest rates right now. There are credible arguments to wait. I think the chairman at the moment is navigating this situation really quite well. I think he did a decent job yesterday of navigating the dissent and has done a pretty decent job of navigating what is increasingly a very difficult situation with the White House.
Yeah, the markets seem to really have endorsed Fed Chair Jay Powell. And frankly, even though we did get 2 dissents, this was a meeting that really skewed hawkish. And it seems like the bulk of the committee, the rest of the others, do support what Jay Powell is doing. So it doesn't seem like this is necessarily at a level that is really raising the ire of people in markets.
Take a beat. We'll get some more data, 2 more CPI reports, 2 more payrolls reports, and get back together again on September 17th to make another decision. Equities at the moment on the S&P 500 doing okay, positive by 0.9%. On the NASDAQ, up by 1.3. Big tech having a major part to play so far this morning. And the surveillance this morning, counting down to the president's trade deadline.
We made our deal with the European Union. The Japan deal is done. Many of the other deals are done. Indonesia was a very big deal, but we'll see what happens. We're talking to India now. We'll see what happens. It doesn't matter too much whether we have a deal or whether we charge them a certain tariff, but you'll know at the end of this week.
It's the latest this morning. President Donald Trump announcing new tariff deals and demands before his deadline tomorrow. The president revealing 15% tariffs on South Korean imports, matching the rate for Japan. Joining us now from the nation's capital, Bloomberg's Tyler Kendall. Tyler, just briefly describe what the next 24 hours is going to look like.
Yeah, hey, John. Well, we're still waiting on a few announcements from some pretty crucial trading partners, so perhaps we'll get some sort of movement there. I'll point out that President Trump is expected to have a phone call later on this morning with Mexico's President Sheinbaum, and it's been sort of ironic, I think, because Mexico and Canada, too, which we're also waiting for some sort of announcement from, they were tariffed months before these other trading partners, yet they still haven't been able to reach an agreement. A person familiar does tell Bloomberg News that the negotiations with Mexico have now reached the level where the decisions need to be made on the leader level, perhaps showing us some movement in the right direction, but we still know that there are an array of different issues that this White House is looking for when it comes to Mexico in particular. Now, in terms of some other countries that we could see movement on, Thailand and also Cambodia, we're expecting they're likely going to see a lower 36% rate announced at some point in the next 24 hours. The U.S. Commerce Secretary Howard Lutnick said as much. And then just lastly, I'd say even though we're still waiting on announcements, we're also still waiting on details from the announcements that we've already gotten. And we know, for example, that the Treasury Secretary Scott Bessent is still set to meet with South Korea's finance minister later today. So perhaps we'll be able to glean out a few more of those details when it comes to that agreement that was announced, because while we know, John, that there's going to be this 15% lower rate also extended to autos, we still need to see the bigger picture here when it comes to those investment commitments of $350 billion, $100 billion investment for U.S. LNG imports, how exactly all of this is going to work, since it was considered to be essential in ultimately clinching that lower tariff rate.
Tyler Kendall with the latest. Tyler, thank you. Bloomberg's very own down in Washington, D.C. To extend the conversation, Jason Furman, the former economic advisor to President Obama, joins us now for more. Jason, welcome back to the program, sir. The data seems to be okay. The earnings from corporate America, better than good. We're a few months into this process, and I just wonder from your point of view, Jason, whether you believe it's premature to sound the all clear.
I don't think the data is that terrific. In the first half of this year, the economy grew at a 1.2% annual rate. That is way below where we should be. Core inflation was a 3.0% annual rate. That's way above where we should be. So no, it's not a catastrophe by any stretch of the imagination. But you know, there's more than a hint of stagflation in the numbers we saw in the first half of this year, looking at it together.
It was something, Jason, that Bob Michael was talking about. The key question for a lot of people is, how big is the stag and how big is deflation? What are you looking for to determine the answer to that question?
Look, one of the confusing signals here is the disconnect between GDP growth, which has been weak. It was even negative in the first quarter, although some of that I think was spurious measurement issue, and the job market, which if you look at the unemployment rate, which Jay Powell rightly emphasized yesterday, has held up quite well. And, you see consumers cutting their spending back, but continuing to get jobs, continuing to get raises. And that on the stag side of the ledger is making things even more unclear.
Well, on the inflation side of things, right now there's a question about the trickle-out effects of the tariffs, whether we've seen the ramifications yet. A lot of economists have been saying, wait until the third quarter, wait until the fourth quarter, and see exactly how companies really manage through this. Who do you think is a good example, or is there an industry that you think is a good example that might have given us an early look at how this trickles out and what consumer receptivity is to absorbing those price increases?
Look, some of the lowest margin businesses like toys, you see that passed on very quickly. At the other end of the spectrum, you have cars, where you have the president telling them not to raise prices. Their prices are very visible. They've been reluctant to do it, but it's not like General Motors is going to continue to sell cars at a loss indefinitely. They're eventually going to have to raise those prices.
Jason, do you see this being offset by what's developing in services inflation at the moment? How are you reading what's happening in one side versus the other?
Services is continuing to come down, but we sort of always thought that was going to happen. That was our path to 2%. That was the part we were counting on. The problem is that the goods deflation has reversed, and now we have goods inflation again. And so one of those I take for granted. It doesn't seem to me like the news. The other one, the goods side, that's the unpleasant surprise here. Now, the idea that it's transitory is not at all crazy. I think there's even a very good chance it's true. But if you're the Fed, do you want to bet everything on a very good chance when you're definitely not sure?
With that in mind, do you think 2 months of data is enough data to draw any conclusions before you make a decision?
You always think that 2 months from now, everything's going to be clear, and then 2 months from now, everything is still muddy. So it's going to be muddy 2 months from now. They're going to be getting conflicting data. But yeah, maybe it'll be a tiny bit clearer than it is now.
I keep going back to the way that John opened the show, which was Jay Who, and it raises the question implicitly about how relevant the Fed is at a time of massive technological explosion, and we're seeing that in the tech earnings. How much does the advancement, the investment coming from some of the tech giants in the United States overwhelm some of this discussion and certainly overwhelm the negative consequences from the tariffs that a lot of people had expected?
It depends what you're talking about. If you're talking about the stock market, yeah, a lot of what's going on in the numerator, which is earnings, rather than the denominator, the discount rate, is what matters right now. If you're talking about GDP, we're not seeing a lot of tech, at least in the supply side. Frankly, we're actually seeing it more on the demand side right now. And so if anything, it might be inflationary up front. Productivity growth is basically right on the track we thought it would be prior to the pandemic. So tech is helping the stock market quite a lot. I'm optimistic and hopeful it'll help GDP, but right now it is not having any real material impact there.
Jason, that's a strong final point. We'll leave it there. Thank you, sir. Jason Furman there of the Harvard Kennedy School. When I say Jay Who, I imagine Jay himself probably likes it that way. He'd probably prefer that we weren't talking about him as much as we are.
You mean rather than having the president next to you saying, I'd prefer if you lower rates and slapping him on the back?
Prefer that he talked about Zuckerberg
and
Nadella after yesterday.
That is the ultimate goal. He wants to remain in the background because they don't have the clarity, as does none of us, as do none of us, right? So the point is, how does he not remain the story so that he can just take a passive view on exactly how things can progress? The relevance of Fed policy right now, I think, is also a question, given some of these other drivers of the economy.
You've got the economic story and the market story. And in the economic story, you've got a good story and a services story, two very different stories, which is why Ford versus Microsoft I find absolutely amazing. Ford is really relevant for the goods economy, but when you're 7 basis points to the S&P 500, you're not as relevant as Microsoft, which is about 7 percentage points. It's a major difference between the two.
Yeah, but everyone has a car. Most people in this country have a car. So all of a sudden it becomes very relevant for popular opinion and for the general belief in the economy.
Futures positive at the moment, up by 0.9% on the S&P. Up next, Daniel Rusker of Bernstein with Ford becoming the latest company warning of major tariff impacts. Plus, Danny Berger with your morning movers. CVS boosting its outlook. That stock higher by close to 8%.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersetchi in Vienna, and this is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Live from New York City this morning. Good morning. Bramo's impressions this week on the money. Where are these coming from?
I just, it's bubbling up. I'm going to try to put them back in.
Had a lot of messages the last few days about.
I know, it's a mess. Okay, let's move on.
Yeah, not bad. Okay. Futures positive on the session. We're up on the day, up on the week, higher on the month as we close out July. Equity futures up by 0.9% on the S&P. On the Nasdaq up by 1.2%. With your morning movers is Danny. Hey, Danny.
Hey, John. It's hard to look anywhere else but here this morning, and that's after the results of Meta and Microsoft and the huge rally that we are seeing pre-market. 11.7 for Meta. For Microsoft, it's 8.3. The spending continues. Gone are the days where we just like tech companies being capital-intensive companies. Instead, commitments of tens of billions of dollars and Microsoft joining the rarefied air if this gain holds of being worth more than $4 trillion. We also had some other earnings this morning, CVS being among them. It is a raise in guidance for profitability from CVS. That's sending shares higher by an 8 1/3 outperformance of their pharma unit, their health insurance unit. Some of the other industry has seen some issues with higher costs than expected, but it seemed that CVS dealt with that in 2024, has moved beyond that for 2025. Also heard from Comcast this morning. For them, it was a lower loss than expected for their broadband customers. Of course, that's the bulk of their business, so that sent shares higher. Also seeing good results when it comes to their media business. They are splitting some things off in their cable business, but specifically Peacock that they're holding on to, getting closer to reaching profitability, I guess thanks to shows like Yellowstone and Love Island. John.
Danny, thank you. I don't watch Love Island. I do watch Love Island. Danny, thank you.
Would you like to share some impressions of it?
The UK version, I've got no impressions.
Okay.
I wouldn't like to do that to my fellow Brits. Oh. It would be unfair.
Oh, yeah, I'm sure you'd never do that at home.
On a radar this morning, Meta and Microsoft surging in early trading, both tech giants pledging to spend lavishly on AI following blowout quarters. Tech results continue after the closing bout with Apple and Amazon.
Yeah, it just shows that people were saying the bar is pretty high. Can they cross it? And then they leapt across the actual protocol that people were looking for them to show. A key question is, there are two different stories. Meta has an advertising business. They can raise prices on their advertising because of how well they can target some of those ads. The promise of that is fueling some of their hopes and dreams for something even greater to diversify their business. Microsoft, it just is a cash cow. It is just shocking to see a 39% growth in their Azure business. And so that's the reason why people are cheering some $330 billion of expected spend for the hyperscalers just this year alone.
What's interesting for me are the stocks that are moving on this and the stocks that aren't. So off the back of this, Amazon's doing well. Nice read through. Apple's not moving. Apple is on an island. NVIDIA is doing well this morning. NVIDIA, if you think about what the bull case for NVIDIA rests on, it's the patience of the investors in their biggest customers. And they have a very, very concentrated customer base at NVIDIA. And basically, what these companies learn overnight, what we've learned as investors in these companies, is they've got a green light to keep on spending. Keep spending on what? The likes of NVIDIA.
Yeah, it's a tale of two techs, right? And you've got the chip sector and the AI sector tied to the cloud computing and some of the other generative intelligence that a number of different companies are really pegging their hopes on. Then you've got the Qualcomms, which really speaks to the Apple story, which came in disappointing because people are not buying that many handsets. The phone recycle, the super cycle just hasn't happened. And I think people kind of are realizing they might be in isolation from one another.
Two Mag 7 stocks do not look like the others, and that's been the story so far this year. The other story for me as well is what happens with the labour market, Lisa, and I think increasingly we need to be thinking about that. You can have this dynamic in the equity market where the big players are doing really well, pushing AI, doing fantastically, and you can have adverse effects developing in the labour market at the same time. That can go in either direction for a while. At some point, some real tension starts to break.
Yeah, and this, I think, is what people are looking at, the idea that you could end up having some sort of positivity in the equity market at the expense of the labor market. We're seeing some signs of that this morning with what we're getting in terms of the job cuts announcements from Challenger Gray and Christmas. Basically, a huge spike in layoffs. We can get into this later, but really a lot of firms citing artificial intelligence as a reason for that. And that, I think, is one thing we have to keep watching.
Could be a big story tomorrow morning, 8:30 Eastern Time. Payroll's just around the corner. Here's the latest on trade. President Donald Trump announcing new levies, including a 15% tariff rate for South Korea and 25% for India. Sources telling us here at Bloomberg, the president is planning to speak with the Mexican president, Claudia Sheinbaum, today ahead of his August 1st tariff deadline.
Yeah, really interesting to me, India. And we've talked about this, but I think it's important to keep coming back to this. It was a real surprise, and not in a good way, for India to get 25% rather than 19%. With the extra hair that they need to really do something about the relationships with Russia and China. With Mexico, it might be even more fraught because of the interdependency of these two nations. So I'm very curious to see who has the preferred treatment of 15%, which is shocking that it's not 10%, and who gets something a lot more punitive.
In some ways, this tariff deadline doesn't apply to Mexico and Canada. You've got to renegotiate USMCA. That's not happening overnight. That's not happening in the next 24 hours.
Yeah, which is a reason why maybe people are putting that off. But I wonder what the ramifications will be for some of the key industries that depend on these two countries. Is just faith that there will be some sort of agreement reached.
Just finally, one further story. This coming from the Wall Street Journal in the last 24 hours. The president and the JP Morgan CEO, Jamie Dimon, catching up face to face. Sources also telling us here at Bloomberg the pair resumed direct talks back in June, discussing the economy and Fed rates in a private meeting at the White House just last week.
Yeah, look, it pays to be close to the president. And there has been sort of a tepid relationship between these two men with some dueling kind of tense tweets and truth socials and comments and all of that. At the end of the day, though, it's clear that President Trump has respect for Jamie Dimon, and Jamie Dimon, who has traditionally said he is always open to have a part in policy making of any sort and has often had a close relationship with different government officials, sees the benefits of having a closer connection in that front.
Breaking news. I have nothing snarky to say about this.
Okay, that's
at all. I just think it's a good thing. It's a good thing that the CEO of the biggest bank in this country is speaking to the President of the United States about major issues.
I couldn't agree more. It's somebody who has a real-time experience in what's actually happening in the economy and have that mouthpiece in front of the President, just like Jensen Huang. Having a real view, I think, is unabashedly a positive thing.
They're the kind of individuals that you want to have influence, would want to have influence over this administration for sure. Let's turn to the autos. Ford is the latest automaker, warning its profit will take a hit from tariffs. Daniel Rusker of Bernstein has an underperform rating on Ford shares, writing the following: second half market strength and tariff offsets remain critical to hitting full year targets. Daniel joins us now for more. Daniel, good morning.
Good morning, John. Hey.
We know the rules of the road now, to some degree. Who's in a good spot at the moment?
Nobody. I think it's very clear that tariff headwinds have started. They're not going away. They're going to get worse. And it's also clear from the earnings cycle we have that automakers are not going to be able to offset this. So there will be the pressure on automakers to raise prices as we go into the second half.
So you don't think this is going to be absorbed on margin? Margins aren't big enough? Is the bulk of this going to be passed on?
I think, again, half, right? If we think about it and what the companies have said, they're looking at kind of tweaking production footprint a little bit, but you can't really move all those assets quickly. They're thinking about cost reductions, which I would say they can do anytime, anyway. And then they're thinking about raising prices. Ford had an interesting take that they also want to focus on mix and push higher mix into the second half. And I think both better pricing and better mix depend very much on the health of the consumer.
How much is this a problem of the auto manufacturer's own making? And how much is this an issue of tariffs that disrupted a really positive cycle for some of these auto manufacturers?
I think it's a combination of both, Lisa, where, I mean, overall, I think the economy as we got into this year was kind of in a mid-cycle state and wondering where to go. And now we're all waiting kind of for the shoe to drop when these prices filter through and hit the consumer. At the same time, the automakers, remember, we're coming off of this sugar high through COVID, where there was a lot of supply constraint, and we're still adjusting to having lower prices. And now they had the prices go down over the past couple of years, and now we've got this extra cost pressure just coming into their business.
Yeah, well, we see this question around where some of them are going to actually produce their vehicles as well. John was talking about Mexico and the questions around Mexico and Canada. That has been the latest supply chain du jour that a lot of these auto manufacturers have relied upon. How independent can they be to rely on domestic factories, to engage with robots, to potentially fortify some of their production lines in a way that makes them more immune to some of these changes?
I had a really interesting conversation with Jim Farley from Ford yesterday, and we talked about kind of the long term, where does all this lead? And what he said is he believes that we'll go not just into regional product categories, so cars for Asia, cars for Europe, cars for the US, but also regional production kind of ecosystems, and that import-export will decrease over time, and each region with its own emission standards and production ecosystems will kind of develop on its own. And for the US, it's going to be critical how they will phrase USMCA, and from what we've heard over the earnings cycle, I think there's a lot of engagement with the administration how to ensure US manufacturing, but also enable the components from Canada and Mexico that are relevant to make this industry work.
Daniel, I just want to extend and build on the conversation you had with Farley and think about what that could mean for some manufacturers here in the United States. Do they just give up on China? Do they just exit the region? Where does it leave Europe? Where does it leave the product mix? Do they give up on EVs in certain places? How do you think this plays out?
I think strategically OEMs will need to decide which region do I want to play in. And we've talked about this before on GM, where I think GM will exit China ultimately. Ford is in a position that they have a stronghold in Europe, they have a stronghold in the US. And what Farley also said yesterday, the way I think he sees it is they will develop their platforms and cars for the US market, and that means bigger cars, less EVs, And internationally, he said they will rely more and more on working with partners. So they'll go to Volkswagen, and they'll work with Volkswagen to use their technology for the European market.
Do we end up spending more on cars as a result of all of this?
Yes, definitely. But I think there's a difference in the medium or kind of the next 3-4 quarters in the long term. The next 3-4 quarters will be really tough because there really isn't any other way to offset the tariff costs than pricing. Very long term, the administration has just initiated a lot of changes on emissions. And that has the potential to take billions of cost off the table for the US manufacturer. So that's in the, let's say, 12, 24 month time frame. That's a really good trade-off where maybe a US manufacturer needs to accept to pay more, but gets some relief on emissions.
Just on your point about USMCA, and just to sort of pay attention of what to look out for later today when we hear from Claudia Sheinbaum and Donald Trump in their phone call, how much have the components coming into the U.S. from Mexico and Canada come from China ultimately? How much is this sort of the back door? And they're really a fundamental problem that's going to make it difficult to continue with that type of supply chain.
The overall content of Chinese origin in U.S. cars is below 5%. It's not large. But what does happen is you do get some chips, some wires, some parts that come from China into Mexico, get built into components, and then those components get shipped to the U.S. As long as you can make those chips cheaper somewhere else, I would question why not. And I would also question whether the administration really wants parts manufacturing in the U.S. I think that's challenging with the high labor cost. Or whether it wants to focus on automotive manufacturing. And my view would be that the administration will look very closely how to treat parts and cars coming from Mexico differently.
Can we just finish on one company that we haven't mentioned, Stellantis? Let me go through some of the brands. Alfa Romeo, Dodge, Fiat, Jeep, Lancia, Maserati. Then you've got all these European names as well that a US audience might not be familiar with. When are they going to do something about this? We've been asking the C-suite of Stellantis about this now for years. When are they going to fix it?
The question is this something you need to fix? What they are doing is they are harmonizing the technology platform all these brands work on. And you build the same car, and you paint it red, green, and blue, and put a different badge on it. It'll take them another 4 to 5 years to get to that point, but that's the strategy. I cannot see the new CEO, who's been with the company for decades now, really change that strategy. And so I think they're going to continue with this multi-brand environment, but they're going to streamline the operations that underpin those.
Do you think it's a good strategy?
I think it's a strategy available to them, right? We're not in a world where you can just throw away decades of capital spending and build the OEM you like. So if I think about what do they need to do, this is what they need to do. They need to do it faster and better, and they need to come to terms with their new strategy in the U.S.
Daniel Ruska of Bernstein. Daniel, thank you, sir. Appreciate it. Diplomatic there on Stellantis, as you might expect.
I love it. You just, paint all the cars different, and one is a maroon Dodge and one is a silver Maserati.
Not quite the same, is it? That might be a problem.
Just saying.
Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. President Donald Trump announced a massive exemption on his 50% tariff on copper imports, unveiling refined metals that are the mainstay of international trading will be spared from the levy. The move triggered a record plunge for U.S. copper prices, as you can see. Meanwhile, at least 24 people were taken to hospital after a Delta Airlines flight encountered severe turbulence that forced it to make an emergency landing in Minneapolis. According to the airline, the plane was less than an hour into its 9-hour flight from Salt Lake City to Amsterdam when the pilots encountered very challenging conditions. And former Vice President Kamala Harris said she will not run for governor of California next year. According to a statement, she said she loves the state and its promise, but after deep reflection, she's decided she will not run for governor in this election. Harris's decision, of course, leaves the door open for a third White House bid. That's your Bloomberg Brief. John?
Yahara, thank you. Thank you very much. More from Yahara in about 30 minutes' time. Up next, Double Dissent.
We had 2 dissenters who I think, you want that clear thinking and expression of your thinking, and we certainly had that today.
Up next on the program, we'll catch up with someone who knows about dissenting, the former Kansas City Fed President, Esther George, live from New York City. You're watching Bloomberg TV.
indications have been received positively both in Kenya and UAE, and we are optimistic that we should be able to open the office in the fourth quarter. We think the Middle East have deep capital sources. It has strong logistics for trade, and it is a strong center for investment. And we are seeing increasingly the global GDP is increasingly becoming overweight in Asia and Middle East. So that linkage with the middle income segments growing in India and China, they will provide a very strong market.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
The gains continue, up by 0.9% on the S&P, on the Nasdaq higher by 1.2. On the Russell, no big tech on the Russell. The small caps down by 0.6, and here's the why. This move in Meta. Here's two whys. This move in Microsoft. Microsoft up by 8%, Meta up by 12%.
And it comes on the heels of a lot of spending promised for the remainder of this year and an acceleration next year, and the idea that it's truly paying off, whether it's in advertising prices where they can charge more for their clients, or whether it's cloud computing where people are lining out the door saying, please give us more, and they got to build it, and they are already there, not let alone will come.
Huge turnaround in this equity market over the last 24 hours. Equities down on the Fed meeting, higher off the back of these earnings. After the bell, more earnings to come. And the surveillance this morning, double descent.
On the dissents, you know, what you want from everybody and also from a dissenter is a clear explanation of what your thinking is and what are the arguments you're making. And we had that today. We had two dissenters who I think, you know, you want that clear thinking and you know, expression of your thinking, and we certainly had that today.
So here's the latest this morning. Fed Chair Jay Powell doubling down on the decision to hold rates steady after the Fed's biggest descent in over 30 years. Joining us now to discuss is the former Kansas City Fed President, Esther George. Esther, welcome back to the program. I remember your descent in 2019. I remember your descent, I think it was in 2022. You've got some experience. Can you describe for us what it's like entering the room, the committee has a conversation, and you say, you know what, I disagree. I think we should be going in a different direction.
Well, it is part and parcel of decision making in a large committee, in my view. And you approach those conversations, those decisions, in a way that I think is respectful of what you're hearing around the table, that you've taken into account. I agree with the chairman. You want to acknowledge that you are listening and understand what the arguments are. But at the end of the day, decision-making is difficult, and I would argue it is particularly difficult in times when the read of the data is not so clear across the table. And I always felt it was as much an obligation to the public to express those views, to be respectful, again, of what you've heard, but at the end of the day, to really voice how you see the economy and the appropriate stance of policy.
We saw a pretty big divide represented by the views of Fed Governor member Chris Waller, as well as Fed Chair Jay Powell. Both have a very different view of the labor market, and John's been really good about accentuating the point that we only have 2 months of data. Do we have enough time to really bridge that gap between the two men
to really understand whether this labor market truly is stable and solid or whether there are cracks?
Well, I heard earlier a comment on your program that talked about each time you finish up one meeting and think you have plenty of time to see the data for the next. That is never conclusive. You will always face uncertainty around what the data is telling you and whether the trends you're relying on are about to shift or whether they will continue. And so that, of course, is going to be the focus in bringing these two views to some kind of consensus. I'd be surprised if 2 months resolves that, but obviously both will be looking very carefully to try to reconcile how the economy is unfolding by that time.
Is your sense that there's quite a bit of disagreement on the ending point? Because certainly on Wall Street, there's a great deal of uncertainty about whether the neutral rate is something closer to 4% or whether it's closer to 3%. Do you get the sense that there's that type of disagreement just among Fed members?
Well, at some level, Lisa, it is absolutely the issue at hand, because when you are trying to specify your policy, when you're trying to describe it, particularly after a time when you brought down rates by 100 basis points, trying to calibrate around what is an equilibrium, should we be expecting that the end game is. And so you see that in a long run sense in the dot plots. But of course, for any given stage in the economic cycle, you'd be very hard pressed to know exactly what you're looking for. So that, I think, at the end of the day is really the question. Is this mildly restrictive policy? Is it restrictive? Is it not restrictive at all relative to the outcomes we're getting? Is at the heart of what the committee is debating.
There seems to be disagreements on both sides of the mandate, Esther, not just on the inflation story, but also on the labor market. We have payrolls tomorrow. We've heard from Governor Waller. He was pretty explicit. He came on this program and said the same thing. He thinks the labor market is on the edge. That was like day and night compared to what we heard from Chairman Powell yesterday when he talked about the labor market, and the committee continues to call it solid. Can we get your opinion, how you view the labor market at the moment, and whether you'd characterize it as solid?
Well, I think this is a labor market that's shifting. And obviously, in a macro sense, this is a committee that is making macro policy, has to rely on a macro number, which the chairman said is going to be the unemployment rate. So in that sense, they have explained clearly in a broad sense what they're looking at. As things move around, though, underneath the covers of that unemployment rate, I think you have to be mindful that the Fed's reaction to that cannot be a direct response. In other words, if you're going to lower rates thinking you will arrest the changes that are going on under the covers, not likely to happen. And so in a time when your backdrop is coming off of high inflation, trying to get back to that 2% target, it creates this wait and see. It creates a real sense of having to have conviction around the next move in your policy rate to know what you are responding to.
Esther, thanks for sharing some of your experience with us this morning. We appreciate it. Esther George there, the former Kansas City Fed president, who, as we've said, knows something about dissenting in both directions, by the way, in 2019 and in 2022.
Yeah, robust discussion at times of economic crossroads where there is just a great deal of uncertainty. You said something earlier, and I've been thinking about it. Isn't it a good thing for us to be saying Jay who? Isn't this the objective of Fed Chair Jay Powell? And I would argue, if you take it an even step further, how nice it is to have a market that is not driven entirely by the Fed. I remember those years of financial repression where every single market participant said, don't fight the Fed. That's no longer on anyone's lexicon. We're all looking at the earnings. We're looking at specific stories. We're looking at technology. Isn't that the way it's supposed to be?
I think we all wanted to leave behind the era of superstar central bankers, the Bernankes, the Draghis, someone I have a great amount of respect for, the Carneys, another man I respect. But ultimately, we don't want to be talking about central bank leaders again and again and again as if they are, to borrow Mohammed's phrase, the only game in town. And I think that we are in a situation at the moment where they, quite simply for this market, and maybe for the economy too, are no longer the only game in town.
We're shifting from financial engineering to something that feels a little bit more real and, frankly, more physical in terms of the real economy.
Up next on the programme, we'll catch up with Gargi Chowdhury of BlackRock, Walter Piecyk of Lightshed Partners, Jonathan Pingle of UBS, and Mark Lehman of Citizens JMP Securities.
there is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it. And so far, we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I'm never doing that again.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
AI is definitely in the center of it, and we're looking for how do we spend time and which industries do you invest in. Investors becoming more and more digital or AI-enabled. That actually adds value to economic growth. And this, we think could be time because you have a strong hardware power and you have a strong software power as we see, and it's accelerating significantly. But a very important, another element, which is changes in demographics. More AI-enabled softwares and applications may improve the people's lives and actually increase productivity in times where demographics are decreasing everywhere around the world. So this, I would say, is a major theme. So digitalization and AI-related technologies. And we think of it technology, but in reality, a lot of the businesses coming up and claiming to be technologies that are actually cannibalizing a lot of traditional businesses.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
Investment story in AI is real, and it's going to be significant.
Once again, AI CapEx plans are actually exceeding expectations.
The market is pricing in some idea that you are going to get that broadening of the AI benefits.
AI is a watershed event on the timeline of technology, and we believe that this flows through all 11 sectors.
AI has the potential to be the biggest productivity enhancer for the global economy since electricity.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance starts right now. Your opening bell is 90 minutes away. Your scores look like this. Equity futures positive, up nicely on the S&P by 0.8. On the NASDAQ, up by 1.2. Thank you, Meta. Thank you, Microsoft. These two names right here. Meta up by 12%, Microsoft up by 9%. Think about 4 names that make up 20% of the S&P 500, $11 trillion of market cap. 2 names down, 2 names to go. After the bell today, after the closing bell, you'll hear from Apple and Amazon. Big tech reports, so far, so good.
So far, so good. Today might be a little bit different given where expectations are coming in and this sort of tale of two techs that we've been talking about all morning. Yes, the hyperscaler is doing really well, and Amazon probably can fit in that bucket given the fact that AWS, their cloud computing business, really does drive their revenues. Apple's going to be the interesting one. They deal in stuff, and their stuff isn't purchased as much. They've got the China overhang, they've got the manufacturing questions, and they have the AI adoption that hasn't come to fruition in the same kind of way. That is going to be a real wild card in otherwise a tech bonanza.
They've got a whole bunch of problems, that's for sure. That stock is down by double digits so far this year, but Microsoft, Meta, the numbers are absolutely amazing. When you're spending this much cash, you need to start demonstrating to investors that you're starting to see growth off the back of it. That's exactly what they did, and some. The bar was already high. They hopped over it.
And that's the reason why the likes of Meta is demonstrating that actually when it comes to things like advertising, guess what? They can charge more if those advertisements are 10 times more effective and can target people in a way to get them to actually spend their dollars. It points to the concept of what a moonshot some of this technological development could be for the economy, for corporate profitability, for efficiency, and whether this is going to be inflationary or deflationary. The fact is, how do you price in something that is a moonshot and that's on this kind of scale? And I think that's the reason why people have been grappling with the importance of things like policy shifts, whether it's the Fed or whether it's the president.
Lots of earnings coming up this afternoon, some data as well later this morning, 8:30 Eastern Time, jobless claims, then on to tomorrow. Payrolls, the payrolls report just around the corner, heading into the weekend. Coming up this hour, we'll catch up with Gargi Chowdhury of BlackRock following strong tech earnings, Walt Piecyk of Lightshed Partners previewing results from Apple, and Jonathan Pingle of UBS reacting to this morning's data. We begin this hour with stocks rising on better than expected earnings from big tech. Gargi Chowdhury of BlackRock writing AI and tech continues to lead here, pushing back on the broadening out narrative yet again, as underpinned by strong beats from Meta, Microsoft, and Google. Gargi joins us now for more. Gargi, good morning.
Hi, good morning.
Just phenomenal beats from these companies. How difficult is it to leave the US behind and just pile into this Europe trade, pile into this everything else trade?
You know, one of the things that we've been talking to clients about is the need for diversification, but at the same time, not giving up on the US tech AI theme. And I think to the extent that investors have not had any international exposure, massively underweight, for those investors, having some exposure to quality international names does make sense. But so important, as was made evident by yesterday's earnings, what you need in your portfolio is parts of the equity market that are continuing to have revenue growth, continuing to throw out amazing amounts of free cash flow. And Jonathan, I think you made that point earlier, that we're finally getting a ROI on all of the CapEx that has gone in over the last year. And we're seeing the world's largest companies growing revenue in the high double digits, which is amazing.
In some ways, the least interesting thing about this week is tariffs and the trade deadline. Now, if you'd asked me that on April, back in July, whether that would be the case, July 9th, going into that deadline, I would have said, what are you talking about? Tariffs is like the story. Do you think that's going to reassert itself in the months to come?
I think we're all, and I know I follow your show, you're focusing in it as well. Obviously, some of the headlines yesterday around copper, around India tariffs, those idiosyncratic stories are going to drive certain markets. And eventually, in time, when we realize what the landing zone of tariffs will be, whether that's closer to a 15% or a 20%, eventually we will see that feed through. And we're already kind of seeing that in goods inflation, certain components of goods inflation. So it will appear, it won't disappear, it will appear in data, and it will appear in margins, or it will appear in certain foreign companies reducing their prices. But as of right now, I think the bigger theme is the two things. Number one, the ROI on CapEx coming through, and large cap tech and AI really being the story that's going to propel US exceptionalism forward. And I think the second one, which is also less exciting this morning, which is that the Fed, while I think they were quite hawkish, they're still telling us in their own way that if things wobble, especially on the unemployment rate front, they are here to start cutting rates. And I think that's something else that the market will eventually care about as well.
When you put these stories together, there's sort of this big question underpinning the market. When are we going to get the trickling out of some of the benefits that the hyperscalers are experiencing to the rest of the market? When are you going to see a broadening out where their leadership isn't just a ballast amid a storm, but really something that is driving gains in efficiency and profitability across corporate America? How far away from that are we?
So I think depending on what people mean when they mean broadening out, I would argue you're seeing some. And then at the same time, you're obviously continuing to see the largest companies throw out the largest revenue growth. So when I say there is some amount of broadening out, I would say when you look at something like financials, when you look at different sectors or subsectors within the equity market this year, you are seeing more of those sectors being in positive territory. That could be one way of thinking about broadening. But at the same time, obviously, you have the largest hyperscalers being the largest revenue growers. And I think that probably pushes back against the broadening out narrative. I think the theme is clear. It is one of moving away from small cap, unprofitable companies to large cap quality companies. And that's what we've been talking about. And many, you guys have been having a lot of people on your show that have talked about that theme of large cap. Perhaps it doesn't feel as comfortable to talk about it if we also talked about it last year, but it's still working and it will continue to work. I think the theme going forward for the next 6 months is finding pockets of diversification in your portfolio in addition to this AI and tech trade. International plays a role there, fixed income plays a role there, assets like inflation-linked bonds, gold, and certainly market-neutral strategies that aren't giving you too much beta, but at the same time giving you alpha makes sense.
International plays a role, and John was alluding to this earlier. There was this belief that international was going to outperform the U.S. earlier this year, and it did. And a lot of it was pegged to the dollar and what we saw the weakening. There's been a huge and violent about-face. Do you think that there is staying power where the first half was the rest of the world and the second half is back to U.S. exceptionalism?
I think that a lot of that violent move that you mentioned was very much around the dollar underperformance. And obviously with July, with the dollar coming back, rallying back, has led to a little bit of that reversal. I think the path forward, a big part of that story will be what happens with the dollar. Frankly, what we're seeing in flows and what we're seeing when we poll our investors and our clients is a recognition of the need to diversify away from large cap because that's all they have. Not because it's not going to generate returns, but because there is a need for getting that value component into portfolios and getting that from international. To the extent, not just US investors, but global investors continue to move away from US into going back to their home countries. So we look at European investors and APAC investors, and many of those investors are just being a little bit more diversified away from the US. To the extent that happens, I think that the international story can certainly have some legs, but not at the expense of US large cap quality and growth.
Let's just sit on the US. When you said diversify, you said diversify the equity. So if I'm in the US right now and I diversify my equity exposure to the international story, given where we are right now with the dollar, is that something I need to currency hedge?
You know, that's an interesting question. Like right now, the view for our firm is still that the dollar can continue to depreciate. Usually what we've seen is that the dollar depreciations happen in these long cycles. It's not just for 1 month or a week. It happens over many months, 18 to 24 months, and we're just in the beginning of that. In that case, obviously, you want some of those foreign exposures. You want that exposure to some of the EM as well as DM currencies. Fixed income, though, is another story, right? So usually what we've seen our clients do is in fixed income allocations, not necessarily taking the FX risk, actually hedging it back into US dollar for that enhanced yield. And that's something that, some of our portfolio managers, especially in fixed income with products like BINC, are doing, taking advantage of the hedged cost for European and other areas, credit markets.
Gargi, appreciate it. It's good to see you. Thanks for breaking it down. Gargi Chowdhury there of BlackRock on your equity market worldwide and a little bit of cross-asset as well. Can you remember a day after the Fed where we talked this much about the Federal Reserve, and by this much I mean this little?
All I can say is it's a victory. So congratulations, you can do a victory lap, Jay Powell, for us talking about Jay-Who and talking about anything else but the Fed. Maybe this is the way it should be.
He can thank Satya and Mark. Let's be very clear about that.
The Fed chairs Satya and Mark. I do think that they right now are driving this economy.
Yes, thank you very much to them. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. The U.S. reached a trade agreement with South Korea that will impose a 15% tariff on imports, including cars. That also sets up a major investment in American energy and shipbuilding. Commerce Secretary Howard Lutnick said the deal includes a $350 billion South Korean fund for U.S. investments, with 90% of the profits, according to him, flowing back to the U.S. Meanwhile, President Trump suggesting he won't make a trade deal with with Canada. Trump posting on Truth Social, quote, Canada just announced that it is backing statehood for Palestine. That will make it very hard for the U.S. to make a trade deal with them. Canada faces a 35% levy on imported goods if it does not strike a deal by tomorrow's deadline. Meanwhile, moving on to China, Chinese authorities have summoned NVIDIA representatives over alleged security risks related to its H20 chips. The country's internet watchdog cited comments by U.S. lawmakers about the need to install tracking capabilities into advanced chips sold to other countries. The move comes after CEO Jensen Huang visited Beijing just earlier this month. That's your Bloomberg Brief. John?
Yahara, thank you. Thank you very much. Shout out to High Yield Harry on X, writing this. It's got a picture of Robert De Niro. You're bearish, question mark. Every large tech company is spending $100 billion on AI, and you're bearish.
That's the problem, and that's the reason why nobody is. High Yield Harry, I hope you're loading up this morning.
I'm sure that, what's Tom, triple leverage long cash?
Yeah.
I'm sure this individual's not triple leverage long cash. Equity futures right now, the S&P up by 0.9%, big tech performing. Up next, we'll get you some morning calls, plus we'll catch up with Walter Piecyk of Lightshed Partners, looking ahead to what could be a difficult one for Apple. From New York City this morning, good morning. At the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
You have the Mag 7s supposed to contribute about 2/3 of overall profit growth. But then if you look at what's driving markets, The Mag 7 are driving about 1/3 of overall market action. So that's healthy in our view to see that markets are still benefiting from a lot of different catalysts here, but you still have that anchor when it comes to the Mag 7 and technology to help lift the tides a bit.
That was Mira Pandit at JP Morgan weighing in on the equity market. That rally continues off the back of tech earnings, positive by 0.9% on the S&P, up by 1.3 on the Nasdaq. That's the price action. Here are your morning calls. First up, Dan Ives of Wedbush raising its price target on Meta to $920, expecting 2025 revenue growth well ahead of its initial estimate. Your second call from JP Morgan raising its price target on Meta to $875, saying the company, quote, did not miss a beat in its core ad business. That stock is higher by 11.6%. And finally, KeyBank upgrading Microsoft to overweight, noting fears of its April downgrade haven't played out. That stock rallying 8.8% so far this morning. Let's stick with tech. Better than expected results from both Meta and Microsoft, setting the stage for more Mag 7 earnings. Apple, Amazon reporting after the closing bell. Ed Ludlow joins us now for more. Ed, welcome to the program, buddy. It's good to see you. I was on the way home yesterday following the Fed decision, saw these headlines start to drop on the Bloomberg app and just smiled to myself and just thought, wow, stunning numbers from those two players.
Yeah, they really are. I mean, in aggregate across both of them, it's a very simple equation where all of the capital expenditure is justified by the top line growth, and they gave sort of more granular detail that it directly relates to AI. You know, the Microsoft print was very interesting because for the first time, they told us how much revenue they actually booked from Azure Cloud. In fiscal 25, which was the fiscal year that just ended, $75 billion. Now that puts them at a pretty distant second place in the cloud market to Amazon, who had in the same period revenue for AWS of $112 billion. But it shows like this is going in the right direction. And, you know, Microsoft, I would say, you know, in my relatively brief career, gave us more information about how people are using the technology, the different kinds of customers and how they pay for it, than we've seen for some time. And then Meta, just an astonishing set of numbers. I don't know even really where to go with them other than that they beat across the board and then told us something that we haven't seen for a very long time. They told us what they're going to do next year in 2026, which in tech, you know, there's no crystal ball, but that was something that many investors did not have on the bingo card.
Ed, thank you, sir. Ed Ludlow, looking forward to the program later on this morning, 11 a.m. Eastern time for Bloomberg Technology with Ed Ludlow and Caroline Hyde. Then this afternoon, they're going to be busy again. Apple and Amazon just around the corner. Walt Piecyk of LightShed Partners has a neutral rating on Apple. He came out in front in the last few months or so and said the tech giant should also consider a new CEO. Walt joins us now for more. Well, welcome back to the program. Let's talk about what you're expecting from Apple later on this afternoon.
Well, first, Jonathan, I just want to comment on your last segment. The two things about those high-moving stocks is that they're investing in AI, and that's really the issue that we have with Apple. In terms of the quarter, you know, look, there's a pull forward, right? Trump had announced tariffs. I think people went out and bought iPhones ahead of time. We've already seen this commentary out of the major distribution channel for Apple, which is the wireless operators, Verizon, AT&T, T-Mobile, and others. So you are going to see a pull forward of iPhone revenue this quarter. So then the question, as it always is for Apple, is, you know, what is the guidance for next quarter? But again, that focuses on, I think, you know, the near term, where what investors are really wanting to know about is what is the AI strategy for this company for the long term? Because clearly the companies that are succeeding in the markets today and seeing investor dollars flow into them are those that have a clear AI strategy.
Well, this just points to the idea that we might see their expense costs go down because they've lost a couple of pretty high-profile AI technicians and strategists to the likes of Meta, which is offering $100 million payouts. I just wonder how important it's going to be for investors to see spending by Apple, to see that they are working on getting back some of that promise from this latest technology.
I mean, there's two lines of spending. You have capital investment, where they're investing in the stuff that supports an LLM. It's probably too late for Apple to do that now. But there's another line of spending, and that's R&D, which is over $30 billion a year that the company invests. In the old days, when they would have analysts on that would ask tough questions, you would have people ask and say, like, hey, where are you spending the $30 billion? There'd be some response in terms of the mix of R&D investment in new products versus old products. And there'd be some indication to give investors some hope that there would be new products or services incoming. Then we know what happened, right? Things like Project Titan that would have gotten them into autonomy were killed. And we saw other products that came to market, like the Vision Pro, that really didn't find a market opportunity. So I think hopefully we have some analysts on the call tonight during that Q&A session that will ask about where are you investing that $30 billion in R&D? What are some of the new products we can invest in? What is the AI strategy for the company going forward?
Well, you've mentioned this a couple times, so we have to go there. You think that the analyst community hasn't done a good enough job holding the feet to the fire of Apple at a time when it seems like maybe some of their strategies were overly complacent?
I think it's a problem with earnings calls in general these days. We do at LightShed, we do a quarterly review of this. We count the number of times analysts get on call and say, "Great quarter, guys." I heard it last night on another call again for a company that had a $1 million in revenue, and an analyst was congratulating them on a great quarter. And they do that because they get on the calls, right? And then when they get on the calls, they don't ask the tough questions that management need to be asked, that investors want to hear to figure out what that long-term strategy is. It's very frustrating.
Well, I see this with journalists too. How do we fix it?
I mean, investors themselves have to put pressure on there. I'm certainly never one for incremental regulation, but I think the investors, the people that actually own the stock, need to start pressuring the companies, or look to us or others to provide. Maybe Bloomberg should start doing their own quarterly review like we do, evaluating which analysts are getting on the call, which have buy ratings versus holds or sells for asking questions on these calls.
Well, Apple's an odd one. It's probably the most well-researched company on the planet. There's only 3 cells on it, and to your point, it's a company in a difficult spot that should face some difficult questions later on this afternoon, and well, maybe won't. The issue that I have with some of the bulls is they often come on the program and talk about the same thing over and over again. They'll talk about growth that's coming further down the line. They'll talk about an upgrade cycle that doesn't seem to be happening well. When do they capitulate on that? At what point do you think they have to?
I mean, to me, that's just laughable, right? I mean, you're exactly right, Jonathan. I mean, it's the 5% growth that it doesn't happen next quarter in the guidance. So they just said, oh, it's going to come the quarter after that or the quarter after that. But I think, again, look at Apple's performance relative to the Mag 7. It still has a multiple that's a premium, right? It's still a good brand in the market. There's still an opportunity, I think, for them to get out of this if they get more focused on product and developing, some type of AI strategy. I've suggested that may require a change in the management, a change in the CEO specifically. There's others that think that they can do it with the existing CEO and just give them another year. But the problem with that is, a year from now, what is the market going to look like? What products are going to be in the market that are already disrupting Apple? The pace of innovation because of AI is faster than anything we've ever seen. Everyone agrees, right, more or less, that AI is going to be something that's have a bigger impact on our economy than even the internet did. And yet, we're still not getting the questions asked of them in terms of, what's going on with AI? Why do when I still use Siri today, why does it still work the same it did, 3 years ago, it seemingly to me, when I can pick up ChatGPT, press their audio button, and it works great?
Well, before we let you go, I'd love to hear your take on China and India and the manufacturing pathway for Apple. How much visibility do you think they're going to give? Will people be making iPhones in New Jersey?
I mean, there was some excitement about some shift of manufacturing to India, but there's been a great book, I forget the name of the author, but that came out recently talking about how Apple has moved manufacturing to China, has enabled that country to be a manufacturing powerhouse, and the difficulty that exists in trying to move that, to other countries, whether it's India, the United States, or elsewhere. So obviously that remains, there's always these like existential or, existing risks, whether it's manufacturing in China, the $20 billion plus that Google pays them for search, which is obviously under scrutiny of the government because it was used as a way to keep Apple out of search. There are these big ticket items in terms of events that can certainly, still happen. That's not a way to invest on these big ticket items that, that may or may not happen. We should be focused on at least where the AI strategy is. And look, you're right. Like, I don't know what they can update us on in China, how quickly they could get out of China. It's doubtful they would have anything that would make the market the concerns go away, that all of a sudden you're going to move this amount of volume out of China back to a different market.
Well, appreciate your time. Walt Piecyk of Lightshed. Thank you, sir. You're thinking of Patrick McGee as well. Apple in China, fantastic book. From New York City, more data up next.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential makers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
The up and about 60 minutes away. Economic data seconds away. Your scores going into it look like this. Equity futures on the S&P positive by 0.9%. On the Nasdaq 100 higher by 1.3%. In the bond market, your scores 2-year, 10-year, 30-year. Yields higher yesterday, lower this morning. We're down by 3 basis points on a 10-year to 433.82. On a 30-year at the very long end of the curve, 486. Call it 487. With your economic data, let's cross over to Mike McKee. Good morning, Mike.
Good morning, John. Well, numbers, we got a lot of numbers for you here. The employment cost index rises 0.9%, same as the first quarter. That's something the Fed keeps a close eye on. We'll see what the wage component of that is. Initial jobless claims, 218,000. That is only 1,000 more than last week, so no sign that the employment side of the Fed's mandate is a problem. But let's go over to PCE, where prices rise on a headline basis 0.3%. That's up from 1/10, but it matches the estimate for the month of June. On a year-over-year basis, the headline up 2.6%, so that is a 3/10 rise from what we saw in May. The core is up 3/10. I want to look at the 3 digits for that one as well. 2.8% is now the core price index for the PCE core, 2.7% last time. So that's a 10th higher than it was in May and a 10th higher than was anticipated. And when you look at put all these numbers together, guys, what I would say is we should probably throw up a graph or something of the PCE because the line is going up. And if that continues, it's hard to imagine the Fed wanting to cut rates at all.
Mike McKee, thank you, sir. Stay close. I'll just run through the price action cross-asset briefly. Not seeing a major move off the back of this. We can start with equities on the S&P 500. Still positive off the back of tech earnings. The Nasdaq higher by 1.3. In the bond market, yields were lower going into this. They stayed lower. We're down by 3 basis points on the long end of the curve on 10s at 434. And in foreign exchange, major move higher in the US dollar. I say major because we are facing potentially the best week for the US dollar going back to 2022. This morning, a bit of dollar weakness against the euro. Euro dollar 114.37. But I'd just like to pair this data with a line that came from Chairman Powell yesterday, that inflation is further from our goal than employment. And in many ways, when you look at the inflation read this morning, kind of speaks to what the chairman was speaking about just yesterday.
Yeah, you're not seeing initial jobless claims pick up in any kind of material way, and you do see a slight upward revision or upward surprise to that core PCE, which is what they look at, and you are seeing the upward trend. He did say that this is part year-over-year comps, et cetera. I do think it's notable that the employment cost index surprised slightly to the upside, 0.9% versus the expected 0.8%. Again, nothing shocking. This isn't going to be 1970s runaway inflation type numbers. However, it feeds into the idea that employment isn't necessarily the disinflationary force that a lot of people thought it could be.
Mike, stay close. We'll come back to you in just a moment. I want to bring in Jonathan Pingle of UBS. Jonathan, good morning. Good to see you.
Thank you. Good
What's your first take on this data this morning?
Well, most of it looks largely in line with expectations. Not really that far. I don't think this is anything that's really going to change the narrative. You know, initial claims have rolled over a little bit. They look low. The employment cost index, you know, it's still going to be consistent with the general cooling that we've seen in the labor market. You know, I think about sort of the inflation data coming in this morning. I mean, this is exactly what we sort of predicted after yesterday's GDP report, where we got the quarterly numbers. So overall, this looks kind of in line. I think the one thing, you know, going to Lisa's point and also going to Chair Powell's point, being data dependent yesterday, is there's a certain amount of directionlessness in this, right? The GDP report shows some slowing. You know, you can sort of probably pick and choose to tell a lot of different stories right now. I think what Chair Powell really wants to do is see the next 2 months of data, and then they can decide what they're going to do in September. But I don't think this morning it's all so close to expectations. I'm not sure this is really going to change the narrative a whole lot.
We've been talking about this stasis, this uncomfortable stasis, particularly in the labor market for quite a while. We're not really going anywhere. And there was this feeling that it was going to break and had the potential to break to the downside. And that was the point that Chris Waller raised. We're certainly not seeing that today. How big has the possibility of a break to the upside gotten, especially after seeing some of the corporate earnings that we have?
Yeah, I mean, that's a risk, right? So clearly first half growth slowed, and the June employment report in its details was pretty weak. I mean, excluding returning strikers, private employment only expanded 68,000, which would be a weak report in almost any U.S. expansion. The breadth was poor. The work week fell. In fact, work week's been declining, so the number of people who are actually working are seeing less and less hours that they need to work. So I think that's the backdrop. I think, I think Governor Waller and Governor Bowman made really legitimate points about the potential risk. This sort of goes to the directionalist, and I think also the importance of tomorrow's report. I think we're all looking for signs of which way, as you say, is it going to break? Is this going to break, like, is this temporary, transitory, or is this a slowing that's going to continue to slow? And I think that's really what's going to drive the September rate decision, because there's a point they're just not going to want the labor market to slow any further. And I think a 68,000 gain in June is sort of that kind of litmus test. But they get 2 more reports to see is that the new run rate, or is this going to rebound?
Why does the chairman keep calling it solid? Nothing you said sounded solid. A low churn dynamic in a labor market can hardly be called solid, can it?
Well, to Chair Powell, it can't. Yeah, no. Chair Powell's comments are fine. Like, look, the unemployment rate is still relatively low. But Chair Powell said more than once to a number of questions he thought the risk to the labor market to the downside. And I think that's the concern, right? Does the unemployment rate just sort of stabilize here, or is there, some risk of deterioration?
Do you think they have to take the leap of faith in 2 months' time? Do you think they have to make that decision on September 17th, or can they just stay in this wait-and-see mode for the foreseeable future? We've spoken to a lot of people that see no rate cuts in 2025. Is this just something that could continue through the year ahead?
Look, if non-farm payroll employment is going to run 150, 200,000, there's not a whole lot of reason to cut rates, right? So I think we can all be clear on that, right? No. I think Chair Powell yesterday sort of raised two issues. One is sort of the level of inflation, the level of employment, but he also talked a lot about the risks as well, right? So I think in September there is going to be some sort of risk assessment, 25 basis point rate cut, just to sort of keep in the markets mind that the direction of travel is lower, which is something that he said yesterday. Maybe some sort of risk management approach that they want, but they are going to need to see 2 months of data, I think, to make that assessment.
It's been a couple of months, it feels like a couple of years, where we've been in a crystal ball that's been completely clouded with blindfolds over our eyes, trying to understand where we are in this labor market. Adding to the confusion, about an hour ago, we got this data coming from Challenger Gray and Christmas about job announcements coming from companies. Job announcements do not always mean job cuts down the line, but they seem like they're getting pretty high, that this is the second highest July for a July increase in announcements, trailing only 2020 in terms of how high they are. A lot of companies citing artificial intelligence as one reason why they are planning to cut jobs. Do we have an understanding of what the technological overlay that we've been talking about all morning will do to the labor market?
We have no idea. I don't know what to tell you. First of all, this is not. So the Challenger, it's interesting the fact that they noted it in the headlines, but we have been hearing the anecdotes from the consulting companies and others that are, scaling back their hiring because they can do more with AI. So clearly, this is in the margin, starting to seep into firms' productivity growth, reducing their demand for labor. But we don't know what the speed with which this will be taken on board and transpire, nor the overall extent and magnitude, what range of tasks get replaced. And we're just still at such early stages. But I will say, we've done some empirical work on layoff announcements and claims, and they do tend to lead initial claims with about a 3-month lag. So the idea that, if this is sort of a new level of layoff announcement and it shows up in things like, warn notices that inform UI, these do tend to translate into claims eventually.
So is there an inverse relationship to the gains that we're seeing in technology and what we could see in the U.S. labor market, say in 3 months' time? Is that something that economists are trying to wrap their head around?
I think we're all trying to wrap our head around it. But yeah, no, it's totally possible, right? So, if we think about what happens in these productivity gains, when we see true productivity gains, they do tend to be labor replacing. Right. And I know that sounds really dangerous, but if you thought about like the 1990s experience, there was a lot of technology taken on board that was labor replacing. But we had such strong growth from that productivity growth that labor was reallocated to other expanding sectors. And it was really a very positive feedback loop for the U.S. economy.
Mike McKee wants to jump back into the conversation. Mike, I know you've had a second look at the data. What do you see?
A couple of interesting things, John. First, when we look at the spending numbers for Americans, the goods purchases were up 0.5% after 2 months, basically, of decline. And that was something that Jay Powell emphasized yesterday, that goods spending is starting to pick up. Services spending is the same as the last 2 months, is up 0.3%. So goods spending rising faster than services at the moment. In terms of the ECI and in terms of the income numbers, wages and salaries up just 0.1% in June, according to the personal income figures. But according to the employment cost index in the second quarter, wages and salaries were up 1%, a full 1%. So make of that what you will, Jay Powell and company. When you look at disposable personal income, it was up 0.3%, not a whole lot. The savings rate up 4.5% right now. And then I mentioned I wanted to look at the 3-digit numbers for the PCE cores. And what we're seeing is that the PCE headline was 0.281, so it rounds up to 3, and the core 0.256, put it that way. That is up from the prior month, but it wasn't as strong as some people thought. There was a feeling that we could go as high as a 0.4 change. When you look on a year-over-year basis, though, the headline PCE, which is the Fed's number that they're following, and the core PCE on a year-over-year basis is 2.793% when you take it out to 3 digits. So it's less than 11 basis points, basically 10 basis points away from 3%. And 3% would probably be an impossible sell for the Fed in terms of getting a rate cut going. So this is something that the Fed is going to be watching very closely over the next couple months.
It's a good point, Mike. Appreciate the update. Thank you. Michael McKee there breaking down the data. Jonathan Pingle, UBS, is still with us. So, Jonathan, let's take a few more beats on the labour market if we can. Payrolls tomorrow. Guess for 8:30 Eastern time. The Pingles are very good at this. What are you expecting tomorrow morning?
We're expecting a 95,000 headline gain. So a step down in the headline gain. But if we think about the details, really details that are going to be no softer really than June. Private employment rising around 90,000, work week stable. Unemployment rate ticking up to 4.2%.
Does the unemployment rate take on additional emphasis now, additional importance after Chairman Powell yesterday?
Well, I think it do. I mean, there's always been this tension inside the Fed over the unemployment rate. You know, it's a stock, so it's relatively slow moving, and non-farm payroll employment is sort of the flow, right? I mean, it's the faucet into the bathtub. We used to have this bathtub model at the Fed, right? So they are going to have this challenge of trying to understand, you know, because normally you'd say if non-farm payroll employment did X, that will tell you the direction that the unemployment rate is headed over time. But right now there's such confusion over what the trend in labor supply is with the fall in immigration. We've also seen a big drop in the participation rate for other reasons lately, which has cooled labor supply growth. So I think that it does put a little bit more emphasis on the unemployment rate and trying to understand what these underlying trends in the labor market are.
Jonathan, appreciate your time.
Thanks
Good
for
to
having
see
me.
you. Thank you. Jonathan Pingle there of UBS. Looking ahead to payrolls tomorrow, 104,000, the median estimate in our survey. The range, as we've said repeatedly over the last 24 hours, is incredibly wide.
Yeah, going from 0 to 170. I would love to be a fly on the wall with the Pingles ahead of payrolls Friday, given the robust argument and the Jonathan Pingle 1 and Jonathan Pingle 2 discussing.
Just remember that Pingle Jr. outdid Pingle Sr. in the last 12 months.
I hear that's a point of real contention.
Yeah.
I hear that this is a problem when
We'll
it
get
comes
you
to
an update
Thanksgiving.
on how 2025 is going later on this year. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. Recapping the latest data, core PCE picked up in June, rising 0.3% month over month and 2.8% year over year, showing progress stalling on the way to the Fed's 2% target. Consumer spending also rose slightly after a decline in May. Better news in the labor market, where jobless claims came in below expectations at 218,000 for the week. Meanwhile, a DoorDash driver may have saved the life of an employee at the Blackstone building in New York City, where a gunman earlier this week killed 4 people before turning the gun on himself. According to the Wall Street Journal, the employee was heading down to the lobby when the driver texted her about the gunman. The woman immediately took shelter with several other colleagues. Wow. Meanwhile, Roblox shares are surging 18% in the pre-market after raising its full-year revenue guidance. The video game platform's daily active users jumped to nearly 112 million, and users also spent much more time on the platform. Much of the activity is due to the popular game Grow a Garden, which in July set a world record with nearly 22 million concurrent users. Apparently, growing a garden outside is overrated. That's your Bloomberg Brief. John?
Yahara, thank you. I'm still wow. Make sure you tip your delivery driver later on. That is just a phenomenal story.
Yeah, and it shows how people are people at the end of the day and are going to look out for each other. And hopefully that will be the takeaway going forward if we can have one positive lining.
Phenomenal. Up next on the program, let's set you up for the day ahead. We'll catch up with Mark Lehman of Citizens JMP Securities, looking ahead to another big afternoon full of tech earnings.
You've said 25% last year, I believe, of Google's code is AI generated. You have over 180,000 employees right now. Is it half that in the future?
I expect we will grow from our current engineering base even into next year, right? Because it allows us to do more, right? I think the opportunity space is also increasing. I just view this as making engineers dramatically more productive, getting a lot of the mundane aspects out of what they do, allowing them to spend on higher value-added tasks. But that means it's an accelerator. People will be able to do more, which means maybe we'll create new products, and hence we will need more people. At least in the near term, to me, it looks like we will expand engineering velocity, and that doesn't mean we're constrained in what we will do. We'll end up doing more as a company as well.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
I don't think the data is that terrific. No, it's not a catastrophe by any stretch of the imagination. But there's more than a hint of stagflation in the numbers we saw in the first half of this year, looking at it together. One of the confusing signals here is the disconnect between GDP growth and the job market. We see consumers cutting their spending back, but continuing to get jobs, continuing to get raises.
We got economic data just moments ago, 20 minutes ago. Data's okay. No big changes there whatsoever. No big changes in this market either, driven higher by big tech. Equity futures positive by 0.9% on the S&P 500. On the NASDAQ 100, higher also by 1.35%. With your morning movers is Danny. Hey, Danny.
Hey, John, let me show you what big tech is doing this morning, because this is the difference as to whether your portfolio is outperforming or not this morning. Meta up 11.3%. Microsoft up 9% this morning. Blowout numbers, both the results themselves and their key businesses, and the tens of billions every single quarter that these companies have committed to capital expenditures. Taken together, they're going to add about $530 million in market cap to this equity market this morning. That's about the size of a Netflix. Meanwhile, we also heard from eBay after the bell yesterday. Really strong results. The CEO there pointing to the resilience of the American consumer that keeps spending and has outsized purchasing power compared to their European business, for example. Also pointing out that they're less exposed to tariffs considering eBay is secondhand goods. So those shares up 12%. Also, when it comes to consumer demand, another good sign, this one coming from the cruise operators, this time Norwegian. They initially flagged in April some unevenness, some bumpiness, pullback in demand for consumers. Well, they say it is back. People are back booking cruises, reflecting some of what we heard from some of the other operators this earnings season. Those shares up about 13.33%, John.
Danny, thank you. Thanks for this morning. Appreciate it. Plenty going on in the last 24 hours. Lots still to come through the next week. Here's the trading diary. Still to come today, 4 p.m. Eastern Time. President Trump signs executive orders after the closing bell. Results from Amazon and Apple. On to tomorrow, July payrolls and President Trump's self-imposed tariff deadline. A sneak peek of next week, Monday, durable goods. Tuesday, the trade balance, PMI data, plus
AI, 40% of the expenditures in AI, the venture dollars are being spent in San Francisco. And those are all back to work dollars. They want people in the office and that kind of energy that you get when they're there. So a combination of that market resurrecting both in the real estate and in the work environment, but as well as in the kind of companies that are really changing the way we do business and changing way. And like I said, I think it really is just the beginning. And fortunately, at Citizens, we got a big effort in the private bank and in wealth and other things in California, and we're benefiting from that as well.
How much do you see startups and acquisitions and things of that nature on the heels of some of the high profiles, hyperscalers, with promise of future advancement? I mean, do you see that pipeline really building?
We do. I mean, we've seen some of the big firms. You saw Meta make a very large acquisition earlier in the quarter, or earlier in the second quarter. It was a $15 billion acquisition to buy half of a company, and that sounds like a lot, and it really is, but for a company like Meta, it's really not. We're seeing a race for talent, and that race for talent is really second to none that I've ever really seen. But the ramifications for business across every single business is just that real. And I think, again, we're in the very early innings of that. And like you said, very fortunately, the public-private partnership that we have in San Francisco with Mayor Lurie is actually working.
Mark, how is this going to work for startups? Let's say you're a highly talented individual, you take a role at a startup, and they offer you, as traditionally is the case, equity in the business. And all of a sudden, some of the senior members of the team get poached, and all of a sudden that equity is worth nothing. How's this all going to change in the next couple of years, given how aggressive Meta's been over the past few months?
It's the right question. I mean, what Meta's doing is they're buying talent, but they're buying the companies. So it's a little bit nuanced, but they're really buying the companies. What I've been saying for some time is Meta has all the data, and they need a lot more talent. The startups have all the talent, and they need the data. And there's some melding between the two that's very, very complicated. And you're seeing this unbelievable, unprecedented ascent of valuations here that we've really quite never seen before. But I do think, Jonathan, that there are opportunities, yes, the big LLMs and all the things that you're seeing, but there's other opportunities for startups that, frankly, is a resurrection of talent, and people are really putting venture dollars to work.
What's your advice to some of the talent entering the industry right now? What would you tell them?
You know, it's funny, my soon-to-be nephew asked me the very same question a month ago, and it was between a very well-established company and a startup. And he chose the well-established company because that was better for him. I think for a lot of entrepreneurs, that dream is alive and well, and we are still the best country for innovation and best country for startups, and that is getting proven time and time again. We haven't even mentioned what's going on in data centers and all the other things and the ramifications of that. That's happening here right now, real time.
Love the optimism. It's good to see you, as always. Mark Lehman there of Citizens JMP Securities on the future, particularly for San Francisco.
You read my mind. I was thinking, you know, say somebody was going into college or had children going into college at some point in the near future, you know, what would the major be that they should go into that would give them a leg up in the war for talent, not in the careers rendered obsolete? I mean, that's sort of...
Remember, it was 5 years ago, it was coding.
Yeah, exactly.
10 years ago, coding. Now it's electrical engineering.
Is that what it is?
Plumbing.
Quick word?
The only thing I'd say for all those budding entrepreneurs is AI is going to create great IQ for all of us. Let's make sure our EQs are up there as well.
Okay, so pay attention to your manners.
There you go.
Yeah.
We'll leave it there.
Clean your room.
Coming up tomorrow, some advice for the kids, I think. Okay. Is that direct? Do you want to talk to them directly?
It's okay. Let's just
all right, we'll move on.
What's going
all right. Coming up tomorrow, Sebastian Page at T. Rowe Price, Premier of JP Morgan, the former senior Trump trade advisor, Kellyanne Shaw, plus we'll catch up with Nadia Lovell of UBS. Payroll's just around the corner from New York City. That does it for us this morning. Thank you very much for choosing Bloomberg TV. This was Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
You have had a number of games overseas in recent years, and in fact, you opened the season going to the opening game in Brazil. So do you expect to do more overseas games, and is that a part of your strategy?
It is. We had 5 last year. We expect to have 8 this year, which will be the highest we've ever had. Our hope would be at some stage to get to 16 games in the next few years. We think we can do that. I think it's an indication of the popularity of our game. Every time we take our game to a new market, Brazil's a great example of it, the fans go crazy for it. They sold out the tickets in less than 90 minutes. People had a wonderful time. It was the talk of the town. And I think it will be the basis and the sort of the match that lights the excitement and the popularity of the game in that market, as well as what we're doing around the world. So we're very excited by it. It's just one element of that strategy. You need to have television. You need to have activity and participation in the sport, and flag football is a big part of that. So all of those factors, I think, are going to be what we think will be a very successful formula to be a global sport.
Do you ever envision having a team that's based overseas in Mexico City or in London?
Listen, we've talked an awful lot about it, and I think there are markets that could, without question, support an NFL franchise.
Welcome back to the circuit. This time, we're taking you to the frontier.
Do we have a camera, or do we don't want to lose you, Emily, in all of this?
Stargate, put that name down in your books. What we're undergoing right now is sort of the largest infrastructure build in human history.
To meet the people rewriting the rules of code and culture.
How do you personally grapple with the pace of it all?
It does feel like it's going very fast.
When did you realize, oh my gosh, my life is never going to be the same?
The day I got engaged, I was like, whoa, what have I bitten off here?
Where the future gets real.
How confident are you that AI's promise will outweigh the perils?
I'm not confident.
So the tech companies are lying or fudging.
And a little weird.
What's the point of this?
What is the point of any of this?
Tune into Season 3 of The Circuit with me, Emily Chang, Thursdays at 6 p.m. Eastern on Bloomberg Originals and Bloomberg TV.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Michael McKee in Victor, Idaho, and this is Bloomberg.
We are off to the races. 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, Meta seizes its AI moment as Microsoft joins the $4 trillion club. Apple and Amazon take the spotlight tonight. President Trump unleashed a flurry of last-minute trade moves ahead of his tariff deadline, including surprises on India and copper. Plus, the president has renewed his feud with Fed Chair Jay Powell as the deluge of data continues. Such amazing alliteration.
There we go. And there's a lot to get into, as Matt just walked us through, but I think we have to start with earnings, and we have to start with some of these big tech names. Meta soaring as it takes advantage of advertising revenue to boost its AI spending, which is now expected to top $100 billion in 2026. Microsoft is behind me, though. Here we go. Here's Meta, up about 11% right now.
They're different stocks, even if...
They both start with F.
That's true. I was going to point that out as well. Microsoft is the one that's going to hit $4 trillion today at the open, thanks to a strong cloud growth and AI expectations. The company says 800 million people interact with its AI features in some way, shape, or form, which seems like a lot. It seems like a lot of people.
Yeah, absolutely. Let's get deeper into these tech earnings and welcome in a roundtable now of Bloomberg Tech co-host Ed Ludlow, as well as Bloomberg Intelligence Global Head of Tech Research, Mandeep Singh. And Ed, I'll start with you. And honestly, it's hard to know which of these companies to start with. So let's start with Meta, because we were talking about that massive spend. It depends, of course, on the advertising revenue continuing to sort of knock the cover off the ball, to borrow a phrase from Matt Miller. It seems like for right now, that dynamic is working well.
Yeah, the simple story or the reaction from analysts is that what we saw in growth in the core ad business as well as ad pricing justifies ongoing investment into AI. So the headline was that capital expenditures in the current fiscal year, they narrowed the range, right? $66 billion to $72 billion. But what was most unusual, like it was a big surprise, was in the CFO Outlook commentary, but also on the call, they gave us a lot of detail about what happens next year in 2026. And basically, what Susan Lee, the CFO, said was that capital expenditures will continue to grow and grow at a rate that's above this year. It's a really long-term commitment from Meta to continue investing in infrastructure. Data centers the main cost from a CapEx perspective, but increasingly talent hiring is a part of that. And on the OpEx side, they were also kind of honest that, like, look, our leases and our energy costs are going to go up proportionately as well.
So let me ask Mandeep, if they have the free cash flow, do they have the actual cash on hand? How do they finance this?
Well, so you're right. Up until now, they were able to use the free cash flow that they generate from their operations to fund their CapEx. Now, when we are talking about next year, 100 billion plus in CapEx, clearly that's not sufficient, and they're probably going to partner. And look, when you are growing 22%, I mean, the street is going to give them a lot of benefit of doubt that they'll be able to monetize, and, you know, the top line will continue to benefit from AI spend. But right now, we don't have enough proof points because their large language model still trails, you know, the likes of OpenAI and ChatGPT. So a lot of this AI top line growth is really maybe taking share from the likes of TikTok. We don't exactly know for sure that, you know, AI is getting monetized the same way it shows up for Microsoft. In Azure, you know, AI is 21% growth contribution, and that's the cloud infrastructure that they have a backlog of over 300 billion. So the visibility for Microsoft when it comes to AI spend is far more than the likes of Meta, where, again, they are benefiting, but probably not the same way as Microsoft is.
And you mentioned Azure, so maybe we should talk a little bit more deeply about that, because this was the first time that they broke out Azure revenue, correct? And how does that set us up as we get into some of their rivals' figures coming tonight?
I mean, look, Azure is an $86 billion business, growing at almost 40%. So when you compare that to an Amazon, which is $115 billion run rate, growing at close to 18, 19%, I think there is clearly a share shift going on, driven by AI. And so with Amazon, you want to see that sequential increase in growth. So Azure went from 35% to 39%. Because they said it will be supply constrained, chances are they're probably going to top 40% next quarter. You want to see that same sort of sequential improvement in Amazon AWS growth. It has to grow from 18% to probably over 20%. If they don't do that tonight, probably you can infer that Amazon is losing share, because we saw that from Google. They went from 28% to 32%. So that sequential growth is very important for Amazon AWS.
And Microsoft says 100 million people use its Copilot, and that 800 million use its AI products in some way. Are they just making these numbers up? That doesn't sound real.
No, I'm sure they're not making them up. But Mandeep's earlier comparison was really interesting. Do we have better data for Microsoft or Meta on how AI is being used by the user base or core customer? So Copilot is interesting because saying that more than 100 million people a month use it for Copilot AI stacks Microsoft up against ChatGPT, even on the enterprise level. You know, it's a more directly comparable data point. Compare and contrast with Meta. What we learned about Meta was the core ad business has been strong. There's been pricing strength because of AI investment, and even Chinese advertisers pulling back, they still did well. But this big vision that Mark Zuckerberg has for AI, we don't have the same Copilot data point. What we did learn in the quarter gone is that they actually saw sales of the Quest AR/VR headsets drop, while sales of the smart glasses, which you guys know I'm a wearer of, right? Not today, they went up.
Mandeep too.
And that's the form factor that Zuckerberg's really pinning Meta's AI future on. What is the AI future for Meta? It's one where you buy their smart glasses as hardware, augmented reality at a later date. You use their models through that as a generative AI tool, but they're targeting not productivity gains or knowledge workers like Microsoft does. Zuckerberg even threw shade at that. They're targeting the creator economy and everyday people. We don't have any data around whether that's paying off yet or not.
All right, you guys in your glasses. Before we let you guys run, Mandeep, I do want to talk about what we're expecting after the bell tonight, because we knew that Microsoft, Meta, that these were expected to be up arrow stories. That's what we're seeing in the pre-market today. When we're talking about Apple, Amazon, more of a mixed picture that's expected. So as you dial in tonight, what do you want to hear? Which of these stories are you more excited to get some clarity around?
I mean, in the case of Apple, everyone wants to know their AI play, and clearly there is a big tariff impact now with India getting tariffs. So in the case of Apple, the tariff impact and AI, and in case of Amazon, you want to see that sequential AWS growth. If they don't show that, you're not going to see a similar stock reaction.
All right, we will be watching for that. Mandeep, thanks so much for joining us. Mandeep Singh there of Bloomberg Intelligence. And Bloomberg Tech co-host Ed Ludlow, you can catch his program kicking off at 11 a.m. New York time, 8 a.m. Am I doing that right? In San Francisco. Yes, of course, Pacific time. President Trump resumed his seriously harsh criticism of Jerome Powell after the Fed declined to cut rates. In a social media post, the president wrote, "Powell is too late and actually too angry, too stupid, and too political to have the job of Fed chair." Meanwhile, the market is holding gains following the latest inflation data, which showed an increase at the fastest pace this year. Michael McKee, Bloomberg's international economics and policy correspondent, joins us now at the desk. Mike, I thought Powell was a very good man. Didn't Trump just say Powell was a very good man?
As recently as last week?
Yeah.
Yeah, well, this is all like being called ugly by a frog, as the saying goes. I don't think Jay Powell is too worried about it at this point. You want to make some money, though. Tell the folks at Meta or Microsoft to invent glasses that will enable you to see into the future. That would be useful, because
ball, perhaps.
The Fed is trying to figure out what's going to happen. Yesterday, Jay Powell made the case that the economy is still in good shape, even though they are expecting inflation to rise as tariffs get into the economy. And the data today back up that argument. You look at the PCE headline and core numbers. They were revised up for April, revised up for May, and they're higher in June, 2.6% and 2.8% for year-over-year numbers in terms of the headline and core. And that is certainly not something you want to see if you're thinking about cutting interest rates. Spending ticks up again, up 0.3% after a couple of months of flatlining. Not a huge amount, but Americans are out there still spending some money, in part because they're making more. Incomes were up 0.3%. Now, here's an interesting stat. In the PCE report for income, wages and salaries only went up 0.1%. But in the employment cost index, which is a quarterly number, also came out today, wages and salaries were up a full 1%. So somewhere in there is the truth. And it does appear that Americans still have the money to spend. Now, let's take a look at the labor side of the argument for the Fed. Jobless claims certainly suggest that Jay Powell's right about the strength of the labor market at the moment. We're not seeing any real move towards laying workers off. Here's the ECI, as I mentioned, up 0.9%, same as last month, but we're not seeing a huge inflation impact on that side of it. And wages were up. Now, here's the chart you don't want to see if you're the Fed. You can see in the last couple of months, we're moving up again with PCE inflation towards 3%. If you get to September, and that's what you're looking at, it's going to be very hard to make a case for rate cuts. So right now, the data are saying the majority on the Fed and Powell are correct in their assessment, but we've got a couple more months to go before they meet again.
Well, we'll get another piece of the puzzle tomorrow morning at 8:30 with the unemployment rate. That's expected to tick up slightly. We're going to get into all those details with you tomorrow. That is Bloomberg's Michael McKee. Now, coming up,
more tariff surprises, countries rushing to strike a deal, and copper traders get a huge shock the day before the deadline. We'll discuss that all next. This is Bloomberg Open Interest.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
I think with the new world reorder, it means that there will be regional clusters of excellence. There will be regional clusters of great companies. And so it's okay to be number two, because you could be number two in every single region and still command that premium. Because today we talk about AI, we talk about data, we talk about processes that's going to be very specific to industries, specific to countries, specific to regional challenges that needs to be built and addressed. And therefore, the good of it is that now it's not just going for that one company and overpaying for that company until the returns goes to zero. It's actually about finding regional champions, which could also be huge category leaders for us as funds as well. And I think it's actually good for the world to have multiple pots of excellence that can be localized to its own needs.
Your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Let's get to high interest now. Look at what's making headlines around the world. Rokos Capital Management is asking investors to agree to an increase in their fixed management fees to 2.75% over the next 3 years. But wait, there's more. The performance fee will also increase to 25% over the same period. That decision is driven reportedly by the firm's efforts to invest in talent as well as in research and technology. And as a good friend once told me, these yachts are expensive. The global copper market is reeling after President Trump imposed 50% tariffs on copper imports, but exempted refined metal, so the final product. The decision to exempt refined copper is upending the global trade of the metal, which plays a crucial role in the world economy. You can see that we have big drops today, but yesterday they were way bigger. We need this stuff, obviously, for electrical wiring. Ford Motor is falling in the pre-market. They use a lot of copper. After announcing they would take a $2 billion tariff hit, the CEO, Jim Farley, joined me yesterday to talk about the fallout.
We think it's $5,000 on, like, say, a RAV4 versus a Kentucky-built Escape, and maybe as much as $10,000 on a Japanese-built 4Runner or a Subaru versus, you know, a Bronco built here in Michigan. So it's really meaningful.
Now, Ford recorded that tariff hit before a spate of new trade surprises unleashed by the president in the 11th hour before his August 1st deadline tomorrow. For more, let's welcome in Bloomberg's Washington correspondent Tyler Kendall, joining us live from D.C. So August 1st is tomorrow. What is the logic here? What are people telling you about why perhaps we're seeing this flurry of trade surprises just as we drumbeat to that deadline?
Right, exactly, Katie. It's clear that the administration says that it wants to hold firm on that August 1st deadline, and we've sort of seen this hurry to get some sort of announcement out there, even if we have to wait on the more formal details down the line. And even as we get some of these announcements, like South Korea, like President Trump's threat now against India when it comes to 25% tariffs and then an additional penalty over their imports of Russian energy supplies, there are still a lot of nations that were waiting to see if we would get any movement. I point you to the fact that President Trump is expected to hold a call with Mexico's President Sheinbaum later on this morning. Our reporting indicates, according to people familiar, that negotiations have reached the point where now the decisions have to be made on the leader level. So perhaps that could be taken as a sign of optimism. But we do know that the White House wants a broad array of concessions, particularly when it comes to Mexico, whether that be fentanyl or addressing the goods deficit, for example. I would also point out that we are expecting a few other agreements to come later today, particularly when it comes to Thailand and Cambodia. We heard the U.S. Commerce Secretary yesterday say as much, that they have reached an agreement. Matt and Katie, they are facing a particularly high tariff for that region, 36%, though it does seem like it's going to trend lower.
And if Mexico gets 15% too, all auto production is going to move out of the United States. What does the administration say to the concern that if they're nickel and diming U.S. producers to the point where vehicles cost $5,000 to $10,000 more to produce here than they do in Japan or Korea, it's running counter to their goals of bringing production back?
Right, and Matt, they've been really defensive on that point. They say that they want to bring the investment here, and they want to just start making sure that there is that cushion to lead to production down the road. They really haven't addressed those concerns in perhaps a more meaningful way other than that. I will point out, though, particularly when it does come to autos, we haven't really seen much of a movement in terms of a Canada deal. We did hear from Canadian Prime Minister Mark Carney yesterday, who said that he doesn't seem, he's sort of lowering expectations. He doesn't think that they're going to be able to get over the finish line in time for August 1st. Of course, also at play here with our North American trading partners is USMCA compliant. And while we do see a bulk of goods that are USMCA compliant, ultimately there's still a lot that's left on the table. Just from Mexico statistics, I pulled the data this morning, 83% of the goods that come over the southern border are USMCA compliant, but that still leaves about $80 billion worth of imports that are subject to a higher tariff.
All right, Tyler, certainly a fluid situation. Really appreciate your reporting. That is Tyler Kendall joining us from Washington. Now, some other movers on our radar as we count down to that opening bell. eBay gaining as sales growth tops estimates, and Americans continue to shop on the platform. Shares up a whopping 13% pre-market.
Yeah, big move there. Also, Norwegian Cruise says demand rallied in recent months, allowing it to confirm its guidance. That's good for a 11% gain in the shares pre-market. And we're going to hear from the CEO of Norwegian later in this program. Harry Summer joins us.
Looking forward to that conversation. Let's quickly talk about Shake Shack having a totally different morning, slumping in a big way after the burger chain forecast revenue that fell below expectations, pointing to inflation and those cautious diners. They're spending all their dollars on eBay. They don't have money left over for Shake Shack.
Well, the Shake Shack burgers are very expensive, and I actually need to do the math. Maybe if I cut out my Shake Shack spend, I could afford Zepbound.
Gosh. Which is partly one of the things that we're going to talk about next, GLP-1s. Coming up, a ton of health earnings this morning. We'll dive into that sector next. This is Open Interest.
The most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
U.S. jobs numbers are released, Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
CVS surging this morning after raising guidance for the full year, with the Aetna health insurance arm and its pharmacy unit both outperforming expectations. Bloomberg health reporter Ike Swetlitz joins us now. Ike, you and I spoke to David Joyner about these results, and a big portion of the conversation was about what exactly is CVS doing when it comes to predicting those insurance costs that have tripped up plenty of its rivals.
So maybe a year or two ago, CVS saw similar problems that other insurers are seeing now in the market. They repriced their plans, changed some of the benefits, and so are better positioned now. Other insurers, didn't make those changes at that time, and so are feeling the effects now instead.
What's the result of the huge story around GLP-1s? Because for some of the GLP-1 producers, it turns out to be not great. How is it for CVS?
Well, so one of the parts of CVS's business, Caremark, is a pharmacy benefits manager, which helps employers and other plan sponsors manage their drug costs. And one of the things that they've been doing, starting recently, they've decided to sort of prefer, push patients more toward one of the drugs, Novo Nordisk Wegovy over Eli Lilly's Zepbound, and they are doing that, in order to get a better price on Wegovy. They aim to save those employers and other plan sponsors money. They estimate about 10 to 15% of the obesity medicine costs. We'll see over the next few months as data comes in how that's playing out.
Yeah, and remember, Matt, in May, they dropped Eli Lilly's Zepbound as the preferred drug. That was certainly a win for Novo.
Tirzepatide.
Yeah, there.
Should I go to row.com to get that instead of CVS?
I, as a journalist, am not prepared to give you an answer there. But Ike, before we let you go, let's quickly talk about risks potentially to this upgraded outlook that CVS gave. It was interesting. It seems like vaccines, whether or not people actually go out and get their COVID boosters, could be a potential wrinkle here.
Yeah, so that was something that the CEO mentioned. It was also mentioned in regulatory filings a little bit earlier this year. There have been a number of government changes to CDC recommendations, also just changes in attitude from government health officials. Vaccines are profitable for large chain pharmacies, and so it's a question of what's going to happen sort of in the second half of the year here.
Ike, thanks very much for your reporting. Great story. We're going to continue to follow this because, frankly, everyone cares about CVS.
Yes.
Right? Is that just in New York, or?
I do worry that might be our own bias, but definitely we interact with CVS a lot. We were talking about COVID vaccines. Let's quickly talk about Moderna. Moderna, the news out that it's cutting about 10% of its workforce to reduce spending as COVID vaccine sales decline, potentially also an issue for CVS in the second half.
Yeah, we see Bristol Myers down, as well as Eli Lilly. We'll talk about all these companies at the open and beyond. Just 3 minutes to go until we do that. This is Bloomberg.
For Trump to have been, you're never too young to learn AI. That's why he's urging the government for school kids as young as 6 to be taught how to use it.
Within this system, from first grade, they all start with the AI education. They play 4 years, just playing. And then from 5th grade, they start to develop AI by themselves. And STEM and robotics, I see very clearly how Vietnam should be in future. Vietnam just about 100 million people, young people, good education, and latest technology. That's the only way to go. Education not contribute much profit for FPT, but from the country point of view, that's most useful contribution what FPT should do. And today we're thinking about every kids, not in cities like Hanoi or Ho Chi Minh City, but kids in the countryside should got the good education. That's what we're going to do now.
So you're leapfrogging.
Yes, exactly.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersachian Zahran, and this is Bloomberg.
We are moments away from the start of trading, and we're looking at potentially a new record, definitely another $4 trillion company in Microsoft. This is Open Interest. I'm Matt Miller. We're seeing futures rally pretty hard, 0.8% on the S&P futures, more than 1% on NASDAQ futures. Small caps are moving down. You hear and see the opening bell at the New York Stock Exchange. Figma out with the biggest IPO this year, and they are pumped. It looks like fun. It looks like fun down there. At the NASDAQ market site, you've got Intuitive Machines. The ticker is Lunar, L-U-N-R, and it's a pretty cool business, but the stock has been a dog, down 36% so far year to date. Speaking of stocks, you're looking at one going the other way. Katie Greifeld, what is it?
Yeah, we can't have performance like Microsoft. You take a look at what it's doing this morning, becoming the second $4 trillion company thanks to huge growth in its cloud business. Its CEO says that some 800 million people interact with the AI features in its ecosystem. I know Matt Miller has some suspicions about this. Shares currently up about 7% right now. I believe it was even higher pre-market. I do wonder, Matt, if we could see a Starbucks situation where it opened so much higher and then those gains faded. But at least for right now, people are excited about Microsoft and buying shares at the open.
Buy the rumor, sell the news happens. Katie, do you use Copilots at all, Microsoft Copilots?
No, I'm not the best person to ask.
Apparently 100 million people do. Do you use Microsoft AI products in any way?
I'm very AI resistant.
Apparently 800 million people do.
Apparently.
I don't. So I don't know where those numbers are coming from.
You are representative of every person there ever was, so who knows?
Meta, well, the two of us together. Meta's digital ad growth is still outpacing YouTube and TikTok, helping fuel AI spending, which Bloomberg Intelligence says will top $100 billion in 2026. That's for this one company. They're going to spend over $100 billion on AI next year. They're spending over $70 billion on AI this year, and yet the stock is up. I guess, you know, they did better than expected. They had a great outlook, an 11% gain for Meta Platforms. It's pretty fascinating to watch. Moneta Chief Global Market Strategist Ethan Devitt joins us now to talk about this big run-up in the AI bet. Just when you thought it couldn't go any further, Ethan, it continues to rise and looks like it's going to push us to new highs. What's your take?
Exactly. It did seem, I was surprised at that Meta number 2. One would have to think that a lot of this was already priced in, but clearly there was a lot of money sitting on the sidelines keen to get on this really arms race that we're seeing around AI, data centers, and just spending. So quite surprising. Probably coming from the sidelines of money market funds, but it just really remains to see what the rest of the year has to hold in terms of this momentum.
Yeah, absolutely. That is the big question there. This is a very busy week, to put it mildly. Of course, we got the Fed decision yesterday. We had the press conference. We have a wave of economic data, and we have all of these earnings. For the trajectory of the rest of the year, Ethan, what is really going to be the catalyst? I know the answer is something along the lines of all of them, but what do you think is really the driving force of this market through the end of 2025?
I think when it gets down to the detail, the devil will be in the detail of the execution and how some of these trade deals actually look on the ground. There was a lot of fanfare around the EU trade deal, this commitment to invest in the US, really unprecedented. It wasn't quite clear what the EU got from that trade deal, if anything. Certainly seemed like a net negative for them. But now it will remain to be seen as to how that will actually be enforced. We also have some deadlines being set by President Trump around the geopolitics of the whole region, particularly in Ukraine, Russia, and that will have an impact on the supply of fuel, and we'll see how Europe fares. Europe won't be in any position to fulfill its conditions if it is continuing to be really facing these headwinds. So it's going to be the devil in the detail. We have this strong growth. Does that feel like that on the ground? We're seeing pictures of empty Las Vegas. We're hearing about the consumer feeling the pain. We saw Carvana up today because we know that used cars are in higher demand, probably reflecting a lack of interest in buying new cars. So we do have this kind of coming apart at the seams for the lower end consumer. So it remains to be seen just how this euphoria is translated into the rest of the year.
I mean, I gotta say, Ethan, it seems like Europe got away pretty good with just 15% flat tariffs on the cars that they sell into this market. Whereas U.S. producers like Ford, they had to pay 50% on steel, 50% on aluminum, 25% on foreign parts, up to 80% stacked tariffs on Chinese stuff. And when you get done adding that bill up, they're paying $5,000 to $10,000 more per car than direct rivals being looking at production in Japan or in Germany. Is that a concern to you that the administration is shooting itself in the foot with this tariff policy?
Well, that's certainly been the economic dogma, that tariffs are not good for around inflation, and certainly the Fed seems to believe that. It has not been in any way kowtowed by pressure. We know that today, even though there were 2 dissenters. So they're quite clearly concerned about the effect. We do know that the transmission effect of tariffs is going to be delayed. And we're all focused today, myopically it seems, on the tech earnings. And we've almost forgotten about the old economy earnings that were getting the headlines last week when we heard about just how much these already razor-thin margins in the old economy stocks, like the auto manufacturers, are being erased by tariffs. And this is really where the uncertainty remains. There is less uncertainty, I'd say, in the AI momentum. We all know what direction that is heading. We all know the commitments to expenditure that have been made and the deep pockets that can support that. What we don't know is where the other old economy companies, how they're likely to fare, and a lot of uncertainty still prevails there.
Absolutely. A good reminder on that persistent dichotomy there exists when it comes to the old economy and the new economy. But to that point, Ethan, you asked the question in the notes that you sent over to our producers. Should we look at big tech stocks in the U.S. as a law entirely onto themselves, such as a fifth estate? I'll ask you that same question. Are they a fifth estate at this point?
It does seem that way. They certainly seem to be immune from trade, from geopolitics, from many of the other factors around consumer demand. They have built giant moats around themselves. They were basically dominating the U.S. stock market. Investors seem to like that. They've seen that state of affairs prevail for 18 months. They haven't been in any way perturbed, it seems, by the fact that other smaller mid-cap stocks, as well as older economy or more basic stocks, have not participated. So I would say equally that the seat at the table that these tech leaders are getting now is unprecedented. We've just seen them really start to move the needle and influence policy in a very big way. We saw that with the recent AI bill. They are going to be driving their own vertical integration of supply chains around data centers, etc. So it really seems that they are somewhat untouchable at this point in regards to policy that doesn't affect them.
All right, Ethan, that's a good place to leave it. Great to get some time with you. That is Moneta Chief Global Market Strategist, Ethan Devitt. Meanwhile, let's get a check on this market. We're about 7 minutes into the session, and the numbers look pretty good. You're up 0.7% on the S&P 500. But if you wanted to get a little bit worried here, this is a pretty narrow rally. You have about 200 names in the green, 300 in the red, trading places a little bit there. It's all the names that you would want to see leading the way higher. Microsoft, Meta, NVIDIA, Amazon, the list goes on. But you can see that Microsoft gains, they're already starting to fade. The company's still up 5.5%. Certainly nothing to sneeze at, but still not where we were pre-market. On the other side, you do have Meta extending their gains from the pre-market, currently up about 12%, and Amazon getting a bit of a bid before it takes the stage tonight. Take a look at the downside quickly. You can see that Alphabet dragging us down. You also have Lam Research and Applied Materials on the back foot as well. Let's take a look at what this looks like at the sector level. This is interesting too. You have communications up at the top, up 3%. That's just Meta really flexing its muscles there. Big tech also having a good day, as we know. You go down to the bottom. It's pretty much an even split right now, Matt Miller, but you can see that real estate, consumers, staples, and healthcare are your laggards of the day, even though CVS put up a really impressive beat and raise quarter last night, or this morning rather.
You know, we are focused on here on set and in the control room, Microsoft's GIP graph, because one of our producers, Assad in London, wants to make a bet with you that Microsoft stays above $4 trillion through the closing bell at 4 p.m. The stock is trending down a little bit. Right now it's worth $4.024 billion. You gonna make that bet?
It looks a little bit vulnerable. I'll take the other side.
All right, very good. We'll continue to track that to see if Assad wins or Katie does. Coming up, Apple and Amazon on deck after blowout results from the M's, the A's after the bell today, and we'll talk about what to expect next. This is Open Interest.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta. And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Welcome back to Open Interest. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, United Health getting cut to a sell over at Baird. The firm sees a more challenging road ahead for the company after it reported results that fell way below expectations. Shares down another 3% this morning. Next up, CoreWeave getting upgraded to a buy over at Citi. The firm expects that AI demand will continue into next year, and Citi says we come away with a stronger view on the demand picture as highlighted by Microsoft. And speaking of Microsoft, Wall Street weighing in on its stellar quarter. KeyBank raising its rating to a buy, whereas you have JP Morgan, Barclays, and TD Cowen all raising their price targets. The software giant just moments ago hitting that $4 trillion in market cap, Matt, but there is some debate as to whether that will hold through the close today.
Right. We see this is a two-day chart. So obviously a massive jump overnight after those earnings. The question is, does it keep at $4 trillion? We saw Starbucks, as you point out, go up and down yesterday. And a lot of times investors like to take profits after these big milestones. Meta is also rallying after delivering a strong revenue outlook. We are waiting now for Amazon earnings after the bell. Joining us with more is Youssef Squali, senior analyst at Truist Securities. He has a buy rating on Meta with an $880 price target and a buy rating on Amazon with a $250 price target. Youssef, great to have you on the program. Before we get to Amazon, what's your take on Meta's spending? Because it seems to me that they're running out of money.
They're not running out of money. And I think to the extent that they continue to deliver the goods in terms of accelerating top line growth, which is what they delivered last night. Last night, they put up a 22% growth versus like 16% the quarter before. To the extent that they keep delivering the goods on the margin side and on the EPS, they delivered like a 43% operating margin, up from like 41% the quarter before. I think they have earned the right to continue to invest and continue to chase this AGI or SGI, as Mark Zuckerberg likes to call it, right? So, you know, I think the $100 billion or the implied $100 billion CapEx number for next year is dizzying. But when you look at the underlying, you know, kind of drivers of the business and how AI has so far really improved the economics, it has improved the advertiser conversion, it has improved the user engagement. And remember that are like 3.4 billion users already and growing. Again, I go back and say they have earned the right to continue to invest.
Yeah, and I think that's a really important point because I feel like a broken record at this point, but I keep bringing up the year of efficiency that followed that massive cash burn on the metaverse. And right now you have investors really cheering along this AI spending. Of course, there's a bit of an arms race going on when it comes to the Magnificent Seven and the CapEx spend. But Youssef, how much confidence do you have in this management team to actually spend that money in a way that delivers results, some ROI here?
Well, so the answer to that question is not very clear and honestly won't be satisfactory because we don't have the KPIs to be able to say they've spent, you know, they're spending $70 billion this year. What are they really getting for it from an ROI perspective? And that's because this is a company, even going back to its IPO in 2012, has really been investing with an eye towards the 5 to 10 year plus investment horizon. That said, the breadcrumbs that we have is what I mentioned earlier. Today, they're using AI to drive their core business, right? And to the extent that they're able to accelerate the top line growth, to the extent they are able to increase the user engagement, increase the advertiser ROI while generating higher margin, right? That's really all you can ask for today. 5 years from now, 10 years from now, I think it's going to be a totally different environment. We're going into an environment where maybe the smartphone won't be the primary way people are communicating, et cetera. Maybe it'll be smart glasses. Those are the type of investments the companies investing in. Today, they're losing their shirt on them, right? Doesn't mean that 5 or 10 years from now, they won't. But going back to the IPO, seeing how they've been able to execute against what they've promised, I think it's a stellar management team.
I hope I don't live to see a future where people communicate via smart glasses, Youssef. Smartphones, bad enough. I want to ask about Amazon because President Trump surprised a lot of people with some tariff changes yesterday. And one of the things he's going to do away with is the exemption on goods under $800. When I think of companies that sell Chinese stuff that costs less than $800, I think of Amazon. How come investors don't care?
You're not wrong. You're not wrong. Keep in mind a couple of things, though. One, over half of all the goods that are sold on Amazon, they're actually sold by third party, right? And Amazon takes a cut. They take a 35% margin. So in a way, as those costs are passed on to consumers, ASPs go up, average selling price goes up, and so Amazon actually gets a higher cut of that. Of the other piece that Amazon sources itself, we think Amazon, this is a relative game, right? We think Amazon has the scale, they have the logistics, they have the brand, they have the relationships to actually, pound or force those manufacturers back in China to give them the best deals they can, or they will give to any of their partners. So again, maybe net Amazon loses a bit of growth from the de minimis exemption going away, but because this is a relative game, Amazon still comes out a net winner, in my view.
All right, looking forward to maybe getting some clarity at the bell today on Amazon. Great to preview those results with you, Youssef. That is Youssef Squali of Truist. Also reporting after the bell today is Apple. And here with a preview is Krish Sankar. He is senior research analyst over at TD Cowen. He has a buy rating on Apple with a $275 price target. It's been hard to be a buy on Apple this year, Krish. And you think about why. The big reasons are, of course, trade uncertainty. How are tariffs impacting Apple? And that overhanging narrative that Apple has really fallen behind on AI. Do you expect any dispelment of those two narratives after the bell this evening?
Yeah, hi. Thanks for having me, Katie. I think you kind of characterized it very well. This has not been a great year for Apple, at least in terms of headline news. Number one behind in AI, tariffs, lawsuits, Google, TAC, etc. I don't think you're going to get any of the resolution today, to be honest. AI still is a longer-term thing. The management usually doesn't comment on ongoing litigation, so you're not going to hear anything about, any of the Google tax stuff. Maybe they might quantify some short-term impact from a tariff standpoint. But other than that, I don't think you're going to get a resolution from AI and any of the overhang the stock has been having today.
In terms of the spend, when does it get to be too much, Krish? I mean, I could ask that question for any of these companies, but Apple seems to be the one that needs it the most.
Yeah, you're not going to hear like Meta, Microsoft's kind of numbers, right, in terms of spend. I think last year CapEx is about 10 billion, give or take. I think they do obviously have like more of a cloud strategy where they go through other third-party data centers. I think what the investors really want to see is some kind of, I would say, a coherent AI strategy from Apple's standpoint. People got excited last year with Siri, and that didn't really go much further. I think what you need is something more concise. I would also say that, if you look at the smartphone, I do believe that they need to have better hardware specs in order to do more inference on the edge. Ability to have a better, more seamless cloud strategy in case the smartphone has to integrate with the cloud to do inferencing. And then third, I think more importantly, have some sort of like Gen AI software development kits so you can actually transact with third-party apps. Clearly, the apps aren't there much today, but I think it might come out in the future. But I think these are a few of the things that Apple needs to do in order to show that, you're doing something on AI. But you're not going to get any answer today. But I do think that they still have probably a year and a half or so before people really start seriously worrying about them.
And Krish, we have less than a minute left here, but I think back to Texas Instruments, their results, how they were unsure whether the demand that they saw in the previous quarter was a pull forward ahead of tariffs. Could we see something similar with these Apple results?
Yeah, I think we've been hearing from the supply chain there was some probably pull forward, especially on smartphones. It's hard to quantify it. Keep in mind, Apple probably run rates around give or take 50 million units on a quarterly basis around this time. There might probably be a handful, maybe a couple of million that got pulled in because of tariffs. They're not going to tell you the exact amount, but I do believe there was some kind of pull-in.
All right, Krish, great to preview these Apple results with you. That is Krish Sankar of TD Cowen. This is Open Interest.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on with stocks the day after Microsoft and Meta released earnings that impressed. You see S&P 500 6413, so holding firmly above the 6,400 level, an all-new high. We made an intraday high, and if we stay here, a closing high. NASDAQ up 0.8% as well. Actually, I don't look very often at the dollar. Wait, check out, Brian, the dollar here. I mean, it's been on a run. It's been on a little bit of a streak, so that's interesting as the 10-year yield drops down to 435. Apple right now, little changed. Amazon up 1.5% there after the bell. CVS impressing with earnings we talked about. We'll talk about it more. Up 5.7%. Norwegian Cruise Lines up almost 14%. We're going to talk to the CEO in the next hour. Katie?
All right, looking forward to that conversation. I will point out that Microsoft is still up 5%, which is not bad, but it was as high as 8%. So fascinated to see if those gains hold.
Winning the bet.
This is Open Interest.
worried about your borders because of what's going on in Russia and Ukraine? Is that something you worry about in terms of the impact of Russia, Ukraine on your investment appetite for things like that?
I'm not worried about Russia invading Norway anytime soon. We are a member of NATO. We do border to Russia, but now, since Finland and Sweden joined NATO, we feel stronger than before.
So today, what would you say your biggest investment concerns are? You're running $1.7 trillion fund. For the average person to not manage that much money, what should they be worrying about, and what are you worrying about?
No, I think you've got two things. One, you have the known unknowns, right? So, and there at the top of my list would be two things. One is inflation, because I think there is an argument in a tight labor market when you potentially decline the supply or reduce the supply of labor. In the US, you put on tariffs. These things can be inflationary, and there could be a moment where, given the high level of government debt, that the investors suddenly decide, you know what, we want a much higher coupon to lend to, to governments. And so you could see a step up in interest rates, which could be negative for financial markets. Then, of course, all the AI-related stocks, the epicenter here is Taiwan, so you need to watch that. The thing that really scares us when it happens is the unexpected,
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne Ruhodern in Buenos Aires, Argentina, and this is Bloomberg.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. President Trump's tariff deadline is just a day away, and CBS News has learned he's planning to speak with Mexican President Claudia Sheinbaum this morning. Hers is just one of the remaining countries yet to cut deals. Bank Alliance President Lori Bettinger bets it'll lead to higher prices here.
In anticipation of tariffs, of expecting to pay more for imports, a lot of companies sort of try to build up their inventory, the amount of items that they have available to sell to all of us. So I think that in many cases, people have been able to delay price increases. But over time, I don't know if that's sustainable.
Thousands of police officers line the streets outside a mosque in New York City, where a funeral is being held for Officer Dider al-Islam, one of 4 people gunned down inside a Manhattan office building this week. Retired NYPD detective Christopher Panetta is among the mourners.
Unfortunately, we live in a world where no one's immune to this. Like I said, we just have to come together as a community, come together as a family, and take care of one another.
Officer Islam had 2 children and a third on the way. Officials believe the attacker was targeting NFL offices, but took the wrong elevator. A tragic mystery in the South.
4 family members were found murdered execution style in a wooded area of rural northwestern Tennessee after their baby girl was mysteriously abandoned in a car seat on a stranger's front lawn in 100-degree heat. Amy Anderson is a family friend.
It's tragic. It's tearing everybody apart. Everybody don't know what to think. There's been rumors here and there.
The baby's 20-year-old mother, 21-year-old father, 38-year-old grandmother, and 15-year-old uncle were discovered dead, and what authorities are calling a calculated and targeted killing. Jim Crisula, CBS News.
FAA is investigating after 25 people were injured. Some suffered broken bones when a Delta flight hit severe turbulence from Salt Lake City to Amsterdam. It was forced to make an emergency landing in Minneapolis. CBS News Minnesota reporter Barrett Leone spoke with one of the passengers.
He described it as everything going up in the air. He lost his phone. He said at one point,
passengers were grabbing a flight attendant that was walking through the aisle to hold her down from hitting the ceiling. So really a scary situation.
People for the Ethical Treatment of Animals is going to court to try to stop organizers of the Maine Lobster Festival and its host city, Rockland, from boiling thousands of live lobsters. The group's Amanda Brody.
PETA is suing to put an end to this display of lobster torture.
Just in, Microsoft, now the world's second trillion-dollar company. Dow's up 126 points. This is CBS News. New research shows these hotter summers could be making us sicker.
The study in the journal Scientific Advances tracked emergency room visits in California over 11 years and found those visits steadily increased as temperatures did. High heat has been linked to cardiovascular deaths and respiratory and kidney failure. Dr. Larry Kenny runs Penn State University's heat lab.
When our body temperature goes up and we can't get rid of that heat, it puts a strain on the cardiovascular system.
Our heart, kidneys, and other organs have to work harder, raising the risk of them breaking down. Michael Wallace, CBS News.
Results of a large clinical trial published in JAMA this week find a mix of exercise, a healthy diet, social engagement, and brain games may improve cognitive capabilities in older adults at risk of cognitive decline or dementia. The principal investigator calls it a new recipe that proves healthy behaviors matter. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Paul Sweeney.
The real outperformance has been the U.S. corporate high yield. These are two big-time blue-chip companies. One person's chaos is another person's animal spirits.
Breaking market headlines and corporate news from across the globe.
Our view is that the economy is slowing down.
There is the possibility of a death spiral.
Both quantum computing and AI are going to power the future.
People are just buying everything with tech.
Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City. We're also streaming live to the YouTube folks out there. Head over to youtube.com and search Bloomberg Live Radio. We're going to talk a lot company earnings today, a lot of tech earnings last night and tonight with Apple. We've got a lot of economic data to get through as well. And we've got three simulcasts we're going to do with Bloomberg Television with some C-suite level people. We're going to start off in the 10 o'clock hour. Robinhood Market CEO Vlad Tenev is going to speak with Bloomberg Television anchors Matt Miller and Sonali Basak. And then in the 11 o'clock hour, Dylan Field, Figma CEO. This is a company that just went public at a big valuation. Going to speak with Bloomberg Television's anchor Caroline Hyde. And then Cristiano Amon, Qualcomm CEO, speaks with Bloomberg Television anchor Ed Ludlow. So we're going to hear from a lot of C-suite people today, get a sense of how the economic conditions out there, the business conditions are across a number of industries. So a lot of good stuff coming up in the next 2 hours. And we're going to kick it off right now with John Tucker. We'll get a Bloomberg Business Flash.
All right, guys, this Bloomberg Business Flash is being brought to you by Interactive Brokers. Trade over 10,000 U.S. stocks and ETFs, U.S. equity index options, U.S. treasuries, and more on your timetable. Learn more at ibkr.com/around-the-clock. So let's start here. You want to guess Microsoft joining the exclusive club, now worth $4 trillion. Wow. That is more, by the way, just for sake of comparison, that's more than the GDP of the United Kingdom. Wow. It's more than the GDP of France. That is more than the GDP of Italy, and that is more than the GDP of Canada. Of course, it is tech powering stocks higher. Record for the S&P 500 right now. Also a record for the NASDAQ 100. And Amazon and Apple, they're reporting after the close of regular trading today. Shares right now of Amazon, they're up 1.7% ahead of that. Let me do Microsoft shares right now. Right now, the latest quote, 4.9% higher in the early going. Meta Platforms, after their results, after the close of regular trading yesterday, they are up 12.6%. And Tatiana is going to go into more detail about these stocks in just a moment. Moderna cutting about 10% of its workforce, part of an effort of the struggling biotech company to try and reduce spending of sales at its COVID vaccine. The Federal Reserve's preferred measure of underlying inflation accelerating in June to one of the fastest paces this year. Consumer spending barely rose. That was the economic report we got this morning. And CVS Health raising its profit guidance for the year after posting strong results in its health insurance and pharmacy businesses. Kind of an encouraging sign there after a bunch of missteps by rival insurers. And the market's attention also turning to Friday's jobs report, the payrolls report for the month of July. Right now, the S&P 500, 54 points higher, but is up 0.8%, 64.17 on the index. The Dow Jones Industrial Average is up 117 points. The NASDAQ 100 up 217. We're brought to you by Interactive Brokers. Trade over 10,000 U.S. stocks and ETFs, U.S. equity index options, treasuries, and more on your timetable. Learn more at ibkr.com/round the clock. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Paul.
And then I look across, and who's sitting in the power chair? Nora Melinda.
I'm like confused because there are like 4 people in here. I don't know who's co-hosting anymore.
Yeah, I don't know, and they're also brightly dressed. Very nice. We're here in our drab, like gray.
Speak for yourself.
And I mean, Nora and Tatiana
Gotta stand
all
out.
brightly dressed. So we're sitting here with Nora Melinda. I'm Paul Sweeney. Let's take a look at some of the stocks on the move today. We can do that with Bloomberg's Tatiana Dari. Tatiana, there's a lot of names to look at today. What are you focusing on?
Exactly. Well, I picked 3 names because I think they underscored the divergence between big tech riding the AI boom and the rest dealing with tariff concerns. So by that, I'm looking at Meta up 12%, hitting a record high here after crushing estimates this quarter. A really strong quarter. You know, its largest revenue surprised in at least 2 years. And with this move, a 12% move after earnings, that marks its best post-earnings rally since February 2024 when they introduced their first ever dividend. And lots of eyes on AI spending there. They did narrow that forecast, didn't quite boost it, but signaled that in 2026 we will see more spending. But investors are not bothered because the results Corp's message here and Zuckerberg's core message on the call was that AI spending is paying off here and now and not years later. And I think that's starting to convince investors that maybe all this overvaluation or bubble concerns aren't really that justified.
CapEx is really the story here this earnings season. It feels as though that's really what the focus is for investors as we're thinking a lot about these big tech earnings. I'm looking at Mag 7 stocks more broadly. Of course, NVIDIA is the front runner, as you'd expect, but Meta being the second best performing stock today, or this year rather. You're also looking at Microsoft.
Yes, Microsoft also hitting a record high, although pulling back from its session highs here a little bit. CapEx is the story there as well. They hit a record $24 billion in CapEx spend this quarter. They signaled an even bigger one in the next quarter. But, you know, the key story here is that these numbers would have been more problematic if we didn't deliver on the results, but these companies are delivering. And I think that's the most important message and one that tech investors are rewarding right now.
Definitely.
All right, we got one more here. Qualcomm, what's happening there?
Yeah, so Qualcomm would be part of the rest, you know, that are dealing with sort of the potential tariff weakness. They are exposed more to the consumer goods. They're slightly under pressure here. Well, it's gone down more, down 4%. The ticker there is QCOM. And that's largely on a pretty good quarter, but there was a little bit of softness in the smartphone-related market that is fueling concerns that that tariffs are going to take a toll on this industry, and analysts are saying the strength in their fiscal third quarter was because people sort of pulled that demand forward, and that will leave the next quarters or the next year's results a little bit at risk there. So it will be interesting to see what the CEO has to say on Bloomberg TV later today.
Tech all the time.
All day.
I mean, I'm looking at the NASDAQ up 1.2%, by far outpacing the S&P 500. So we'll keep an eye on that. Tatiana Derrier, thank you so much for joining us. Tatiana covers all the markets for Bloomberg News. And for more conversations like this, subscribe to our new Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. I'm looking at Robinhood Markets. We're going to hear from the CEO in just a moment. I mean, there's another stock. I mean, if it's not tech, nor it's crypto. I mean, look at Robinhood. Absolutely. The stock is up 186% this year. If you do it on a trailing 12-month basis, 400%. So to me, when I look at Robinhood, I got crypto and I've got tech. And that's just
combined. A nice fusion. I mean, we did get results earlier today, second quarter results that failed to meet that high bar set by some of the investors that are really following this blistering rally that we've seen this year. But I mean, as you mentioned, really strong performance from Robinhood here. Of course, a lot of retail traders tend to use that platform when they're thinking about their trading activity. But it's just insane. Up 185% year to date through yesterday's close.
Yeah, I mean, I'm just looking at some research from the streets and people taking their price targets up, which is, if you're a secular bull on crypto, if you're a secular bull, like there's not that many ways to play it. So I got to be in these names. And if you're an analyst here, you just got to ride it. It's tough to make I'm getting out of the stock because it's getting too rich. And I'm seeing a lot of analysts that are sticking with this thing and just raising price targets.
Right, 20.
Bernstein reaffirmed its outperform rating, despite, again, almost 190% move higher this year.
It's just been so buoyant, this rally that we're looking at. 20 buy ratings on the stock across Wall Street, 6 holds, only 1 sell, and that's from Rothschild.
Yeah.
And Redburn.
Yeah, it's interesting. I mean, I'm just looking here at some of these research reports. Robinhood posted, quote unquote, a breakout second quarter on Wednesday. The revenue's up 46% year on year and adjusted EBITDA margins climbing to 56%. That's what the Bernstein analysts are calling out here. So, again, a lot of these companies, and this is the difference really from my experience in 1990 and 2000 when I was in the market, there are real earnings and real cash flows that are growing. And you can make an argument that these stocks, a lot of these stocks, whether it's NVIDIA or Robinhood, they will grow into their valuation. And that's what a lot of bulls are saying. That's what Dan Ives has been saying for years.
Right. And I'm looking at Citi, also a note that they put out saying that they believe that the stock is pricing in much of the growth potential in their view. So the question is, how much further can it run, the stock? But of course, we did have Citi raising the price target to 120 from 100. So clearly they see some upside here.
Yeah, I love this. I love the ticker, HOOD, H-O-O-D.
The best one.
Yeah, it's a good one. It's got a market cap of $95 billion. So we're certainly on the $100 billion watch for Robinhood. And again, there's a select group of investors that are passionate about crypto as an asset class, and there aren't many ways for equity investors to get exposure. Certainly there's the ETFs. But right now, we're going to we're going to hear Robinhood Markets CEO Vlad Tenev. He's speaking with Bloomberg Television's anchors Matt Miller and Shonali Basak. Let's take a listen.
We welcome now our Bloomberg radio and television audiences. Robinhood is posting second quarter revenue that beat Wall Street estimates, boosted by strength in cryptocurrency trading. We're joined now by Robinhood Chairman and CEO Vlad Tenev. And you're back up on the day. You're bringing your year-to-date gains for Robinhood closer and closer to 200%. Your stock has just soared this year. Do you feel pressure at that valuation now to increase your growth rate to meet investor expectations?
I think we're always challenging ourselves to serve our customers better and consequently grow the business. But if you're asking if I'm like looking at the stock and trying to drive that directly, no. I mean, we're looking at the inputs to our business. And right now what we're seeing is our customers are happy. Net promoter scores are at a 4-year high. It's leading to net deposits, which have been very strong through July. And that's leading to gains in market share across all of the assets. And you're seeing that in revenue and EPS, which have been very, very strong as well. And, you know, we're having these product events where we're announcing products that are, I think, far ahead of where the rest of the industry is. So I don't think it's slowing down. We're, if anything, accelerating further.
By the way, more than 420% over the past 12 months. You're worth almost $100 billion. You're now worth a lot more than Intel, which for an old guy like me, that's a real milestone. Where do you see the biggest growth? I know you're expanding overseas. We talked with you last time about tokenization. What's the biggest shooting star at Robinhood?
I think if you look long term, the big potential that I see for Robinhood is how can we expand across 2 different axes. One is from being US only or US primary to being fully global, available to billions of people around the world. And the other is, can we go from being retail only and serving the full wallet of a retail customer and being this sort of like financial super app to a full platform that serves not just retail, but businesses and institutions. And you know, we're getting into that through some of the acquisitions that we're making and through organic platform expansion.
By the way, could I live on Robinhood now? I mean, could I have Bloomberg deposit my paycheck with you and pay all my bills with you and, you know, get a loan from you and do my trading with you? Are you looking at that full suite?
And how fast can you get there?
You can do the lion's share of that. Robinhood Banking is actually rolling out later this quarter. We're still on track for that. It's now rolled out internally to our thousands of employees, and it's looking really good. So that'll allow you to put in your paycheck, get checking and savings accounts. You don't have to go to the ATM. We figured out how to get cash to you, to where you are. For those of us that still use cash, you can do your estate planning. We have a home loans partnership with Sage that lets you have a mortgage at an industry-leading rate. And of course, your trading, your investing, your advisory. So we can help you with the lion's share of that. I didn't even mention the credit card, but you saw my credit card last time. I think it's the best credit card on the market.
So you were talking about Robinhood Banking launching to a broader audience soon, but what does that put you in terms of your relationship to the broader banking industry? You just saw about a day ago, JP Morgan and Coinbase inking a deal to allow wallets to be more linked to bank accounts. Are you going to be partnering with banks, or are you running in direct competition to them?
I think that as our companies become bigger and bigger and just diversify into more segments, the relationship with counterparties will be collaborative and will partner in some ways. And of course, in the broad sense, every financial company competes with every other one if your goal is to get customer assets and greater wallet share. But yeah, I think it's nothing in the financial services industry. The large companies have always like collaborated and competed across different axes.
So to Matt's point a little earlier, one, you're growing tremendously. You have stock as currency to do so. You became worth more than Intel. How much firepower does that give you for a transformative acquisition? Could you do something much bigger? And what are the types of places you would look?
Yeah, interesting. I've never had Intel brought up as a comp. But I see what you mean about that being historically, you know, these companies that you think of as very infrastructural.
It's iconic. It's an iconic company if you grew up with it like me, you know, and then you've eclipsed it.
Even being in the same conversation as those brands is humbling. I think we've always been very deliberate with acquisitions. So we want to make sure it pencils and it makes sense for the company. It gives us 18-month acceleration to the product roadmap. We get a team that's like DNA culture aligned with us because we like to move fast and we have very, very high bar for talent. And if all those are met, we've been pretty active, as I'm sure you're aware, in the acquisition market. So I wouldn't say, you know, I have a particular itch, but we've got a great corp dev team and we tend to look at every opportunity that comes up.
You became a household name during the first wave of retail trading, post-pandemic retail trading, and now we've seen that pick up again. In fact, a lot of investors or bankers come on this show and say it's really retail that's bought this 30% surge from the bottom in April, and institutional investors have to catch up. Can that hold? Have we seen a fundamental shift in the way people invest?
I think the fundamental shift is that if you think about, institutional investing, all these fund managers, it's very abstracted. So I think they tend to make decisions about portfolio allocation based on macro factors. Tariffs, geopolitical conflict. Let me use that to rebalance the portfolio. And so you end up having somewhat strange things where a company that is unaffected or perhaps benefits from that type of uncertainty could just get sold off because of broader macro. Now, retail doesn't think that way. Retail says, I want to buy this stock because I believe in this particular company. And so you see them doing very, very well in the scenarios where, broad market activity affects companies that are otherwise doing very, very well and shouldn't be unaffected, but institutions' hands are basically forced because they have to reallocate. And I think that's it's a positive thing. We've gotten so abstracted that I think we need to get back to the basics of people buying stocks because they believe in that particular company and not because of some sectoral correlation that may or may not actually exist.
Well, it's great to get some time with you, Vlad, especially here in New York on set with us. Vlad Tenev there, the CEO of Robinhood.
All right, that was Robinhood Market CEO Vlad Tenev speaking with Bloomberg Television anchors Matt Miller and Shanali Basak. Robinhood stock up 186% year-to-date. Been just an extraordinary story. All right, let's get a little bit of a reset here. We'll go to John Tucker and a Bloomberg Business Flash.
All right, Norm Paul, this Bloomberg Business Flash brought to you by Oracle. Attention growing businesses. Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitment, see if your company qualifies at oracle.com/Bloomberg. Right now, the S&P 500, 46 points higher, up 0.3%, up right now 0.75%, 64.10 on the index. That holds up. That's another record. Dow up 76. The NASDAQ 100 up 167 points. That's good for a record. That's up 0.75% right now. The S&P 500 set for its longest streak of monthly gains since September. And Microsoft briefly topping $4 trillion in market cap. It's since fallen back just a bit. As it comes, of course, after the close of regular trading yesterday, we got the results in AI optimism. Meta Platforms jumping 12% right now in the early going. Strong earnings there as well. And fellow mega caps, Apple and Amazon.com. Those reports are due after the close of regular trading today. We check the markets for you all day long. Right here on Bloomberg Radio, I'm John Tucker. That's your Bloomberg Business Flash. Nor and Paul.
All right, John Tucker, thank you so much. We appreciate that. Norma, Linda, Paul Sweeney. We're live here in our Bloomberg Interactive Brokers studio. We're streaming live on YouTube as well, so check us out there. As John was just reporting, Meta, big earnings numbers last night after the close. Stock up 11.5% here today. All-time high, 52-week high, whatever you want to look at it. We're on a $2 trillion market cap watch here, 1.95 trillion as we speak. Let's check in with Kurt Wagner, tech reporter for Bloomberg News. He's in Denver, Colorado. He's worked out this scam. I have no idea how he did it, but it's a good gig for Kurt. Kurt, talk to us about Meta here. Some people feel like, Meta might be a little late to the AI party. I don't think that. And I don't know, Zuckerberg was talking pretty aggressively about the spending there. What did you take away?
I don't think they're late at all. I don't think that they have offered some of the same products that some of their rivals like OpenAI and Anthropic have, Google. So they have been building AI models for, basically a decade. They've mostly kept them in-house. They use them, in this case, they've been talking a lot about how they're using them to improve their own ad targeting and their own content recommendations. And so while they're not out selling access to their models in the way that rivals are. They're still building them. And, you know, clearly the street's very happy with what's happening here, which is that their ads business, which is powered by Instagram and Facebook, is just a cash printing machine. And they are taking all the profits from that and they're, you know, funneling them into AI. And yesterday we saw that the ads business is doing better than expected, and they're spending even more on AI. And that is a combination that people seem very happy with right now.
Well, Kurt, even if there are people saying that Meta is late to the AI party, if you look at shares year to date and you compare it against the others in the Mag 7, we are seeing it as the best performing stock, the second best performing stock, right behind NVIDIA. What do you think has really propelled it forward to that magnitude here?
Well, I think there's a couple things. One, there's the Mark Zuckerberg factor of this. You can love him, you can hate him, but Mark Zuckerberg has a pretty strong history of, you know, quite frankly, reaching the largest audience with his products. That is something he's done repeatedly throughout Meta's history, and he has sole control of this company. So if you are a believer in him, you are a believer in Meta right now, and I think that's one factor. And then I think the other is, you know, that reach matters a lot when you're talking about AI, because when you build, in this case, Meta AI is the name of their chatbot, they have put it into Facebook, Instagram, WhatsApp. It already has 1 billion monthly users simply because they have that existing audience. So where a lot of companies are building these AI products and then trying to find the audience for them, Meta already has the audience. So when they figure this out, when they, you know, if their Ray-Ban glasses, for example, take off in the way that they hope they will, they have the built-in online audience already for these tools. And I think that that's something that a lot of people are optimistic about.
Kurt, you mentioned WhatsApp. Boy, I think I was covering the stock when they bought WhatsApp 7-8 years ago. Are they finally starting to monetize WhatsApp? And if so, how are they doing it?
They are starting to monetize WhatsApp. They announced in June that they're going to start running ads in WhatsApp for the first time. If you're a history buff in terms of following Facebook history, you'll know that that's been a long time coming, and there's been a lot of bumps and bruises along the way in getting there. But I will say the CFO, Susan Lee, she did warn yesterday on the earnings call that even though they are putting ads into WhatsApp, this is a long road. It is not going to be a material impact for the business in terms of revenue or ad impressions for the next few years. They're going to start slow. I think that makes sense for a couple of reasons. The first being that WhatsApp is popular in a lot of regions that aren't necessarily lucrative in terms of advertising, you know, India, Brazil, places like that. And then second, you're kind of trying to convince advertisers to shift budget perhaps from more lucrative things like Instagram or Facebook. And so I think it's going to be slow for people to maybe move over their money towards WhatsApp. But again, fast forward a few years from now, I think there is obviously potential here. That app has a multiple billions of users globally.
Kurt, it's hard to be a bear here on this stock. I'm looking at Wall Street ratings right now. 74 people have a buy. We have 5 holds on the stock and then 1 sell, and that's coming from BNP Paribas. But if you really had to dig in and see what the overhangs could potentially be here for this company, what would you say are some areas that investors are looking to see a bit more of a push forward?
Well, I do think the spending is a lot. And so while the ads business continues to chug along, people are going to say, okay, that's fine. If there is a stumble in this ads business, you know, heading into the holiday quarter or something like that, suddenly people might start wondering, why are they spending so much if the ads business isn't delivering? So that's one. The other is their Reality Labs division. That's the Quest VR headsets, things like that. That is a loss leader. I believe $4.5 billion in losses just last quarter alone. They also mentioned on the call that Quest sales were down year over year. So that's a concern, I would imagine, for some people.
Kurt, thank you for your reporting. Appreciate it. Kurt Wagner, tech reporter, Bloomberg News in Denver, Colorado. I'm never driving I-70 again up to the mountains again. I made that vow a year or so ago. Let's get to these markets here because they are ripping here. Lorene Gilbert joins us. She's the CEO of WealthWise Financial. Lorene, this continues to be a market that, boy, if tech works, the market works. How do you think about, what are the conversations you're having with your clients these days?
Yeah, well, let's not forget that we started the year with DeepSeek and then tariff turbulence in April. And since then, we've seen a remarkable recovery. And as you said, it's really being led by the AI catalyst. So when you think about technology, you have to think about AI. And when we think about waves of technology that have happened in the past, This is the biggest wave of technology that we've seen. So with that, we're saying to our clients, this is still in its infancy, and there's a lot more opportunity. And certainly we don't want to miss that opportunity. So at the same time that we're focused on AI and the companies surrounding that down the supply chain, we're also balancing that trade along with defensive trade with the tariff and the trade issues. So looking at financials and utilities, while we're still very focused on the companies that we see are going to lead the AI race.
When we think about tech stocks more broadly, of course, they've really driven the gains in the market, not only just this year, but in the past 2 years that we saw as well. Are some of these big names too expensive now?
Well, I think we have to look company by company, most definitely. And today we're going to hear from Apple. And that's a company that we really question as far as what we're going to see going forward. In comparison, I would say, with some of the other names that we really do like. So we're also going to hear from Amazon. So I would say that it certainly is company by company. It's still hard to tell in the AI race who are going to be the necessary winners. So certainly having some diversification there is important. But I would say company by company, looking at each one.
Lorraine, how does fixed income fit into your discussions with your clients? I mean, you can sit in a 2-year treasury and get darn near 4%, or if you want to take some credit risk and get more than that. How about fixed income these days?
We certainly, when we look at our portfolios and we look at even a balanced portfolio, has done very well year to date because we're still getting a nice yield on our fixed income at the same time while we've seen the equity markets do quite well year to date. So we've locked in with our fixed income these long-term coupons that we're able to collect. And so we are of the mindset that quality is important. The extra amount that we would get by going into high yield just isn't worth it for us. We're keeping our credit quality high and enjoying just collecting that coupon.
Well, let's talk about rates here. So we have, of course, the Fed that kept rates unchanged yesterday. And we have some traders who are kind of pricing in a potential September rate cut. Is that something in your view as well? And how are you thinking about that when it comes to investing?
Yeah, I think there's no doubt that we're going to see rate cuts this year. I think it's the question of how many. And so our baseline is 2 cuts this year and 3 cuts next year. So I think we have to take the whole picture together. While we don't know how many cuts we're going to see this year, we're on the trend of the rate cut cycle, despite Powell's comment about, not raising rates and spooking the markets a little bit.
Yeah.
We're going to see rate cuts. So
Yep.
I think that it's just a matter of how many.
Lorraine, thank you so much for joining us. Really appreciate getting some of your thoughts and perspectives. Lorraine Gilbert, she's the CEO of WealthWise Financial out there in Irvine, California. As we close out here just this segment, we've got the S&P up 43 points at 0.7%. Not bad. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. We're brought to you by IBKR. Financial advisors switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges, no conflicts of your interest. You can learn more at ibkr.com/RIA. All right, so you have 7 of the 11 major industry groups in the S&P 500 higher right now. You want to guess what they are? Communication services and information technology. Tech, the leaders right now. Meta Platforms in there. That's at a record high. Meta is taking advantage of its advertising business. They're stepping up spending and investing in artificial intelligence. Microsoft, now earlier we told you they touched a market cap of $4 billion, coming down just a bit from that. They delivered an encouraging update on the Azure cloud computing platform. That's the centerpiece of the company's AI efforts there. S&P 500, 40 points higher. That's up 0.6%. It's a record 6403 if it holds up through the close. Dow Jones Industrial average up 95 points. The NASDAQ 100 right now up 136 points. And that is a rise of 0.6%. That's good for a record, too. After the economic data today, right now the 2-year down a basis point, 392. The benchmark 10-year, 2 basis points lower, 434. Let me do the yen for you because that's kind of an eye popper. 150.49, so that's a weakening against the dollar, down about 0.6%. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Nora and Paul.
All right, John Tucker, thank you so much. We appreciate that. Norma, Linda, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. March 13th, 1986, Goldman Sachs took a little technology company called Microsoft public at a split adjusted price of 7 cents per share. As John Tucker just told you, stock's trading at $536 a share today. You go do the math. That's a win. Anurag Rana, he's been there almost the whole time, technology analyst at Bloomberg Intelligence. Anurag, what's Microsoft doing so well that it's setting all-time highs seemingly every day? What did you take away from their earnings last night?
I think the biggest takeaway for us was that their AI strategy is, probably shining better than any other large public company out right now. They invested early in OpenAI, and a lot of that is flowing through the bottom line of the cloud results at this point. And very few times, I don't think I can remember ever a $75 billion business growing 30% above and the growth rate going up. So, I think, there are very few things you could, say anything wrong about these results. Pretty spectacular.
So, of course, this earnings season has really been about CapEx. How has Microsoft here really been doing with debt and also just when it comes to AI spend?
So when you look at somebody like a Microsoft, they have the luxury of certain products that are extremely sticky to the enterprise, whether that's Office or Windows, that generates a lot of free cash flow. So they will never have a problem, going out to the debt markets and, raising capital for spending. In this particular case, they are extremely judicious about what they're spending on. A year ago, they were talking about what we call as the long tail assets, which is creating data centers and stuff. This quarter, they're talking a lot about shorter duration assets such as GPUs and chips. So sooner or later, they will basically go out and say, you know what, the expansion, we're just going to rent out capacity rather than doing it ourselves. But at this point, I think the backlog is so much that they have to invest so much in CapEx.
All right. Microsoft, it's on autopilot. I get it. I'm assuming it's in my 401k in a million different places. Apple, this is the one that I really want to get smart on, because here's a stock that seemingly was on autopilot for EVs, but now it's down 16% year to date. And I just had a guest, a fund manager, a registered investment advisor, basically just said she doesn't even think about Apple anymore as one of the big tech stocks to own. What does Apple have to do today when they report their earnings and talk to their investors in the street? What do they have to do to maybe reignite this stock?
I think, something that they did in the last worldwide conference, not this year, but the year before, when they talk about that they have a plan to make sure that their products are infused with AI. They did it very well last year, but this year, that hasn't done much, and which is why the stock's gone down. they really have to say that even though they're losing people to Meta in terms of researchers, they will go out and partner with third-party providers, add more AI capabilities to their ecosystem over the next, let's say, 6 to 12 months. Something like that can pacify investor angst about it, but I think when it comes to just AI, people don't. You're right. Don't put them at the same bracket as Microsoft or Amazon or OpenAI.
So if we're to talk here about their decline and seeing them down 16% year to date, of course, we know that expectations for tech stocks are always really high. They have a high bar to hit and meet. Do you think that maybe the market's being a little bit too harsh here when they're just kind of comparing it against a lot of these other mega caps here?
See, it all depends on what your framework is, because when you look at the growth rate of Apple, it's only going to grow 4 or 5%. So even if they beat that by a little bit, let's say 6 or 7, they are not growing in double digits like the rest of the players are. So there is a structural difference that they are a product company, not a services company. So it's not apples and oranges. I mean, it's apples and apples. It's two different business models, frankly.
And is Apple management, are they comfortable with that perception of their company now? Again, it still trades at 20 times earnings, and it's grown about 15%. Its stock price compounded every year over the last 5 years. But are they comfortable maybe being left out to some degree of the current tech discussion, which is AI related?
See, one of the ways they can turn the narrative around and say, listen, we control probably the most important distribution system in the consumer land is through the phone. So they control the phone, and from that point, they control a lot of the apps that are on the on our device. So they have a very strong play in this ecosystem, but they need to figure out how they are giving it to the customers, directly into the ecosystem. Whether it's through Siri, whether it's through search, how are you helping customers become more productive so that the AI is part of the iOS. You don't have to go to an app to get it. And I think that's the comfort that they need to give to investors.
So Apple's biggest segment is the iPhone, as you mentioned here. But of course, we also know about Apple Intelligence that's been floated as well. Where are they in that journey?
So when you look at iPhones, Apple Intelligence is integral to all the products. It's part of the iPad, it's part of the Mac, but most importantly, it's part of the iPhone. When it comes to you could say the evolution of Apple Intelligence, they really need to figure out now who do they partner with? Do they go with Google? Do they go with Anthropic? Do they go with OpenAI? They already have a partnership with OpenAI, but are they going to go much deeper with that? And I think that is the single biggest, overhang, apart from the payment that they're going to get from Google. So those are the two things I would say that they have to overcome, for people to get more comfortable with the stock.
So it's interesting. I'm looking at the MODL function, the model function, folks. And if you want to see what the street is forecasting for units, prices, the real guts of these earnings models from global Wall Street analysts, you can check out the MODL function. And that's what the pros are going to be looking at today after the close when Apple reports earnings. Anurag, what do you want to see? What's the key data point for you when they report?
So we think that the Apple, results are going to be good because we are going to see a pull forward in demand for iPhones and other products because of the tariff risks. But I think the guidance for next quarter may not be that good, and which is why I'll be, closely watching MODL to see where they are on the iPhone revenue growth rate for next year compared to where consensus is. So that's one number. I want to see what the buybacks are going to be because that's an integral part of the story. If they, for example, accelerate their buyback, it will show confidence to the street, and that's another data point that's on our mind.
All right, very good. Anurag Rana, he's a senior technology analyst. He and Mandeep Singh, they kind of run our tech research effort at Bloomberg Intelligence. I don't know how many analysts we have around the world, but we got them in Asia, North America, and Europe as well. So that's how you have to cover the global technology business because it is a global business, global supply chains, and that's what Bloomberg Intelligence does. Anurag Rana, tech analyst, Bloomberg Intelligence. He's out there in Chicago. And again, folks, type in the symbol Apple Equity, then MODL to get you the, I'm talking detailed model. They forecast like how many iPhone 15s are going to sell, how many iPhone 14s are going to sell in incredible detail, and they break it all down for you. And that is the summation. It's a consensus of Wall Street sell-side analysts. They submit their data. We put it up there on the terminal for our terminal users. Hugely valuable. And you bet the pros are going to be looking at it today. This is
listening to Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio.
All right, let's talk a little bit healthcare here. Eli Lilly, I mean, it's all about like the obesity drugs. Who's the winner? Who's the loser? How big is the market? But there's a lot more to talk about. I don't know. Damian Gardet, he joins us here. He's a healthcare reporter. Eli Lilly, the blockbuster diabetes drug Mounjaro, fell short of expectations that it would do a better job at preventing heart attacks and strokes than its older medicine, Trulicity. Is that a problem, Damian?
It depends on how you look at it, but it does underline, I think, what you mentioned, that the bar is so high for these medicines, both commercially and clinically. So what we learned today, Lilly ran a study comparing Mounjaro, the newer GLP-1 combination medicine, against its older GLP-1 called Trulicity to determine whether it worked as well in preventing heart attacks and strokes. And the good news is the study met its goal. It proved non-inferiority as a scientific term, which is to say it did just about as well as the older drug. The bad news through the lens, I think, of a lot of investors is it didn't prove to be superior, which was kind of the, if not expectation, then kind of hoped for outcome here.
So what's the biggest business here for Eli Lilly? I mean, is Mounjaro one of their front-running drugs that we're talking about here?
It is. So Mounjaro is, it's a little tricky because it's the same basic medicine, but when it's used for diabetes, they call the drug Mounjaro. And when it's used for obesity, they call it Zepbound, but it's the same scientific molecule underneath it all. And that combined is by far Lilly's biggest growth driver. And it's a medicine that is in demand. It was until relatively recently in shortage officially, and it is definitely paving the path to Lilly becoming the most valuable drug company in the world. And it's also outpacing Novo Nordisk, the Danish company that really invented this market, that's also had a lot of unfortunate news in recent years. Lilly is lapping the competition there and is on pace, it's assumed, to kind of dominate this market, at least in the near term.
So I'm looking at the PGEO function on the Bloomberg terminal. It kind of breaks out kind of where the revenue comes from, either by business line or by geography. Cardiometabolic health, that's their biggest revenue line. Is that the obesity stuff?
Yeah, that's inclusive of obesity and diabetes.
All right, dude, I mean, look at this. Let's go 2021. That had $13 billion in revenue. Okay, good business. 2024, it had about $30 billion of business. Expected to be $43 billion this year, $52 billion next year. Holy cow. That is out of control growth. No wonder they're so valuable.
Well, exactly. And it's, I mean, that's what we've demonstrated, what Lilly has demonstrated in sales just with the products that it has on the market. But I think when you look at the company's valuation, what's being priced in is a soon-to-come oral GLP-1. So they would have a pill.
That's what we're talking about.
That could win approval next year at the earliest. And that is likely to both be a massive commercial product for obvious reasons, but really like democratize this therapeutic category, because these are all injectable medicines that we're talking about.
I am, as the injector of this medicine on another person, which I enjoy. I get a cocktail out, we make a little party of it. But the oral thing, that's going to open up the market like crazy, I would think. Because there's probably a lot of people that don't want to inject them.
Don't enjoy doing the shots.
Yes.
I mean, because a lot of people don't like needles.
Yeah. And it's also going to probably diversify it. So a lot of the focus on these medicines is what percentage of weight loss do they drive? It could get up to 25%, for example. But for a lot of people, they don't need to lose 25% of their body weight. The pill seems to have a lower percentage body weight change, but the assumption is that there's a huge demand for that, and that when there's a multitude of these medicines, the heavy-duty ones versus the lighter ones, then you could really meet a lot of the demand that people need.
How about all the other stuff in the world, like, I don't know, cancer, dementia? Where
are they in that?
Yeah, where's Lilly in that type of thing?
Well, Lilly particularly does have an approved medicine for Alzheimer's disease, and a lot of drugs for cancer, mostly in the pipeline. That's been a major investment of theirs. But one thing that's notable about the GLP-1s, not to pull it back there, is that we've seen that in the long term, as this study demonstrates, it reduces the risk of heart attack and stroke. But likewise, there are observational studies tying it to reduce risk of Alzheimer's and of cancer, which follows reason in that these drugs basically make you eat less, and in many cases, drink less, smoke fewer cigarettes. These are things that we know are behavioral changes that prevent cancer, heart attack, and stroke.
I think it's funny that these things came out at the same time as gummies came out, just saying.
Well, I mean, I think that there's well, maybe there's a correlation there. Right. Just need to find it. But, I mean, when we think about this company, how are they in comparison to competitors right now? I mean, this is a massive company here.
Yeah, Lilly, I think, this is a long-term, dating back about a century, investment in diabetes research that Lilly has, and the GLP-1 medicines grew out of. They began as diabetes treatments before they were discovered to have such profound effects on obesity. So I think Lilly would say this is them carrying on the tradition, and their market cap and all of these kind of superlatives we can affix to them are just the markers of a success that they set in motion in years past. I would say other major American drug makers look at them with some envy and perhaps occasionally resentment, because they and Novo Nordisk are the leaders in GLP-1. Pfizer, Johnson & Johnson, Bristol Myers Squibb, Merck, all of the heavyweights of this sector missed out on that first wave of obesity drugs that have really driven the success of the industry in recent years.
And I'll tell you, this is how you see it, Nora. You asked that question, kind of where do you see the difference here? How about valuation? On 2025 estimates, this is on the BQ function, folks, and this comp sheet is curated by Bloomberg Intelligence, so you know it's right. It's the right comps and the right numbers. That's what the BI folks do. On 2025 numbers, Eli Lilly stock is trading at 34 times earnings. The rest of the peer group, 15 times. So more than twice the valuation Wall Street is giving to Eli Lilly versus the other big cap names like, Johnson & Johnson, AbbVie, Merck. So just extraordinary there. Damien, thanks so much for joining us. Really appreciate the reporting there. Damien Gardet, healthcare reporter, Bloomberg News, joining us live here in our Bloomberg Interactive Broker studio. I didn't know that. I didn't know that Lilly was such a premium valuation.
Massive.
So keep an eye on that one. All right, folks, for our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now, with the markets a little bit mixed here, giving up some of the gains. S&P up 22 points this evening.
This is Bloomberg Intelligence with Paul Sweeney.
The semiconductor business is a really cyclical business. The market's telling me, here's another AI play. Just bid it, buy it. Is the market over their skis? Are people just too exuberant out there?
Breaking market headlines
and corporate news from across the globe.
This was a big success story for Apple.
We like bonds. We think bonds are attractive.
Private markets have become very diverse.
What we're telling people is be cautious here.
Bloomberg Intelligence
with Paul Sweeney
on Bloomberg Radio, YouTube, and Bloomberg Originals.
All right, Norma, Linda, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. That means we're on TV. Everybody look good. And you can find us there. Just search Bloomberg Live Radio. Figma, big IPO, going to get priced. They priced last night. We're going to break that down. Anthony Hughes, Bloomberg U.S. ECM reporter on this IPO. We'll break down kind of what happened there. We're also going to have a discussion with Dylan Field, Figma CEO. We're going to simulcast the discussion. He's going to have a Bloomberg Television anchor, Caroline Hyde. That'll be just in about 10 minutes' time, so that'll be good. We'll get this guy. He's got a victory lap in a big way, so a big IPO there, so we'll break it down in several ways. Mike McGlone, Bloomberg Intelligence, senior commodity strategist. Talk about this copper trade. He's got to explain it to me like I'm a 5-year-old. I don't know why copper's down 20%, but he'll break it down for us. Kujan Sobhani, Bloomberg Intelligence senior semiconductor analyst, talked to us about Qualcomm and their results. So a lot coming up in this hour. We're also going to have a discussion on the media business as well. So a lot going on here. Let's kick it all off here with Amy Morris down in Washington, D.C.
All right, thank you, Paul. A rally in big tech did drive stocks higher. Markets giving up some gains at this hour. We do check markets for you all day long here at Bloomberg. The S&P 500 is up 0.4%. NASDAQ up 0.75%. The Dow is down, little changed on the downside. The 10-year Treasury yield at 4.33%. The 2-year yield at 3.92%. And Microsoft reached a $4 trillion market capitalization after reporting quarterly earnings beating Wall Street expectations. Microsoft shares right now up 4.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That is a Bloomberg Business Flash. Paul and Nora.
Amy Morris, thank you so much. We appreciate that. A lot going on in the markets here. Kind of red and green on the screen, but what had a strong open and kind of giving up some of those gains. So let's take a look at some of the stocks on the move today. I'm Paul Sweeney with Norma Linder. We're joined by Bloomberg's Denitsa Sakova. Denitsa, what are you looking at?
Let's start with Meta. Obviously, it's been the big story of this macro-heavy weeks has been two big stocks. Meta is up about 11%, more than 11%. Obviously, crushed the expectations with the latest results. Everyone is looking at AI spending. It's been a story of for months how they've been increasing it. But we're actually seeing some profitability there, which I think is obviously very important. Operating margins rose 43% in the second quarter, up from 41% in the first quarter and 38% year earlier. So clearly, there is a trend there, and investors are very happy with it so far. And it's not only investors. We saw so many upgrades today. And the price tags we're seeing, we're talking about $200, $300 increases. Looking at HSBC, they upgraded it from hold to buy. New price tag is $900. We have JP Morgan. We have really so many upgrades. And what we're seeing is that Meta and its peers are relying on their legacy businesses to really fund this pricey AI talent, data centers. But so far, both with Microsoft at $4 trillion, Meta a record high, we've seen it work, and it's really kind of escaping all other big stories in the market. It's just Magnificent Seven.
No, the market is definitely Magnificent Seven as we're really digesting a lot of these tech results. And then we still have Apple and Amazon to come after the closing bell. But enough about tech for now. What are you looking at with eBay?
Yeah, let's move at consumers. We've been talking about big tech all day. So let's look at eBay, which is also having an insanely good day, obviously at a small scale. Shares jumped 18%. The company projected sales that topped analyst estimates. The ticker is EBAY. Second quarter profit, excluding some items, was $1.37 a share, which is 7 cents higher than what the street expected. This suggests optimism for continued consumer resilience. Although I looked at the report and I think it's interesting that the sale of used and refurbished goods grow faster than other categories. So that's definitely showing to sensitive consumer. And also purchasing powers from the US consumers grew, but then it's helping offset softer demand from European markets. Nevertheless, the stock is up more than 40% this year, so some good news for consumers with some caution there.
Are you all still using eBay? I feel like I'm more of an Etsy person now. Amazon.
A little Amazon.
But it's interesting because the stock is having its best day since 2008.
Incredible.
That's recession territory.
You want to see a chart? You want to see a chart? Carvana, CVNA is a ticker. Put that bad boy up there. GP it.
Incredible.
And go max for the time frame. This thing hit a high back in late 2021 of about $370. Then it went down to literally zero right at the end of 2022. Here we are setting all-time highs again at $395. And I know a guy on the board there. This thing's been a crazy ride. What's going on at Carvana?
The company is up 100% year to date. Today, obviously, a massive jump, more than 20%. It comes after the company boosted sales and profit well above what Wall Street was expecting. The company also posted a 6-fold increase in net income, record quarterly sales of used vehicles, which again is pointing to relatively cautious consumer. That said, we're talking about 143,000 vehicles to retail buyers, a record, and 41% increase. So really incredible. And Carvana said loan sales accounted for $278 million of the profit. So that's obviously making a big part of their business.
All right, Denitsa, thank you so much. We appreciate that. Denitsa Sokovic covers all the markets for Bloomberg News. And for more conversations like this, subscribe to our new Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. It's been a pretty good year for IPOs. We've had some really successful IPOs here. I'm surprised we're not seeing more and more hit here. I mean, she hit a red headline crossing the Bloomberg terminal. Trump extends tariff deal with Mexico for 90 days. So there you go.
There we go.
Gracias. So interesting. One of the big ones is just priced last night. Figma. It's design software maker. I have no idea what that is. But it priced last night higher, above the range, $1.2 billion. We're going to talk to the CEO in just a moment, simulcast with Bloomberg Radio and Television. Anthony Hughes joins us, Equity Capital Markets, or as the kids call it, ECM. He's a reporter there for Bloomberg News. Anthony, talk to us about this company. What does Figma do?
Yeah, hi guys. Yeah, Figma is a software company that makes its money by subscriptions, but it really offers a browser-based software product which allows designers, and it's really beloved by designers, to collaborate to build things like applications, mobile applications, and websites and stuff like that. So it has a high growth profile. It's a company that's been growing in recent periods by more than 40%, which is quite hard to find around the market, and one of the reasons why this IPO has really resonated.
So, I mean, how does it fit into the broader ecosystem? Who would be the potential competitors here? Kind of contextualize it for us.
Yeah, well, interestingly, the company get an offer from Adobe. It was about to be bought by Adobe a few years ago, and that deal fell over due to regulatory concerns. So Adobe is a sort of an incumbent rival, but you know, there's some as always in the tech space, there's always upstart competitors as well. So, but you know, I think one of the risks that this company's doing very well, but one of the risks that people will be keeping an eye on is the impact of AI, which is both a threat and opportunity for a company like this, because they have a product which is an AI product where you know, effectively a conversational prompt allows people to then create the end product, the prototype of the sites that they're designing. But you know, AI could also cannibalize some of their existing products, arguably, and I think the CEO will have some thoughts on that.
Who do they compete against? Because every time I see a new software company enter the public marketplace, that's kind of always my first question, because there's lots of good, big software companies out there. So when you get a new one come in, who do they compete against?
Well, Adobe is the incumbent competitor, as I mentioned, but I think when we think about enterprise software as a whole, and you're talking about it from an investment perspective, you really comp it up against, you know, when you're looking at the valuation, you're looking at other high growth software companies, and you know, obviously in the software space, Palantir is this stock which gets this huge multiple, but other companies that get this sort of premium multiple, which Figma is getting, and you'll see that get this afternoon when it lists, or today when it lists, you know, you're up around the sort of mid-teens to 20 times sales, forward sales, and that, you know, you're talking about companies like Snowflake and Cloudflare and you know, companies like that, which are at the premium of the software. A lot of software companies, but they're the ones that get the premium valuations at the moment. And these valuations are a lot lower than they were getting in 21, but yeah, they're back on the rise. So that's why the software sector is interesting again, but with an AI flavor this time.
Yeah, and just from a simple search, I'm seeing other competitors being like Canva, Sketch, a lot of these other companies. I definitely am very familiar and use Canva quite often to make a nice flyer and whatnot. But if you were to take a step back here, what is the broader IPO market looking like right now in 2025?
Yeah, well, I think it's been a bit stop-start this year because we had with the tariff drama in April, there was a hiatus there in April where we didn't have so many IPOs, and then it picked up again particularly in June, and Circle created a lot of excitement. It's trading up, you know, I haven't looked at it, but 500% or something like that. And you know, you've had a number of IPOs that have done really well, but it hasn't been a flood. I think people have to sort of be a little bit cautious, because not every company is a 40% grower or has the scarcity value of a Circle. So we are definitely the bankers are are more optimistic about what will happen, particularly after Labor Day. That's when, you know, that's historically when you get a bit more of a breakout, or when the excitement is for more IPOs. But you know, there's also a lot of larger private companies who aren't necessarily in the rush to go public, or there's a lot of private capital around, and then they could wait till next year. But there's definitely some interesting names that will be coming after Labor Day. We reported today about Klarna probably going in September.
Who's that?
Klarna, which is the buy now, pay later firm, which is not really more of a fintech. And really a lot of the IPOs we've seen this year have been more fintech sort of oriented. But you know, software is actually a bit more of a challenge space in some respects. But
so I'm kind of surprised there hasn't been more. We've got stock market hitting all-time highs here. I mean, back when I was running this stuff, I'd be making 50 calls a day.
You wanted a flood right now. Exactly. That's what you want to see.
Yeah, so I think, you know, historically software was a big portion of the IPO market, but in fact, in many parts of the software market, it's been quite challenging. So, I mean, we think about the Mag 7 when we think about some of these sorts of products and services, but in terms of subscription software, it's been it's been tougher and it's under some pressure. But also, there's just valuations are just not where they were in 21.
Yeah, but they're not going back there, kids. All right, I'd have to have these tough conversations.
So temper these expectations.
Anthony Hughes, equity capital markets reporter for Bloomberg News, bringing us the latest here on an IPO price last night. Figma, technology company, software company, has not opened yet today. I haven't even seen an indication. I have no idea what these people are doing. Again, I got my deals out the door no later than 10:30, so I don't know what they're doing out there. Tom Butler over at Merrill Lynch, same thing. He got his deals out on time. But coming up, we're going to check in. Speaking of the Figma, we're going to check in with Dylan Field. He is the CEO of Figma, and he's going to be taking with Bloomberg Television anchor Caroline Hyde. Get the sense of what's the future for this company? What's the growth opportunities for Figma? What's the competitive landscape look like? What are they going to do with the use of capital? Let's go right now. Dylan Field, Figma CEO.
to our world TV and radio audiences. I welcome you back to Bloomberg Tech outside the New York Stock Exchange, sat with the latest listing, the CEO of Figma. Dylan Field joins me now. And to your 13 million users, to the thousands of global employees worldwide, how's it feel to go public?
It feels surreal, and just thank you for having me and for being here with us today. It's just amazing to see the community turn out, and also just to be with the team. The contributions of Figmates past, present, and also just all the things we've learned and continue to learn from our community. They all just kind of show up today and physical manifestation, and I couldn't be more grateful.
I mean, the vibes, there's a live DJ, there's so many of your employee base, as you say, your Figmates, those who have backed you early. Why this? Why this? What does it show about your community?
Well, I mean, what we really want to do is involve the design community in this experience today that we're having, because I think it's not just that Figma is going public today, design is going public today.
Yeah.
And if you think back several decades, back 20 years ago, the sort of mindset was that design was lipstick on a pig. This is how you make it pretty. And maybe a decade ago, it was design is how it works. And then today, 2025, in a world where software, the competition is increasing so much, it's easier than ever to create software.
Yes.
I think we're now in a world where design is the differentiator. That's been our thesis for 10 years. We've seen it play out, but it's even more clear now that design, craft, point of view, that's what sets companies apart. And so we're just trying to be this engine for product design and development. And to be able to celebrate design today with all of our friends and community is such a privilege.
What sets you apart to be able to enable design versus the whole plethora of generative AI startups that are suddenly here and on the scene and making things very cheap to build, as you say, design?
Yeah, I think that there's such an opportunity for us with Figma Make to be able to help people go from prompt all the way to app. And we're very focused on that and improving that surface area. We have so much more to come there, but already you can not only do things through prompting, but you can also copy and paste things in from your Figma design, your canvas, into Figma Make. And there are times you want to edit via prompt. There are also times you want to edit in a more direct manipulation way, where you go into the canvas and you're able to see many different options in the option space. We think both are important and both have to work really well together. And so that's something we're excited to uniquely enable. And I just think in general, we're kind of in this MS-DOS era of AI. And if we're able to get to the point where we really, well, it's true. And if we're able to get to the point, I mean, I used to say Telnet era, and people are like, what's Telnet? So, stopped with that and went to MS-DOS. But if we're able to get to this point where people can really explore the latent space of these models and what can be generated and see the entire option space of what they can do, then humans, designers, can add that craft and really figure out how to differentiate. And also have the system in their head, not just the design and the technology system, but also the business constraints. And that's why it's important to lower the floor, raise the ceiling, bring more people into the design process.
So that $1.2 billion that you raised through this process, where does that go? Where does that get allocated to ensure that you're building?
Well, so one thing that was unique about this transaction was because of the cash balance we have at Figma, due to rounds we've raised but never really used, cash that we've generated, and also the breakup fee, we had quite a cash balance. And so it's a transaction that is a lot of secondary, and then there's some primary, but mostly for the release of RSUs, and so it's more synthetic primary. And so, I mean, we already have quite the cash balance. It's more or less what we're exiting the transaction with. And when we think about the future of how to deploy that, first of all, we want to be good stewards of capital always. But I did put my founder letter in the S1.
Yeah.
Expect us to make bold moves. And I want people to know that in the investment community, because we're going to invest in AI. We're going into an investment cycle here. And it's important people are aware of that.
You are going to invest. You're not going to be focusing on profitability. You're going to be focusing on growth.
We are focusing on growth. And we're focusing on all the great things that we can do right now and enable for our users, the value we can create for our customers.
Do you think the public markets are going to give you that bandwidth?
Well, that's their choice. That's why I want to make sure I called it out up front.
Yeah.
And the other thing that I think is important to note is, in terms of big swings, can't say when or if, but my intention is to do big swings when it comes to scaled M&A.
Okay.
And
what kind of companies?
Well, when I think about how we approach the process, we're always surveying. We're always trying to learn. And there's so much that can be applicable to Figma when you think of the breadth of product design and development in that entire process, which we're really trying to cover. And not all the gaps we have will be filled with us building or buying. A lot of them will be partnerships. But I wanted to call it out because for scaled M&A, as you do that, it's often misinterpreted by markets. It creates volatility. People get, sometimes they don't understand the really good stuff. And obviously, we'll be prudent. It has to be an amazing team, an amazing asset. It has to be something that we think the team is culturally consistent, the least, but preferably culture add.
Yeah.
And they're going to create new dimensionality to our culture that we didn't have before, and we're going to learn from them. But third, and most importantly, it has to be a main priority going forward. That's the minimum.
Yeah.
And we will hold a high bar for if and when we do that.
To our TV and radio audiences, we're with Dylan Field, the CEO of Figma, which has just gone public. And if we cast our minds back, the valuation that you're currently at looks at about $20 billion, and that was the amount that Adobe wanted to pay to buy you. That didn't work out. So just talking about M&A, was this the right path to be independent? How does that make you feel?
I mean, we've been so focused on this path for years now, and I'm just really excited to be here today. The Adobe stuff kind of feels like so long ago now.
Yeah.
And yeah, just as we look forward, I mean, there's so much to build and such breadth of opportunity. We have, like I said in the founder letter, more ideas than ever.
Yeah.
And it's all about prioritization, and it's all about clarity for the team. And that's what we're trying to do, is to create that clarity.
I mean, talking about demand, you were 40 times oversubscribed. To those retail investors that want to get in on this, what do you say for the short term if the shares pop?
The only message I can give you if you're on the retail side is understand what we do. We have our S1 out there. We've done our best to present it in a really readable way. Read the document and look at our numbers, understand where we're headed and what we offer, play with the product. Yeah. Become a designer. I think, that's true for a lot of people and a lot of companies. If design's how you win or lose, you should be part of the process too. But the more you can dive in and the better you can understand it, the better you can make a decision on things. And that's the main advice I give anyone, whether they're joining Figma, trying to invest in Figma. Those are both investments of time, of money, and that's important, is to deeply understand it.
Dylan Field, CEO of Figma, on the day of their IPO from the New York Stock Exchange. Ed, back to you.
All right, that was Caroline Hyde, Bloomberg Television's anchor Caroline Hyde, on the floor of the New York Stock Exchange, speaking with Dylan Field, CEO of Figma. This is a fintech, or it's called a design company, application software company going public. They priced last night $33 a share, just above the range. The stock has not yet opened. We'll bring that to you when it does open later in the day. Let's get a little bit of a reset here on this market. We'll go to Amy Marsh down in Washington, D.C.
All right, you bet, Paul. This Bloomberg Business Flash is brought to you by Oracle. Attention growing businesses, Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitment, see if your company qualifies at oracle.com/Bloomberg. We do check markets for you all day long here at Bloomberg. The S&P 500 up 0.25%, NASDAQ up 0.6%, the Dow down 0.3%. The 10-year Treasury yield at 4.32%, the 2-year yield at 3.91%. Microsoft reached a $4 trillion market capitalization after reporting quarterly earnings that beat Wall Street's expectations. Microsoft reported better than expected growth in its cloud business, with its Azure cloud computing unit posting a 39% rise in sales. Microsoft shares are more than 4% higher. And President Trump now says he has extended Mexico's current tariff rates for 90 days to allow for more time for trade negotiations. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That is a Bloomberg Business Flash. Paul and Nora.
All right, Amy Morris, thank you so much. We appreciate that. Nora, Melinda, Paul Sweeney, we're live here in our Bloomberg Interactive Broker studio. We are streaming live on YouTube as well, so check us out there. Copper. The global copper market is reeling from a shock after President Donald Trump imposed 50% tariffs on copper imports, but exempted refined metals. I'm not really sure what that means, but our next guest does. Mike McGlone, Senior Commodity Strategist for Bloomberg Intelligence. All right, Mike, if I go mine some copper somewhere, I bring it back to the U.S., that's not getting tariffed. But if I refine it somehow into a product, that will be tariffed? Is that the thing?
Yes, if you convert that copper into pipes or wires or tubes or anything, that's going to be taxed, or tariffs. But it's the actual refined copper, which is, from my bottom line, is what's traded on the futures contract, is what's really the shock, and that's what really matters. That's why we've seen the biggest plunge in copper ever. Still up in the air, but just shows how expensive it was for silly reasons, and now its implications, what it means for this long-term potential enduring peak in copper in the U.S.
Mm-hmm. So, I mean, what are the broad strokes here? How is copper, the copper market, reacting to this?
Well, it's plunged. The key thing is I look at it is, and with respect for a lot of our listeners and viewers who are traders, I'm an ex-trader. I think I probably would have lost money trading copper this year, even though I had some of the calls right, because it's been so volatile. But it's significant now just of where it's going and why. Copper's peak this year looks very similar to what crude oil did in 2008. It pumped up to 147, and by the end of the year is below 30. We could see the same thing in copper. Copper right now is about $4.35 a pound. The high this year was almost 6. It can easily go back down below 4 and even get to 3 on a normal correlation cycle. Partly, first of all, the key things, demand pull sources for copper are China. Now, one way to look at China as far as demand, look at bond yields in China. 1.71 is a 10-year note yield in China right now compared to 4.35 in the U.S. That's a severe sign of deflationary forces. You look at iron ore. Iron ore is under pressure in China. And then you look at the U.S. 10-year note yield at 4.35. If you just change that to the price of copper, it's the same price as the per pound's price of copper. So there's a risk there that everything starts tilting lower now. But the key thing to remember about copper is we had such an extreme this year. That aberration between copper traded in the U.S. and copper traded in London got to 31% just this month. It's never been that high. And when you do extremes like that, the history and lessons of commodities is that's usually an enduring peak that can last forever. Crude oil's high from that in 2008. It's still there. So I'm worried now that the lessons you learn in commodities, you get a lot of pain sometimes. Markets go the direction of most pain. The most pain for copper now is probably downward and more lower.
Well, Mike, you mentioned the volatility here when we think about the copper market, but are we seeing any sort of uptick in interest from maybe institutional investors when it comes to using copper as a hedge against inflation?
Not really. The key thing to hedge about inflation is broad commodities. I've heard about some more tactical people wanting to buy copper and get on board this train for that global demand pull electrification. I've never been on board that because it's what's happening in China. It's more the bigger picture macro. The number one demand source for copper now, one of the top sources now is solar panels. That's still increasing. But the key thing is, remember, it's known as the metal. It's a PhD in economics, and it's starting to plunge rapidly for good reason. The key thing I also want to point out is you look at the price of copper in London. Right now it's in tons, 9,600 tons. The highest end of year close ever for that was about 9,800 and 2021. So my thought is to close at a new high at the end of the year is very likely. The risk is everything tilts lower. And now I'm worried that this decline in copper, industrial metals, and iron ore is showing you the tilt in the world based in tariffs towards deflation. And the one thing holding everything up is that U.S. stock market. So it might be indicating a little bit of risk there too.
So for copper, I can buy and sell it and trade this thing in Shanghai, in London, and in Chicago. Why can I trade this thing in multiple markets?
Well, it's the same metal everywhere, just like a typical commodity and gold, depending on the purity. And it's always the arbitrage, Paul, but you can't, it's moving that copper. A lot of the inventories went from Europe to U.S. to be able to take care of that, take advantage of that arbitrage. But now we have an excess supply, excess inventories in the U.S. We have to do something with that. And that's what arbitrage traders do. So that's the key thing is, in history, you've always been able to arb between the LME and the CME copper. It's always been trading within 1 or 2% of each other. And this year pumped up to 30%. First of all, that caused a lot of pain. It stopped people out. And then I got people to jump on board that train. I've been talking about it since it was last year at almost 20%. So I probably would have stopped out as it extended towards 30%. And then what happens within minutes, it collapses right back to zero. And that's what commodity markets do. If it's easy, something's wrong.
So what are the biggest tail risks to commodity prices over the next, let's say, 6 to 12 months?
Well, the number one thing I think, Jess, the biggest biggest headwind, I would think, or tail risk, is if the U.S. stock market backs up a little bit. We're up 10% in the year. It's been a great year already, and we're only July, and now we're heading towards that volatility season. So that's the number one risk. The enduring pressure factors for all commodities is what's happening in China. I mentioned that 10-year yield of 1.71%. And one of the key bullish factors for all commodities has been the declining dollar. Commodities are trading in dollar. The Bloomberg Commodity Index is up about 7% this year. The Bloomberg Dollar Index is down about 7%. But remember, the number one commodity that's been pulling up all commodities is gold, and that's not a good sign for other commodities.
All right, Mike, great stuff as always. We'll get to beef next time. I don't know what's going on there with beef prices. Mike McGlone, Senior Commodity Strategist, Bloomberg Intelligence. He's down there in our Miami bureau. Don't ask how that happened. Cristiano Iman, Qualcomm CEO, in just a moment, going to be speaking with Bloomberg Television's anchor Ed Ludlow, talking about the chip business. Again, the only thing I know about the chip business is it is a long cycle business. It is a cyclical business, and boy, you've got to pick that timing right. And some of the pros, they know how to do it, but it's not for the faint of heart here. So we'll have some discussions there, keeping with our technology discussions here. Again, Cristiano Iman, Bloomberg, Qualcomm CEO, speaking with Bloomberg's anchor, Ed Ludlow. Let's listen in.
We want to welcome our Bloomberg TV and radio audiences worldwide. Shares of Qualcomm under a bit of pressure. The company posted third quarter results showing a bit of lackluster growth in the smartphone market. But their story longer term has been a move into other areas. Delighted to say that Qualcomm CEO Cristiano Iman joins us now. And you and I have discussed this so many times, the move into IoT and in particular automotive. So I thought that a good starting point would be to ask when smartphone and handset is no longer the majority of revenue, and when that kind of tipping point, or how close toward that tipping point is, where your diversification efforts have shifted the business model.
Very good, Ed. Great talking to you. Look, I don't really understand what not to like about it. We have been consistently delivering what we said we're going to do. I think the company has changed. The company created a lot of growth opportunities. And to answer your question, we outlined, I think, in last year on our Investor Day, a plan that we're going to have $22 billion of non-handset business by fiscal 29. And at that point, we expect the company to be diversified at a 50% non-handset revenue. And we continue to execute on that plan. We're happy with it. We provided a new metric. The new metric that we provided, as we provide guide for fiscal 25, we now expect that we will have the second consecutive year of QCT, or chip business, non-Apple growth of 15%. So we have second year double-digit growth on non-Apple revenues. I think the company continued to diversify, continued to generate growth. We're executing what we said we're going to do, and we're happy with it. And we're creating optionality for the company in other areas. For example, data center, in robotics, all of those which are going to be upside to the plan. So we're just going to continue to execute on our strategy.
The data point is new, right? QCT ex Apple revenues. And I was interested to read and understand it. You've also communicated quite a lot about this shift as Apple moves away from your modems for iPhone. May I ask what you think investors need to understand and remodel for, or even what is it that investors are misunderstanding about that process, Cristiano?
Look, I believe that investors are probably still over-indexing on the short term, and they've been focusing about Qualcomm as a handset company. I think the handset market has been a market that has not been growing, and then you have this conversation about the fact that Apple's transitioned to their own modem. You have to step back And you have to step back and you have to understand that Qualcomm has very, very unique and competitive IP across many areas. We're no longer just a communications company. We have very compelling computing IP, both on the CPU, on the GPU, on the AI accelerator of our NPU. And this IP is creating leadership position in other industries. Actually, we execute on our growth and diversification. Right. Out of nowhere, we create an automotive business. We're now going into the era of AI at the edge with industrial.
Yes.
Our IoT had a great quarter and exceeded expectations because of our new personal AI devices like the Meta glasses. And we're growing on Android. We had outlined where we're going to be doing 5%. The market will grow on Android 5% per year at our Investor Day. We're doing in around 10%. So the company is showing its growth and earnings power, 15% on Apple. Yes.
So I'm sorry to interrupt you. There's so much I want to get through because
Yes,
I understand the calculus on the long term. The thing that many were trying to understand is the pull forward effect of tariffs. Did you see in the data anything that would suggest orders went in 1H or the most recent quarter and then won't show up in the second half of this year?
No, and that's reflected in our guide. We had a strong guide in the handsets for the next quarter. I think we'll remind folks that we don't have flagship lines in this quarter, and we have seen no pull-ins.
If you're listening live on Bloomberg TV and radio, we're speaking to the Qualcomm CEO, Cristiano Amon. Cristiano, I don't know if you remember, but 2 years ago, almost to the day, you and I sat on stage and did a demo of an on-device running of an LLM in airplane mode. 2 years on, I'd like to ask if that shows up yet in revenues and how that's playing out in the real world.
Yes, you have to look on how people are using those devices. And we provide an interesting data point. With the Samsung Galaxy S25, that is the one they're selling right now, compared to the prior phone, the Galaxy S24, the use of Google Gemini is 3x, triple. So what you're starting to see more and more, you have people using AI. It's a mistake to be talking about, is this cloud connected? Is this on-device connected? It's both. The smartphone is the most cloud-connected device in the world, and we have a lot of processing power in our devices. And we see that playing out. And in this quarter, we said something very unique, Ed. We said, first time ever, we show 1 billion parameter model running on a glass, on a smart glass. So think about, for example, the use case of everything you say to the glass, you can have an immediate response with the model running locally. Right. And this is how this is going to evolve.
As you know, I'm probably one of the few journalists on the planet that likes to rip apart things, including cars and servers. And I've been thinking a lot about your automotive business. You've made gains, sales are up, but I wanted you to talk through the equation of content per vehicle and whether that's the key metric that's going to drive growth.
Most of our growth right now is actually converting our pipeline into revenues. Remember, we outline a very large pipeline of design wins as those cars are launching, they're getting to SOP. Those started to show on their revenue. That is what's driving our growth. Our growth has not been driven by the size of the market. It's by converting. It's about share gain, converting the pipeline. Having said that, we see content in automotive accelerating. More and more computing is going to the car in the digital cockpit for Gen AI use cases. A lot of OEMs adding use cases on the dashboard of the car, on the infotainment, because we're going to be working from the car, get entertained from the car. We're going to talk to the car. The second thing that we see is content for ADAS and autonomy, and that is adding a lot of processing content. And we have a runway ahead as a lot of these software-defined vehicles change microcontrollers into a central computing. So we have a roadmap to continue to increase content.
Cristiano, I asked this same question earlier in the hour to ARM CEO Rene Haas, so I'm going to ask you the same question out of sheer objectivity and fairness. Longtime partners, when will you bury the hatchet? My understanding is investors want to see movement towards that. Look,
the most important thing, we had a trial We are incredibly happy with the trial outcome. It determined that Qualcomm is fully licensed for Orion CPUs, and will continue to be able to build ARM-compatible CPUs. So from our perspective, our ability to continue to build incredible products and ship to our customers, we're in great shape. And I think you should be looking at Qualcomm as a company that has the ability to provide one of the best ARM-compatible CPUs, and we're going to bring that across every one of our markets.
Cristiano Amon, Qualcomm CEO, thank you for your time here on Bloomberg Tech.
All right, that was Bloomberg television anchor Ed Ludlow speaking with Cristiano Amon, Qualcomm CEO. The company reported earnings a little bit disappointing. The stock is down 5.8% today, down 2.5% for the year. Let's break down what happened in that quarter with an expert. Kunjan Sobhani joins us. He's a senior analyst who covers semiconductors for Bloomberg Intelligence. He joins us via Zoom from San Francisco. Kunjan, you do this stuff for a living. You see all these companies. Break down the Qualcomm earnings. What did you see?
Yeah, look, there was nothing hugely wrong with these results. In fact, there were a few positives, namely the beat on the IoT due to better smart glass chip sales to Meta and others. Auto still continuing to be on track despite the automotive end market seeing weakness. The handset guide for next quarter, which is to come in line with to typical seasonality, which is actually surprisingly positive, given that they're going to have significant Apple share loss starting next quarter. That means that the gains they're gaining in Android, and Android continues to get better for them, for their chip sales. But all of this goodness is still sort of near term or one time. The big questions in investors' mind don't disappear from this goodness, unfortunately. There is going to be that big Apple loss this year, this calendar year, and the next calendar year that is going to weigh on their top line revenue. And there is no offset to completely offset that loss. So that's going to stay. The diversification efforts in IoT and auto and the PC and the XR, etc., is moving on track, but it's not sexy enough or new enough in the near term to get investors excited about this name.
And that's what I'm seeing the rest of the street saying as well. I mean, the CEO just said in the interview with Ed Ludlow that they see content in the automotive space accelerating here, but then we see the print that we just are analyzing right now, and the street is saying that weakness in the handset and automotive chip sales sector, that all coming in weaker, has really kind of put a damper here for investors. How much runway do you think that the company has here?
I mean, they've been pitching this diversification story for a while now. They have, to give them credit, they have made meaningful progress in a lot of these avenues. If the automotive and IoT still looks to be on track to get to that $22 billion target that they've promised. Once you get there, it will be enough to offset all the Apple losses. It's just moving very slowly, which is good. It is still moving consistently, but slowly. And in the times that we are in right now, when an investor in semi has the optionality to look at all the fast-growing AI names where most of the spending is coming, it's just very hard to get people excited very quickly about still investing in a company which is still primarily today driven by handset revenues.
Kunjan, what is Qualcomm and maybe some of your other chip names, what are they saying about tariffs? About 30 seconds.
Well, most of the companies in our coverage are not calling out tariff impact directly. Some companies have, decided to take a step forward and call some kind of pull-ins. We heard from Cristiano and Qualcomm is saying they haven't seen no pull-ins. It's very hard to delineate because, initially from our channel checks, we believe there were some pull-ins because of tariff fears. But as the discussions and the news has sort of died down, the risk for that has reduced. So the consumers which were initiating pull-ins might have normalized. So we're not seeing a lot of impact on the semi space for the most part from tariffs, except for this movement between 2Q and 3Q demand.
Kunjan, thanks so much for joining us. Kunjan Sobhani, he's a senior analyst covering the semiconductors for Bloomberg Intelligence based out there in San Francisco. All right, now let's get a little bit of a reset. Head down to Washington, D.C. We'll check in with Amy Mars and a Bloomberg Business Flash.
All right, thank you, Paul. We do check the markets for you all day long at Bloomberg. The S&P 500 up about 0.5%. NASDAQ up 0.8%. The Dow is little changed on the downside. The 10-year Treasury yield at 4.33% and the 2-year yield at 3.92%. And after the close, as you mentioned, the tech earnings continue with Apple and Amazon reporting. Lightshed Partners tech analyst Walt Piecyk says Apple should be posting some solid sales for its smart devices, but then what?
So you are going to see a pull forward of iPhone revenue this quarter. So then the question, as it always is for Apple, is, what is the guidance for next quarter?
Lightshed Partners tech analyst Walt Piecyk was a guest on Bloomberg Surveillance. Design software maker Figma and its backers raised $1.2 billion in an initial public offering, pricing its shares above the marketed range. Figma shares are indicated to begin trading at $65 to $70 each. That is as much as a 112% gain above the IPO price of $33 apiece. The Federal Reserve's preferred inflation gauge ticked higher last month, a sign that the president's broad-based tariffs are starting to raise some prices for many goods. The Commerce Department says prices jumped 2.6% in June compared with a year ago. That's up from an annual pace of 2.4% in May. And President Trump says he has extended Mexico's current tariff rates for 90 days to allow more time for trade negotiations. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That is a Bloomberg Business Flash. Paul and Nora.
Amy Morris, thank you so much. We appreciate that. Nora, Melinda, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. All right, the tariff country of the day, Mexico. Tyler Kendall, Bloomberg Television Washington correspondent, joins us from D.C. Tyler, again, it just feels like every day a different country in the headlines. Today it's Mexico. What did the president decide with Mexico?
Yeah, definitely, Paul. As we ramp up to that August 1st deadline, we are starting to get this deluge of announcements. Now, in terms of Mexico, President Trump did post on Truth Social that there's going to be a 90-day extension in talks. And during that time period, Mexico will continue to pay that 25% tariff that has been imposed on them. Keep in mind that if they didn't get this extension or didn't reach a deal, they were going to be slapped with a 30% tariff. So that does keep the tariffs at a lower rate. The president also said that those sector-specific tariffs, including on autos and steel and aluminum, those are going to remain in the same place. That's 25% for autos, 50% on steel and aluminum. Important context here is that the negotiations with Mexico have always been on sort of a separate track. Mexico was tariffed months before so-called Liberation Day, and the White House did invoke the same sort of legal basis when it came to tariffing Mexico as they did for all these other trading partners. It's the International Emergency Economic Powers Act, IEPA, except for that this is really on the basis of the White House's concerns surrounding the border and fentanyl flows into the country. And that's something else that President Trump ultimately said in his Truth Social post that they were going to keep working on together as they try to reach this trade deal. Just quickly, I'll leave you with this idea that USMCA compliant goods are still exempt from these tariffs. And that's a really important part of this conversation. About 83% of the goods that come into the United States from Mexico are USMCA compliant. But because we do so much trade with them, that still leaves about $80 billion worth of goods, at least according to the data last year, that would be subject to a higher tariff.
Tyler, so Trump has made it abundantly clear that he has no intentions to extend this tariff deadline that's coming tomorrow. Can you just quickly remind us what countries are still in limbo here as we approach tomorrow's deadline?
Right, exactly. There are quite a few, enough to at least make a list. Australia, Canada, also when we're talking about our North American trading partners, doesn't seem to be having a deal imminently. In fact, we heard from the Canadian Prime Minister Mark Carney the other day, who sort of seemed to lower expectations that they were going to be able to get the negotiations done in time. I would point you to two countries that we are actually expecting to get a deal, but we haven't heard official confirmation yet, and that's Thailand and Cambodia. The U.S. Commerce Secretary Howard Lutnick last night said that they had reached a deal. This is going to be an important one because those nations are facing relatively much higher tariff threats compared to the other nations in the region that have been able to strike a deal. They would be faced with a 36% tariff if they are unable to get it lower. But that's something that we're closely tracking and does appear to be coming imminently.
Just remind us, I'm sure I speak for everybody here, what do we do in China again? What's the latest there?
So as of now, it looks like we're trending towards that there's going to be an additional 90-day pause. The administration has to give us more of a formal announcement of that. But after the negotiations that we saw in Stockholm earlier this week, it looks like that de-escalation is going to continue. And China's a really interesting thread because up to now, the negotiations have really just been centered on keeping the negotiations going. We're not expecting to get lower tariff rates or really concrete deals of what details of what a deal would look like, because these are very complicated talks, perhaps more so comparatively to these other trading partners, because this is going to take a lot more time, and there's a lot other things on the table, including how we've seen export controls, for example, really take center stage. And these past meetings that we saw just earlier this week really did amount to sort of a check-in, Paul and Nora, to make sure that both sides were living up to their agreement when it came to making sure that those export licenses for critical minerals continue to flow, that the U.S. loosened some of its export controls when it came to less advanced semiconductor chips, just so that they could keep talking and moving this along.
Well, Tyler, you mentioned Thailand and Cambodia as having very steep tariffs that they're potentially facing here, but which countries are some of the most consequential for us? I mean, I cover real estate stocks, and I immediately always think to Canada and Mexico when we think about lumber and all the other materials that are needed for building homes. But what would you say are some of the countries that are most in focus here for us?
Yeah, definitely. I mean, the fact that we got the deals with South Korea and Japan most recently, that has been something that there has been such an emphasis on, particularly when we're talking about the impacts to the auto sector, because we know that those sector-specific tariffs really did come into play significantly in those negotiations, with both of those countries being able to clinch a lower tariff rate for autos, 15% matching their so-called reciprocal tariff rate. And then, of course, the European Union was really the one that we were all holding our breath and waiting for, ultimately being able to clinch a deal, considering that that's a 27-member nation bloc, and it does seem like they got this lower rate, though we should say with all of these deals, in quotes, these agreements, we're still waiting on the fine print details, and that's really going to give us a little bit more insight into the exact circumstances that were agreed to, and could give us a little bit more of a feel on what exactly the U.S. is getting, what exactly these other countries are getting in exchange beyond just a lower tariff rate that was threatened to go into effect by tomorrow.
Tyler, thank you so much for your reporting. Really appreciate it. Tyler Kendall, she's Bloomberg Television Washington correspondent. She's kind of like a tariff correspondent here, with whether she does it all. Or not. She's one of our go-to voices down there in D.C. She's down there in Washington. Looking at these markets, we've kind of given up on some of the gains here. The S&P is up 29 points. That's about 0.4%. The Dow is actually down 12 points. The NASDAQ holding on, though, up 180 points. That's 0.8% here. Coming up, Geetha Ranganathan. She is the media analyst for Bloomberg Intelligence. Comcast, they reported some numbers that continue to lose subscribers, but maybe at a lower rate in their broadband business. We'll break it down. This is
This is Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio.
Norma Linda, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. You can search Bloomberg Live Radio. Comcast reported results here. I guess they lost fewer subscribers, and that's kind of a net win. The stock's up 1.6% for the day, down 12% for the year. It just feels like there's a lot of headwinds for this industry, the cable TV / broadband industry. Geetha Ranganathan, she covers all the media stuff for Bloomberg Intelligence. Geetha, what do you see from Comcast numbers today?
Yeah, thanks so much, Paul. So what happened really was last week we had Charter, which is the second largest cable or the second largest broadband operator, reporting. They reported broadband subscriber numbers that were extremely weak. Losses were much higher than what the investment community was expecting. That triggered a 30% plunge in Charter stock price and generally spooked Comcast investors as well. So there was a lot of kind of panic and nervousness coming into today's report. And Comcast did lose subscribers. They in fact lost the most number of subscribers that they ever have lost in their broadband business, but it was still better than what the street was fearing. And that's why we're seeing a little bit of what you can call a relief rally here for Comcast.
Absolutely. I mean, what is the broader market looking like right now? I mean, you've compared it against Charter, but how are we thinking about broadband right now?
Yeah, so broadband really has been, at least over the past few years, Nora, has been completely dominated by the cable industry. So just, even up to 2 or 3 years ago, cable had almost a 67% share of the, home broadband, what we call the fixed broadband market. But with the telecoms, so with AT&T, Verizon, and T-Mobile coming in and becoming extremely aggressive in terms of two of their product offerings. So one, which they call fixed wireless, which is basically, also called 5G home internet, and the other being fiber. And with both of those on the fixed wireless, really from a pricing perspective, because they're only charging about $50 or so a month. So they're really competing with cable on the low end. And then if you want a superior product to cable in terms of both upload and download speeds, you go for fiber. So they're really attacking cable from both ends. And that's where we're seeing kind of this intense competition for the cable operators like a Charter and a Comcast that have been losing subscribers really at a pretty, alarming pace. The problem is that they're going to continue to lose subscribers, and that's kind of how we're framing it for the cable investors right now.
All right, Geetha, Comcast is a big company. It's a diversified company. It also owns NBC Universal, but that's also a challenging part of the business. Where are we in terms of that company maybe selling or splitting off some of their cable network businesses? What's the status?
Yeah, so they are spinning off their cable networks business. That is their most challenged portion of the whole NBC portfolio. They are spinning it off into a company called Versant. That should happen a little bit later this year. So once that happens, then you're left, as far as the NBC asset mix is concerned, you have the broadcast network, which is, the NBC broadcast network. You have Peacock, which is their streaming platform. And then you have the slightly higher growth assets. So remember, they are investing very big in their theme park business. They just opened Epic Universe, reported some really stellar results today in terms of revenue growth thanks to Epic. And then, of course, their studio business. I don't know if you saw the news, but they already have one of their movies, Odyssey, which is a Chris Nolan movie for which they're pre-selling tickets a year in advance. So their studio business in really good shape as well.
So executives have acknowledged that competition in broadband still remains quote unquote intense, especially when we think about other wireless companies like AT&T, for instance. And we're seeing shares down for Comcast, down about 11% year to date here. How are we thinking about competition as it relates to Comcast?
Yeah, competition is going to be a huge factor for Comcast down the road. So, Paul talked about Comcast being a diversified company. Yes, they have exposure to, the cable systems, but they also can diversify a little bit with NBC. But still, cable brings in 80 to 85% of the company's EBITDA. So it's really important for them to have some kind of visibility into their broadband business. So again, competition is intense. Both Comcast and Charter refer to this. It's going to continue to be intense just because we're seeing very, very aggressive fiber rollouts from all of the telecom operators. So we don't necessarily expect the cable broadband business for Comcast to return to growth. However, they are trying desperately to kind of really curb churn And so we're seeing them kind of really, go very aggressively after promotions, kind of tweak their pricing and packaging strategy. So that's kind of going to help them defend their turf a little bit, but I'm not necessarily sure it's going to be a game changer. So competition is a huge issue for them.
Have you been to Epic Universal yet?
Not yet.
We got to get her over there. Bring me too.
Yeah, so we'll see. All right, Geetha, thanks so much for joining us. Geetha Raghunathan, U.S. media analyst for Bloomberg Intelligence. Epic Universal, I mean, that's a huge... I tell you, the theme park business, whether you're Comcast or you're the Walt Disney Company, the theme park business has quietly become like the #1 business for you. Forget your cable, your network business. Forget your studios. It's the theme park
Bringing the family out in person. When's the last time you went to one?
I only go to theme parks when Disney invites me down in one of their Wall Street trips.
Oh,
so they
good.
shut down the park. We get the whole free reign of the park.
I love that.
That's how we roll. I don't do crowds. I don't do any of that stuff. I'll go out on their cruise ships when they have, the analyst day. We go out, we steam out of LA, stay overnight, and come back, and that's basically it.
Quick one, too.
Yep. SpaceX, it is launching a crewed mission to the International Space Station. We're going to have complete coverage of that coming up on Bloomberg and on YouTube, so that'll be cool. And for our listeners in the U.S., a reminder, you can listen to us via satellite radio and Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Stay with us. Your top stories and global business headlines are coming up in just a moment. Nora, Melinda, thank you so much for joining us here today. The 2 hours flew by. Looking at the markets, kind of the tech stocks leading the way here. S&P up 31 points. That's 0.5%. The Dow's flat, but the NASDAQ on the back of some of those big tech earnings, up 195 points. Let's call that 0.9%. So a big move there. Top stories, global business headlines are coming up right now.
This is CBS News on the Hour, sponsored by ZipRecruiter.
I'm Steve Kathan. President Trump announces a 90-day negotiating period with Mexico after a call with the country's president. 25% tariff rates stay in place for now, at least. Tomorrow is his tariff deadline for most nations. Trump has threatened Canada with trade repercussions for moving to recognize a Palestinian state. CBS's Ed O'Keefe is not far from the Canadian border in Buffalo.
Pumping out IPAs, shandies, and stouts at Resurgence Brewing Company is costing owner Jeff Ware much more than it did a year ago because of tariffs on Canadian goods.
We get a lot of our grain from Canada, and then most of our aluminum, if not all of our aluminum, comes from Canada.
And one thing he didn't anticipate, Canadians upset with the trade war who no longer cross the border.
Probably 15 to 25% down year over year. Oh, I never thought that angry Canadians was going to be something that we had to put on the list of things to discuss at our management meetings.
There's a hearing in Kerr County, Texas today about the July 4th flooding that claimed at least 136 lives. Lieutenant Governor Dan Patrick says it's the start of a long process of figuring out what contributed to the deaths and what can be done about it.
We will pass bills dealing with the immediacy of things that we can address now, but we will be doing this in the next session and the session after that.
Police in Arkansas have arrested a 28-year-old teacher in connection with the murder of a couple who were walking in a state park with their young daughters. The children got away safely. CBS's Jim Krasula has more on a tragic mystery.
4 family members were found murdered execution style in a wooded area of rural northwestern Tennessee after their baby girl was mysteriously abandoned in a car seat on a stranger's front lawn in 100-degree heat. Amy Anderson is a family friend.
It's tearing everybody apart. Everybody don't know what to think. There's been rumors.
The baby's 20-year-old mother, 21-year-old father, 38-year-old grandmother, and 15-year-old uncle were discovered dead.
Now to the Middle East. CBS's Deborah Patta reports on a new analysis that could spark more controversy and finger-pointing about the situation in Gaza.
In a new report published by a respected medical journal, The Lancet, a group of health professionals said it was time to break the silence on genocide. Their findings, made since October 7, 2023, are damning. Life expectancy has reportedly fallen by 35 years. Gaza has the highest number of child deaths of any conflict zone, and the report concludes starvation has been relentlessly used as a weapon of war.
Wall Street, right now the Dow is up 20 points. The S&P is up 34. This is CBS News. It seems pop and politics may have found a love match.
In the audience at Katy Perry's Lifetime's tour stop at Montreal's Bell Centre last night, Justin Trudeau and his daughter. Canada's former prime minister was casual in a black T-shirt. He smiled and appeared to sing along 2 nights after he and Perry took a walk in a local park and dined out together. The restaurant says they stopped in the kitchen after and thanked the chef. It sparked speculation of a young romance, but neither has commented publicly. Perry recently split from her fiancé, Orlando Bloom. Trudeau and his wife Sophie separated 2 years ago. Deborah Rodriguez, CBS News.
Energy drinks that mistakenly contain alcohol are being recalled in several states. It seems some high noon beach variety packs with vodka were mislabeled as Celsius Astro Vibe energy drink. Steve Kathan, CBS News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
Welcome to Deadline Day. The Thursday edition of Balance of Power lands with only hours until the clock turns on reciprocal tariffs as threatened by the Trump administration. That's 11:59 p.m. tonight. We'll discuss the political implications with Republican strategist Alex Conant from Firehouse Strategies later this hour. But first, we need to launch a rocket, a SpaceX Falcon 9. It's on the pad right now in Florida, set to blast off only moments from now on an historic mission to the International Space Station. Only moments away. We'll be joined by Keith Cowing at NASAWatch.com to walk us through it. And it's all after a look at Wall Street. Let's check where stocks are before we get rolling here, and flying for that matter. The latest on Wall Street with Amy Morris. Amy, how's it look?
Oh, Joe, they're paring back some gains on Wall Street. We do bring you the markets all day long here at Bloomberg. The S&P 500 had advanced about 1%. It's now up about 0.5%. NASDAQ up 0.9%. The Dow is little changed on the downside. The 10-year Treasury yield at 4.43%. The 2-year yield at 3.93%. Microsoft reached a $4 trillion market capitalization after reporting quarterly earnings that beat Wall Street expectations. Microsoft reported better than expected growth in its cloud business. Azure Cloud Computing Unit posting a 39% rise in sales. Right now, Microsoft shares are 4.5% higher. And President Trump is set to meet Goldman Sachs CEO David Solomon at the White House this afternoon. They'll be talking about issues surrounding the economy and geopolitics. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Let's get back to Balance of Power with Joe Matthew.
All right, very good, Amy. Thank you so much. In for Charlie Pellet here on the Thursday edition of Balance of Power. Your timing is impeccable. If it's noon, it's news around here on Bloomberg. So thanks for joining us on the Thursday edition. You made it to Little Friday, and we've got a lot to cover here in the next couple of minutes, never mind the next 2 hours. So strap in here. We've got a launch, as you can see on YouTube, where you can join us right now. This is one of those times that you'll want to watch the program as well as listen to it. So go to YouTube and search Bloomberg Business News Live as we get ready for this SpaceX launch in Florida. Looks like the weather's cooperating. We're only a couple of minutes away here. In fact, about 2 minutes away from the launch. And this is important here. A Crew 11 mission, the Dragon spacecraft, a Falcon 9 rocket. We're starting to get used to these terms here. And it's actually an historic mission. We've got 3 astronauts and 1 cosmonaut aboard heading to the International Space Station. And while they are there, they will celebrate 25 years. Pretty remarkable. 25 years of continuous human occupancy of the ISS so far above the Earth. Now, I'm really glad to say that, as always, for a launch like this, we're joined by our good friend Keith Cowing, the editor at NASA Watch, and, of course, a longtime NASA official himself. Every launch is a great day for Keith, and that's why he's with us now on Bloomberg. 39A, Launch Complex 39A at the Kennedy Space Center in Florida, an historic location here, Keith, designed for the Saturn V. Saw the Space Lab go up, saw many space shuttles go up, and now it is the home of this SpaceX rocket. We're about 30 seconds out. Keith Cowing, what are we looking for in the first couple minutes?
Well, you know, of course, when they get to 0, you see the flames come out and the rocket goes up. And this is kind of characteristic of what has always happened at this pad. different than the older rockets. This one is a commercial one, and I'm not sure. It could easily have flown 5 times. This is a reusable rocket, which is not normally what we would have been launching back in the day. So that's the big difference.
Yeah, right.
Otherwise, it's a ride up into space, 5-6 minutes, your waitlist, and you're there.
Pretty remarkable. How long will it be until this crew is actually docking with the ISS, Keith?
It'll be later today. I don't have the exact timeline, but they're able to do this pretty quickly now. They go up and bang, they're there. And, you know, again, this is a routine thing here. It's almost like sitting at the airport waiting for your plane to pull out.
Producer James is telling me that Mission Control has called for a hold here due to weather. Maybe we can pot that up, James, and listen to what they're talking about. We do have some clouds in the area here. Let's listen to the stream for 1 minute, Keith.
Come to play for launch today.
Dragon SpaceX, bad luck on weather there. We just got clipped by a cumulus cloud right over the pad, so ended up scrubbing for weather. With that, you are go to proceed to 5.100 for launch scrub. We'll begin offloading the rocket.
So we're done, Keith. We're not launching today, huh?
I mean, you look at the picture, and that's the thing about Florida. You know, I've sat there on the beach, and it'll be raining in my face and sunlight on the back of my head. I mean, it's Florida.
Well, I'll tell you what, this was a quick little conversation, wasn't it? Obviously, we've got another window, which will be tomorrow, 11:43 a.m. Keith, I was talking about the historic nature of this launch, and we do have to stop down to acknowledge 25 years of humans living on the ISS. It's pretty remarkable.
Yeah, isn't that cool? Well, I'm one of the thousands of people who helped design this space station back in the 90s. And so for all of us, I mean, I'll be 70 in October. I was in my 30s when I worked there. And, you know, it flies over your house, and I'm one of those people that goes out in the middle of my street at night in a quiet neighborhood, looks up. My neighbors kind of know what I'm doing. But it's an amazing accomplishment that I just wish more people were aware of.
Here. And it's something that, of course, not only the United States is involved in, but there have been huge questions since Russia's invasion of Ukraine about what exactly the role will be that Moscow is playing in the ISS. The head of Russia's space agency, Keith, set to visit the U.S. here to discuss the future of the ISS and its deorbiting with NASA's acting administrator. Of course, that's also the Transportation Secretary, Sean Duffy. Dmitry Bakanov. Is this a friend, a partner in the program? Where are we with Russia?
Well, you know, the funny thing is we get along vastly better in outer space with all these countries than we do on Earth. So, you know, maybe we're learning something in space that we can apply on Earth. But the weird thing is that the geopolitics, they leave at the launch pad. Okay, it's one crew. But weirdly enough, in Russia, they're putting in the media the fact that he's coming over here, but NASA has not said a single thing about his visit or who he's meeting with at NASA. I don't know what's going on. This is, you know, five-dimensional chess with the State Department, I guess. But you put that all aside, 25 years we've had an international space station with one crew after another, and other than a few glitches here and there, it's been one crew, one mission, and it could go on as long as we want it to go along, or if we get new space stations, start over again on a new one.
Isn't that something? We're going to be talking with Senator Ted Cruz later today. Keith will be on the late edition of Balance of Power, of course, from his perch as the chair of the Commerce and Science Committee, also a Texas lawmaker. He's deeply involved in this and wants to extend the lifeline of the ISS as long as possible. What are our options? How long could it stay in orbit?
I'm with him. You know, it comes down to the issue of how much you are willing to spend to fix things. We designed that thing to last, depending on which part, 10 or 20 or 30 years, and it's showing its age. But again, you know, it took so much to get it up there, and the amount of effort to keep it operational, you know, it's the whole thing of now you've made this investment. And you see buildings that are repurposed all the time and redone. This is a research lab in space, and I'm glad that Senator Cruz sees the value of it and is seeking to keep it going. The problem that NASA is beset with is a budget, and they're talking about replacing it with other space stations. They really don't have the money to do what they're doing now, so I kind of want to know what the plan is.
Interesting you mention money, because budget cuts are a very real thing at NASA since the DOGE showed up. And of course, the Trump administration is rethinking a lot of the projects and funding for them, with news that NASA will lose nearly 4,000 employees, Keith, through a voluntary resignation program. This is a big push to reduce the overall federal workforce. But what does it mean for this agency when 4,000 people with experience all walk out the door at the same time?
All right, I don't know how you get to work, but imagine you had a car and you just take one tire off and you don't have a spare. You can drive, you're just going to leave a lot of sparks and you'll ruin you're not going to be able to do what you're supposed to be doing. And the strange thing is on one hand, you know, they're all this fiscal cutting here and there, and it's not just NASA, it's everywhere. And they're just cutting with chainsaws, and if you have a pulse, they want you to take a buyout. Then you hear the rhetoric of, we want to beat China in space. Okay, let's say that's a good idea. You want to have your A-team. You want to have your front bench. You want to have the best budget, the best people, the best plans, and the best schedule. And they're cutting all of that at NASA. So I'm just sort of bewildered as to how we're going to beat China to the moon or Mars or wherever we're supposed to beat them with, you know, 1/4 of the people gone and everybody else freaking out that they may be next. So, you know, someone's got to explain this to me. It doesn't seem to be the right path to be taking if you really want to retain and expand America's leadership in space.
Not exactly great for morale here at the moment in Washington.
No.
You know what else is dinging morale around here? And I will probably talk to Ted Cruz about this too, Keith. He wants to take the space shuttle out of the Smithsonian. If you go out there to Dulles Airport, the Udvar Hazy complex where the space shuttle is on view, you can walk right up to it. It's not hanging from the ceiling. It's standing there right there on the floor. An incredibly impressive display they put together years ago. He wants this thing to put it on a barge and bring it to Texas. Keith, is it possible to do this without harming the shuttle?
No, I live 11 miles away from Udvar Hazy. I stood inside of this spacecraft in the 80s when it was being built. So I have a personal affinity for this thing.
Wow.
And you know, it belongs to the Smithsonian. It was deeded by law to them. It doesn't belong to the United States government. So somebody's going to have to make a new law to get that back. They only put $83 million in the budget, but that's like a fraction of what it'll take to move it because, you know, you've got to cut. Look at what they did in L.A. They had to cut trees down just to move it. Right. The plane that used to fly it around is gone. It's a museum exhibit.
That's the old 747. You piggyback the shuttle on that. We don't have it anymore. So the idea would be basically cutting this into pieces, right? You'd have to break it up into pieces, put it on a barge, and truck it somehow to Texas. I don't know, Keith, if that's a great idea, is it?
It's not. And on top of that, you know, they've got so much stuff down there. And, you know, there's 50 states in America. Everybody paid taxes for the shuttle. Every state could probably make a claim. I get the Johnson Space Center's historic involvement. But, you know, the shuttles weren't where they went. It was a fair competition. And I'd hate to ruin the shuttle for want of a few $1 million. You know, again, this is politics. We're just at the one step forward, two steps back point. We'll see what happens.
They got the Enterprise on the Intrepid up in New York, right? That's already on the water. Just take it from there.
Well, yeah, you know, you could do that, but they want a flown orbiter, I guess. I don't know. Again, it's politics. I would hope that Senator Cruz is, you know, able to, you know, sit back a bit, look at the big picture. And he is. Again, his interest in the space station and so forth. And he supported the American space program. I just hope he keeps a national perspective, not a parochial one.
We're going to play some of this to Ted Cruz later on, Keith. We didn't get our launch, but we had actually a pretty fascinating conversation. They better not touch the Blackbird that's sitting over there either at Udvar Hazy. Keith Cowing, let's hear it for him, everybody. We didn't get a launch, but we still spent some time with the editor of NASAWatch.com. Many thanks, Keith. Hey, maybe we'll launch tomorrow. We'll give this another whirl. As everybody comes down from the launch pad, I'm Joe Matthew in Washington. Alex Conant is on the way in next on Bloomberg.
It's 12:21 on Wall Street. I'm Amy Morris, and we bring you the markets all day long. We check them for you here at Bloomberg. The S&P 500 is up 0.6%. NASDAQ up 1%. The Dow is little changed now on the upside. The 10-year Treasury yield at 4.34%. The 2-year yield at 3.93%. Microsoft reached a $4 trillion market capitalization after reporting quarterly earnings that beat Wall Street expectations. Microsoft reported better than expected growth in its cloud business. Azure Cloud Computing Unit posting a 39% rise in sales. Microsoft shares right now 4.6% higher. CVS Health raised its 2025 profit guidance as the company's Aetna Health Insurance arm and pharmacy unit outperformed expectations in the second quarter. CVS's CEO says the company is probably a year ahead of the market after focusing on operations, pricing, and forecasting. Shares of CVS now nearly 2% higher. For on-demand news 24 hours a day, you can subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That is a Bloomberg Business Flash. Now back to Balance of Power with Joe Matthew.
All right, Amy Morris, great to have you with us. Amy in for Charlie Pellet, watching Wall Street, and we'll do that again a little more than 10 minutes from now as we keep tabs on the Thursday trade in this case. Massive moves, or as we call them, power moves. When it comes to Microsoft and Meta today, we've got another big boatload of earnings that we'll be talking about after 4 o'clock and on the late edition of Balance of Power that will likely carry us through tomorrow's trading session. They never got off the pad. If you're just joining us, we thought we'd start today with a SpaceX launch, Falcon 9, Launch Pad 39A, Cape Canaveral, then a bunch of clouds showed up. They did not get off the pad. This was actually a pretty important mission to bring 3 astronauts and a cosmonaut to the ISS, where they will mark 25 years of uninterrupted human occupancy, if you can imagine that, on this space station that is orbiting the Earth. Because of weather, it didn't happen. They'll have another window tomorrow. I don't know where that coincides with the program. Is that going to be for us, James, or don't we know? When it happens, you'll hear about it on Bloomberg. This, of course, is the eve of the big deadline day, and President Trump has already said he's not moving it. So put your tacos aside for a moment. Tariffs are going to take effect 11:59 p.m., right? Because it's, well, midnight here, so we're calling this the deadline day. Tomorrow, they will be in effect when you wake up. We're anticipating a flurry of paper, an avalanche, actually, of paper, because you've got the countries the president has announced arrangements with, but then everybody else gets another letter. It looks like how this is going to work. And those will be going out tonight and into tomorrow. But we actually have news on 2 important trading partners right here in the hemisphere. Yeah, you've been asking, what about Canada and what about Mexico? It's not looking great for Canada, as the president said just yesterday. Posting on Truth Social, wow, exclamation point. Canada has just announced its backing statehood for Palestine. That will make it very hard for us to make a trade deal with them. Oh, Canada. 3 exclamation points. We knew that things were not going well with Mark Carney. He was looking to get a deal done by his own deadline that was then extended, and Canada looks like it's in nowhere land at the moment. But keep in mind the USMCA exceptions. Now we turn to Mexico again. Put the taco aside. Donald J. Trump, I have just concluded a telephone conversation with the president of Mexico, Claudia Sheinbaum, which was very successful in that more and more we're getting to know and understand each other. Guess what, everybody? We have an extension. We agreed to extend for a 90-day period, he writes, the exact same deal as we had for the last short period of time, namely that Mexico will continue to pay a 25% fentanyl tariff, 25% tariff on cars, 50% tariff on steel, aluminum, and copper, immediately terminating its non-tariff trade barriers. So that might be all we get in terms of actual specific deals or frameworks with countries. The rest would be letters, and as the president says, the letter is as good as a deal. And this is where we start our conversation with Alex Conan. Firehouse Strategies, Republican strategist. Alex, it's great to have you back, and I'm pretty sure you were sitting here the day after Liberation Day. I feel like we met right after these first went out, and boy, there's been a lot of water under the bridge since then.
Yeah,
So here we have deadline day tomorrow. I know that some of these dates are moving depending on the country, and we have a lot of questions about some of these deals. But how are you feeling about it? When you look back the last 90 days, was this a success, a good strategy?
I remember when I was here about 90 days ago, and I told you he's going to walk these back. Right? The tariffs that he announced on Liberation Day would have crushed the American economy. They would have been bad for consumers, ultimately bad for Trump's political standing, wildly unpopular around the Hill, and that we should expect him to walk it back. And we have seen a steady walk back of those, to the point where he started getting embarrassed, right? The so-called taco trade, Trump's always caves. And he said enough. August 1st is going to be the day when all these tariffs are going into. But it also, I think, helped him with his negotiating power to go to countries and say, look, you have until August 1 to cut a deal, really lit a fire under the trade negotiators. He has announced all sorts of trade deals now, which is mostly just us raising tariffs, not as much as he originally said, but still raising tariffs on some of our biggest trading partners. The devil will be in the detail on those, right? We have yet to see the fine print on any of those deals. And I think the market, companies are eager, importers. I think if I'm a customs agent, I want to see the details right now. So I think it'll be interesting to see the details of those, which they'll have to produce very quickly. And it'll also be interesting to see if these hold, or if we see more walkbacks in the future with some of our big trading partners. The tariffs that he's talking about on Canada, that's really going to hurt the U.S. economy. I mean, the U.S. economy is deeply intertwined with Mexico and the Canadian economy. This is why he's done the delay for the Mexico one. And it'll be interesting to see if the Canada one actually holds.
Well, it sounds like you see the jury as still being out. We thought we'd have a deal with India. That was one of the first countries that came up. Didn't happen. You wonder if these threats result in one, because they've said, well, this is a deadline on August 1st. Anybody can call the president, make a deal anytime they want. So how much of this will continue to roll into the fall?
Yeah, well, and I think one of the issues is that we talked about this 90 days ago, and I think it remains true that the administration still has not laid out a clear rationale for why we are embarking on all these new tariffs around the world, right? Some of it is, look, we need to crack down on China, and we need to really raise tariffs on China. China actually is getting let off relatively easy so far. And you have a lot of companies who are in China who are looking at, well, India would be a good place to move jobs, move that manufacturing. And now the tariffs in India are even worse. So I think there's a disconnect with this. Is about China? Is this about raising revenue? Because sure, it's raising some revenue, but not nearly as much as they promised. And at the same time, you're seeing it starting to really drag on GDP, which ultimately is also going to impact tax receipts. Or is this about reshoring American jobs? Because we haven't seen any evidence of that yet either. So, I think the administration does have some challenges here. Ultimately, this is driven by what Trump believes, which is that tariffs are good. This is the one thing he's been consistent on for his entire adult life, that he wants more tariffs. And we're going to, and that's what we're finally seeing. And I think the economic impact, once they are actually in place, it'll be real.
What do you make of the messaging that's coming out of this White House that it's not inflationary, tariffs are maybe a one-time adjustment? When we hear from the likes of Procter & Gamble this week, we're hiking prices on a quarter of our goods. You're a political practitioner. At some point, this makes its way to the consumer, to the voter, that may not be consumed or even interested in any of this talk of tariffs or what these deals include. At some point, though, it lands on the kitchen table, and that's where the political operatives come in.
I mean, look, as Joe Biden found out the hard way, inflation is the number one killer of a presidency. And tariffs are inflationary, full stop. I mean, tariffs literally are raising the prices of imported goods. And you can make them in the U.S., but they're going to be more expensive in the U.S. And for the consumer, that means ultimately they're going to be paying more for many of the goods and services. Look, if you like avocados and these tariffs going into effect in Mexico, the price of avocados are going up. The price of guacamoles are going up. And so the consumers will ultimately see that, and they will hold the White House accountable. Look, if inflation is not going up, that's because demand's going down, and that's what we saw in the inflation numbers that came out this morning, where inflation was up, but not as much as we feared, in part because demand is falling. So, look, either consumers are buying less, which is not great for the economy or for consumers, or inflation's going to go up. Either is a political loser for Trump in the long run. Now, look, there's going to be a lag. And the last time I was here 90 days ago, I was like, look, Trump is really threatening Christmas. Well, a lot of this stuff that people are going to be buying for Christmas has already been imported. So, a lot of this won't show up until 2026. Unfortunately for Trump and the Republicans, there happens to be a pretty big election in 2026.
Well, that's very true. The timeline here could be very difficult for Republicans. knowing, of course, that you can't have a taco without avocado. You mentioned guacamole. You reach for this, Alex Conant, on what producer James reminds us is National Avocado Day. How does this happen? July 31st, the avocado, as I read, is a food without rival among the fruits, the veritable fruit of paradise. That could come back to bite Donald Trump.
I was born in 1980. When I grew up, we did not have avocados. When I was a teenager, I had never had guacamole. Now I'm from Minnesota, so we don't have a whole lot of Mexican food in Minnesota. But I swear that this is the fact that Americans enjoy avocados in the vast quantities that we do is because of NAFTA.
How about that?
It's because of NAFTA, and Americans aren't going to stop buying avocados, but they might start paying a lot more for them. And you know what? They're not going to like that.
That's wild. And boy, isn't that the truth? I never saw a taco when I was a kid growing up in northeastern Canada. I wouldn't even know what that was. Right. A bagel was exotic. So bring this down to the congressional level, because you've got lawmakers who are on recess right now, and they've got to carry all this water. Uncertainty about tariffs. Maybe there's some support for tariffs if you're talking to steel workers. It depends on what your district is, but particularly these states along the Canadian border, this is a real issue. People are talking about it all the time. Yeah. You add Jeffrey Epstein, you add some of the other issues that have been coming out of Washington lately. What do you tell a Republican lawmaker trying to have a town hall?
Well, look, first off, it's not all doom and gloom out there. The president has had, I would argue, a wildly successful opening to the first 6 months of his presidency. You look at his successes in the Mideast vis-a-vis Iran. You look at the tax bill that they just passed, some of the regulatory efforts that he's got, which I think are very popular. I think the tax bill, I know Democrats are very excited about it because it polls poorly, but I think once Americans start recognizing some of the benefits from it, look, no taxes on tips, no taxes on Social Security. Those are going to be election winners. And a lot of the stuff that's dominated the headlines, the cuts in health care that I think will ultimately not be popular, a lot of that doesn't come into effect for quite a while. Most of it not until after the 2026 midterm. So if I'm a congressional Republican, I'm back right now, I'm pointing at, look, GDP is high. It's growing. We're at the GDP growth is fine. Inflation is low. Unemployment is low. The world seems safer now than it seemed 9 months ago. That is all.
So you can craft an elevator pitch. That's
and by the way, you don't have to pay tax on your tips this year. This is all pretty good stuff. So I think the Republicans are in good shape right as we sit right now. I do think that tariffs add a lot of uncertainty into the economy, and how the economy looks a year from now. It's going to be different than it is now, and there are clearly some headwinds if you look at the data.
We've got about a minute left. Are you running odds for a shutdown?
Yeah, it doesn't look good. I mean, look, here's the issue. You need Democrats
they're out.
Yeah, you need Democrats to keep the government open, and the Democrats have, their base really wants them to fight. Their base was furious when they did the CR earlier this year to keep the lights on.
Rescissions was the real sin, though, right?
Yeah, they don't like I think they don't like the rescissions. It was $9 billion. I think the larger issue is that they are feeling immense amounts of pressure from their base to not cooperate with Republicans at all. So I do think it's going to be a challenge. There's going to be a big fight this fall. It's going to be fun to watch.
Have a great August. If I don't see you before, then let's get back together when lawmakers return and see where we are.
Let's do it.
Always a great pleasure to spend time with Alex Conant, Firehouse Strategies. Happy Avocado Day. We'll assemble our panel up next with a lot more to talk about here in Washington. Stay with us on Bloomberg. No launch today. We'll try again tomorrow. I'm Joe Matthew. This is Bloomberg.
It's 12:40 on Wall Street. I'm Amy Morris. A big tech rally is pushing stocks toward fresh all-time highs. This just a day before that key jobs report that could help make the case for the Fed to cut interest rates. And we do check markets for you all day long here at Bloomberg. The S&P 500 up 0.6%. NASDAQ up right at 1%. And the Dow is up 0.1%. 10-year Treasury yield at 4.34%. The 2-year yield at 3.93%. Now, after the close today, tech earnings continue with Apple and Amazon reporting. Lightshed Partners tech analyst Walt Piecyk says the iPhone maker should post solid sales for his smart devices.
So you are going to see a pull forward of iPhone revenue this quarter. So then the question, as it always is for Apple, is, what is the guidance for next quarter?
Lightshed Partners tech analyst Walt Piecyk was a guest on Bloomberg Surveillance. Figma is poised to open trading at more than triple its IPO price. Shares are $33 each, but could open as high as $110 each. The design software maker and its backers raised $1.2 billion in an initial public offering, pricing its shares above the marketed range. The Federal Reserve's preferred inflation gauge ticked higher last month in a sign that President Trump's broad-based tariffs are starting to raise prices for many goods. The Commerce Department says prices jumped 2.6% in June compared with a year ago. That's up from an annual pace of 2.4% in May. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Let's go back to Balance of Power with Joe Matthew.
All right. Amy Morris, part of the program today. As ever, we keep our eyes on Wall Street, and it's going to be something when Figma starts trading. Are you following this? FIG, plug it into your terminal. Figma IPO today. These numbers just, producer James keeps putting these prices in front of me. It just keeps getting bigger. Figma shares now indicated to open $105 to $110 each. Remember, the IPO price was $33. It's a fascinating company, this digital design firm that's got everybody excited at the New York Stock Exchange. When it starts trading, you'll hear about it right here on Bloomberg. This is something that we're going to talk about now that has the president very upset. It has nothing to do with tariffs or trade. Why would one Republican, the president asks on Truth Social, Senator Josh Hawley from the great state of Missouri, join with all of the Democrats to block a review sponsored by Senator Rick Scott and with the support of almost all other Republicans of Nancy Pelosi's stock trading over the last 25 years. Yet this is an effort to stop insider trading in Congress, and apparently Josh Hawley is on board. President says the information was inappropriately released just minutes before the vote, very much like sabotage. The Democrats, because of our tremendous achievements and success, have been trying to target me for a long period of time, and they're using Josh Hawley, who I got elected twice, as a pawn to help them. He refers to Josh Hawley as a second-tier senator in this effort to combat insider trading on Capitol Hill. He's referring to Nancy Pelosi because she has frequently been the poster child for this kind of stuff. That's where we start with our political panel today. Jeannie Shanzano is with us, Bloomberg Politics contributor, senior democracy fellow with the Center for the Study of the Presidency and Congress. Of course, Bloomberg Politics contributor, as I may have mentioned. Joined today by John Seaton. It's great to have John back, Republican strategist, founder, CEO of Echo Canyon Consulting. And so here we go, Jeannie. We've talked about these stock bans before. The lawmaker stock trading ban is now advancing in the Senate because of one Republican, Josh Hawley. President says he is a second-rate senator as a result. And we've got news now that Hawley had a good chat with Donald Trump over this, but the stock trading bill is something that people feel pretty passionate about. We've done a lot of stories on it around here, Jeannie, but this kind of activity continues. When a lawmaker gets inside information via committee or something that was said in the writing of a bill, then they sell all the shares before the thing goes down, or vice versa. Will this ever stop? Is there a way to control this by way of legislation?
I was chuckling when you were reading Donald Trump's truth because, number one, again, just like he did with Chuck Grassley the other day, he has taken to saying he got these people elected. So he got Josh Hawley elected twice. He got Chuck Grassley elected. But the other part of it is when he's questioning why Josh Hawley is doing this, well, I think he may forget that just this spring, he himself said if a bill like this crosses his desk, he will sign it. And as opposed to saying, I disagree with this portion, or let's work on it, let's rewrite it, the president is all out attacking Josh Hawley. And of course, he is on the wrong side of public opinion on this. About 8 to 9 out of 10 Americans say that members of Congress should not be trading on the stock market because of the work they do in Congress, where they get information that can help them. And so this is a very popular bill, but, you know, I think the president is a bit concerned about the impact on himself, even though now he's carved out of it, so he doesn't have to worry.
It's actually called the Pelosi Act, John Seaton. This is the Homeland Security Governmental Affairs Committee that was voting on this. It cleared 8-7, would ban lawmakers and their spouses from actively holding stocks. Imagine the blind trust or whatever, you put all your money into ETFs. Is this a good idea, John? And is it something that could actually be passed and turned into law?
As Jeannie noted, it has tremendous amount of public support. I think people are very concerned that lawmakers are getting information before the general public and then using that information, right or wrong, to make decisions as to their stock portfolios. So I do think it has a lot of support. I do think that Josh Hawley has been very consistent on this. He is a true populist, and so I wasn't terribly surprised to see him vote the way he did. I was a little bit surprised by the president's reaction, but yeah, I think this thing has real legs, and it would not be surprising to me if it made its way to the president's desk.
The bill apparently was originally dubbed the Pelosi Act. Now it's the Honest Act. Is that right, Cece? She got a name change on it. Rick Scott, the Republican from Florida, Jeannie, asks, anybody want to be poor? I don't. Does it come down to that? Rick Scott already has a lot of money, doesn't he?
He does, as do most members of the Senate. Not all, but this is why we call it the Billionaires Club. And, you know, you go back to, I think it's a 2022 New York Times study, which found in Democrats and Republicans, because, of course, this is bipartisan, about 20% or a fifth were buying and trading stocks in this study that benefited, and they benefited from their work in Congress. And, you know, as John just said, and everybody would agree, most Americans think that in a representative democracy, you would elect people, send them to Congress, not to enrich themselves by buying and trading stocks based on information they've gotten, but doing the work of the people. And so I do think there are concerns, by the way, about this bill. I am particularly concerned about the impact on spouses, partners, children, the like. You know, I think there are discussions to be had, but I also agree that we need to move forward on something that makes sense, so that we do have rules in this regard in the Congress, but they do need to be strengthened so that the American public has more confidence in the people that they are sending to Washington, D.C., which is at an all-time low, as you know today, Joe.
John, what do you make of the modification for President Trump? Jeannie mentioned this. It was changed to carve out President Trump here because he's term limited and cannot seek another term. This would be triggered by, you'd have to divest within 90 days of your intention to seek another term. That's how this would work. Rand Paul says the substitute would protect Donald Trump. He's actively investing in a lot of things right now, John, including crypto. Why not keep the president covered by this?
You know, I think Republicans rightly have a lot of concern that there has been kind of a weaponization against this particular president and his family. It's important that this bill move forward, and I think the Republicans want to make sure that it's not used kind of as yet another cudgel against President Trump. So writing it in such a way that he is term limited out, it can't retroactively impact him or his family, but again, do the right thing and do what the American people really do want, which is some accountability from lawmakers and make sure that they're not enriching themselves due to the jobs they have in the Congress.
I'm kind of surprised we don't hear more outcry from voters on this. I mean, there have been 60 Minutes pieces. There's been endless coverage on Bloomberg about this, but senators, Republican senators, with the exception of Josh Hawley, are in many cases just frozen in the headlights here, Jeannie. Bernie Moreno, Republican from Ohio, freshman, of course, a co-sponsor of the original Pelosi Act, voted present on the substitute amendment, arguing that senators should not have been forced to swallow last-minute changes. Quote, if you had a gun to my head, I could not tell you what I am about to vote for. How could this be, Jeannie?
It is hard to believe. I think it is reflective of the fact, a very simple rule in Washington, that when it is called the Pelosi Act and it is Republicans aiming the gun at Democrats, they are for it. And when it switches and it is looked like it's aimed at the president or other Republicans, you find Democrats on board and Republicans fall off. And this is what is so troubling to the American public about this. And that's why on this issue of the carve-out for Donald Trump, I do think that the carve-out makes sense. I also think he has been skirting ethics, if not running up against them, as it pertains to enriching himself and his family in ways that we've never seen before. I think it's unconscionable, but I also think it is such a politically charged issue that if we want to move forward at all with legislation, that carving out the current president and vice president may be the only way to do that, or so I would have thought until last night when this bill, even with the carve-out, didn't get much Republican support beyond Josh Hawley.
See, Donald Trump writing, I don't think real Republicans want to see their president, who has an unprecedented success, targeted because of the whims of a second-tier senator named Josh Hawley. I guess they had a chance to talk it out. Coming up in our next hour with our panel, Jeannie and John, we're going to be talking trade a lot because we're counting down the hours here to the trade and tariff deadline. August 1st, yeah, that's tomorrow. So technically at midnight, the tariffs, reciprocal tariffs, will take effect. So here we are on the eve. You could argue that this is the deadline day because once the clock strikes 12, they're in effect. 11:59 is technically the deadline. And John, we could get more deals today, but I'm wondering your thoughts, and we'll have a lot more time to explore this in our second hour here on Balance of Power. Your thoughts on the way this is playing with voters. Are people paying attention to the details of these trade deals that are coming out in the past couple of days?
I don't think that people are paying a lot of attention. I think certainly Republican voters have been hearing this president talk about tariffs since long before he was president of the United States, and so I don't think it's a huge surprise, at least to Republican voters. And honestly, I think people start paying attention if they see big changes in the cost of goods and in their overall quality of life. Until then, I think it's just kind of background noise, and they really aren't as tuned into it as we are, frankly.
90 deals in 90 days was the line, Jeannie. We got 8 deals in 120 days. How should we be looking at it?
And you know my view, Joe, 8 deals with no details and not really any sign off. I'm not sure if I'd call them deals, but okay. It's less, but I'll tell you when people are going to start to notice. I mean, we heard today that Charmin is going to increase their prices come the fall, the summer perhaps. And those are household goods that people depend on, from, toilet paper, if you see diapers go up, if you have children, as, we all know how expensive those are. That's when people are going to start paying attention to this. If those prices, people follow Charmin and those prices go up, which if we get huge, tariffs put in place on all these countries in the next few hours, that very well could happen.
Don't squeeze the Charmin, John. The fact is that's owned by Procter & Gamble, which said this week it would hike prices on a quarter of its consumer products here in the United States. Is that the kind of thing that puts fear into Republican lawmakers?
Yeah, look, I mean, I think we saw with the last administration, we probably talked about it on this show, that they were so slow to kind of react to and recognize people's concern with skyrocketing prices that by the time they tried to do something about it, it was really too late. So I do think that Republicans in Congress and in the administration are going to pay very, very close attention to the cost of those household goods that Jeannie talked about. And I do think that they'll really want to keep an eye on it and make sure that they do everything they can to keep prices low, because that is something that voters definitely notice and definitely will impact the way they behave next November.
I'm a little worried about it. We're going to do this whole panic buying of toilet paper again. Is that happening, Cece? Do I need to run out to Costco now, get cases of Charmin? Just wait until this fall and the back-to-school shopping stories kick in. Jeannie Shanzano and John Seaton Our Democrat and Republican, a great panel today. Thank you both for the insights on the Pelosi Act, if we're still calling it that. And we'll have much more on the trade front coming up in our next hour as we welcome our global television audience to the conversation. We'll have an update from the White House from Tyler, and Ron Kirk, the former USTR, will join us just hours away from the tariffs kicking in. Much more ahead, only here on Bloomberg.
From Washington, D.C., this is Balance of Power with Joe Matthew and Kaylee Lines.
Deadline day is upon us. Welcome to the Thursday edition of Balance of Power as we count down to reciprocal tariffs threatened by the Trump administration, set to take effect at midnight. I'm Joe Matthew alongside Kaylee Lines in Washington. Thanks for being with us on Bloomberg TV and radio. As we count down here, Kaylee, to midnight taking effect, you wonder if we get more deals or if this is all we're going to have with the president making A few posts about Canada and Mexico, but no major trade deals announced today.
Yeah, keeping in mind there are 11 hours for countries to be able to strike an agreement with the U.S. and avoid these tariffs going into place on August 1st. But it's unclear whether or not any more will be able to do that, as the White House says that August 1st is a hard and fast deadline. It's for real. It will not be budging, except apparently in the case of Mexico, after the Mexican president, Claudia Sheinbaum, spoke by phone with President Trump earlier today and secured a 90-day extension of its own current agreement.
I'm sure there's a taco line that would be funny there somewhere. Canada, on the other hand, not so much. Announcing plans to recognize a Palestinian state. That's a deal breaker, it seems, for trade with President Trump. Just a two-line truth on that. It doesn't look like we're making any progress with Canada.
Yeah, it's interesting as well, because Canada is not the only major economy that has taken that position in recent days. The UK did the very same thing, and yet the UK trade deal or framework that was agreed between the two countries seems intact for now. President Trump didn't have much reaction when it was Keir Starmer making that
it's really true, because that's been kind of the poster child, the example of what a trade deal could be. He didn't like it when Emmanuel Macron did the same. UK gets it passed. Canada apparently doesn't get a deal at all. So we'll be keeping our eyes on Truth Social and our ears on the White House. We'll have an update from the North Lawn in just a moment.
Yeah, and we'll speak with former U.S. Trade Representative Ron Kirk about all of this as well. So there's a lot to look forward to this hour, but we also need to begin with a check on the markets, because we're in the thick of the busiest week of earnings season with more tech stocks reporting this afternoon. So let's get a check on those now with Amy Morris here in Washington. Hey, Amy.
Hey, Kaylee, we do check markets for you all day long at Bloomberg. The S&P 500 up 0.5%. NASDAQ up 0.9%. The Dow up about 0.1%. The 10-year Treasury yield at 4.33%. The 2-year yield at 3.92%. This just crossing the Bloomberg terminal. Google will be forced to open its App Store after Epic Games won its case against the tech giant. Now, this ruling means the Google Play Store will have to lift restrictions preventing app developers from setting up rival marketplaces and billing systems. Figma shares are indicated to begin trading up to $110 each, implying as much as a 233% gain above the IPO price of $33 apiece. The design and collaboration software company and some of its backers raised $1.2 billion in one of the year's most anticipated IPOs. Microsoft reached a $4 trillion market capitalization after reporting quarterly earnings that beat Wall Street expectations. Microsoft reported better than expected growth in its cloud business, posting a 39% rise in sales. Microsoft shares now more than 4.5% higher. eBay shares jumped after that company projected sales topping analyst estimates, suggesting optimism for continued consumer resilience at a time of shifting U.S. tariff proposals. eBay shares right now 18% higher. Federal Reserve's preferred inflation gauge also ticked higher last month in a sign that President Trump's broad-based tariffs are starting to raise some prices for many goods. The Commerce Department says prices jumped 2.6% in June compared with a year ago. That's up from an annual pace of 2.4% in May. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. We go back now to Balance of Power with Joe Matthew and Kaylee Lines.
All right, Amy Morris with a look at where we stand at 1:03 p.m. Wall Street time in the middle of this trading day. It's actually about right now that we'll be keeping our eyes on the White House, as well as the White House Press Secretary Caroline Leavitt is set to brief reporters on a number of issues. Tariffs and trade, of course, I imagine will rank most highly on what's on the mind of the journalists in the room, as we are approaching this midnight deadline for countries to reach trade agreements or not with the United States and face the implementation of them tomorrow, August 1st. And of course, later on today, Joe, we will also hear from President Trump himself as he's getting set to sign executive orders and welcoming the press in as he does so.
I have to admit, I mean, there's always tomorrow, but this just feels like one of those days when he walks into the briefing room. It could be one of those days when he wants to
Can't rule anything out.
Shape the narrative here, because we're all asking the same questions. Is that it? Remember, 90 deals in 90 days. We technically got 8 deals in 120 days, realizing one of those deals includes the full block of the EU. We could frame that as more than one deal, I guess. But look, we could get more where this came from. As we mentioned earlier, Kaylee, the update on Canada is not good, as the president says its decision to recognize a Palestinian state is a deal breaker when it comes to trade. Mexico gets a 90-day reprieve. Let's go to the White House to see what else we may have learned here in the last 24 hours. Bloomberg Washington correspondent Tyler Kendall is on the North Lawn of the White House right now to bring more to us here. Tyler, what's happening in that building behind you? Is the president done?
Hey, Joe. At this point, it's not really clear, though, at 4 p.m. Eastern, as Kayleigh mentioned there, he's going to welcome the press into the Oval Office, sign some executive orders. We'll have to see if those include actually putting pen to paper when it comes to putting these different tariff rates into effect, because keep in mind, so far all we've really gotten are these Truth Social posts, the letters that he sent, but we actually have to see the formal documents to see what's actually in the text and going to go into place. Now, you mentioned there, of course, Mexico was pretty big news today, getting that 90-day reprieve. That was perhaps unexpected, considering that the White House had said that there would not be any extension when it came to that August 1st deadline, though we should keep in mind that Mexico is actually the United States' largest trading partner, perhaps why we've heard administration officials say that the country would get a little bit more of a preferential a position when it comes to these negotiations. A lot, though, that we're still tracking, and a lot more that could still be on the table. Keep in mind, you mentioned Canada. We also haven't heard about Australia, for example, and then two countries, Joe and Kayleigh, I'll put on your radar that we could get an update later today, Thailand and Cambodia. The Commerce Secretary, Howard Lutnick, last night said that they had finished those agreements, but we've yet to see what that lower rate could be. Right now, they're facing a 36% tariff, comparatively higher to what their neighboring nations have gotten in that region.
Well, when we consider that region, Tyler, in which, of course, China features incredibly heavily, do we have an understanding of how it went when the Treasury Secretary Scott Bessent and USTR Jameson Greer briefed President Trump on their negotiations with China in Stockholm earlier this week?
So we've heard from President Trump that it's gone positively. In a interview earlier today, the Treasury Secretary said that they were still working out some of the technical pieces when it came to an update to the trade talks there. We are expecting a 90-day pause to go into effect when it does come to keeping this de-escalation on track, because essentially that's what those Stockholm talks were, right? We heard the USTR basically amount them to a check-in, make sure that both sides are living up to the agreement that was reached in London, which is really about the agreement that was reached in Geneva, make sure that those magnets are flowing into the United States and that the U.S. is upholding its end in terms of perhaps loosening some export controls for less advanced semiconductor chips. They want to keep this process going and make sure that they're still talking, but we know that there are a lot of sticking points on the table. These are going to be talks that take a long time to accomplish. Just one that we haven't really spoken about a lot, but we heard the Commerce Secretary in an interview earlier this week say that the TikTok deal is happening adjacent to these talks. Things like that that really do come into the picture and the negotiating picture that just make this all the more complicated.
I don't know what they're trucking in there, Tyler, but if you need to get out of the way here in the driveway, this is a working White House, obviously. Tyler, thank you so much, as always, for being with us. Bloomberg Washington correspondent Tyler Kendall, live on the North Lawn at the White House. We try to seek voices of experience, practitioners, people who have been in the process of, in this case, cutting trade deals, to get a better sense of what's happening here at the White House. Kayleigh, we've talked so much about the lack of paper, the lack of detail. And we thought we'd talk to somebody who's actually been in the room for these deals to get a better sense of what they mean.
Yeah, I'm pleased to say joining us now here on Balance of Power is a former U.S. Trade Representative himself, Ron Kirk, who served in that position from 2009 to 2013 in the Obama administration. Ambassador, thank you for being with us once again on Bloomberg TV and radio. As we consider what are being described as deals here, does it meet your definition of a deal? Do any of them?
You know, they are not trade deals in the traditional sense of a formal treaty like the USMCA or other agreements that are enforceable, or even agreements in which Congress signs off on them. But I think our partner countries have accepted the fact that we are just in uncharted waters in terms of this administration. And the fact that the president is using a heretofore never used authority with these emergency economic powers and are just trying to avert what could be a horrific situation, not only for them, but I keep stressing the point, this is not good for American business nor families, because no matter how many times the administration says it, whatever the tariff rates are, they're going to be vastly higher than they were last year at essentially 0 or 2%. And they're going to be paid by small businesses, large American importers, and ultimately American families and consumers.
What do you make of President Trump's conflating of geopolitics with trade policy? We've seen this take place now with India and Pakistan, Cambodia and Thailand. In the case of today, Canada, recognizing, it says, will formally recognize a Palestinian state. Donald Trump says that's a deal breaker. We can't have a trade deal with Canada. That would be the definition of uncharted territory. But what does it mean for both our trade policy and our geopolitics and our relationships with our allies?
In fairness, there have been cases in the past where there were overriding geopolitical factors that prevented us from moving forward with a trade agreement. You may remember the Colombia agreement, which I inherited when I served as trade rep for President Obama, was stalled because a member of the Colombian government had murdered a U.S. soldier. But in this case, I think it's the lack of consistency, Joe, that bothers people. A number of the member states of the European Union have also spoken out and been, even before Canada, saying that they thought there should be a Palestinian state. But the biggest thing that troubles me in talking to businesses, what they want is some sense of what the playing field is going to be, some level of stability. Tell them what the rules are going to be, because all of us, I think, want to support the president's desire to bring manufacturing back. But as you know from talking to businesses every day, the uncertainty, the on-again, off-again nature of these tariffs makes it impossible for businesses to try to forecast and plan ahead. And in the interim, you have a number of businesses, particularly small businesses, that are just suffering under the weight of these tariffs and looking for relief.
Well, and of course, some of those businesses in some U.S. states have taken to the courts to try to find that relief. As you well know, Ambassador, there was a court challenge on the president's use of IEPA powers, specifically a suggestion that the legal mechanism for which he is using to apply a lot of these tariffs may not actually hold water. An appeals court is actually considering that very question today, though it's unclear when we'll get a ruling. What would be the course of action for the president if indeed the appeals court decides that IEPA is not applicable in the vast majority of these cases?
If the court were to rule in favor of the plaintiffs, who in most cases have been small businesses, and that is questionable given the latitude the courts have given this administration, but if they were, then the president would have to follow the traditional legal norms that Congress has put in place for the president to be able to levy tariffs outside of the normal protocol. And those would be the tariffs, for example, that he has talked about with Brazil under, I don't want to get too technical, under a 301 investigation. And then there is a different section of the trade law that allows the president to levy some tariffs under national security concerns. But in each of those, businesses have to have the ability to go in, file, share information with the administration on how those tariffs may or may not impact their businesses. It is a much more informed process. That's what the president did the first time. I mean, I'm told he was frustrated by that pace, and that's one reason he has used this very novel approach of relying on a emergency economic power that has never been used before to levy tariffs.
The ambassador referring to it as a novel approach. Ron Kirk, the president says the deadline will not move. Well, I guess unless you're Mexico. But if that's the case, they've also said countries can call. What's that?
He told us the deadline wasn't going to move on Liberation Day. He told us it wasn't going to move in 90 days. And I think, look, and not to make light of it, the one reason I think you've seen the markets not overreact to this is they've become a little bit dependent on the belief that when he gets up to the point of knowing the economic harm these tariffs would inflict, he has found a way to back away. He did it with China, did it with Mexico today, we've done it with Japan. So we'll have to see. We'll know by, I guess, noon tomorrow.
Or not. I've looked at, I don't know if you like tacos, Ambassador, but the White House has said that if countries want to call after the deadline, we'll still enter negotiations and maybe we'll cut a deal after the fact. Based on your experience in dealing with our trade partners, would they take Donald Trump up on that offer after all these letters go out in the next 24 hours?
Well, I think every country will, particularly, the level of tariffs that the president is imposing, frankly, just don't relate to the harm that he says he's trying to cure. And you've had enough economists speak to that. And sadly, many of these smaller economies, ironically, have a trade surplus with us. And yet they're still being hit with tariffs on mostly sending us goods and trinkets for which there's just not that big of a market going the other way. So I think all of us expect that if these countries can somehow get into the queue, if their president can call and, in our president's view, bend the knee or say the magic words, then relief will be coming. But the most powerful factor in this, frankly, has been the market. Every time the president has threatened to impose, double-digit tariffs above 20%, the markets have spoken and spoken quite quickly, and the president has backed off, similar to when he made the threat to fire the head of the Federal Reserve.
Yeah, Chairman Powell, at least for now, safe in his job despite not cutting interest rates yesterday. Ambassador, we'll see if that changes. Just quickly, as we look ahead to another deadline, August 1st is one thing, August 12th is another. That's when the current trade truce between the U.S. and China is set to expire, and President Trump, to this point, has not yet signed off on an extension. Are you concerned at all that we may actually see a rebound to the sky-high level of tariffs we experienced between the two largest economies earlier this year?
I'm concerned, but I will tell you I think I and others are relieved that at least the language we're hearing both out of the White House, out of the U.S. Trade Rep and the Secretary of Commerce's office seems like an attempt by both countries to really sort of de-escalate the tension and get to a level of negotiation that's going to be more beneficial to both countries. Now, to be sure, we are in a very different place with China, and not because of Trump administration, but because of President Xi and his nationalist policies. But both countries have realized there's a lot more pain to be inflicted on one another than if we can find some way to at least make sure that American industries have access to those critical minerals that we want while protecting our basic interests. And as you noted in your earlier comments, perhaps give the U.S. giving a little bit on some of the export controls.
Thanks for bringing us inside the process, Ron Kirk, former U.S. Trade Representative in the Obama administration. It's great to have you with us. We'll assemble our panel next, only here on Balance of Power on Bloomberg TV and radio.
121 on Wall Street. I'm Amy Morris. We check markets for you all day long here at Bloomberg. The S&P 500 is up 0.3%. NASDAQ up 0.7%. The Dow now down 0.1%. The 10-year Treasury yield at 4.34%. The 2-year yield at 3.93%. Right now, all eyes are on Figma. Shares may begin trading up to $98 each. That is nearly triple the IPO price. The design software maker and its backers raised $1.2 billion in one of the year's most anticipated IPOs. CVS Health raised its 2025 profit guidance as the company's Aetna Health Insurance arm and pharmacy unit outperformed expectations in the second quarter. CVS's chief executive officer says the company is probably a year ahead of the market after focusing on operations, pricing, and forecasting in the latter part of last year. Shares of CVS are up 0.8%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Now back to Balance of Power with Joe Matthew and Kaylee Lyons.
All right, Amy Morris checking on the markets for us. Thank you so much. An equity market, of course, which is hovering right around record highs, even as we face a looming deadline of midnight tonight, the implementation from this White House of higher tariffs on the vast majority of the United States' trading partners that haven't yet been able to reach trade agreements with the administration. And yet markets seem to be paying it no mind. Perhaps that has more to do with strong tech earnings today than anything else. But it becomes a question of whether or not that will stick, knowing how they reacted to the initial Liberation Day tariffs on April 2nd. Or perhaps they just no longer buy that these deadlines are hard and fast, even as the White House says that they are, though Mexico was able to get a 90-day extension today. So take that as you will. All that said, whatever market participants are dealing with, businesses are having to consider whether or not to take these tariffs seriously, how to reorient their supply chains as well. And they're speaking to those that represent them here in Washington about it. We spoke with the Democratic Senator from New Hampshire, Jeanne Shaheen, about that last night on Balance of Power. And this is what she said about what she's hearing.
Every business I visit in New Hampshire has expressed concern about the tariffs. As much of a problem as the high tariffs are and the increases in cost, it's the uncertainty that it means for their business because they don't know what the president's going to do. He's made about 100 contravening statements on tariffs since he took office.
Right after Senator Shaheen spoke to us on Balance of Power, she went down to the Senate floor with 5 of her Democratic colleagues to ask lawmakers for unanimous consent to pass a piece of legislation with her name on it that says tariffs cannot be authorized under IEPA, the International Emergency Powers Act that the president has used to justify these tariffs. It did not pass, as she told us. It's expected, but Democrats are trying to plant a flag here to throw down a marker on tariffs before they even take effect tomorrow. And it's where we start our conversation with our political panel. Bloomberg Politics contributor Jeannie Shanzano is with us, Democratic analyst and senior democracy fellow with the Center for the Presidency and Congress. John Seaton, Republican strategist, founder, CEO of Echo Canyon Consulting, is the other half of our great panel today. And Jeannie, I'll start with you here. Having heard from Senator Shaheen, it was like a tree falling in the woods last night. Let's be honest, in the Senate, nobody thought this would pass. It didn't pass. Never mind unanimous consent. You're not going to get a single Republican to square off, it seems, with the president on this. And so Democrats in Congress as a whole then is simply in spectator mode here, right? This is something that the president will own himself.
Absolutely right. Of course, as you mentioned earlier, this case of IEPA and whether the president has the power to impose these tariffs under IEPA is in court today, interestingly enough. Already, the Trump administration has been told that it is unlawful, the use of IEPA to impose these tariffs by 2 other courts. It's now in a 3rd court and will likely go to the Supreme Court, but we know how long that takes. And of course, Donald Trump has other options, not just IEPA. But I think, listening to Senator Shaheen, it's fascinating because she is talking about the pain that her constituents, small business owners, are feeling on the ground. You just talked to Ambassador Kirk, pain that all of us will feel going forward. as it pertains to the increase in prices that regardless of what happens, we are all going to feel. And to your point, the president is going to own that because there's very little that can be done outside of the courts at this point to stop him.
Well, so John, how much pain do you think President Trump is really willing to tolerate?
That's a great question, and I do think that he's extremely mindful of the markets. He's extremely mindful of prices. He ran in large part to kind of undo the huge spikes in inflation from the previous administration. So if prices start to really go up dramatically as a result of tariffs going into effect, I do think that he'll be paying attention. It'll be very interesting to see how he kind of calibrates.
Well, it's, town hall season, John, and I wonder how this plays, if at all, when voters ask lawmakers questions. In some cases, they could be talking about government spending, the big, beautiful bill, taxes, Jeffrey Epstein. Do tariffs come up here? And I ask you that because there was a lot of concern around Liberation Day that wasn't just Wall Street. There were consumers worried about higher prices coming. Where are their heads now?
Yeah, again, I think it remains to be seen what happens with prices, but I think it's a great point that town hall season is here. It's the August recess work period. And, I think most of the attendees, especially Democratic attendees, are going to be talking about the big, beautiful bill. But as prices creep up, again, if they do, in fact, creep up as a result of these tariffs, congressmen are going to start to hear from their constituents about their concerns. So I think as we sit here now, I expect big, beautiful bill to probably be front and center at a lot of these town hall meetings, maybe a dash of Epstein as well. But as the summer progresses, as August progresses, if prices rise, congressmen and congresswomen are going to be hearing about it.
Well, as we consider what we're hearing from all sides here, Jeannie, what we've heard consistently from the White House leading up to tomorrow, August 1st, is that that deadline is not moving. It's not budgeable. It is going to be when these tariffs go into effect. And then this morning, you get a phone call between the president of the United States and the president of Mexico, and all of a sudden, Mexico has itself a 90-day extension. Does President Trump not risk playing right into the taco narrative that he's tried so hard to push back against?
He absolutely does. I keep thinking back when he said the other day, it's 100% firm or not 100% firm. It was like both ways. And, this is what people have gotten used to. And what's so troubling about this is, to me, that as we think about prices going up, the American public will ask themselves, why is he doing all this? Why are we paying more? And there are circumstances under which Americans will say, okay, I understand we need to pay a little more for security and other reasons. But what did we learn overnight? The president is saying now, you're going to pay more because my ally in Brazil is going on trial for corruption. You're going to pay more because I don't like what Canada decided to do in recognizing Palestine. You're going to pay more because I don't like India buying energy from Russia. These kinds of reasonings are just wholly and completely 100% not in the realm of what we see when we think about tariffs this steep, that you're doing this for agendas in other countries. So the president, I think, here is going to have a lot to answer for as it pertains to why this entire Liberation Day, what was it all for?
Curious, Mexico gets an extension on National Avocado Day here, Jeannie, but I want everyone to hear what Mark Carney had to say. This matter of essentially breaking off talks with Canada over recognizing the Palestinian state is a pretty interesting wrinkle in this ongoing saga. Listen to the Prime Minister of Canada.
Canada intends to recognize the state of Palestine at the 80th session of the United Nations General Assembly in September 2025. This intention is predicated on the Palestinian Authority's commitment to much-needed reforms. Canada will increase its efforts in supporting strong democratic governance in Palestine and the contributions of its people to a more peaceful and hopeful future.
Donald Trump takes to Truth Social, writing, "Wow, Canada has just announced it's backing statehood for Palestine. That will make it very hard for us to make a trade deal with them. Oh, Canada, triple exclamation point." John Seaton, what does Palestine or a Palestinian state have to do with trade?
Well, as was noted by your previous guest, this is certainly not the first time that administration has used all of the, everything they have at their disposal to try to nudge countries to make good foreign policy decisions. I think there's a very
It didn't derail the trade deal with the UK, Canada. Though. Is that weird?
That is interesting, but it should not be a surprise. Again, I think that the timing that Canada made this announcement is regrettable. I'm not surprised that President Trump reacted the way in which he did. And so again, we'll see. Never say never. I don't think that trade negotiations have been completely cut off. But I do think that there was a better way to handle this, and I do think that it did set trade negotiations back in really an unnecessary and unneeded move by the Canadian government.
Well, when we consider the timing, Jeannie, it of course comes at a time in which countries around the world are fixed on Gaza and the malnutrition and apparent starvation that is happening there. President Trump himself has acknowledged this in recent days. And we just learned from the White House press secretary, Caroline Leavitt, that Steve Witkoff, his special envoy, will be visiting Gaza tomorrow to inspect food distribution sites where we know there have been difficulty distributing food, and in many cases have actually resulted in deaths of those trying to seek that aid. Does President Trump himself reach a breaking point at some point soon here? Maybe not to go as far as to recognize a Palestinian state, but to break more decidedly with the Israeli prime minister?
I think he might. And I think to your point, Kaylee, we saw inklings of that in his comments in Scotland. We understand that in particular, the First Lady, not just the president, are horrified by the pictures that we are all seeing of children starving and reports of 60,000 dead. Even if 20,000 of those are Hamas fighters, that's a lot of civilians dead. And so I do think that Israel risks isolating itself from the world if it keeps pursuing this path. And quite frankly, Donald Trump has the power and has the relationship with Israel and Benjamin Netanyahu to move the needle. To your point, maybe not going so far as to recognizing Palestinian statehood, but of trying to move them in a different direction. Because long term, what we're seeing in Gaza, even though they've restricted press access, what we're seeing in Gaza, the pictures that are getting out are very, very troubling. And the president made that case. And I think if Steve Witkoff doesn't get some movement over there with this latest visit, we may see the president come to a point where he has to push Benjamin Netanyahu in a different direction, on the very least on humanitarian and food aid.
All right, Jeannie Shanzano, Senior Democracy Fellow with the Center for the Study of the Presidency and Congress, alongside Echo Canyon Consulting founder and CEO John Seaton, our political panel today. Thank you both so much for joining us here on Balance of Power as we keep tabs on what we're hearing from the White House press secretary out of the briefing, not just the news that Steve Witkoff is going to Gaza, but also, Joe, that President Trump has sent letters now to 17 pharmaceutical CEOs around drug pricing, and we're seeing markets reacting to that.
This is a big deal. This could actually end up being in the big news of the day, and something that's just now breaking after we heard from the press secretary. Eli Lilly shares have just turned negative. Lilly was, in fact, one of the companies that received a letter and had been rising on news of this Mounjaro study that came out before the bell. We'll have a lot more on this ahead. Maybe pharmaceuticals are next, Kaylee. Stay with us here on Balance of Power, only on Bloomberg.
It's 1:40 on Wall Street. I'm Amy Morris. We do check markets for you all day long here at Bloomberg. The S&P 500 up 0.2%. NASDAQ up 0.5%. The Dow is down 0.25%. The 10-year Treasury yield at 4.34% and the 2-year yield at 3.94%. Microsoft reaching a $4 trillion market capitalization after reporting quarterly earnings that beat Wall Street expectations. Microsoft reported better than expected growth in its cloud business, with its Azure cloud computing unit posting a 39% rise in sales. Microsoft shares up more than 4%. eBay shares jumped after that company projected sales topping analyst estimates, suggesting optimism for continued consumer resilience at a time of shifting U.S. tariff proposals. Shares of eBay 19% higher. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. It's a Bloomberg Business Flash. Let's go back to Balance of Power with Joe Matthew and Kaylee Lines.
All right, Amy Morris, thank you so much, and thank you for joining us here on the Thursday edition of Balance of Power, the early side edition, where we expected a flurry of paper today from the White House. This is deadline time for reciprocal tariffs. They would take effect midnight tonight, so 11:59 p.m. we'll call our deadline here. But Kaylee, this is not a flurry of paper about tariffs, at least not yet. It's about pharma. The president just kicked out a pile of letters to the likes of Johnson & Johnson, Pfizer, Eli Lilly, Regeneron, talking about requirements. And we've heard most, if not all of this before through executive order in an effort to lower drug prices. It's a four-pronged approach. And what's news here is he wants binding commitments from these pharmaceutical companies by the 29th of September. Each is signed at the bottom in Sharpie. And in the cases where he has relationships with the chief executives, he's actually crossed it out. In the case of Regeneron, which is run by Leonard Schliefer, he crossed it out with Sharpie and just wrote Len.
Yeah, making these a little bit more personalized. Otherwise, each letter seems to be a carbon copy of the other with a different addressee on the top. But of course, this is a follow-up to his executive order from earlier this year in May around drug pricing. In particular, we're seeing it have a market reaction as the pharmaceuticals index within the S&P 500 is now right around a session low, down about 1.5%, and will continue to follow those moves, knowing that healthcare costs and drug costs are just one kind of cost that this White House has pledged to get down for the American people. The difference is perhaps that we're not seeing as much concrete action on other elements of everyday costs at this time, and that was evident arguably in today's inflation data. The Fed's preferred inflation data, actually, PCE, coming in a little bit hot year on year. And we want to get more on that as we look at a deadline on higher tariffs of tomorrow, which could threaten to send inflation higher, as we turn to Catherine Edwards, economic policy consultant and Bloomberg opinion contributor. So, Catherine, if we are to believe the White House is going to raise tariffs effective at midnight, August 1st is a real deadline that these are going to stick for some time. What's likely to happen to PCE and to inflation? And does it mean that the Fed probably made a good move in keeping rates steady this week?
I don't think there was really any question that rates were going to go down this week. I think the bigger question is what happens in September. And to your point, y'all, that's a big if. If it goes off as planned, if they stay into effect, if they're not canceled or paused or delayed again. And in the meantime, we have a lot of court cases related to the legality of these tariffs that are still evolving. I don't think that you can plan for the tariffs in either direction, which is why Powell and the Fed chose to hold steady, even though they saw signs of concern in both the consumer market and the labor market. What I worry about is the extent to which this continued uncertainty at the highest level plagues businesses and consumers.
So is this a huge I told you so for Jay Powell?
I just don't think it's in the man's nature to say that publicly, so I wouldn't want to give him I wouldn't want to give it to him when I know he wouldn't say it.
Well, what we did hear him say this week, Catherine, is that he thinks the Fed is farther away from its inflation goals than its labor market goals. He did not seem to share the same concern around the labor market that the dissenters, the likes of Christopher Waller, who, of course, would have cut rates at this meeting, had. What will we be watching for in the payrolls report tomorrow to give us a sense as to whether it's Governor Waller or Chairman Powell who are proving more prescient on that point?
He's spoken in the past about how the labor market is not as strong as the unemployment rate would necessarily predict, that there's problems in which industries are posting job gains. Are they really reflecting economic activity or an aging population? What hiring has looked like, the unemployment rate for young workers. I mean, he's brought about all these things before, but I think the price uncertainty question has to be paramount right now and has to take priority over the labor market because those are concerns and not red flags. Whereas broad tariffs are absolutely a red flag. And the effect on prices of broad tariffs is faster than any effect we've seen on the labor market. So he's got to be basically ready for the first worst thing that can happen, which will be tariffs, should they go into effect, if they stay into effect.
Yeah, we just got a headline from the White House. The press secretary is briefing reporters right now in the briefing room, Catherine. And President Trump will sign an executive order today on trade. We understand it will be on tariffs. So I guess with the exception of Mexico, these tariff rates are in fact going to take effect at midnight tonight. What will be the window before they show up in the hard data?
That's very hard to say. I think what we learned from the first big deadline in April is that businesses have been doing a lot of maneuvering to anticipate what is happening and protect their business, their supply chains, and their customers before they take effect, or assuming that they will. So I don't know how long it'll take, but I do wonder, at some point, something's got to break for a lot of businesses. They either have to pass on the prices or they have to start pulling layoffs because they can't afford it. And so how long they can wait in uncertainty has been an open question since we've entered the start of this administration. Another big tariff announcement in the Rose Garden, another big cardboard with lots of pieces, with lots of numbers next to it. That just could push a lot of businesses over the edge to say, whatever I've been holding back, I have to do now. That has less to do with the policy itself and more about how well people can anticipate and protect their businesses.
Mm-hmm. Catherine, it's great to have you as always. Catherine Edwards on the eve of the tariff deadline. Economic policy consultant. Find her work on the terminal. She's a Bloomberg opinion contributor. And we want to bring in the voice of a lawmaker. Congresswoman, Republican Nicole Malliotakis from New York is with us. New York's 11th district. Now that the home district work period is underway. Congresswoman, welcome back to Bloomberg TV and radio. There's always a lot we'd love to talk to you about, but I'd like to just start here with the conversation that we're having. We're listening to Caroline Leavitt and preparing for these tariff rates to go into effect. What are you hearing from business owners in your district when it comes to the impact of tariffs?
Look, both business owners and consumers rightfully have some concern about what this will mean for them, what this will mean in terms of cost if you're a consumer, what's your bottom line if you're a business, and how are you going to make sure that it doesn't impact you. But what I would say is, and I've told the administration this multiple times, it's my hope, what we will hear from the president, is that he will pause some of these tariffs, continue the pause, for the countries that have been working in good faith. We have many countries right now that are at the table. They're negotiating in good faith. They're looking to lower their barriers of entry, allow more American products into the country, try to make a more balanced trade. And I think that if they are working with us, then we should give them a little more time. Obviously, it is difficult within that 90-day period to make so many trade deals all at once because each is very exclusive, specific to that nation, and addresses different needs. But what we have seen from the president is more fair trade for the American company, for the American worker, as it relates to giving us a better deal, right? Making sure that our products are not hit with tariffs when they are imported elsewhere. And we've seen this with multiple Asian nations. We've seen it with the EU. We've seen it UK. And there's still a slew of other countries out there that we know are at the table negotiating, and we should not, try to put this additional tariff on them if they're acting in good faith.
Well, when we consider the administration is also touting the revenue that is being brought in by the existing tariffs, Congresswoman, knowing that that revenue is coming from importers who are paying that tax when they bring these products into the United States, is that really a better deal for them?
Well, it is bringing in significant revenue, and we shouldn't be turning a blind eye to that. I mean, look, we're talking of what could be, well over $1 trillion, trillions of dollars over the next decade that could certainly help pay down our debt in one respect. The thing is, you want to make sure that it's reasonable, so it's not going to, again, impact those end users or consumers. We really haven't seen those consumer prices increase. What we have seen, by the way, is trillions of dollars of private investment coming to the United States, whether it's from foreign companies or domestic companies, companies that are looking to expand their facilities. You mentioned the pharmaceutical industry earlier, automakers. We're seeing that they are investing in the United States. That is creating jobs. We saw the 3% GDP growth. I think you'll continue to see that. Now that we've also passed the tax legislation that will be pro-growth, pro-jobs, that will play a role. It all needs to be balanced. That's, I think, at the end of the day, what people are looking for, some type of balance here. And tariffs is a small piece of that equation, is a strategic tool, needs to be used, though, in a targeted approach. And really, we should be looking for a particular outcome from the nation that we're dealing with, not just an across-the-board, slamming every country with tariffs, particularly if they're working with us at this moment to get a more fair trade deal.
Well, it's possible we'll see more extensions before this day is over after Mexico got one. Congresswoman, we've been hearing from a lot of your Republican colleagues in the House and a number of Republican strategists who talk to us every day here on Balance of Power, who seem to think that a government shutdown is a lot more likely now than it was even a month ago following the passage of the rescissions package. A lot of Democrats are saying we're pulling away from the table. Republicans cannot be trusted. Does that ensure a shutdown at the end of September?
Well, I think Democrats not wanting to work with us in a bipartisan manner to fund the government can certainly lead to a shutdown, particularly when you need 7 votes in the Senate to pass any appropriations bill. And so it is concerning. I would argue that, all our appropriation bills have passed in a bipartisan manner. It is the right thing to do, is to avoid a government shutdown, make sure, and I've been through this now probably about 5 times, we've always averted the shutdown. So really, if we have a shutdown, it will be because the Democrats don't want to work with us in a bipartisan manner, because all these bills will be bipartisan at the end of the day, so they shouldn't hold their votes. And I would say that, look, we need to be responsible here. We need to legislate. The impact of a shutdown is very problematic, and we should really try to avoid that at all costs.
Yeah, of course, considering there may be political consequences as well as the midterms approach, Congresswoman. And as the midterms approach, we have a question as to what exactly the map is going to look like, knowing that Texas, in a special legislative session right now, is actively pursuing redistricting that could see Republicans net 5 seats in that state. Your governor in New York, Kathy Hochul, is now threatening to try to take action of her own. She says, "I won't sit by while Donald Trump and Texas Republicans try to steal our nation's future." Are we about to get into a dangerous gerrymandering war, Congresswoman?
Look, I hope not. And as somebody who is a victim of gerrymandering, I don't care if it's the Republicans or the Democrats that are doing it. It's wrong, and it should not be done. We have to make sure people are electing their representatives, and to try to alter a map to tilt the scale is wrong. We had to sue the governor in 2022 when they tried to really tilt the scale, in my case, put in very heavily Democrat areas of Brooklyn. It was the most ludicrous map. And because of my district, the whole state map was thrown out. And I think the Democrats learned a lesson there. When we had an independent person draw the map, they ended up losing 2 incumbents and then multiple seats in addition to that. And so what I would simply say is, whether it's Republicans or Democrats, gerrymandering is wrong. It should not be done. It's corrupt. And we have to make these maps as fair and balanced and competitive as possible. And perhaps we need to move toward computer-generated maps or just court independently drawn maps. But I don't support the gerrymandering, and I could speak about that from firsthand experience.
Yeah, I know this hits close to home for you, Congresswoman. It sounds like you agree with Democrats in Texas, though, that this should not happen.
Look, I agree with anyone who does not want to gerrymander, because like I said, it is just not the right thing to do. And I think that at the end of the day, we should be making these maps. And by the way, it shouldn't be made also to protect incumbents, which is the thing we see here in New York. These maps, whether they're at the state or federal level, are drawn to protect incumbents, and they're not competitive. My seat happens to be a competitive seat. It's one of the only competitive seats. Actually, I think it is the only competitive seat in the city of New York on the federal level. And that's the way it should be. So the voters have a say on whether they want me to represent them for another 2 years. Unfortunately, it's not like that throughout the state, and it shouldn't be an incumbent protection program either.
All right, we appreciate your candor, Congresswoman, and you joining us, as always. Congresswoman Nicole Malliotakis, the Republican representing New York's 11th district, here with us on the early edition of Balance of Power. We'll, of course, have more at 5 p.m. Eastern Time, which could be the aftermath of President Trump signing expected executive orders on tariffs and trade, knowing August 1st is quickly approaching. Midnight is only 10 hours away. We'll see you later on Bloomberg TV and radio.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody. Live from Bloomberg headquarters in New York City. Carol Masser, Tim Stenivek. I got to say, I've got 4 or 5 screens, maybe 6 up. I'm not quite sure where to start.
Should we start with Figma?
Let's go
It's
there.
the red headline. Hey, Figma shares finally have started trading. They were up 158% in their trading debut. They reached as high as 183%. But Carol, just moments ago, it's halted due to volatility on the upside. There's a trading pause with Figma. FIGUS is the ticker.
Yeah, definitely front and center. We've seen a few IPOs this week. In fact, we're going to be talking with the founder of One. It's a chip IPO. The stock soaring for a second day, began trading yesterday. Ambic Micro's founder will be here with us. So that we are going to certainly get into. And listen, we got to talk about the Mag 7, right, Tim? Because we're seeing some outperformance. Not every name is higher, but Meta and Microsoft certainly are.
Yeah, that's on our radar from yesterday and in today's trade. But after the bell today, we're hearing from, of course, Alphabet. No, not Alphabet. Did I say Alphabet?
That's okay.
Yeah, that was
Apple
last
and
week.
Amazon.
Oh my gosh.
I know.
Apple and
it's
Amazon.
a lot.
The final 2 of the Mag 7, except for NVIDIA, that we got, in a few weeks.
Yeah, we're watching them all, though, because they are such an engine behind some of the moves that we tend to see in the market. We're also going to keep an eye on what's going on with trade. We did see White House spokesperson Caroline Leavitt saying that President Trump will sign an executive order on trade later today. That order to have to do with logistics on tariffs. At the same time, she mentioned that the U.S. Treasury Secretary Scott Bessent and U.S. Trade Representative Jameson Greer continuing talks with their Chinese counterparts. So, is it Friday yet?
No, it's not even close.
And by the way, it's really dark outside because it's going to start pouring any minute.
All right, all that and more over the next hour. By the way, Figma opened at $85. 33 was that IPO price. We're going to continue to cover this throughout the hour right here on Bloomberg Business Week Daily, though. First up, a day's check of the day's trading top business stories. Here she is, Amy Morris, in for Charlie Pellet. Hey, Amy.
All right, thank you, Tim. Yeah, trading halt for design software maker Figma. Backers raised $1.2 billion in an initial public offering, pricing its shares above the marketed range. Shares opened around $85, but right now the trading has been halted. President Trump signed 17 letters to the CEOs of pharmaceutical companies, calling on them to take action within the next 60 days to lower drug prices. S&P Pharmaceuticals Index now down more than 1% to a session low. We do check markets for you all day long here at Bloomberg. The S&P 500, little changed on the downside. NASDAQ is up 0.2%. The Dow is now down 0.3%. The 10-year Treasury yield at 4.34% and the 2-year yield at 3.94%. Microsoft reached a $4 trillion market capitalization after reporting quarterly earnings that beat Wall Street expectations, reporting better than expected growth in its cloud business. Microsoft shares now more than 4% higher. eBay shares jumped after the company projected sales topping analyst estimates, suggesting optimism for continued consumer resilience at a time of shifting U.S. tariff proposals. Shares of eBay right now 19% higher. On-demand news for on-demand news, 24 hours a day. Subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Let's go back to Bloomberg Business Week Daily with Carol Masser and Tim Stenivek.
All right, so much coming at us. Amy Morris, thank you so much with the rundown. Hey, yeah, one day after the Fed decision, one day before the closely watched monthly jobs report, and it's a day when we got, Tim, a bunch of data that showed stubborn inflation and weaker than expected personal spending.
Bloomberg TV and radio international economics and policy correspondent Michael McKee is with us right now. He joins us right here in the Bloomberg Business Week studio. Mike, you were on Bloomberg Surveillance with Tom and Paul a little earlier, how everyone at the Fed seemed pretty comfortable at the press conference, but based on the recent data flow, including today's and ahead of tomorrow's jobs report expectations, does the Fed decision and commentary to you, is it checking out?
Yeah, I mean, I think
in a word, yeah.
The data today, yeah. I mean,
when did you become a man of so few words?
I thought you were asking me in here to talk about the Major League Baseball trade deadline today.
We may get to it.
That would be just answering your own questions because I have no idea what you're talking about.
But the data we got today basically makes Powell's case. The case that he was making yesterday was that we don't know what's going to happen with inflation because the president's taken so long to get this stuff going, and now we're finally going to start getting it, theoretically, tomorrow, and it will take a while to get into the economy. And we also don't know what this will do to the economy, except that right now the economy looks fairly solid and the labor market looks fairly solid. And that was all kind of reinforced by the data we got today. The inflation data rose, and it doesn't look good. And if we still have this kind of news coming in September, it's bad for the idea of a rate cut. But it's not going out of control, and it's based on some things that are not tariff related. You look at the initial jobless claims numbers; they don't move, and it's not like companies are firing people. So they may not be hiring. We'll find out tomorrow, but they may not be firing. Incomes went up. Okay, wages were low, but the employment cost index showed a big gain in wages. And spending rebounds. It wasn't a huge amount of spending, but it was up from what we saw. So overall,
we're doing okay.
Yeah.
Right? As the U.S. economy. How much of this did Jay Powell and the Fed have? No. Okay. So pretty good.
No,
Jay Powell and company, right?
They had the GDP report, as we all did yesterday, but they would not have gotten anything by the time of that meeting.
It was such a fascinating meeting, and I don't know. I know we're not supposed to have opinions on things, but it felt like that was a Fed chair being a Fed chair in terms of really looking at the data, thinking about the mandate. And I know there was two dissenters, and I don't know. Some people said that maybe that was political. Some said Jay Powell was being political. But what you are saying is, based on the data, all of this made sense. But how do you kind of roll in the two dissenters? Because that was, the first time we saw that in more than 30 years.
Yeah, there could be politics to it. But
they were appointed, right, by President Trump.
Politics in the sense that they want to express their dissatisfaction with the direction that it's going right now, so perhaps they're considered
or politics in the sense that Chris Waller would like to be Fed chair.
Okay, that's what I was getting at.
Yeah, I mean, and he would tell you he'd like to be Fed chair, but he would also argue that he's not making the case, the dissent case, because of that. And his dissent case that he laid out a couple of weeks ago was very well reasoned, and it makes a lot of economic sense. And there's, I mean, you have to make certain assumptions that the rest of the Fed about the progress of the economy, the rest of the Fed disagreed with, but it wasn't like wildly Trumpish. It was a well-reasoned thing. And so because it was that, and because Waller has the personality he has and gets along with all these people and is very well respected as an economist, I think they just put that aside, and the rest of the Open Market Committee, and they say, okay, that's a good argument. We don't necessarily agree, but you did a good job of explaining yourself, and nobody's taking it personally, and nobody's looking at it as any kind of attack on Chairman Powell. I mean, you go back to the Volcker years, you had four governors at the time, they called them the Gang of Four, who basically tried to vote against him every time because they did not like the fact that he was raising rates, all that. And that was quite political, and that was quite an attack on Volcker. But
remind us how that looked in hindsight.
Well, obviously, in hindsight, Volcker is the patron saint of central bankers now because he stood up to the political pressure, and he brought down inflation for decades.
Just before we go, jobs tomorrow, what are we expecting? What are you watching for? Jay Powell said labor market's a really important statistic to watch.
More of the same, basically. The Fed is watching the unemployment rate. They see that as the sort of benchmark for the overall economy and how it's performing and going to perform. And it's not so much the number. It's supposed to go up to 4.2 from 4.1. That's not a big move. It's the speed with which it would move. If you got up to 4.5 by September, the Fed would be worried because it would suggest that a lot of companies are starting to get rid of people because they see something in the economy they don't like.
Right.
A small rise isn't going to matter. And the hiring is slowing down, but companies are not firing. So everybody's just kind of waiting to see what's going to happen. We'll see you tonight at 11:59 or whatever, and see what happens.
Michael McKee, so appreciate it. International economics and policy correspondent at Bloomberg TV and Radio. Speaking of waiting, we were waiting for Figma shares to start trading. They have, and waiting for us downtown, Tim, is our own Caroline Hyde.
She's the co-host of Bloomberg Technology. Right now, shares are paused due to volatility, but they surged as much as 229%. The company raised $1.2 billion in an IPO. Caroline has been there all day at the New York Stock Exchange. She, in fact, interviewed the company's CEO a little earlier today. Caroline, why such a discrepancy between the IPO price and where this started trading?
I mean, wow, to triple. No wonder price discovery took so long and it took forever to get this opening trade. But really, the retail investment enthusiasm, the institutional investor enthusiasm has been phenomenal. This was 40 times oversubscribed IPO. People wanted in that much. And remember, they actually went out there and sort of auctioned this on the roadshow, trying to get a better price discovery than perhaps we've seen for Circle or for CoreWeave. But the pop has still been more than tripling of that $33 price that they priced at yesterday, and the opening trade coming at 85, and now it's above $100. People trying to wrap their head around the opportunity of this design software company. This is all about designers, says the CEO, Dylan Field. But he said, make no mistake, yes, I'm in this to grow the company, but not always to drive the share price higher. This is about the long term. This is about generative AI. This is about innovation. This is about M&A. He said he's going to take big swings. He's investing in this company longer term. Remember, he has more than 70% majority control in terms of shares. He can still do what he wants in terms of pursuing growth of this business, even though it's gone public, Tim and Carol.
Caroline, I want to understand, I feel like with all these companies that are coming out, especially when there's an AI connection, what exactly does this company do? Who's going to be their customers that will actually provide that growth going forward?
I mean, their customers are all the big names on the S&P 500, on the Fortune 2000, and they have 13 million users. In 13 short years since they first built this business, they now have 13 million monthly active users around the world. 80% of those are outside of the United States. Who are they? Yes, they're designers. They're designer of the website that you use, the designer of the application that you use on your phone, but they're also developers, and this is where the generative AI aspect comes into it. They've been really innovating in terms of product since even the Adobe deal was called off. Remember, they wanted to buy $20 billion for this particular company. It's now worth triple that. Adobe wanted it for the design side of the equation, but they kept on bringing us new products. You can now use generative AI with Figma Made, and that's a way in which you put a prompt in, and then suddenly you can create that website, that application with ease. You don't have to be a developer. But there are things for developers. There are things who want to create a slide deck around design. It's all about bringing people together on one URL to be able to keep on iterating on a particular website or app that you're designing. But really, Dylan Field feeling that the scale of this is nowhere near current standards of 13 million monthly active users. He wants to keep on building, and I think the opportunity is there. Remember, he's got startups snapping at his heels. He's got to keep on delivering when it comes to generative AI.
It's a almost $55 billion market cap company, Tim, here out of the gate.
Yeah, and it's had a pretty incredible journey, given that a certain acquisition of the company did not work out. Caroline, before we let you go, what does it say about IPOs moving forward, especially in the tech space? I already had a source text me today expressing enthusiasm about this pop because he works for a company that is pre-IPO.
I mean, really, the enthusiasm has been so palpable here from the people who work in the business, but the early investors as well. I had Index Ventures on. Now, they invested at seed round. I had Kleiner Perkins. They were in at Series B round. And these are the companies that now have Discord that they've backed, if you're taking Index. You've got plenty of companies eyeing if you're wondering about where Canva goes next. If you think about whether Klarna is waiting to go as soon as fall. All of these companies have been waiting on the sideline. But remember, Figma's done something quite unique. They have come at a market capitalization more than their 2021 round. You can't say that about Service Titan. You can't say that about some of the previous companies that raised earlier. So this is the key issue. We'll have to see whether those companies can get a valuation that wins out for all investors.
Caroline Hyde, the co-host of Bloomberg Technology, live just outside the New York Stock Exchange. Caroline's going to be joining us a little later, too, on Bloomberg Business Week Daily to cover all the earnings after the bell.
All right, back to the macro, the Fed, the trade, the markets, tariffs, everything that we are keeping a watch on this Thursday. Even though it feels like a Friday, it is still Thursday. In particular, we want to dig a little bit into what we've seen in the dollar and the FX trade. Jayati Bardwaj is with us. She's Director in FX Strategy for TD Securities back here in our studio. Good to have you here. A lot coming at investors. We've seen some strength as of late in the U.S. dollar. Let's go back to the macro. What's of note, especially in a week where we've heard from the Fed, got a decision. We have the White House still doing trade deals and tariff deals. There's some extensions. We're trying to figure it out. What's the important macro trade right now for the U.S. dollar?
Thank you so much for having me. Always a pleasure to join both of you in the studio. I think what we have learned from this week is that, there is still a lot of uncertainty, even with the trade deals being announced, particularly on the data side. With the trade deals being announced, you're obviously getting less confusion on the trade front, with EU being the largest trading partner. You have some certainty on what that tariff rate now looks like. But unfortunately, the Fed did come out yesterday and told you that there's still a lot of uncertainty on the data front that warrants a lot of caution, a lot more caution than what markets were priced for. Going into the meeting, markets were more than 50% priced for a September cut. They felt comfortable with the fact that the Fed should be coming and easing interest rates, but Powell gave no such indication because there's still a big risk out there, particularly on the inflation side, which is severely underpriced by markets right now, which is what we've learned, that while you're getting a little bit more clarity on the trade front, now we're utterly data dependent because on the macro growth and inflation side, there's still a lot of uncertainty, which is not resolved with just us knowing those trade deals.
Why do you think inflation is being mispriced by the market right now?
So this is actually a very interesting question. So we actually have some in-house models, which is where we actually track trading currencies on the basis of different macro factors. So our macro factor, our growth factor, our equity factor, all of those factors are making a lot of money, but our inflation factor has actually been losing money, which is an indicator to me that FX markets have actually not been paying attention to inflation data. They think that with the tariffs and the uncertainty around the trade deals, focus has primarily shifted to the growth outlook. But one thing we are now realizing is that the baseline tariff rate is no longer 10%, it's at least 15%, which is also interesting because we don't know what that pass-through of inflation will look like. The last CPI report that we had...
This is something Bob Michel on our Fed specialist said yesterday. Like the range was more like either, I can't remember, 18 to 20, but it's much higher than the 10% that we've all been talking about.
Yes. And the last CPI report had, the market reaction was very telling. We had a downside surprise, but markets took it hawkishly because you saw the first signs of inflation tariff pass through into the goods categories, particularly into toys, which markets took to be very hawkish, even though the core CPI was a downside miss.
And forgive me, I meant Bob Michael. So what's interesting is, all right, so what does this mean for the dollar then going forward in your view?
I would say that, we are bullish the dollar in the short term tactically. You still have August 1st, the deadline tomorrow, which is ticking, but there's two scenarios which can play out with most of the countries. Either you don't get a trade deal, which brings in a lot more uncertainty and volatility into your local assets. The second path is you do get a trade deal, but on terms which appear more favorable to the US than your country, which is now actually leading into US local equity market outperformance over other countries' equities. Both of these are actually dollar positive. So thankfully, in the short term, this makes my job a little bit easier because irrespective of a deal or no deal, it should feed into a little bit of a dollar bounce in the short term.
Stronger dollar, though, possibly U.S. multinationals in terms of selling their goods. So is that something to think about when we look at profits and ability going forward?
We do think that this dollar bounce will be a bounce. It will not, bring up that, rise back of the U.S. exceptionalism. We won't get euro back to 105 or below. I think it's that kind of a move. It's more of a short-term adjustment which market needed given what was priced in.
We promise more time later. We love having you on with us. Jayadi Bardwaj, she's director in FX strategy for TD Securities, joining us. Coming up next, we got to go back to the Mag 7. So much coming at us.
It's 2:21 on Wall Street. I'm Amy Morris. The S&P 500 wiped out an advance that had reached 1% ahead of the jobs report and President Trump's tariff deadline. We check markets for you all day long here at Bloomberg. The S&P 500 now down 0.1%. NASDAQ little changed on the upside. The Dow is down 0.4%. The 10-year Treasury yield at 4.36%. The 2-year yield at 3.94%. Figma is a web-based interface design tool for websites, apps, and other digital products, and its shares jumped 229% in its trading debut today. Trading opened at $85 a share. It's now bouncing right around $105 a share. CVS Health raised its 2025 profit guidance as the company's Aetna health insurance arm and pharmacy unit outperformed expectations in the second quarter. Shares of CVS right now down 1%. For on-demand news 24 hours a day, you can subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Let's go back to Bloomberg Business Week Daily with Carol Masser and Tim Stinovec.
All right, gotcha. Amy Morris in for Charlie Pellet today. Well, Meta Platforms shares soaring to a record after Facebook's parent company gave a strong revenue forecast and reported second quarter results that beat analyst expectations. Microsoft also rallying, not as much, but still a pretty strong rally, pushing it up intraday to a $4 trillion market cap. That after reporting quarterly earnings that beat the street's expectations. We should point out Microsoft reported better than expected growth in its cloud business, with its Azure cloud computing unit posting a 39% rise in sales. With the day after, with the roundup, back with us is someone we lean on big time when the numbers are coming at us in real time for what we need to know. Bloomberg Intelligence Global Head of Technology Research, Mandeep Singh, here in studio. Thank you for coming back. I know it's been a busy 24 hours for you. Meta and Microsoft, anything new that came out on the company's calls that you think is of import, or did it just kind of confirm everything we got in the actual earnings?
You know, I look for the token count, so I was looking for that in the Microsoft call.
Token, the token count soon, right?
We're talking about it because you are talking about it.
And so Microsoft did share that for the full year, the $500 trillion number. The units get really big, but that's how this stuff works. And look, that's what I think Meta is missing. I mean, the print was awesome. Everything was great. But when you look at the app usage, WhatsApp, Instagram, Facebook Blue app, you don't see the kind of jump that Microsoft Copilot or Microsoft GitHub apps have. And that is where the Gen AI usage is getting reflected. Meta doesn't have that bump in the usage. Still, ad pricing was very strong, which is why they had such a big beat.
Why doesn't it have that bump in the usage? Is it because people, as consumers, as customers of these products, because that's what we are, do we not associate Meta platforms with AI the way we do ChatGPT?
No, so it's about the core use case of Gen AI. Gen AI right now is being used in coding agents. That's where the GitHub Copilot comes in. It's being used extensively for search. Your ChatGPT use case, the Copilot, Microsoft Copilot use case. So in the case of Meta, yes, they have 1 billion monthly active users for Meta AI, but it's being used in WhatsApp. And within WhatsApp, nobody is actually going to Meta AI to ask questions. So that's where you will see the bump. Meta AI as a standalone app doesn't have the kind of monthly active users that ChatGPT and Gemini have, which is why all the frontier model companies have a separate app.
People don't go to these apps to ask questions because historically they're not known as places where you get answers. They're known as places where you look at photos, like in Instagram, or known as places where you communicate, like in WhatsApp. How does Meta Platforms change that?
So then my question is, if you're spending $70 billion in CapEx to get AI compute, not the traditional CPU compute, where are you using it? How is it driving engagement? And so next year, they're spending $100 billion. I would say 60 to 70% of that is going towards AI compute. Where are you using it? And that's, to bring it all home, token consumption. That's your AI usage. So if you're not sharing token count, if your engagement is not going up, I mean, your results are great because your traditional ad business, which is machine learning driven, is doing phenomenally well. They are optimizing for, showing you the most targeted ad, and that is what gets reflected in ad pricing. I do think they got a lift from TikTok's, uncertainty and the fact that TikTok could actually be banned after getting a couple of extensions. So all that video ad budget is going towards Instagram. In fact, there was a study that said if TikTok was to be banned, 60% of that ad revenue would go to Instagram, 20% would go to YouTube, 10% to Snap, and then Reddit, etc. So maybe they are getting that bump from TikTok uncertainty. But to my mind, the Gen AI usage is nowhere reflected in Meta's results yet. And they're talking about $30 billion additional capex, similar to Microsoft. But Microsoft has a backlog of $368 billion in cloud. And they grew Azure segment 39%. Next quarter, it'll probably be higher. So they have so much visibility to the using that AI infrastructure that if you're a Meta investor, they're spending $100 billion. But you don't have that visibility. How are they going to monetize it?
So wait, so help me out. So the stock's up almost 12% as we speak, pretty much at its highs of the session. It's up almost now 33% year to date. So are investors maybe getting a little overenthusiastic about the AI impact to Meta?
So yesterday, Mark Zuckerberg in the morning put out this blog post about personalized superintelligence. What he's saying is this AI will improve on its own. So you don't even have to keep training it on open internet data. The AI that they are looking to build and deploy will be a lot more personalized AI that can learn about your habits, that you can use in your day-to-day tasks, which, again, to me, it's no different from what ChatGPT
I also talked about the metaverse at one point. No, but I'm just, but is that, like you keep saying that the other guy, that so much is kind of in-house, right? And used? Like, I'm just trying to understand, like, are investors getting this wrong, Mandeep?
Not wrong, because their core business is so strong that they can afford to invest in infrastructure. And it's a good thing they have pivoted from metaverse to AI. So having this infrastructure alleviates any sort of constraints they may have on the compute side. I mean, Microsoft called out how they are supply constraints still.
Right.
So imagine if Meta was to use public clouds, they would be supply constrained. They can't even find the compute. So at least from that perspective, they have all the compute available to deploy. Question is, what are they deploying and where will the engagement show up? Because it's not showing in their family of apps and they don't have a standalone app like a Gemini. Like Google showed that engagement in AI overviews. They showed that in the Gemini app. I don't see that in the Meta family of apps.
Could it come?
It could come, yes. That's why they have poached all these smart researchers and, you know, they're paying them 100 million plus salaries. So the hope is it will come. And that's why I think investors are buying into it for that hope that, you know, they have assembled a great team. Maybe it will come in next 2 quarters.
Okay. Well, in the meantime, investors certainly liking it. Shares of Meta are up about 12% as we speak. And Mandeep, of course, also talking about Microsoft. That stock's up about 4%. Mandeep, thank you so much. Bloomberg Intelligence Global Head of Technology Research, Mandeep Singh, here in studio.
Hey, now to the other big tech on our radar today. That would be Amazon and Apple reporting after the close. Let's bring in Bloomberg News Managing Editor for Global Consumer Tech, Mark Gurman. He joins us from our Bloomberg News Bureau in Los Angeles. Mark, the expectation today when Apple reports tariffs are going to be front and center. Will we get an update on the effect that tariffs have on Apple?
For sure. That's going to be a large part of the conversation, I anticipate. During the March quarter, you know, Apple said that they are anticipating a $900 million, so a sub $1 billion headwind because of tariffs in this June period. So we'll get an update on that. But overall, you know, this is going to probably be a muted earnings report. I'm not anticipating a lot of fireworks. I'm mostly interested in the post-game commentary. I really want analysts to be asking, if you're watching this, analyst, here's what you need to ask. Definitely ask Tim Cook about succession. Definitely, you know, put him on the fire regarding artificial intelligence. And definitely see what he has to say about his relationship with Donald Trump and if that's going to come into place here to help them in the coming quarters with tariffs, because that's when the real impact is supposed to take place.
We talked with Laura Martin of Needham, and we're going to actually talk with her tomorrow. And she's talked about that maybe it isn't Tim Cook that needs to be at the company and leading them forward kind of for their next era.
She joins Walt Piecyk over at Lightshed as well.
Yeah, not alone. Not alone. Is it time for a new leader at Apple?
There's a difference between if there should be a new leader at Apple and if there will be a new leader at Apple. And I'm in the business of telling our viewers what the reality is, what's actually going to happen, right? And what's actually going to happen is that Tim Cook is going to be the CEO of Apple for as long as he wants to be the CEO of Apple. And I anticipate that to probably be 3 to 5 more years, maybe 7 more years. I think he's going to be running that company for a very long time to come. I'm not anticipating any imminent change to who the CEO of Apple is, right? There are a number of reasons for that. They're putting the design team under Tim Cook in just 6 months from now. If there was anything imminent related to a CEO change, they'd be putting the design team under who that next CEO is going to be. Tim Cook is probably going to end up becoming chairman of the board of Apple in the next year or two. Their current chairman, Arthur Levinson, is at that required 75 years old retirement age for being a board member at Apple. So you'll likely see that shift to Cook. That's something that Satya Nadella has done at Microsoft. He has both roles. Obviously, Mark Zuckerberg is a founder, but he has both roles. Given that Apple stock is up 1,500% since Tim Cook became CEO back in 2011, given that there was not certainty over how Apple would do in the post-Steve Jobs era, I think Tim Cook has bought a lot of goodwill with the one group of people that matters when it comes to CEO, right? The board of directors essentially has one job, to hire and fire the CEO. And I don't anticipate them firing Tim Cook.
Okay, we've talked succession. We've talked potential impact of tariffs. Mark, you know where I'm going now, and that's artificial intelligence. Are we going to get color from Tim Cook or anyone on the call about the AI strategy? I know there are a lot of questions about it.
Well, I can tell you exactly what he's going to say. He's going to defend the strategy. He's going to say that they've got new features coming, that they're working hard on it. They're starting to figure things out. They're not too worried about it. Maybe he thinks AI models are going to become commoditized in the coming years anyways, so it doesn't matter how much these companies are throwing at it because everyone is going to have access to the same technology in the not too distant future anyways. So he'll pitch an upbeat message there too.
Is he right? I mean, or is that just sour grapes and being behind? I mean, Apple just lost, what, its 4th AI researcher in a month to Meta.
Yeah, there's the reality of what's actually going on behind the scenes, which is a disaster. And there's also the reality of what Tim Cook is going to portray today, which is that everything is fine, right? And so, you know, the real juice is that they're losing people, they're bleeding talent, their AI models are behind the competition, they're not investing as much as the competition, their Siri features are still several months behind, and the overall Apple Intelligence product is a laggard in the industry. Then there's the other reality of sitting in this chair today, do consumers actually care? Right? And I think that right now consumers don't care. People are not going to stop buying iPhones because they're behind in AI. But talking about 2 to 3 years from now, yes, it's going to be a real problem. But you have to remember, are these models going to become commoditized in that same period of time or not? And is 2 to 3 years enough time for Apple to catch up? I think without an acquisition, no. But with one, I think they'll be fine.
You talk about caring, investors care. Stock's down almost 17% year to date. Stock down just a little bit ahead of earnings after the closing bell. Hey, Mark Gurman, thank you so much. Managing editor for Global Consumer Tech at Bloomberg News, joining us from our LA bureau. We talk about another hot IPO when we come back.
CEOs of pharmaceutical companies calling on them to take action to lower prices for Americans within the next 60 days. S&P Pharmaceuticals Index down more than 2% now, and that dragged stocks lower. The S&P 500 is little changed on the upside. NASDAQ is up about 0.3%. The Dow is down 0.3%. The 10-year Treasury yield at 4.35%, the 2-year yield at 3.94%. Figma is a web-based interface design tool for websites, apps, and other digital products. Figma shares jumped 229% in its trading debut today. Trading opened at $85 a share. Figma right now trading around $105 a share. Sources say Salesforce and ServiceNow are in advanced talks to invest about $750 million each in Genesis Cloud Services. The investments would value Genesis at roughly $15 billion and be a rare instance of enterprise software rivals backing the same company. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's Bloomberg Business Flash. Let's go back to Bloomberg Business Week Daily with Carol Masser and Tim Stinovec.
All right. Thank you so much. Amy Morris in for Charlie. Well, another IPO today. Of course, we've talked about the VC-backed Figma. We'll have more on that in our next hour. We talked about with Caroline
It's up 219%. Just
a little bit of volatility, too, in the session. But talk about welcome, right? A warm welcome, certainly to the public markets, I should say. Just yesterday, we had another IPO, Ambic Micro making its trading debut. Shares soared 61% in that first day of trading. It's been up as much as 34% in today's session. Right now, about a 15% gain. It's a maker of ultra-low power semiconductors for AI applications. It did raise $96 million in that upsized IPO. So let's get into it. The technology, the business, the outlook. With us in studio, Scott Hansen. He's the founder and chief technology officer of Ambic. And as we said, joining us here at Bloomberg headquarters. Scott, your IPO, congratulations.
Thank you.
You did really well and continue to do so in a second day. About the outperformance, what about the business in your view? Can you tell the Bloomberg audience justifies the performance and the reception that we're seeing in these first 2 days of trading?
I mean, look, I can't comment on day-to-day ups and downs, but what I can tell you is
I know
why,
you're happy.
Yeah. Well, I can tell you why investors bought into the vision, right? And, our vision from the start, actually, from when I founded the company back in 2010, was to put intelligence everywhere, right? It was to take chips, take intelligence and embed it in the billions of devices around us, in your watch, in your smart doorbell, in security cameras, and in everything. And in the last couple of years, it's really been about taking AI and breaking it out of the data center and moving it out to these same devices. So we do that by enabling lowest power chips out there. And I think that really resonated with investors. I think there's this belief that AI is breaking its way out of the data center, and in order to do that, you need to be energy efficient. That's what we've mastered over the last 15 years. So I'm taking all of this as an endorsement that people believe in that vision.
What's your moat? Because there is a lot of competition in the space, companies doing and trying to do what you're doing. How do you compete? How do you make sure that you actually have a moat here?
So actually, the company was founded out of the University of Michigan. So I did my PhD work there. We invented a bunch of technology that is now central to Ambic. We've got a circuit platform that allows us to build chips that are 2 to 5 times more efficient than what's out there. We brand that as SPOT, sub-threshold power optimized technology. We could spend the next 2 hours talking about it. I won't bore you with that. But really differentiated and unique platform, patent protected, growing all the time. And what's really exciting is we now have a bunch more money to go fund the ongoing development of that.
What I'm curious about, and we talk about the semiconductor space all the time, there's a lot lopped into semis, and there's different kinds of chips, different types of chip companies. What is it that makes your AI chips different from what we're getting from the NVIDIAs of the world, the Intels of the world?
Most of those companies are thinking when they think about power, they think about watts and kilowatts, right? Watts and thousands of watts. We're thinking about microwatts, so millionth of a watt, and milliwatts, thousandth of a watt. So we're on completely different power scales.
So stuff that would go to smartwatch or glasses and so on and so forth.
Exactly. And there's a huge number of these devices. Even the likes of Qualcomm, let's say, who's made it big in phones, is still thinking in terms of hundreds of milliwatts and watts. And so we're yet below that. So a huge number of devices that want that kind of power.
10 years ago, though, when you guys were developing, or a little bit longer out, I mean, we weren't all talking about AI. It was certainly in our universe, but it's not like it is in the last 2.5 years. So was there a pivot in terms of what you guys were thinking about that your chips were going to do?
Yeah. And I'd love to tell you that I anticipated this, right? But I will say this. The company's name is Ambic. Ambic means ambient IQ, ambient intelligence. So it's always been about intelligence everywhere.
But what was the original mission?
And well, it was that, but it wasn't with AI. AI being this mathematical technique that we can use to really achieve intelligence. Previously, it was let's add sensors where there were no sensors before. Let's add a little microprocessor that can crunch numbers. But suddenly, with what the world saw with the launch of ChatGPT back in 2022 was, oh my gosh, we can do some incredible things with these AI models. That really lit a fire under a lot of our customers because they thought, oh, okay, these tasks that maybe were accomplished by traditional algorithms can now be achieved with AI. And that was a turning point for us. So actually, we like to think of the company in two phases. A phase one was, it was really about extending battery life. We helped a lot of our customers in the wearable space, in smart home space, medical device space, go from a week of battery life to 2 weeks of battery life or 4 weeks of battery life. At some point, that doesn't matter anymore, though, right? And what they really want is they want to add more computation, more intelligence in that same budget. So phase two has really been about that. It's been about let's put AI where there was no AI before.
A big focus for us, and I know a big focus for companies that actually build technology, has been supply chains, given the new tariff regime that we're in. We are expecting to hear from the president at 4 o'clock today when he is going to sign an executive order on trade. We'll bring you updates from that, of course, as we do get them. In the meantime, talk to us about how your business has shifted geographically. Has it moved completely out of China? What's the status there?
So if you were to look at our revenue from several years ago, specifically in our prospectus for the IPO, you would see that China represented a much bigger fraction of our overall revenue. There was a point where it was 50% or more of the business. What shifted for us was a second ago I said, hey, back in 2022, we started focusing on AI everywhere. Well, as we've focused on applications that valued us for that kind of led us outside of China. Okay, so we still have business in China. We still have a great engineering team there that works and supports some great customers. But the bigger opportunities for us at the moment are elsewhere. It's been in the U.S., it's been in Europe, it's been in other geographies outside of China. So we have some dependence there, but it's dramatically reduced compared to a few years ago.
Who are your customers? You keep referencing them.
So
we have this great function, I always like to say, a supply chain function. So we kind of know the input, the output.
Yeah.
It has yet to be be filled in. So fill it in for us.
Yeah, well, we sell to anybody building battery-powered devices. Some names I can mention are Garmin. I can mention Google. I can mention Whoop, the fitness tracking company. A lot of these companies are building health tracking wearables. We've helped them go from, years ago it was basically a glorified step counter. These days they're almost doctors on wrist, right? They're really getting quite good at that.
Does Apple want to work with you? Have you talked with them?
I won't comment on that. We don't ship with Apple today. That's a tough prospect for a small company to take on, and so we've really focused on other customers that were more appropriate to our size. Now that we're a public company, that's something we can, of course, explore.
Yeah, so you could scale up if all of a sudden a giant customer came to you and said, we
Absolutely.
need your help.
And we've shipped more than 270 million units to date. So you go walk around this building, go walk around a mall, go walk around a hospital, you're going to see our devices in use. So we're out there everywhere.
What?
I love it. I mean, you mentioned Whoop, Garmin.
Yeah.
Those are like, that's my world. But you're not consumer facing, so people don't necessarily understand that that's what you do.
Like, what's something we could buy that Tim and I could go to the store and we'd buy? And
your activity tracker.
Yeah, go buy a Fitbit at the store right now, and that has our chip in it. Go buy any number of Garmin watches at the store, and you'll see our chip there.
Talk to us about technological growth. You mentioned Spot. We know Apollo is part of the program as well. When you look out in your pipeline and your ambitions, what do you want the processor to be able to do that it can't do now?
Oh my gosh, that's a great question.
Larger processors, wider market?
Yeah, so first of all, what we've always done, you hear about Moore's Law, right? Moore's Law is alive and well for our portion of the world too. It's not just the bleeding edge data centers and the mobile phones. Every year our products, the Apollo product line is our processor line. They're getting faster, lower power, more integrated. And so actually what we disclosed in our prospectus leading up to IPO was a new family we're developing called Atomic, and this will be our first AI forward product. So what we've seen is we talk to customers in the AR glass space, in the camera space, in a bunch of other spaces. They want more AI compute capability on device, and we've been doing that for years. But they have these really grand ambitions that blow my mind, and so we need to build a product that's going to take us there.
Meta Platforms, a customer?
I can't talk about that. That is a great company for sure, and I would say if you look at publicly available information on them, they have some crazy ambitions that blow my mind. I mean, they talk about what they want to do with those glasses. Just yesterday, Mark Zuckerberg was talking about superintelligence making its way out, and I completely align with that vision.
Thank you so much. Appreciate it.
Come back soon. Scott Hansen, he's the founder and CTO of Ambic, joining us. When we come back, stocks on the move. This is Bloomberg.